rupees of a target price on Dixon.
Valuations are above 45 times for Dixon, Siddharth?
Yeah, so I think if you look at the valuations with these kind of growth, I think we are seeing a P is of about, I'll just tell you. So P for Dixon is on FY 2850 times, and we are valuing it on a DCF basis. Hence, the upside is what I believe.
Okay, stock trading at 50 times PE. Motilal Oswal's target price is 16,000 on Dixon. The stock, though, has corrected from the recent 52-week high. Siddharth, the other big deal is Apollo Micro buying Premier Explosives. Is there an opportunity? Would you recommend a buy on either of them?
I think while we don't have coverage on Premier Explosives, I think for this Apollo Microsystems, it makes sense because if you look at the defense opportunity, that is only improving, and for Apollo Microsystems getting into explosives, I think that will add to a key backward integration. And we have seen how Solar Industries has benefited from its technology know-how and getting into the missile system. So I think this is a big positive for Apollo Microsystems going forward.
Yeah. It is a big positive. With so much happening, right, Siddharth? Yesterday I was just looking at, it's just a long list of winners, and so many names keep coming up, hitting the 100% mark from the lows. And yesterday, real estate has seen a breakout, right? I was looking at something like a Loda from the lows this year. It's doubled. 20-25% in a month. DLF is doing well. So, yeah, I mean, pretty consequential first half. Siddharth, I'm going to come to you, but I just want to play out this TCS conversation. They kicked off the earnings season for IT and Corporate India as well. The top team at TCS sitting down with Rima and me yesterday. Listen in.
It's been an overall quite satisfying quarter. Okay, this is the fourth quarter of consecutive growth. And we are also happy, like you mentioned, the deal wins. And it also included one mega deal win from SKF, which is net new, completely AI-led deal. So that's a positive. And our AI revenue continues to improve quarter on quarter. Like, again, most of the AI revenue is all not annuity revenue, and they're all short-term projects. We continue to...
And that's grown some 13% quarter on quarter.
So that's doing good. And our 5-pillar strategy resonates very strongly with our customers. So overall, it's a very satisfying quarter. From an environment perspective, some of the factors we called out last quarter continues, right? There is no major change in geopolitics. That uncertainty remains. And some of the verticals, I would say banking and tech services have started doing well. We have started seeing better traction. Airlines and retail, communication continues to be under stress. But then while customers try to adopt AI, we actually encourage our associates to give for productivity whenever possible. And so it can have a deflation on the top line, but we are confident as we deliver productivity, customers will have the surplus spend, and that will come our way, and we'll be able to make it up. So,
will this pace of growth in AI revenues continue with this, you think, as the base gets large?
We would want it to accelerate.
I see. And they're not like annuity type, they're like short-term turnarounds.
They are short-term, but we are also started seeing larger, big-ticket projects in AI.
Give us a sense of what the SKF bit, for example, or any other. What is it like? What's the work like? Yeah.
No, SKF is about where we will be doing leveraging AI, right from their S/4HANA modernization to their support and applications everywhere. It's a end-to-end. So our objective will be to leverage AI and make SKF itself a AI-led organization. So it's a large ticket multi-year deal. But I'm saying is AI-led. We're leveraging AI in every part of solution that we'll be delivering.
So this is a global, across globally for SKF.
If I may add to that, I think it's a global impact that we will create through this deal across their global operations. I think if you really look at it, the entire IT operations, right? How do you transform with AI? And that's a big part of it. The second part is...
Were they already a customer for you, Aarti? Were they already a customer for you?
Very,
It's a net new. It's a complete net new deal. And it's a completely net new deal. So that's one big piece of it, right? So take the existing operations, transform with AI, drive efficiency, productivity. The second one is reimagination of processes, and that comes in two flavors. One is enterprise systems, right? Your finance, HR, SAP, Salesforce, those kind of systems, right? Overhaul of those systems to the latest, greatest product versions, in this case S4HANA. But it's not a tech upgrade. It is a reimagination, redesign of the process, and that the execution is fast-tracked with AI.
I'm just using SKF as an example because this is the kind of work I'm assuming that you'll go after with other big corporations as well. But is their pricing, how does it compare to the rest of the work that you do on the traditional IT side?
So overall, pricing is competitive. There's nothing in terms of our expectation is initially it would be people-led. And as we use AI, we would expect a lot of productivity to be deployed and be able to leverage on the same.
Kriti, just coming back to the quarter, when we spoke in April, you sounded a lot more positive. The words you used were, we're entering FY27 with a lot more positivity and confidence. And when I spoke to buy-side, sell-side analysts in April, I think they were expecting you to deliver about 1.5%. So what happened in the quarter? Was it macro uncertainty which was worse, or has Gen AI deflation accelerated?
See, macro, I would say, is impacted some of the verticals significantly, and geographies also. If you take, though our Middle East footprint is small, we did have an impact in Middle East. And then some of the verticals, as I called out, consumer business, travel, airlines, they were impacted. So some verticals are impacted. As I said, banking has done well. So there is some, I won't say a big Gen AI-led deflation, but there is some, because as you start doing projects and as you go through a renewal, most of the renewals today are AI-led, like where we are using AI. So when you go through a renewal, you go productivity that is AI-led. So that also, to some extent, was not fully factored in.
So while Gen AI has been around now for the last 3 years, it's the advanced models started coming in only in February of this year. And these models started getting better and better. So do you think the AI deflation that the market was penciling in, or you were penciling in, do we need to now account for more? And give us a broad ballpark of what is the deflation?
Deflation could be in the range of, in a given work, okay, when you renew it, or when it could be about anywhere, what we see on a large project would be about 10 to 15%.
Over a 5-year project, or 3 years?
Overall project value, it could be 10 to 15%. But we expect that it should not be, maybe it may be volatile or deflationary in the top line, deflationary in the short run. But in the long run, we talked about so many other projects that will happen because of AI. So net, we still expect this to be positive, and there could be some short-term volatility, and we are looking at what we are seeing and what we are doing. We are quite happy with the overall progress you have made this quarter.
At what point does the volume of business that you do...
That will be very difficult to predict.
Outweigh the deflation?
It's difficult to predict because the deflation usually kicks in very quickly. And new projects, when people start leveraging it for their business transformation, that takes a little more time.
Say FY29, would that be off when...
I would want that to be in FY28.
Okay. So what would be the size of AI deals now, Aarti? And what percentage of your overall client base have you managed to penetrate with, get the incremental AI work from them to transform your company? The example you gave.
Penetration is very, very solid. I would say that, upwards of 80%.
More than
so for 80% of your customers, you are doing...
What we announced during our AGM, we looked at all the customers with whom we do at least 50 million or more a year, about 139 customers. Of that 130 of them, we are delivering AI work. So it's AI penetration is very, very deep and significant.
Okay. And the size of these AI deals, because then it's got to show up in your top line, but it's not if you're doing it for...
See, I think we have to look at, the definition of AI revenue itself, right? People like us are reporting it. We have a very narrow definition of what is AI revenue, where AI is being used to drive a industry value chain transformation. We use a lot of AI in how we execute a program. We are not counting that as AI revenue. If we are doing a S/4HANA transformation, for example, we have recently won a large deal, right? Complete HR, supply chain, procurement, process reimagination on S4, right? Implemented with AI. Would you call that an AI deal or not? Right? So those are the questions which are out there. So I think the way to look at it is we have a definition. Different companies have different definitions. Some people are reporting, some people are not. We need to run our race and we need to accelerate our growth because the definitions are not standard. That's how we look at it internally.
I think it's like 10, 12 years back when we used to start talking about digital revenues. What
yes,
digital,
absolutely.
It used to be fungible, right? I mean, what do you call digital revenues?
Yes.
But what you're
long
saying
as
is interesting. You're saying you define it narrowly, which is actually, in that sense,
Very
good.
sharply. Very sharply.
We
Because
don't
we
want
could
AI
dilute it.
washing, right? We don't want to call everything as AI revenue.
So I think, it's about running a race and accelerating our growth with the definition that we have.
Yeah.
And the definition may get broader as the technology evolves.
What about Q2, FY27 now, Kriti? How will you characterize what's coming? Because H2 is typically weak, so the burden of expectations to deliver in FY27 falls now on Q2.
See, overall, still I would say Q2 is positive. But at the same time, things been quite volatile in terms of whether H1 is better than H2. Okay, that I don't want to say H2 will be weaker than H1.
Okay.
But we are quite positive on Q2.
Okay. And FY27, if you have to characterize it?
Last quarter also said it will be better than 26. I still stick by that. It will be better than 26.
Samir, you had a big forex tailwind in the quarter. So talk to us about the margins in Q1, what we've seen and what we should expect going ahead and what the hiring strategy is going to be.
Okay, so the forex tailwind will not impact the EBIT margin, but I'll talk about the EBIT margin first. Our margins are at 24%. We undertook the wage hike, which was from 1st of April, and it was global. And that had a 170 basis points impact. And currency helped on 30 basis points. Forex was over and above that. And we reinvested into partnerships. We reinvested into business requirements. And that was largely offset by operating efficiencies driven by productivity.
Okay. And what is the outlook on margins and hiring?
All right. Overall, as we have taken the biggest headwind up front, and while we continue on the reinvestments which we talked about, I think through the year we'll look at productivity and efficiency-led tailwinds to get closer to first our FY25 number and then further on. And also we'll look at discretionary non-employee expenses to optimize on.
You'll bring that down?
Yes. And hiring, growth and demand hiring isn't, but we'll focus on AI niche skills from a hiring perspective.
Welcome back. You're watching us here on Bazaar Morning Call. There were a bunch of big movers in yesterday's trading session. Saw heavy volumes and some delivery-backed data as well. Hormaz, as always, joins in the morning to tell us about those. Hormaz.
Good morning, Manglam. And of course, can't not talk about Kalyan Jewellers. We'll get to that in greater detail in just a bit. But even yesterday's trade, a couple of stocks that did well but had delivery volumes that were lesser than their 20-day average. HDFC Bank and Bharti Airtel both being a case in point. Even ICICI Bank's delivery volumes yesterday were well below their 20-day average. But the only one standout in this list is L&T. That stock had volumes significantly higher on the delivery front. Even though the stock didn't do much in terms of price. But for Kalyan Jewellers, it was the biggest single day gain on record and volumes as well for the stock. Take a look at the last 3 days where the volumes have gone up from 2.5 crore to as much as 11.5 crore shares that were traded in yesterday's trading session. The 20-day average is only 1 crore shares. Yesterday, 13% of those shares were marked for delivery. So 1.5 crore shares marked for delivery, 6x compared to its 20-day average. The stock yesterday closed both above its 100 and its 200-day moving average. And as the first time since April that the stock has managed to close above its 100 DMA, but still the stock, it was the most traded stock by a distance on the Nifty 500 yesterday. Talking about L&T, the stock ended just below the flat line, 1.5% off the highs of the day. But look at the volumes. The volumes yesterday were the highest in 2 months. 51 lakh shares were traded. The 20-day average is only 21 lakh shares, and 71% of those shares were marked for delivery. So 36.5 lakh shares were for delivery. That was 3x its 20-day average on that front. And the stock over the last 9 trading sessions has declined in 8 of them and is down around about 8% as well in in that period, and down around 12% from its 52-week high. And lastly, another stock that did well yesterday was Swiggy. After that bit of a break on Wednesday, the stock again rose 7% in yesterday's trade. Again, here too, the volumes are seeing a significant move from 3.5 crore shares on Tuesday to 5.5 crore shares traded yesterday. Volumes were the highest this year yesterday since and December of 25 as well. 5.5 crore shares traded, 20-day average of 1.5 crore, 42% mark for delivery, but the stock, of course, significantly below its issue price.
All right. Well, that's the a busy man Hormuz with a busy list of stocks as always. Hormuz, thanks very much for that. Well, I think the top brokerages of the day with another busy man, Sudarshan, is with us with that list. Sudarshan, morning.
Good morning, Prashant. So first one is Aurobindo Pharma. The stock over the last 1 to 2 months has seen a huge surge, and now Citi finds its valuations very stretched. So it maintains sell call, increased target price to 1,270 rupees per share from 1,020 rupees per share. It says recent rally leaves stock trading at 2 standard deviation above its 5 and 10-year mean, and expects growth to moderate sharply in FY28 and FY29. Even on the pipeline front, it finds that visibility is very limited, and sustaining volume-led growth on high base will be a challenge for the company, and benefits from Lanet could disappoint, with sales are down 30% as per IQVIA in last 1 year. Growth levers like biosimilars, Merck CMO are unlikely to fully offset pressures that company has been facing in the core generics. So on the valuation front, it's trading at 20 times FY28 estimated EPS, which is 30% above its historical average. Next one is Lenskart, another positive brokerage note. Now JP Morgan has initiated coverage with overweight call, and target here is 635 rupees per share. It says company has evolved into a scalable, profitable operating model, and it sees a powerful compounding story as far as Lenskart is concerned, and there is a long runway for revenue growth translating into disproportionately profitability growth, and it sees revenue and EPS CAGR of 21% and 41% over FY26-30.
Okay, all right. Thanks very much for that. Lenskart is an interesting story, right? I mean, it's one of those names, the stock it's not very old in the markets, but the month that it was listed, I'm not sure the issue price, but it dived to about 300 on the lower side, right? And now it's basically pretty much doubled from those levels on Lenskart. Siddharth Khemka is still with us. Siddharth, any thoughts? Lenskart?
So Prashant, I think definitely one of those new age businesses which has set up a good omnipresence channel, both online as well as offline. And what we are seeing is that the fully backward integration model, which is helping him kind of report the strong margins and growth. And even last 2 quarters, we have seen strong delivery. Q4, we saw good results, and PAT kind of surged 2.3x. Going forward, also, we are expecting strong momentum led by store additions, tier 2 penetration, and as well as the operating transformation due to the AI-led, plus the supply chain localization. That will add to the overall margins. And hence, what we believe is over the next 2 years, revenue could grow at about 25%, but net profit will grow at much faster, 44-45% kind of a CAGR. And hence, we believe there is still room for upside. We have a target price of 650 on Lenskart. So we continue to remain positive.
Right. Lenskart 650 is the target price. The issue price was 402. For them, the business model was never a concern. It was just the valuation. So, but now it seems like brokerages believe that, there's a lot more to go on Lenskart as well. Sid, I wanted your thoughts on, in particular, Astra Micro, because of the deal that was announced with Premier Explosives yesterday.
So, yeah, I think, as I said earlier, I think this is a big step for Astra Micro. I think in terms of the acquisition to buy about 41% stake at 697 rupees with the mandatory open offer of another 26%. I think it's a positive step given that it will backward integrate into the explosive segments for Astra. Overall, some of these radars plus the upgrade systems, I think the overall entry into missiles, that would open up for Astra Microwave. And anyways, we are expecting a 30% CAGR growth for Astra Microwave, and we believe that defense is kind of a structural story going forward. And consolidation for Astra Microwave, I think that will be a big positive step development for Astra Micro.
Yeah, no, absolutely. And I think that's the latest deal which has come through. Any thoughts? Before we went to that TCS conversation, Sid, I was talking about the real estate space, right? We had Rohit Srivastava who was telling us that technically the real estate index has seen a breakout. And you can see that. I mean, I think Lodha is up about 25% in about a month. DLF is up some 15-16% in a month, and I'm sure others as well. What do you like here? And your view, if you have a strong one.
Definitely, I think if you look at real estate space, we did a sector note recently. We definitely see that the sector is witnessing a sustained demand recovery. Some of the branded nationalized players are gaining market share consistently at the expense of the small players. And what has also helped the sector is that there has been a disciplined launch. So supply has been kind of disciplined, which has led to a sustained so the inventory overhang has now come down a lot. So after a consolidation of almost 1.5 years, I think now with the even the inflationary concerns receding and RBI maintaining the interest rates, the valuations of some of the real estate companies which had fallen sharply has now become attractive. And hence, we believe they are trading at a discount, almost at 10 to 35% discount to their NAVs, and hence we are positive. What we like within the large caps, we like Lodha, DLF, Godrej Properties, and within the mid cap space, Aditya Birla Real Estate is something that we like.
Got that. Sid, thank you very much for those views. We'll take a quick commercial break. We are back, and Moshe Khatri of Wedbush is going to be focusing on the IT services space. We'll also connect with Sudeep Shah and Mitesh Thakkar for some technical trading ideas in a bit. Stay tuned. Let's get some trading ideas out of the way. We have Sudeep Shah of SBI and Mitesh Thakkar of Bonanza Portfolio with us. Gentlemen, good morning. Great to have both of you here. Mitesh, just the Nifty strategy first, the range levels.
Good morning. See, the Nifty, when it declined other day on the news of that war starting again, I think we still managed to hold on 23,800, 850, which was the preferred support zone. I was, fearing it might break down. Given that it's held down, I think we're back to the range of 23,800 to about 24,400. So on the index, not much might happen. Similarly, on the bank Nifty, till we get a closing above 58,500, I think the next leg of up move may not start and there might be still some more consolidation left. So the indices might be sideways, but individual stocks could be a way forward to trade for the next couple of weeks.
We'll come back to you for stocks. Sudeep, good morning. Thank you for joining in. Happy Friday to all of you. Do you see more strength in the markets? Can you buy the gap up?
Good morning, Rima. Yes, I feel that post the markets gapping up, we should be waiting for that 23,980, 24,000 mark for that to be retested. The reason is that post the opening, the 20-day exponential moving average zone will play a very critical role. And yesterday also we saw a rejection from the 100-day moving average around 24,100. So this is a classic range that we need to navigate, and dips to 23,950, 23,980 would be a good buying range. And till the time we are holding above 23,950, with the gap up opening, I feel there could be one more attempt towards 24,150, 24,250 mark.
All right. One more attempt towards 24,150, 24,250. What would be the stocks that you would be backing this Friday, Sudeep?
There are a couple of mid-cap names. The first stock that we like is Canfin Homes. Here we have seen a strong breakout yesterday. On the weekly and the monthly charts also, the stock is quite strong. So here this could be bought with a stop loss of 890 for a target of 950. The second stock is from the mid-cap healthcare space, the hospital space. So that is Easter DM. Here we have seen a strong follow-up buying post that last week's up move. And once again, we feel this is headed towards 840, 850 levels and can be bought with a stop loss at 780 on the downside.
Okay, let's talk about stocks. Mitesh, what would you go with this morning? And if you could also talk about TCS and what the chart is telling you.
So on the stock side, I have a buy on Premier Energies with a stop below 1,065 for a short-term target of 1140. Sun Pharma made a new high, so that should possibly show continuation head towards targets of 2,000 and it can be bought with a stop below 1,905. A buy on Keynes with a stop at 3390 for a target of 3520. And also buy on LIC, which I would recommend buying with a stop below 430 for targets of 455. On TCS, I think, it's extremely oversold, but yet the stock needs to clear its short-term averages. But the first reversal will come if the stock starts getting past 2,110. Once that happens, you might see that sequence of lower tops, lower bottoms being reversed. And then the stock will finally register a higher high, which would be a first signal of a reversal on the upside. So I would be interested once the stock starts getting past 2110, and then the near-term targets could be in the range of around 2230, and in a very good case scenario, about 2320.
Okay. In pre-open, TCS has got a gain of close to about 1.5%, so a little bit of a lift on the company delivering on lowered, subdued expectations, and it's lifted up even Infosys, and that's got a gain of nearly about 2.4%. HCL Tech too could potentially open up stronger. But these are pre-open. We'll wait for the actual rates. In the meanwhile, let's invite Moshe Khatri, Managing Director, Investment Banking at Wedbush. Moshe, anything in the numbers, in the commentary that makes TCS a buy today?
Hey, Rima, good to be here. So I would characterize the quarter as better than feared, encouraging trends. We can talk a bit about that. And then work in progress, as one quarter obviously doesn't make a trend, right? So we like the AI bookings. We like the strategy that suggests that ultimately the focus is going to be on a hybrid kind of human AI model. And then also yesterday, actually this morning, we had ISG talking about AI project scaling with the AI narrative moving from opportunity to risk and commercial discipline, which is something that we've been talking about and waiting for that inflection point. And then finally, the headcount pivot, I think is also interesting given the fact that we've seen headcount kind of shrinking on a quarterly basis for a couple of quarters now. So I wonder if that's the inflection point that we've been waiting for. But net, I would definitely say better than expected for the space. Just remember, we're heading into this quarter with very, very negative sentiment. And it's anywhere from, AI's disruption on the, for the sector, the geopolitical issues impacting demand. But again, I think on a relative basis, we see much better than expected numbers here.
We tried asking Moshe, the management, when the new work from AI will offset the loss of work on account of AI. And the management said it's very difficult to predict right now because deflation takes place immediately, while the new work, the transformation work takes some time to show results and pick up and accelerate. But what's your own view? Now, you make estimates, you've seen cycles. When do you think, the new work from AI will offset, the volumes will outweigh the deflation? What's the timeline you're working with?
I think we're probably going to start seeing that during the next anywhere between 6 to 12 months. We'll probably start seeing better growth for the sector. And I think a lot of that is about the scaling that we're talking about. I think on a relative basis, pure AI work is, less than 10% of revenues for a lot of companies in the space. Once you start scaling it to 20%, 30%, that starts to get reflected in better top line growth.
And how soon do you see AI revenues hitting 20% plus? Now, TCS, for instance, is at 8.5%. But you can see the growth rate slowing down. So in Q4, the quarter-on-quarter jump in the AI revenue was, I think, about 27, 28%. This quarter, it was at 13.5%. So when do you think AI revenues as a percentage of TCS's book hits 1/5?
I remember what ISG's commentary today, that AI is kind of moving more towards, commercial discipline. And this is where you start seeing that scale. So, this is where projects go from beta to actual execution and production, if you will. And this is where we're going to start seeing that hitting kind of the, I would say, benefiting top line growth. So give it a couple of quarters until we start seeing that. Not unusual. Remember, 10, 15 years ago, we're talking about, the cloud. And, back then, there were also a lot of concerns about the shift to the cloud in terms of how this actually would impact any sort of, software customization. And ultimately, when you went into production, that actually created a significant amount of integration work. So I would get there. And again, I think we'll start seeing those signals in a couple of quarters from now.
You remember a couple of weeks back, IT stocks, the entire sector sold off when we got news about these large companies, whether it's OpenAI, Microsoft, entering into, Microsoft was more recent, but Amazon entering into the AI native services space. And we're saying now competition is hotting up. They're coming to get into the enterprise deployment pie. What we thought was the work reserved for the Infosys, TCS, and the large system integrators in India. And the stock sold off across the board. So yesterday, we even asked the management that about this forward deployed engineers, FDEs. Are you seeing them in deals when you compete, when you're bidding for them? And he says, no. Do you want to weigh in if, once again, we get news like we got Microsoft? And these companies are investing billions of dollars. How worried should we be about competition from these large software to hyperscaler companies and even startups entering this space?
Well, entering the space and as a software business, trying to build a services business is not a slam dunk. Remember that. Very different models. On top of that, they have to make sure that they have the right skills to be able to deploy the work. I would say that most of the companies that we're talking to, they're telling us that enterprises are actually using those companies for deploying, AI platforms. So I don't know if I would worry too much about this noise. Look, I think OpenAI some of the other companies have an interest to, to showcase their work ahead of their upcoming, transaction, if you will. So I don't know. I think at this point, a lot of this is a function of if you have a good client relationship, if they rely on your ability to do the work. And so far, look at the booking numbers for a lot of companies in the space, and they look pretty decent. So I don't know if I would definitely take their word as a risk for the industry, frankly.
By the way, it looks like it's the ID pack is all starting up pretty strong. The pre-open session has come to an end. Moshe, let me just quickly sort of read out the stocks and how they're starting this morning. So the Nifty is up 160, but I think a large part of it is the IT names. So TCS, let's look at the large caps, right? TCS is up about 3%. The index is up 2%. I started that interview by saying that TCS will kind of sort of, set the stage, not for TCS alone, but for the rest of the industry as well. And looks like there is a bit of a rub-off there. And I mean, that we played out that conversation with the TCS management. And I was just thinking, I mean, 10 years ago, the conversation would have been around margins and too much focus on, the optimizing and finessing the financial stuff. But bulk of the conversation is around, of course, I mean, what's happening with AI, with TCS, that SKF deal, what Rima was talking about, which is enterprises getting FDE, forward deployed engineers, and whether there's a competition. So a lot of it basically about where they're seeing this thing going. And they sounded actually, I don't want to say confident, but they seem pretty there, and they're going through it, and they're well aware of what's happening, and they seem to be in a not a comfortable place, but in a place where they feel they can continue to do well and without losing too much share, etc. So that was the overall picture that we got from TCS. So I think some of the smaller companies, look at Coforge, look at Persistent, look at I don't know, KPIT, maybe we'll put that up as well. Maybe I think they're also opening higher. KPIT is, of course, sold off very, very aggressively lately. Any thoughts? I don't know if you have a view on these ER&D companies, Moshe?
So a couple of things. First of all, 10 years ago, we probably would have discussed the shift to digital, or SMAC, social, mobile analytics, and cloud. And we went through the same analysis. And this is where I was in equity research. And back then, it was every quarter they would tell you that digital is 20% of revenues. It's growing, 15, 20% versus the rest of the business. It was a very similar kind of process. Rima probably remembers that as well.
Moshe, yesterday in the conversation, I actually brought up exactly that example because, I mean, TCS told us that AI is such and such number of our total revenues. And I actually brought that example up and I said, well, 10 years back, companies used to tell us digital is so and so percentage of revenues. But what was interesting, what TCS said is that they are defining AI narrowly, which is a good thing. Because everything is AI, and you can classify a lot of the revenue pool into what is now AI revenue, but they're saying we're defining it very narrowly, and that has grown about 10%, whatever, quarter on quarter, the number that we had from TCS. But go on, finish that point.
Yeah, so it was a very similar process 10 years ago, and again, there was a lot of fear about what happens with the legacy business that gets cannibalized. And we went through that process as ultimately the boundaries between digital and legacy ultimately blurred, and nobody really kind of focused on that. So that's one thing. Regarding the question about ER&D and product development, this is probably one of those subsectors in tech-enabled services that are actually still doing very well for a lot of companies in the space. You're going to have one of the largest players going public in India, I don't know, during the next few months, Quest Global, that's probably growing, easily north of 10%, great margins. So the R&D side of the business continues to do well, regardless of a lot of noise that's happening in this industry.
We leave the conversation here. Moshe, thank you very much for joining in. Always a pleasure. All right, let's get in some 9-10 calls as we await the market opening. Mitesh?
Yes, I'll go with the buy on Premium Energies with a stop at about 1,065 for a target of around 1140.
Okay. All right. Well, thanks very much for that. Well, I think Apollo Micro and Premier Explosives in focus. Ria has got details here. Ria, take it away.
Well, yes, Apollo Micro has announced that they will be acquiring nearly 41.33% stake in Premier Explosives. Now, this stake will be acquired from the promoters at a price of rupees 698 per share, and this will be approximately 1,550 crores in total in an all-cash deal. And the transaction is expected to close by December of 2026. Now, following this completion, Premier will come under the umbrella of Apollo Micro and will continue to operate under its own existing brand, although with some scaled performance coming in. And the company has also already made a mandatory open offer to the public shareholders of Premier Explosives for 26% stake at again a price of 698 rupees per share. And with this, Apollo Micro can end up owning up to 67.33% stake in Premier Explosives. Now the implied valuation of Premier comes up to nearly 3,753 crores compared to the current market cap of 3,833 crores. But remember that the market cap has eroded quite a bit in the days following up to this acquisition, as the street was widely expecting this acquisition to come through already. Now, in terms of the rationale of the deal, the company has said that they will be combining their complementary capabilities in defense systems as well as energetic materials, and this will also enable operational efficiencies for them as well as enhanced R&D capabilities, and will also enable broader participation in defense as well as space-related programs for them. And in fact, they've also mentioned that this strategic acquisition will be supporting the next generation defense and space programs for Apollo Micro. So all in all, a positive deal for both companies coming in.
Okay. All right. Thanks very much for that. Let's just take a quick look at the top stocks that we've covered this morning. So TCS, and of course, right on the top of the list, and we should put up, actually, as we did, all the IT companies. But Dixon Tech is up 3%. Anand Rathi is up about 0.75% this morning. Apollo Micro and Premier Explosives are there as well. 3.6 on Apollo Micro. Premier Explosives is up about 1. Federal Bank is up about 0.75%. Havells India, Lux Industries, Torrent Pharma, TTK Prestige are some of the other names which came through. So that's the picture as we start, and we'll sort of spotlight these companies after we look at the indices right to the word go. So 24,150, it's about 0.8% higher. The Nifty Bank is up 0.75%, 0.9 actually. So it's a very good start. The Sensex is up about 0.8%, 77,420. The small cap index is up about 0.9% as well, 19,276. So that's the overall start. 1,550 stocks are high. It's too early, actually. Let's not look at the advanced decline because we are just about starting and many names would not have started trading. So maybe in about 10 minutes' time. Well, let's look at the Nifty heat map and how we are starting. At the bottom of the screen are the technology names, and you're seeing a uniform 2-3% kind of a pop come through across the board. Look at that. It's green, all green. And IT are the top 5 gainers on the Nifty heat map. TCS, Tech Mahindra, Infosys, HCL Tech, Wipro are the biggest gainers, and I think contributing the most in a way as well. The others are Shriram Finance, Indigo, ICICI Bank. There's the Adani Enterprises stock and Asian Paints. So that's basically the top 10 gainers. On the other side, there's Dr. Reddys, which had a news flow yesterday. There's Bharti, there's Sun Pharma and Apollo Hospitals. ONGC is undecided so far. So that's the heat map, and a near 200-point pop to start the day, above 24,150. Rima.
Well, it's overwhelmingly positive for the IT names this morning. The Nifty IT index is now moving up nearly 3%, and the rally this month stands at 8% for the Nifty IT index. 1st of July was when most IT stocks had hit that low. When KPIT Tech had cut the guidance, the street was worried that we're going to see such accidents. And since then, stocks have been slowly rebounding, barring some minor profit booking here and there. Right on top is TCS, that's up close to about almost nearly 4% now, crossing the 2,100 mark. Infosys, Tech Mahindra and HCL Tech report their numbers on next week, on Monday and Tuesday. And ahead of that, these stocks are seeing buying. Top 5 gainers on the Nifty are the IT names. Then you go down the curve, you've got Shriram Finance and ICICI Bank. These two are seeing buying. Then you've got beneficiaries of the decline in crude prices to $76.50 per barrel. So Interglobe Aviation is up. Asian Paints sees buying. JSW Steel, Hindalco in the metal pack also higher in trade. On the way down, it's Dr. Reddys, which is getting hit. Yesterday as well, stock was down. There are concerns about the semaglutide Stock was down, I think, 4% yesterday. Another 3% gone on that. Sun Pharma is under pressure. But other than that, there is no notable drag coming through, at least on the large cap end of the screen. Let's just quickly touch upon the two big deals that we have. I mean, the two announcements. Dixon is one, and that's opened up with a gain of about 3%. And the other one is Apollo Micro and Premier Explosives. Apollo Micro is up 3.5%, while Premier Explosives is slightly under pressure because the open offer price at 698 is lower than where the stock closed yesterday. So Premier Explosive is gravitating mildly lower.
Yep, and for TCS, the interesting part is that 2100 call had a fair amount of writing yesterday. So whether those call writers get stuck on the wrong side and that moves, the stock a little more as short covering comes undone is something that we will be tracking. It's also crossed the important 20-day moving average on that stock, which stands a little over 2100, 2106 is where the 20-day moving average is. So technically and from an F&O standpoint, there are tailwinds for TCS, and it's reflecting in the kind of move that we're seeing on the stock as well. But the stock of this morning, has to be Blue Jet Healthcare. We had the details of the QIP demand which were revealed, and you had a strong HNI book, and then you had strong fund action as well out there, demand. And that was up around 6% for that stock. HFCL obviously having an order win. That stock's opened higher. Muthoot Microfin is another stock which is actually surging in trade this morning, about 8.5% higher. That come up with a business update a couple of sessions ago. So maybe the street's taking note of that now as against yesterday, the uncertainty that there was in the market. So Muthoot Microfin is up around 8.5%, near 52-week high. Lux Industries, the deal with Reebok for their innerwear and thermal wear business, also weighing well on the stock. That stock's opened about 9% higher. Real estate is taking a bit of a breather in today's trading session. We have Lodha Developers, which after surging about 20% this month, has come for some profit taking, down about 3.5%. The real estate index itself is mildly lower after a big surge that we've seen already.
Yeah. Lots happening, and there is strong interest across the board. Look at something like I know we don't bring this up, we don't talk about this name at all, but it was a part of Nimesh's chatter list a couple of days back, and I highlighted this yesterday because the news came. I'm talking about Choice International. It was a big mover yesterday. I think it was on 15% or so. It's kind of flattish sideways, but the news is pretty interesting. It's a South Korean large financial services entity which is pumping in a large amount of money into a subsidiary of Choice International. So I thought it was very interesting because we don't see that kind of thing, very much here, especially in that industry. So they do wealth management, they do investment banking, and they do all kinds of, basically the entire gamut of financial services thing. And of course, Mangalam mentioned Blue Jet, where there is, Enam has kind of anchored the latest round of sale of shares which happened, and other big, long-term investors have come in as well. So that is the other one. That's also an interesting, business-wise, an interesting company, which we can talk about later. But yeah, so just two names. IT, of course, I'll just go back to what I started with. The index, I think, is still up and about 2.5% right now, 3%. So yeah, 28,285. And that's the thing, right? I mean, sometimes, and it happens, IT is the latest iteration of this thing, but a sector completely derates. And then when it starts to come up, there is still disbelief because we actually, frankly, don't know. We'll all be wiser in hindsight, of course. But markets, as they say, is collective wisdom. And you keep asking whether this is it, this is over, this is done. And it slowly keeps repairing. And suddenly you see, well, oh boy, that was a great point in time where you perhaps, that was the bottom in that sense. But as I said, we're commenting on some of this stuff live. There are those who, of course, believe that there is a fair bit of repair and recovery, which we're going to see over the next 6 to 8 months. Maybe, the worst is kind of behind. I think even the IT companies themselves, if we ask them, believe that perhaps the worst in terms of sentiment and the damage that AI, etc., can do, that belief, I think, is we've seen the worst of it. Krishna Sangvi is with us, Chief Investment Officer, Equities, Mahindra Manulife Investment Management. Krishna, good to have you with us here. Good morning. Thanks for joining in. Just that point on IT services, and is there enough information to take a call? At some level, you've got to take a call with how much downside is there. right? I mean, upside you don't know. Are we at that point yet?
Yeah, I mean, that's what you mentioned, right? At some point, you need to take a decision. At the same time, information is perhaps, never adequate in market. So you're right. If I look at IT as a broad space, sentiments have been the overhang, the fear of how, AI rollout can impact those businesses in terms of their earning potential. At the same time, news flow or maybe management commentary about how they themselves can use AI for implementing their own, productivity cost structure. At the same time, need for IT companies to be, used as an agent for deploying AI. So I think it's a mixed bag. If you look from a pure market angle, IT stock is clearly suffering from sentiments far more. They've actually all reached a value zone where the fears are really about 3 and 5 year down the line earning. And honestly, it's a difficult call right now. I think it might just make sense to say, okay, let's look at this sector more in the context of what's happening in the world, because financial markets are driven by those narratives too. Let's look at it at a value zone. It's time to buy if you're really a value investor. Otherwise, possibly can wait for a couple of more data points, maybe 1 or 2 more quarters to emerge, and then look at it from if you're not really looking at a value as a primary reason to buy the stocks.
Krishna, India has become a bottom-up idea now, not so much as a macro trade as it was considered maybe 2 or 3 years back. So give us some ideas where you are seeing opportunity, some ideas for creating alpha. Niche ideas, maybe undiscovered, there is still value and earnings potential.
Yeah, clearly, I think, let's say, private banks and IT can be the clear combination of, that value creation happening because of current valuation being, depressed more like a value zone. So that's one thing. If you look from a growth perspective, the entire, Indian economy is having its own, moment of growth coming up from new business segments, whether you call it, capital goods, precision engineering as a segment as a whole, aerospace, defense. What government policies are focused on creating this ecosystem where India does get into higher end electronics, maybe semiconductors. So those kind of companies also are clearly a bottom up space from a growth where incremental government action, policy, corporate investments are playing those spaces. And clearly the core India story, which is manufacturing, we right now have a situation where even currency is giving some additional competitiveness to Indian industry because rupee at 95 odd does clearly support competitiveness for Indian players. So manufacturing can remain that sweet spot, and quite a few bottom up stock names maybe emerges there.
Right. We're speaking about undiscovered ideas. Think about discovered ideas. Kalyan Jewellers, 38%, was the jewelry growth that the company reported. On the day it reported, it was along with Titan, and as a result of which the street compared the two, and that stock was down about 7%. Thereafter, we saw a big surge. So I remember the stock around that day when, it reported its update and was down by about 6-7%. The low that it hit was closer to 348 rupees.
Wow.
In the next 2.5 trading sessions, the stocks rallied 37%. So the weekly move on Kalyan Jewellers right now is 23.5%. This
Sorry,
after
what was
having
the low you said around?
348.
So 350 to 470.
350 to 470 in 2.5 trading sessions. So it's up 23% for this week after having fallen 7% on Tuesday. So that's the kind of move that we've seen.
So you do see these mispricing, right? Like on one day, maybe, you react and say, oh no, it's losing market share, but then it comes back.
Totally. And, that's what the day we had Manoj Menon who joined us as well. He said that I don't want to talk about the stock price because that may do a thing of its own. But from a business standpoint, 38% growth in a jewelry company, irrespective of the base size, is not particularly bad. Yes, Titan is great, but Titan's also at a record high already. So it's not that it's an or market. It looks like it is an and market.
What has happened? Just the fact that it didn't react, it actually went the other way.
It went the other way.
Hard after first quarter
update. It sold off hard after the first quarter update, and thereafter it started seeing an up move. And Kalyan Jewellers, for one, has been known to see erratic moves on either side in the past. Yeah. So we've seen the stock move a certain way. So we'll obviously continue to monitor. From a fundamental standpoint, nothing really has changed in terms of growth over the last 18 months or so for Kalyan Jewellers. But let's go back to our conversation that we're having with Krishna. Krishna, your thoughts on one, this consumer discretionary space, the jewelry space that we were just discussing. And alongside that, maybe if you could extend that to some of the rate sensitives like real estate, which has already seen a big move, but Street believes that maybe demand is still likely to be fairly strong because prices aren't coming down in any time in the very near future?
Yeah, clearly, consumption, consumer discretionary real estate, happens to be part of that, the upper part of K-shaped recovery, which we've been seeing for last maybe 6 years or so in post-COVID. So clearly that segment is growing well. The income profile for, upper end, I'd say part of the population is clearly growing much faster, and the wealth effect is dominating there. So something like consumer discretionary, maybe jewelry, even upper and high value ticket items like real estate are driven partly by wealth effect, and to that extent, yes, those spaces will continue to attract consumer demand pretty much, because we really have potential where this wealth creation finally moves into some sort of consumption in some category there.
I think the line's frozen.
Line's frozen a bit. We'll probably try and repatch that as well.
Okay. Yeah. Okay. All right. So yeah, that's the view coming in from Krishna Sangvi. I just want to highlight the. I think we have an analyst joining us on the Dixon News as well, and maybe we can, bring the analyst in to talk about that one. So I think the stock's up about 2.75%. But as I said in the morning, there has been so much chatter around with the fact that the approval is coming. It's come. It's not. I mean, all in the positive direction, and that's basically meant that the stock has also moved up quite a bit, coming into the news and the confirmation that the approval has now finally come through. JP Morgan has got an interesting note this morning. I mean, of course, the numbers are all well known, and because the stock, the management themselves have guided to it. But the phrase JP Morgan uses in their note, and maybe Upasana can highlight it once again. They say, well, Dixon is once again a growth stock, and because top line growth is now going to be, it's not 25-30%, but it's going to be north of 50% with this additional 30,000 crore boost to the top line coming through. And of course, I mean, they say the net earnings contribution is smaller, some 18-20% or so, but the top line acceleration once again is sharp. So that is the Dixon news in that sense coming through. I think Krishna is back with us. We had a bit of a patchy line. Krishna, defense is another name. We had defense as the focal point yesterday. We did a program, Editor's Playbook, and it was what we discussed. Now, again, here, what's the call? I looked at the earnings growth from 21 to 26, and then some estimates 26 to 29. I looked at 10 companies, and these are Kotak estimates from yesterday. The Kotak initiated coverage. So in the 10 companies, the EBITDA CAGR for 26 to 29 for 7 out of the 10 companies is lower than what we've already seen in the prior 5 years, 21 to 26. What do you like here in this space?
I think without getting into stock specific, I think the core sector of defense is interesting because we got two things. The entire thought process of Atmanirbhar Bharat created India's own demand, and very fact that some of our capabilities were demonstrated in a couple of instances. India has started getting action or interest from global countries rather to get into a direct purchase, as well as some global companies which are into defense are using or looking to use Indian corporates for their manufacturing capabilities. So to that extent, yes, defense as a broad space looks very interesting. Either you are a component supplier to some Indian or a global defense player, or maybe some Indian companies, maybe PSUs, but they directly are able to supply to some other government, some other countries for their own defense capabilities. So overall space is interesting. Clearly, sometimes the base can catch up in terms of EBITDA CAGR, what we're referring, can be a bit higher, partly because of base. But those things, honestly, for a longer term growth runway, can be considered as a growth stocks, and possibly be positive there.
Okay, got that. Krishna, we were chatting with CLSA yesterday, and he's still not convinced that the Middle East flare-up and the uncertainty related to Middle East is behind us. He's like, it's going to keep coming up every now and then. And therefore his portfolio bet is that you should have some non-ferrous metals, particularly aluminium, and upstream companies in your portfolio. And the words he used these were must-haves. Do you have a call on, say, upstream companies, oil and gas companies?
Yeah, sure. I think You're right. Middle East situation is slightly difficult to predict and anticipate. So if you look from a pure play angle of any company in oil and gas upstream which is looking for a volume growth, those companies should be having a double cushion. One is, even if price doesn't move much, the volume growth can create those opportunities. So yeah, clearly upstream companies and can be a part of portfolio with that particular perspective of conflict not having been resolved. But having said that, it's clearly difficult. The kind of news flow one sees on a very short frequency suggests it's very difficult to take a call on reason to buy because of Middle East conflict, or better to buy because you believe in the company's volume growth potential, and to an extent that gives you a real comfort zone to buy.
Right. Take that point, Krishna. Always a pleasure speaking with you. So that's a view coming in on the markets, a bunch of sectors, as well as the investment advice that Krishna has given to us. The stock that actually is fairly interesting was earlier known as EQ Lighting and now changed their name to EQ Technologies. Remember when the ODM boom was on, the stock had listed and had moved all the way up to 437 rupees, only to fall in the subsequent years to sub 110. And in this month itself, it's up around 42%. So the market cap, obviously around 1,700 crores after this 42% up move that we've seen in the last 1 month on that stock. Obviously an ODM player, but no one bigger in this space and in terms of moves than Dixon Tech. The JV with Vivo, that's a mouthful, has come about, and the stock holding with a gain of almost 2.5% after having rallied about 15% over the last 14 days in anticipation of this coming itself. Upasna joins in with the details once again. Upasna.
Well, certainly all I would say is the wait is finally over as the company gets the long-awaited government approval under the PN3 for its JV with Vivo India. Now, both the companies have executed the JV agreement, and this approval certainly removes the regulatory overhang that has been going on since quite a while. Now, JV was announced back in December 2024, so it's been quite some time. Now, let us look at what the management has already guided regarding this JV scenario. Now, JV could lead to a revenue uplift of 30,000 crore is what the management has indicated, as the Vivo enjoys higher ASPs compared to Dixon's existing portfolio. Post-regulatory approval, management had guided that operations will begin in 60 to 90 days. So calculating that, most likely the operations will start in Q3 FY27. Now, Vivo has 35 million annual volumes in India, of which 67% will come to Dixon, which comes up to nearly 22 million. Now, for FY27, the company has given a guidance of 56,000 crores in terms of revenue and 32 to 33 million smartphone volumes, excluding the Vivo contribution. Now, let us look at the various brokerage views, certainly mixed here. Motilal has retained the buy rating with a revised target price of 16,100. It's working with an estimate of 13 million volumes in FY27 and 17 million in FY28 from Vivo. JP Morgan has also given an overweight rating with a target price of 16,700, and it is working with a volume contribution from Vivo of around 11 million in FY27 and 22 million in FY28 and 29. UBS has given a buy rating with a target price of 13,700, and CLSA has given an underperform rating with a target price of 10,400. It believes that there is a limited room for upgrades from here on for the stock. And lastly, coming to Phillip Capital, it continues to maintain its sell rating. So overall, the street is seeing a mixed review on this one.
All right. Thanks very much for that. Well, that's the Dixon conversation and the order, which is the joint venture, which has now been cleared. We have an interesting management with us now. We have KP Mahadevaswamy, a CMD at NBCC, now joining in to talk to us about their business. So a couple of points, right? Ordering and order book trends. This is the most important bit, which we will discuss. Ideal top line mix, cost, inflation, margin outlook, etc. Mr. Mahadevaswamy, thank you for joining us, sir. Good morning, Prashant here. You were in Mumbai, sir, for an investor day late May. You put out some numbers and you met investors. Lots of people attended and fair bit of excitement around it. And I think the number one conversation which came up is the ordering pipeline in terms of what you're seeing, redevelopment and otherwise. So can you give us a comprehensive sense of, the order book? And the pipeline where you have strong visibility, sir.
Good morning, Prashant. So, thank you. Last month we had a convocation investor meet at Bombay. So we have a very good order book around 1.2 lakhs crores. And currently the running project is almost 38,000 crores. So during this year, we are targeting another 20,000 crore we will going to award. And the order book will be naturally running projects will be going to increase. And current year, we are targeting for a turnover of 16 to 17,000 CR.
Right.
This year, you're targeting 16,000 to 17,000 crores in revenues. That is FY27.
Yes.
And you're saying that, so just to get the numbers, lots of numbers, 1.2 lakh crore current order book. Out of this, you're executing 38,000 crores.
Running project is 38,000 crore.
Yeah.
During this year, we're going to award another 20,000 crores. So our running project will be increased from 38 to 58,000 crore.
Got it. You will as a PMC, you will order another 20,000 crores. And okay, got it. So the unexecuted order book after that 20,000 crores will drop to about 70,000 crores, is it?
That will be carry over to next year, next financial year. We are doing in three segment rather, PMC, EPC and real estate. In PMC also, we are doing, one is exclusive PMC projects, other one is redevelopment projects. Redevelopment projects usually takes 4 to 5 years because it is a self-sustainable mode project. And we have to existing structure, we have to dismantle and we have to get lot of approvals and statutory compliance. And one more thing is major is in redevelopment, that is sale of the inventory. That is also important part. So you have to generate the money for self-generation. So that usually takes 1.5 years. That's where we are getting some delay. But our J&K project through now and Rajasthan projects also through. These are all state government projects of redevelopment. So this year it will be, and even we're going to start Super Tech also at the earliest. Super Tech, it is we got through NCLT. Then of course with the intervention of Supreme Court, now we got this work order. So it will also going to mature during the current year.
Right. Just one last question from my side, and then Mangalam has lots of questions. I know he's waiting. So once you award 20,000 crores, I'm saying how much will you take in terms of fresh orders this financial year, sir?
Here we are targeting around 30 to 40,000 crores. We are expecting two big orders. I don't want to name currently, but we are expecting two big orders that will be around 50,000 crores. That will come to our kitty.
Sorry, you said 30 to 40 and then you said 50.
40 to 50,000 crore work order we're going to get current year.
Okay, so then you will carry forward this. So as you start FY28, you will again be at about 1.2 lakh crores in terms of order book.
More than that. 1.2 plus 50, 1.7.
Yeah. No, I'm saying unexecuted order book where you've not started work. Yeah.
Yes.
Oh,
yes.
Got it.
And by when do you expect to get this 40 to 50,000 crore orders?
During this year, hopefully third or fourth quarter.
Third or fourth quarter. All right. No, I just to go back on your revenue guidance, you said this year you will clock revenues of 17,000 crores.
Yes.
That's a slight dip from the 18,000 crore guidance that you had given earlier, right?
Right, 17 to 18,000 only I have given.
Okay, so 17 to 18, this is at the lower end of that range. I just wanted to understand two things from you. The 1.2, 1.3 lakh crore order book that you have right now, could you give us a breakup of that on PMC, Realty and EPC? How is that likely to pan out as you move forward in execution?
Most of the project, around 96, 97% only PMC projects. PMC, we have one is exclusive PMC, other one is redevelopment. Around 50% is the PMC and redevelopment.
Okay, 50-60% is PMC and redevelopment. And how much of the GPRA projects have been monetized this year, and what's the target? You said there were some delays here?
No, there is no delay. We have monetized almost 2.34 lakhs square feet. Already we have monetized through Bharat Business Park, wherein we have sold in two auction almost 8,900 crore rupees worth of inventory already we have sold. Only one tower is left out with us. That will fetch around another 1,000 CR. We are ahead, rather. We are in a very good sale position.
This I think you also said that redevelopment is a big opportunity, right?
Yes.
Yeah.
After successful completion of redevelopment projects in Delhi, that is one is Moti Bagh and other one is Kidwai Nagar. Now, currently we are doing 7 GPRA colony redevelopments. This is very good successful story wherein government is not investing any money, and suppose government is having X number of units, we are giving twice, 2 times of X of inventory, and in terms of area, suppose X times of area, we will providing 4 times of X area. So without charging, rather without burdening to Government of India. This project we are expanding to all the state government, because state government is having huge land parcel at prime locations. For better monetization, this is the best model, better than PPP model, I can say, where because in PPP model, usually contractor, agency, developer want to expect some 40-50% profit minimum in real estate, whereas we are charging only 8 to 10% PMC fees. The rest of the thing lies with the Government of India or the state government. So this is the better model than PPP model.
So
That's why we are getting orders and the state governments also.
Okay, well, so it's a different business model in that sense, but you're saying it's much better than simply the PPP PMC business. So what are margins here, sir, in redevelopment?
Redevelopment we are getting 8 to 10%, including marketing.
So much better than your pure PMC margins, right?
Yes, yes.
So overall, what would your margin outlook be in general? Because you've told us that 17 to 18,000 crores the revenue that you'll do this year. Over the next, say, 2 to 3 years, including this year, if you could give us a margin glide path?
This year we are expecting a PAT of 1,100 to 1,200 CR. Next 2-3 years, we will reaching around 2,000 to 2,500 crore. How we are getting this number? Because we have our in-house real estate also, real estate business. In real estate business, we are getting profit more than 30%. So that's why we may fetch the next 3 years, our bottom line will be almost 2,500 CR.
So that is by FY30, sir?
30, it will be more.
So you're talking 29, it will double, and 30, it will probably be about 3,000, 3,500 crores.
So you're saying FY29, you should be between 2,000 to 2,500 crores in net earnings?
Yes, definitely.
And that would be on the top line of?
A top line of around 28,000 to 30,000.
Okay, 28,000 to 30,000 crores by FY29 with 2,500 crores in bottom line. That's the headline that we get from you. And you did speak about the Supertech project, but there are 2 others as well. There's Nauroji and Ghitorni. Could you give us an update on that?
Ghitorni, we called it consultant tender. We will going to finalize at the earliest. Hopefully, during this year, we are going to start that Ghitorni projects also. But the turnover will come after 2 years. In real estate, so we cannot book the turnover currently. At the time of handover only, it will be booked. So it will take only after 2 years, we will going to book that turnover. But the cash flow will come from during this year. We are expecting we'll get inflow of the cash.
Right. So I just had just a general broader question. In places like Delhi North, basically, is there a shortage of contractors, sir? High quality, good contractors. Is that a bottleneck? Because I keep hearing that from real estate companies.
Yes, really, not a shortage of good contractor, shortage of skilled laborers. Actually, what is happening nowadays? State governments are giving freebies. So because of freebies, we are unable to get good skilled labor. That is the unfortunate part. That's all. Otherwise, India we are having highest population in the world, but still skilled labor is a major worry for us.
The second half of this year, you said that 40 to 50,000 crore order that you're going to get, it's likely to come from the Delhi government?
Not Delhi government. One is from central government. Both are, I think, from central government only.
All right.
Both
are in the PMC space itself, right?
PMC projects.
All right, take that point. Thank you so much, sir, for joining in. 40 to 50,000 crore worth order is what you're expecting in the second half of this year. A big order, which you haven't yet disclosed, but you say most likely to be from the central government in the PMC space. This year, 17,000 crore revenue with 1,100 crore PAT. But more importantly, by FY29, you get to 25 to 30,000 crore in revenue with 2,500 crore net profit as well. Thank you so much for joining in. Wish you good luck on execution. With that, we take a short break, come back on the other side. The IPO rush in the second half of this year, and we'll also assess the mutual fund's cash position, the appetite levels for all the paper that is likely to hit the market in the second half of this year. We have Pranav Haldia and Swaroop Mohanty joining in. Welcome back. Holding fairly well for the market, 24,200. So we are doing extremely well now, just about 300 points away from the earlier high that we hit. But more importantly, the 24,270 mark is an important one for close today. If we do that, we will manage a positive close for the week on the Nifty. As we speak, HEG in the broader markets is a stock that has seen a big surge, up around 7.5% with a fair amount of volumes backing that. And we spoke about the jewelry space, right? Look at Senco Gold 2. That's another stock which has done about 12% in gains this week, 5% coming today itself. They too had reported a strong first quarter update with a 60% jump in their revenue on a low base. But mutual funds are emerging as one of the biggest pillars of India's primary market with steady SIP inflows and strong institutional demand that we see. Domestic fund houses are taking a larger share of IPO allocations even as foreign flows remain patchy. The question is, are mutual funds simply participating in the IPO boom or are they becoming the force that is keeping it alive? Hormas joins in to break it down for us. Hormas.
There's some very interesting data that has come in from Prime Database. We're looking at some number crunching that we did over the last couple of years. So in 2025, of course, the record fundraise that we had through the IPOs of almost 1.75 lakh crore, and mutual funds were participants, the fund allocation there was almost 22% of that, close to 40,000 crores came from mutual funds. Of course, the first half of 2026 has been fairly subdued in terms of the IPO activity. We've had only 28 completed IPOs so far, which was well over 100 plus last year in the full 2025. Now, here we have raised close to 35,000 crore rupees, and this is including the SBI Funds Management IPO, which is 11,000 crore rupees in itself. So that is the kind of funding activity we have had so far. And in these 28 completed IPOs, mutual funds have stayed away from 9 of them. They have not either bid or have not participated in 9 of these IPOs, and they're smaller in size, or most of these IPOs are anywhere between 150 to 400 crore rupees. Of course, it's not as if they have not bid in any small IPO. They have in some of them in small quantities as well. Now, what are the SEBI guidelines that we are talking about? The SEBI guidelines says that up to 60% of the QIB category of the IPO can be allocated to anchor investors, and within that, the 1/3 of the portion must be reserved exclusively for the domestic mutual funds. Now, when you take a look at the 28 IPOs that have been completed so far, only 10 of them have seen mutual funds in compliance with that, or compliance in line with that 33% reservation or more than that for the year so far. Now, which have been the biggest bets that mutual funds have made in terms of IPOs this year? Fractal Analytics is one of them. 1,066 crore worth of investment that they made, 51% of the entire QIB portion. The Coal India unit, Central Mine Planning, that is the other one. Powerica, Sedmac Mechatronics, Amagi Media Labs, where they have seen investments of anywhere between 600 to 800 crore rupees so far. There's some of the IPOs where they have stayed away from. The 9 of them that I mentioned, the smaller IPOs, Gaudium IVF, Shriram Twistex, Rajputana Stainless, Amir Chand, Jagdish Kumar, Innovision, some of them, the ones that they stayed away from, there's some of them. In the 28 IPOs that have been invested so far, it's a fairly mixed picture, or it's even Stevens when it comes to divisions between who has led the IPO, whether it be FPIs or be it mutual funds. It's 13 to 11 in favor of the FPIs as of now, but when you look at the outperformers, out of the 11 outperformers that the 11 IPOs that mutual funds have led, 10 of them have seen positive returns so far, but for the FPIs only 4 of them. And take a look at the best performing IPO where mutual funds were the highest bidders, which is Omnitech Engineering, which is 133% higher in comparison to its issue price. And for the FPIs, it's only 51% for the Gaudium IVF and Women's Health IPO. So mutual funds have done fairly well in the selective bidding that they have done in the first half of the year. Of course, the second half promises to be a bigger and a better one considering the slew of mega IPOs that are lined up. It will be interesting to see the kind of appetite that comes in the second half.
No, absolutely. You know, to that question, Hormuz, that you put up, right, which is who's funding India's IPO boom? It is retail, but it is also institutions very much, right? And the latest one is an interesting one, which is SBI Funds Management, the company behind SBI Mutual Fund. It's the largest asset manager in the country. You know, we got the price band valuation, etc. yesterday, and this morning we know the investors who've put money in the book. On the QIB side, and it's a long list of high-quality investors who've come in. Just want to play out a small snippet of the conversation with the top SBI team. Rima and I caught up with them. Just listen in.
Assuming 25-26% growth, you know, 5,000 crore net profits in F5 28, which gets us a multiple of about 24 times. Is that the right way to look at the is that the right multiple, Mr. Singh?
So many factors around it, but if we go by our past history, the way we have been growing, then definitely yes.
Okay.
But there are always in the markets, there are uncertainties. It could be more than this, it could be a little less than this. But the growth rate, the more and more financialization happens in the country, SBI Mutual Fund is at the forefront. We will get the maximum benefit. The moment today the biggest friction in growth of mutual fund business is the way KYCs are being done. These small players, the way it's a linkage between the remuneration for acquiring a customer and see all efforts to be bring in. So that is not working. The moment that friction is over, which is likely to happen very, very soon, and see once because all the bank accounts are now KYC compliant. The moment any bank account which is KYC compliant, frictionlessly can part money in mutual fund, I think that will be the biggest revolution. And the number which is there today, only 6 crore investors, that will multiply like anything, and that the number could be anywhere. I'm not saying as much as number of bank accounts are there, but at least 20% of the bank accounts will be the mutual fund investors.
Okay, that's SBI Mutual Fund gunning for the captive audience of the SBI accounts, the SBI bank accounts. So they're saying that so far they've penetrated only 2%, and the goal is to capture a greater part of the SBI accounts, the banking accounts, get them to invest via SBI Mutual Funds. And the friction they're seeing is largely on account of KYC, and they hope that will get sorted very soon. So that's one of the big growth levers that the company is leaning into. But let's get back to the IPO data that Hormuz had earlier shared. Pranav Haldia, MD of Prime Database, and Swaroop Mohanty, Vice Chairman, CEO, Mirae Asset Mutual Fund, are here with us on the show. Gentlemen, thank you very much for joining in. Pranav, let me begin with the data that Prime Database has put out. About mutual funds, so far this year, having put in only about 6,200 crore compared to 38,000 crore on the whole that they put in last year. And MF staying away from 9 of them. And Swaroop, come in on this. Is it just purely on account of the smaller size, or is there some difference in the way mutual funds are assessing IPOs right now?
So, Rima, you want me to start or let
Okay,
Pranav
Swaroop,
go,
why
then
don't you go? Because this is mutual funds, because some of the ones which you have missed out on, not you, as in the industry have not participated, are also much smaller in size. And we haven't got those big bang listings so far in the first half.
Oh, Rima, at the outset, it's so refreshing to see the number of companies in India wanting to go to the capital market way. I mean, in 2016, I'm not selling a fund, but just giving you something in perspective, we had to close down our mid-cap fund, citing that there were not many ideas in that space. But cut to 10 years later, the choice for the fund manager is just broadening by the day. And with every listing, every fund house now is a different choice. Now, whether we invest or not during an IPO does not give our view on that stock. It's just the IPO, which is the beginning of the journey of that company in the capital markets, right? Sometimes, there are compelling ideas that would already be in the portfolio, which would stop the fund to take a fresh position in a similar company. So it's not an indication of anything at all to be participating in an IPO or not. But yes, the house view of Mirae has been that if you are an anchor investor, then you should behave like an anchor investor rather than a trading investor. So whenever we've participated in an IPO, we've typically held on to the journey unless something has gone or changed with the journey. So, I mean, it's actually mutual fund participation. Sometimes, or non-participation may not be the beginning or the end of the story is what I like to leave it at this moment.
Pranav, you want to comment on the non-participation by mutual funds so far in the first half of the year?
Well, good morning. So, I just say that we have to look at as a percentage of the issue amount. So while as an absolute figure, the 6,000 crore might appear less, but I think if you look at as a percentage of the issue amount in calendar year 25 and 2026, I think it would be around the same figure. Just as an aside, you mentioned that who's funding India's IPOs boom. And it's ironic that SBI MF is launching its IPO and SBI MF itself has funded so many IPOs. It's come in as an anchor investor. And, if you look at the figures in terms of rankings of top anchor investors, it's been right there on top. And now itself is coming out with an IPO. But essentially what you've been seeing over the last couple of years is, the role of mutual funds has increased manifold. I remember 10, 15 years back, if you didn't have FPI participation, IPOs would not happen. But now what you're seeing is that at least smaller IPOs, IPOs which are, let's say, less than 1,000 crores, can go through with the support of domestic mutual funds itself. The other interesting aspect of this is also in terms of pricing of IPOs, where again, FPIs used to primarily, decide and play a key role in doing that. But increasingly, you're now finding the domestic mutual funds, again, because of their increasing heft with the SIP money coming in. In fact, our study also showed that in FY26, you had the first time that domestic mutual funds overtook foreign investors as anchor investors. So, that's has been a very positive sign, and I expect the trend to continue this year as well.
Just a broader question, Pranav. Morning, it's good to see you. I think we're speaking after a while. And of course, Swaroop, great as always to have you. It's an interesting anecdote you share, that right? No ideas for mid-caps, and now you're bombarded with ideas. But Pranav, just in terms of, because you track this so closely, right? There's this constant retail inflow which is coming through, and thankfully on the other side there is supply which is coming through as well. But is there any way to assess whether that has kept pace? Where is this? Is money still chasing too few ideas, or is it broadened, or is it, I don't know. I mean, what's your, how does one assess it and give an answer?
Well, on the supply side, actually, there is no dearth. The kind of pipeline of issues that you have right now is, the largest that there has ever been by far. We're talking about 250 companies which have either filed with SEBI for approval or are awaiting approval, looking to raise close to 5 lakh crores. This sort of pipeline you've never had. So investors are really actually spoiled for choice. And, to answer the earlier question as well, I wouldn't be surprised if mutual funds are not participating in all IPOs. I think investors, including mutual funds, have become discerning. And, typically you do find that, in case of tremendous supply of issues, there would be a few, an IPO is fundamentally about the quality of the company and the valuation at which it's coming at. So there would be a few companies which would either not be fundamentally good or the valuation may be too expensive. Where not just mutual funds, but even foreign investors may choose to sit up.
Swaroop, you want to just answer that? It's same question.
Yeah, I think, when you look at approaching an IPO, first of all, a new idea will always have takers. And look at the world. I mean, the world prepared for the space idea, right? So their valuations, investment bankers all took a ride and the world prepared to give it money. Similarly, a new idea, a good idea will always have takers. There's no doubt or debate on that. But otherwise, the valuation is a question mark always. And then the fund management today, if it has a similar company in its portfolio, will stretch a bit more to sort of bring that to the discussion table. Now, finally, it's up to the issuer to decide what are the valuation and at what price they want to bring the IPO at. But from the mutual fund side, we have to find value for our book and what is right for our investors, right? And what is right for the mandate of the fund. If those things fall into place, then the application is a no-brainer. But sometimes, in that discussion, if there's a gap, then many funds would tend to stay out and look at it post-IPO also.
Right. Swaroop, just to look at the other side of this, on the one hand, obviously, domestic mutual fund liquidity supports the IPO market, and which makes everyone, a little more aggressive in playing bold, going ahead and offering paper. The other side of this is that the rush that all these IPOs are seeing, maybe there could be a sense of FOMO for a lot of these guys as well, right? Where a lot of the mutual fund institutions go head over heels to subscribe to paper just because everyone else is subscribing. And that, again, causes the cycle to keep moving on, where investment bankers would perhaps give out paper because they know that mutual funds are going to subscribe. Companies which may not have the best financial will still go to the investment bankers because they know that there is liquidity. So all of this can also seed some problems for the future.
Mangalam, I buy your point, but if you were to drill down and ask Pranav to also make a breakup of how many mutual funds, because you've bracketed it as mutual funds applying for the IPO or not, that's a broad bracket. If you just drill down to how many mutual funds have and have not, you would get an answer on that. I think the days of FOMO are gone. The fund management in every fund management unit are fairly pedigreed now, and then catering to the need of the portfolio is more important than participating is a reality. I mean, we would have participated in some and we would have not participated in many. Some within that participation during the IPO phase have worked, and then subsequently the ones which have not worked, we've participated at lower value to get good value for our money. So it's a process. The IPO is just about a starting point. But to answer you, if you drill down a little deeper, you will see that the behavior within the industry for every IPO is dramatically different, and it's very fund specific.
Swaroop, will you have to, now the large IPOs are coming through, raising more than $1 billion each, and many such now in the pipeline, will you have to sell some of your existing holdings to make space for them, either in thematic or in your large cap, flexi cap funds, or there is enough fresh money which is coming in, and therefore it's not that you have to sell one to buy another?
Rima, when you look at the allocation that we get, it's hardly any big money, and the industry is getting flows. Luckily, we also have flows. But if it is a compelling story, what you're saying can happen, though it rarely happens. I mean, at this moment, please understand, apart from the flows, all hybrid funds are also sitting on fair amount of cash for the valuation metrics to also kick in. So there are other ways of allocating to the IPO, not just selling an existing stock. An existing stock would get sold when it does not favor the fund management view, valuation, or whatever, or you've hit your grid of your sell price. But to replace it for a compelling story, very rarely that happens. If that happens, then there's a view on the existing stocks. But, I'll just like to make one small example here. But suppose, as the Indian landscape is changing, you're seeing the birth of thematic funds. Now, suppose there is a financial IPO coming. The way a diversified fund will look at that IPO and the way, say, a banking and financial fund will look at that IPO can be very different.
Right.
So as thematics grow, the buying potential or the nature of approach of mutual funds can be very different within a fund house.
Okay. Gentlemen, thank you very much for joining in. Short conversation, but a useful one. Thank you once again.
Thank you.
Moving on now to Ananya now. She joins in to tell us how Q1 FY27 will shape up for the NBFC sector. Ananya.
So, well, yes, Q1, if you look at the Q1 FY27 business update itself, you can see that the NBFC's growth is holding up despite a seasonal softness. But if you look at the numbers, like Bajaj Finance and Bajaj Housing Finance, the AUM was up 24% year on year. You can see a good growth here. L&T Finance retail book was also up 28% year on year, and M&M AUM was up 12% and disbursements 21%. So good growth going forward. Now the growth story remains intact with healthy double-digit AUM expectations and earnings expectations. However, here the problem is the borrowing cost still elevated and margins are under pressure. The key theme this quarter will be earnings quality and not just growth. So within this setup, if you look at the diversified NBFCs, they are best placed because they have multiple growth engines across MSME, rural and secured lending. So the key watch points will be NIM resilience, credit cost and retail loan growth, especially as unsecured lending competition rises. Now let us go back. Let us look at housing finance. They're also growing well, supported by affordable housing demand, but the focus is now on profitability as lower PLRs and sticky funding costs are putting pressure on spreads and NIMs. So the investors will watch out for that. Now coming to vehicle finance, they also should remain healthy, but the performance will be uneven this quarter. Passenger vehicles, tractors and light commercial vehicles are holding up well, while medium and heavy commercial vehicles face pressures from fuel and freight uncertainty. Now coming to the microfinance sector, which is the most talked about sector now, and it is the biggest turnaround story if you see. Now after a tough FY26, AUM growth is expected to rebound to around 20% from 4% as reported by CRISIL. Now supported by non-MFI products rising from 6% to 14% of AUM and repeat borrowers improving to 66% from 53%. Now coming to gold finance, they also remain a standout. Gold finance loans are now forms nearly 11% of India's retail credit, with the sector growing at a 34% CAGR over FY27 to FY26. But the key question is whether growth is price-led or business-led. Now, funding trends are also supportive if you see, with Q1 FY27 securitization volumes hitting a record 60,000 crore, up 22% year on year, and NBFCs contributing over 98% of issuances. Now, gold loans became the largest securitized asset class, but cost of funds remains the key earnings variable here. Now, valuations, if you see, also remain interesting. Bajaj Finance and Muthoot still command premium multiples, while Shriram and Home First look relatively attractive in this space. So, overall, NBFCs enter Q1 FY27 with a strong growth momentum, but the key risk that the investors will watch out for will be the El Nino risk, fuel prices risk, growth loan sustainability, and most importantly earnings quality. So this is not about who just grows faster, but who just grows better.
Thank you very much for that. Digant Haria, founder Green Edge Wealth Services, is now joining in, one of the most tracked voices on the banking and NBFC sector. Digant, apologies for keeping you waiting. I know you've got to go very soon. So quickly, let's get to actionable advice from you. The business updates are strong, as Ananya was telling us. Expectations for growth are also very high. Which stock would you bet on? What are you watching for?
Hi, I think see, gold loans and microfinance, these have to be the two stars. Like microfinance, 18 months of pain period is over. You will see a very good quarter. So I think microfinance really looks good. They'll deliver stellar numbers. The trends are also good. So I think, something like, say, an Arman Financial, or, these indirect proxies like Northern Arc or Mass Financial, which lend to microfinance companies, I think they should see good traction in the coming quarter. And, the other one is gold loans, because the gold loan as a sector was doing very well, but it was this whole gold price fall which scared the investors, and, the noise around competition and regulation. But I think none of that has really played out. So I think the gold prices stabilized, and, you will see decent growth coming from this sector, even on a very large base. So, companies like Muthoot Finance, Fedfina, Tamil Nadu Mercantile Bank, they're doing really good work in gold loan space. So I think these two should be the standout sectors in the NBFC space. And, lastly, I think even in vehicle finance, the concern around diesel prices and all, I think it's overdone because we did not increase the diesel prices. I don't think the markets are disrupted on the ground. So even something like Shriram, Sundaram, they could not have the risk that we are all worried about. So, even those could post good numbers.
Okay, so Arman Financials, Northern Arc Capital, gold financiers like Muthoot, Fedfina, Tamil Nadu, and even CV financiers like Sundaram and Shriram. So that's a lot to chew on, but let me get in on the show, Lata, as well. Lata.
Okay, thanks for that, Reema. Can't stay away, when it's banks and NBFCs. Well, Digant, what's the sense you're getting about affordable financing? There were some noises in the market that affordable housing finance got a very raw deal. And now it is picking up. Are you noticing anything there?
So, see, there is a slight pickup, I would say, but Lata, see, this sector has too much of competition. It's not that the growth was, growth was fabulous. It's just that there's too much private equity money chasing. There are 5-6 companies which look very similar to each other. Be it Home First, Aavas, Aptus, and a lot of them get their profitability from doing LAP, the small ticket LAP, and that has gone through a bad cycle. So there is an expectation that that cycle will also turn, and hence the growth profitability turns. But I think as growth picks up, their margins will have pressure in this coming year. So not very bullish on this entire housing finance space, affordable housing, especially because see they grow at say 25% and their ROEs are 14-15%. So it's a model which has to be funded again and again.
Okay. Well, let me come to the price. I mean, there's no doubt, as you began by saying that NBFCs are in a fine spot at this point in time. Bad loans are absolutely crashing next to nothing. And we are seeing very strong growth numbers reported by some of the early birds who gave their numbers. But aren't they expensive? I mean, for instance, a Chola, some of them are trading at well over 5 times book and, is there anything you will avoid because it's expensive?
I think a lot of it, Lata, because as you rightly said, see, Chola is trading very high. Even the likes of, say, a Tata Capital or, the HDB Financial from, HDFC Stable. I think for the ROEs which they can make, they are trading at a very, very reasonable valuation. So for a new investor, even though the sector may do well, it's not that everything offers, a reasonable risk reward. And, which is why we have done some, checks. So I think Sundaram and Shriram from the CV Finance pack can do well. Affordable housing, as we said, not too much that we like because everything is at 3 times trailing price to book. And, at this price to book, you don't know, you can't bet unless you have a long-term clarity. So we are restricting ourselves to CV finance, gold finance, and microfinance, these 3 pockets to be precise.
Okay. And would you worry that the NBFC space may be more a trading play and banks may do better? There is a majority view, I won't say consensus view, a majority view in the market that in the second half the Reserve Bank will raise rates because food inflation is expected to pick up. There's El Nino fears are there. It doesn't seem like that in Bombay, where we are finding it difficult to even get from one place to another. But there are a lot of central India and eastern India which are seriously rain deficit. So because of rate hike fears, in the second half, banks likely to do better than NBFCs?
See, maybe, but again, see, banks also have a lot of competition, and especially for us investors, Lata, see, the performance has always been good. It's just that the FII selling was so huge that the private banks were restricted in their stock price returns to the investors. So I think we'll see the same, in this year that performance may not really be bad. But it's just a matter of whether the FIIs become big buyers in this space. So our returns are, somewhat based on 2 things. The sector will anyways do well, but will FIIs come in a big way or not? Whereas in NBFCs, there is a lot of domestic interest and you will see those good ROEs, good turnarounds. And the personal loans, microfinance, both them seen bad cycles and they are recovering. Gold loans, we saw gold price correction. If they deliver good results, people will say, yes, they also have suffered a bad cycle. So I think in NBFC, you have a big cycle support also, which is there. So I think maybe a 25 bips rate hike here or there may not really change this view. And we still think NBFCs are a much better place to be in than banks.
Okay. Thank you, Digant, for joining in and staying on. Appreciate it. We will get into a break. On the other side, Lata will continue to chat with Shailendra Jhingan, the Treasury Head at ICICI Bank, on where the rupee and rates are headed.
Well, welcome to It's the Economy. The Indian rupee at well over 95 to the dollar has disappointed some in the markets, especially equity markets, who have been expecting a 92, 93 reading after the Reserve Bank announced that rather generous FCNR deposit scheme. Bankers have been expecting between 40 and 80 billion dollars, so it's a wide range of inflows. But the start appears to have been slow. Separately, Indian yields fell sharply under the twin factors of a 30% fall in global crude prices in June and hopes that the inflow of dollars via FCNR deposits will ease deposit pressure on banks. Now, the 10-year bond yield fell from a high of 7.1% before the June policy to a low of 6.68%. I mean, 30 basis point fall in early July. But the yields climbed up this week due to the crude surge. To get a handle on both these markets, I have with me Shailendra Jhingan, the Head Treasury and Economic Research Group at ICICI Bank. Shailendra, good morning. Thank you very much indeed for your time. Well, that's the first question. You know, the first question really is, many people asking me, "Arey, tum log sab bola 93 for the rupee, and this 95, 95 and a half, 95.6 has kind of rattled the market." What's your sense? Where are we headed in terms of the rupee?
So I think one fundamental thing to understand here is that the dollars which are coming are going to RBI. You know, it's not like banks are getting the dollar and they have to come in the market and sell, and immediately the dollar supply in the market improves. So I think, that is one aspect of it. I mean, the dollars have gone to RBI. And they're going to RBI rather, and it is as and when RBI decides to intervene in the market, I mean, the currency will move accordingly. The other thing to understand is that Lata, I mean, finally this is a temporary solution. I mean, we are kind of buying time for 3 years. It is not that the fundamental issues in the BOP continue to remain. I mean, the current account deficit is negative. I mean, I know the negative is not large, but I think the best way to look at the balance of payment situation is to look at what we call the basic balance, which is the sum of the current account deficit and FDI. And, because that is the only part of the BOP which is non-volatile, which does not depend on debt capital.
Which is in our hands.
Which is in our hands, and that continues to be negative. And I think so that also drives the sentiment to some extent. But still, our sense is that, once the dollars start coming in, sometime in August, September, I mean, the rupee will have an appreciating bias. I mean, how much it appreciates is very difficult. I mean, earlier I was thinking 92, 93 kind of levels would be possible, but I think maybe, 93, 94 is the range we are looking at now in September.
Yeah, of course, we get colored by the recency bias, and the rise in crude prices has rattled all of us this week. But Shailendra, is it fair to say that it is a slow start because paperwork is not in place and people are figuring out, and that it will pick up by what you think, August or September?
Yeah. So I think, although the scheme got announced on 5th January, I think we have to understand that, most of the things for banks became clear only on 26th June when, the leverage circular came in. So I think it's been hardly 10, 12 days from there. So, I mean, we are seeing some traction, but you're right. I mean, that, maybe we won't see flows immediately and, it will take time. Maybe August, September is when bulk of the flows would come in. But again, I think it is a bit of a challenging situation in the sense that, since RBI announced this measure, I mean, the global yields also have started going up. So what we call the SOFR, I mean, the 3-year SOFR has gone up by about 20 basis points since then. So the global liquidity conditions are also tightening. I mean, we know that there is upward pressure on the US yields also. I mean, markets are pricing in now 2 hikes from the Fed. So all this impacts the funding cost of the banks, and accordingly it will, it could come in the way of the mobilizations also. But our base case continues to be that, we'll see about somewhere close to 50 billion kind of a number on the FCNR deposits.
You took away my next question. I was going to ask you if you can assess the global ecosystem for us. Now, you've assessed it partly for us. Do you think, are you penciling in a Reserve Bank rate hike, MPC rate hike? Because at some point in time, we are going to see inflation at probably 6%, maybe 5.9 for at least a month, given the expectations of El Nino. So is there a rate hike?
So I think RBI has very clearly articulated this. I mean, they are not going by the headline inflation number. They're going to use the flexible inflation, targeting bands, which is essentially 2 to 6%. And they will look through inflation, which is coming from one-off supply side factors. And by one-off, I mean that, food prices obviously will go up. We know that there's a El Nino, monsoons would be in deficit. So there will be a spike in inflation. The headline number might be higher. But I think where RBI seems to be focused on is the core inflation number, and more specifically, the core inflation number X of precious metals, which is now at 2.3%. Yeah. And in any scenario we see, we don't see it crossing 4% even in the financial year. So I would think that, we are not penciling in hike, at least for the next 2 to 3 policies. I mean, if a hike were to happen, I think the last quarter of the financial year is the earliest time it will happen.
Okay, yeah. And I think Reserve Bank has made it very clear that because of global rates, they are not going to, I mean, inflation will be the only reason they will be guiding, that will guide MPC and not global moves, right? So we don't have to worry even if there is a Fed rate hike.
Absolutely.
Okay.
I think the fact that, they have given this subsidy scheme, I mean, is the way, let me take an example of Indonesia, for instance. I mean, they hiked rates by 100 basis points. I mean, RBI has taken a call that, the monetary policy will be based on the growth inflation dynamics, and we'll do other things for BOP. And the FCNR and the ECB's deposit scheme subsidy is the way, they are looking to tackle this problem.
Oh, certainly. They have walked the talk on that. No two ways about it. Now, let's come to yields itself. And like I said in the introduction, we saw it go all the way to 6.68. This is even before the flood of money has come in. Once that liquidity rushes, what is your expectation of yields?
So I think broadly we have a range of 665 to 685. I think market got a bit of a reality check in the last few days. I mean, finally, it was a memorandum of understanding, and market, took it as, that as if the peace has already happened. So I think the crude might, move in a $75, $80 range in the near term. I mean, some uncertainty premium will get built up, but I think the upside on yields is kind of capped. And I think there are a few factors to that. I mean, one that, the market earlier was assuming that, the tail risk of crude oil prices going above $100 and staying there has gone away. Secondly, RBI has told us that, we'll make monetary policy as per growth inflation. So, the tail risk of, RBI using interest rates to defend the currency has also gone away. And I think the third and most important factor in the near term is the tax changes which have happened on GSEC. I think they have had a tremendous impact on the demand for government securities. I mean, the demand supply balance has kind of moved in a positive direction. And, we were looking only at the withholding tax and thinking that that will be the big one. But, by doing both withholding tax and capital gains, RBI has really eased the way FPIs operate. Because, earlier, if you were selling a bond, you had to take a tax certificate, which could take, 2 or 3 days. And remitting the money, especially for open-ended mutual funds, would get delayed. So by doing this, I mean, the tax is completely out and you can, bring in and take out money very easily. Plus the market access has improved in the form of the ETPs coming in. So I think all the enabling conditions have come in and it also paves the way for a Bloomberg inclusion. So I think the fundamental change, and we have seen this, I mean, right, that we have got about 60,000 crores of inflows, since the policy announcement. And incidentally, that is more than the outflows which we have seen on the equity side. So, from that perspective, also, it is a bit supportive for the rupee.
Oh,
so
yes.
I think, I mean, the upside to yields is now capped. I think 685 is in the near term, looks like, the top and coming from, 710, 715 levels, which we had, in May, I think we have come a long way.
I'm glad you said that it was actually the debt market which rescued the equity market, in the sense, made up for the losses in the equity market. A very quick last question. What are you expecting by way of liquidity steps or liquidity, absorption steps from the Reserve Bank when this huge amount of money comes in as expected in September?
So, if one were to look at the liquidity projections, I mean, our sense is that in September, we'll see a slightly larger surplus. I mean, the liquidity surplus will start, moving up to 4 to 5 trillion. I mean, we have to remember that in this quarter, you don't get any outflows from currency leakage also. And, when that liquidity flows in, the system liquidity surplus will move to 4 to 5 trillion. Now, having said that, I mean, in the second half, when the currency leakage actually happens, it will take away all this liquidity. So I think the ideal thing for RBI to do would be to, do very short-term steps. Things like VRRR auctions to absorb the short-term liquidity and ensure that the overnight rate stays around the, repo rate. But, having said that, I think RBI might also consider, OMO as an option. Okay. I mean, if bond yields start coming down too much, because, finally, the success of FCNR also depends on where the local yields are. I mean, if the local yields keep falling too much, that will impact the mobilization. So I think it's a tricky balance. RBI will have to, kind of fine-tune it in that sense.
Fair point. They have to manage both rupee and yields for the FCNR's success. Thank you very much, Shailendra, for a very comprehensive analysis of the rupee and the rates market. Out of time, wrap up on Bazaar, Chartbusters after the break.
TCS kicks off Friday on a strong note after an in-line first quarter performance. While the IT bellwether offers little signal of a broader recovery, deal wins remain robust at just around $10 billion. Brokerages are split. JP Morgan says overweight, while Morgan Stanley retains an equal weight rating, citing limited re-rating upside.
AI optimism lifts stocks. TCS CEO K. Krithivasan highlights improving AI-like productivity and expects AI to spur several new projects. HCL Tech and Infosys advance, with the Nifty IT index remaining solidly in positive territory despite pulling back from the day's high.
The centre greenlights the long-pending joint venture between Dixon Tech and Vivo. Approval removes a key regulatory overhang. The company guides for a 30,000 crore boost to the top line. Brokerages Motilal Oswal, JP Morgan, UBS, CLSA, all are upbeat on the counter. In fact, we'll continue this discussion. Renu Beth Pugalia of IIFL Institutional Equities will join us in just a bit.
Shares of Blue Jet Healthcare climb in early trade. The company closes a QIP successfully, raises over 800 crore rupees. 1.58 crore shares issued to QIPs at 506 rupees a share. Some of the interesting investors include Shamak Investment of Nimesh Shah fame and ICICI Prudential Mutual Fund among key allottees.
Apollo Microsystems is higher by about 3% as it secured 41% stake in Premier Explosives with an all-cash deal worth 1550 crore rupees. The transaction expected to be completed by the end of this year. Apollo additionally has also launched an open offer to acquire up to 26% stake from the public shareholders at 698 rupees a share, which is lower than the previous close of Premier Explosive. Explains why that stock is down by about 2.5%. It's a good start to the Friday. You're watching us here on Chartbusters. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Mangalam Malu, and today with me is Vivek Iyer. Vivek, welcome to Chartbusters, and the markets are welcoming you with a bang. A 200-point uptick is what we're seeing on the Nifty, 700 points on the mid-cap index. The Nifty Bank up 685 points as well. So good going so far.
Good going so far. Good morning, Mangalam. And I know we've kicked off the earnings season on a very strong note. TCS positively surprising, especially in terms of the reaction, in line with some positive commentary coming in as far as AI-led gains is concerned. That's led to a bit of a bounce as far as the entire Nifty IT space is concerned. But the market is moving higher, and it's a good time to welcome Manish Hathiramani for a quick technical check. Good morning, Manish. Thank you so much for joining us. Well, Nifty up almost 1%. Do you see further upside from current levels?
Good morning, Mangalam and Vivek. Thank you so much for having me on the show. Well, the Nifty has taken support around the 23,800 levels, and that's where we've bounced from. My concern on the downside would be if we break this 23,800 on a closing basis. If that were to happen, I'm of the opinion that we can slide further to 23,300. Until that does not happen, I would continue be looking for buy setups on the charts. If we can move up from here, the index can scale up to 24,700, 24,800.
All right, 24,700, 24,800. What was the upside level, did you say, if it continues to hold?
If we move up from the current levels and we do not break the levels of 23,800, then I would expect 24,700, 24,800.
All right, do you have a call on the Nifty Bank, which has been consistently above the 200-day moving average yesterday as well? Closed at that level. So if you could give us a sense on the Nifty Bank and even the IT index, that's been doing extremely well.
So with the Bank Nifty, Mangalam, 57,400 is a key level to watch out for, again on a closing basis. A break of this could take us down to 56,800. The upside is currently capped, but however, if we are moving up from the current levels, I feel we can go up to levels closer to 60,000.
Okay, Manish, lastly, what are your top calls for the day?
I'm working with two buy calls. My first one is on Bharti Airtel, which is for a target of 1980, stop loss of 1855. From a sideways price action, the stock is now broken out on the upside. If we can sustain above 1950 on a closing basis, this stock can go up to 2050. The second is on Ultratech, which is for a target of 12,200, stop loss of 11,250. The stock is in a positive trend, but it had corrected over the last couple of days. We have crossed a short-term resistance of 11,600, and that is what is allowing us to continue the upward journey.
All right, take that point. Thanks a lot for joining in, Manish. Good luck. With that, we'll take a short break, come back on the other side. We discuss the IT space. In fact, we have Rajan Sethuraman of Latent View Analytics to discuss their AI transformation, implementation and partnership with Claude, and more importantly, business prospects going forward. Welcome back. You're watching us here on Chartbusters. Looking good for the market. Let's continue our conversation. Then we welcome a corporate, Latent View Analytics, now a consulting partner for enterprises looking to deploy Claude. And you have, the company having marked a foray into AI transformation from just being an analytics company. Rajan Sethuraman, who's the CEO of the company, joins in to discuss this and more. Rajan, thanks a lot for joining in. Obviously, we had to evolve given the sort of conversations that have been taking place around artificial intelligence, and companies like yourself would obviously partner with some of the AI companies globally, and Claude is one of the leaders out there as well. Just wanted to understand the commercial considerations for this transaction, and secondly, are you the exclusive deployer of Claude in India? Because I'm sure Claude would be talking to a lot of other players like you as well.
Yeah, no, good morning, and thanks for having me on the show. So first off, I just want to set the record straight that it's not that we have not been doing AI work. I mean, ever since our inception 20 years back, there's a lot of traditional AI and ML work that we have been doing. In the last 3 years, ever since the Gen AI revolution, there's a lot of work happening on Gen AI and agentic AI as well. So the partnership with Claude, Anthropic is really with the objective of furthering the work that is happening right in the generative AI and the agentic space. In the last year, when we took stock of the work that we have done, we saw that over half the work had involved AI in some form or the other, either traditional or generative or agentic. And about 28% of the work was client-facing work, where we built solutions which were very AI native and that clients could feel and play with right in their hands. The rest of the work was using AI more for driving our own efficiency.
We understand that. We understand that. We understand your journey as well. But on this particular thing, because the markets are such and the environment is such that any partnership with any company will have the street fairly excited, right? So I just wanted you to set the record on, one, the commercial considerations of this, and secondly, whether this is exclusive or not.
So this is not an exclusive partnership by no means, just like how any other large SaaS player or ERP company would have multiple partnerships. Anthropic also will have multiple partnerships with several systems integration firms and other companies, product companies including. So we are a services partner right here. So the objective is to bring all the capabilities of Anthropic, whether it is Cloud Code, Cloud Cowork, all of the new plugins and tools to the enterprise context. So that's the goal here. Commercially, we are expecting that this will really kick up revenues for both LatenView as well as for Anthropic. That is the intention with which Anthropic
Rajan, so we understand that this adds to the list of services, it adds to the suite of services that you're already providing. So that's a positive development there. In terms of the opportunity, give out and quantify the TAM, after adding this particular capability to your own company. What is the kind of companies that you're talking to? What is the kind of clients that you're talking to? Is it mainly upselling of existing client services, or are you also looking to onboard new client services? And where are discussions at currently?
Yeah. So it's too early to say whether there is an overall expansion of the TAM and the addressable pie, though that is the premise on which most of the organizations are looking at, meaning that as the cost of AI and LLMs and the underlying Gen AI and agentic capabilities become cheaper, companies will spend more money in ensuring that they are bringing all of these capabilities to stay competitive and surge ahead. So the expectation is that the pie will expand and therefore we will also grow along with it. At this time, there are projects that we are executing which are completely AI native. For example, we've been working with a consumer products company where the entire price and promotion optimization space has been built using an agentic AI native solution. Similarly, we are also working in areas where data engineering and capabilities related to model building can be significantly enhanced and enabled by the agentic solutions that we are building. The expectation is that pretty much the entire broad spectrum of work that we do, whether it is marketing, customer analytics, or supply chain, or even fraud and compliance related analytics work, all of that will benefit from the new AI infusion, especially the agentic solutions and models that we are building. So the hope is that the TAM will grow, that there will be greater penetration of AI into most of the work, right? And that's what companies will benefit from as well.
Got that. Take that point. Last year you grew on a dollar basis by about 20%. This year you've guided for about 18 to 20% growth as well. How has the first quarter gone so far without you getting into numbers and getting into any sort of regulatory hurdles? If you could qualitatively tell us whether you're on track for the guidance that you had given at the start of the financial year after the end of the first quarter.
Yeah, as you pointed out, we are in the silent zone, so I can't give numbers. I think at the start of the quarter, we had guided that we would want to get to the 20% mark, but we had confidence and comfort for a 12-13% number. I mean, that is playing out at this point in time. Obviously, we'll be able to share more when the quarterly results are pronounced. There are pockets where there is a very strong traction, and there are pockets where we are still expecting that the engine will rev up.
Well, Rajan, you spoke about the top line growth. Mid of last year, you did see a certain amount of margin contraction, and you had actually guided for a low margin while increasing the top end of your revenue guidance. So now going into FY27, what is the kind of steady state EBITDA margins we can expect?
So the margin guidance continues to remain what we had indicated at the start of the year. I think last year we did between 20 to 23%. This year we said that it will be a tad lower, given the investments that are going into the AI aspects, right, in terms of building capabilities and solutions. So 21-22% is what we had guided at that time.
And one last question, the Decision Point acquisition, has there been a delay there? What is the reason for that, and when do you expect to close it?
There's no delay in the closure of the acquisition itself from an integration standpoint. There is a bit of a dispute in terms of the earnout that needs to be paid. So that is something that is currently it's in discussions. So we are expecting that will close out soon as well. But otherwise, all efforts in terms of integrating the work that we do along with the work that they do and taking a combined suite of capabilities, that's been on for several quarters now, and we continue to accelerate that.
All right, Rajan, thank you so much for joining in. Wish you good luck and hope to speak to you post your numbers as well. By then, you'll have more liberty to speak about what you're looking forward to in terms of business performance and quantify that as well. We'll take a short break, but don't go anywhere because on the other side, we have an important discussion lined up on Dixon Technologies. Renu Vaid Pugalia of IIFL Institutional Equities joins in.
Welcome back to Chartbusters. Well, Dixon Technologies has finally received the government approval for its smartphone manufacturing JV with Vivo. Renu Pugalia, Senior Vice President of Research at IIFL Institutional Equities, joins us now. Well, Renu, thank you so much for joining us. I'm sure you're relieved that you won't be asked this particular question of will they, won't they any longer. Break down the economics for us. How does Dixon benefit?
Well, definitely, I think they have been preparing themselves to strengthen their presence in the mobile EMS and the portfolio segment. So Vivo coming on board definitely assures a given market share-based volume of business to them, which should on a steady-state basis should be 20 million plus units. And the kind of backward integration investments that they're doing on the camera modules, display modules, those benefits as they accrue from next financial year, they will benefit with the volume and scale of Vivo which comes on board.
So on your estimates, were you penciling this in, or now you will change your estimates because of this?
So we had penciled in 1 quarter of benefits coming in from the Vivo JV for this financial year, which should technically have some upgrade because we have 6 months to go. So the benefit could actually accrue for almost 5 to 6 months. And same thing would be, at least for next financial year, we had a forecasted slightly softer volume. And the entire 20 million units could accrue to them. This is where we see there should be about 15% plus upgrade to our earnings forecast as we look for next year.
So have you released the note? I mean, have you made the changes already? And what does that reflect in your, updated EPS and valuation estimates?
No, the published note is yet to be released, so that we will be able to share by Monday.
All right, but roughly what's the kind of range that you're looking at in terms of upgrades, EPS upgrades?
So indicatively, as I mentioned, a 10 to 15% upgrade is what we are looking at.
Okay. The other question, especially when it comes to Dixon as well as other EMS players, has been a bit of a worry as far as memory prices or DRAM prices are concerned. EBITDA margins, do you expect it to be moderated further lower, or do players like Dixon actually have the capability to go ahead and increase prices?
In a contract manufacturing business, you work on fixed conversion cost and price per unit basis. So the increase in the memory module prices, etc., really doesn't impact their EBITDA per unit. What it optically impacts is the EBITDA margins as your realizations or revenues go up. So technically, there's no impact on the business. But more importantly, as a business portfolio, current financial year, we see almost 30 to 40 basis point impact from absence of the PLI incentives. Okay. Since the PLI 2.0 for mobile phones is not yet announced, which also we think should get partially addressed as we come towards the end of the year. More so in fiscal 28 as the benefits of backward integration and the ECMS benefits flow through to the company. So yes, for this financial year, there'll be more of a transient impact on margins because of absence of the PLI 1.0, which they were enjoying until the last fiscal year.
How do you view the stock price move in context of the EPS upgrades that are likely to come by? Because, in anticipation of this, we've already seen it move higher from lows. In fact, the last month itself, it's up around 20%.
Correct. So I think the market has already discounted this development, and I think most investors, analysts might be fully or partially baking in the benefit from the Vivo JV in their estimates forecast. Management base guidance had excluded Vivo numbers in the last quarter, but otherwise they were also indicating a 60 million units on a steady-state basis once the Vivo JV volumes come through. So to that extent, I think the market is already pricing in it partially.
Yeah, that's why the stocks come off highs as well and from lows. In fact, in the last 3 months, the chart comes up for you on the screen. It's up around 27, 28%. So like Renu said, it's probably been discounted.
Renu, 2 questions. One on the competitive intensity within the mobile phone space, and within the EMS basket, what is your pecking order?
Well, within the mobile phone segment, government has been pushing for domestic manufacturer, domestic EMS companies picking up, which is where we saw after Dixon, while other players like Bhagwati, Micromax picking up relationship with Chinese OEMs like Xiaomi, and Amber also recently had their tie-up on a subleasing basis with Oppo being announced. So clearly, domestic EMS companies are now slowly gradually up the curve in terms of smartphone assemblies, where we think Dixon clearly has a significant lead versus peers. It's been almost 5 years they have been there in this market, and now they are much more getting deeper into component ecosystem. So they are at least 2 years ahead of any of the other peers catching up in terms of backward integration and the value add that they do to the mobile phone segment. But yes, on the OEM and assembly business, market will get competitive and margins will thin out. So the players who are integrated on the backward side and companies who have exposure on the export portfolio of mobile phones, smartphones, will benefit. And this is where we think Dixon should still be in a sweet spot as far as these two things are concerned. And overall on the EMS space, our view is market has been competitive. Valuations which were pretty stretched until 6 months back have corrected, looking at moderation in growth and some near-term headwinds across different EMS names, whether it was Dixon, Keynes. But we think these concerns are already there in the price. We've seen Dixon getting re-rated in the last couple of months around news flows of business volumes picking up and cost headwinds easing out. Same would be the case with Keynes in our view. I think most of the headwinds on growth are already priced in. And as we move ahead, if we see the company delivering 35-40% core EMS revenue growth, and some of the concerns which were related to the Istrameco receivables, if they get eased out, company has been looking at various options to address this, including a potential option to even knock off this business back again. So if any of those developments mature in the next quarter or two, we see even that name stacking up well in terms of valuations. Stock has corrected almost 40% plus from its peak levels. So clearly we see there are tailwinds for valuations re-rating and growth in some of these two notable players, both Dixon as well as Keynes in the segment.
All right, take that point, Renu. Thank you so much for joining in and giving us your view on this development and the space at large. As we move towards the close of the show, just keep an eye out on a few of these stocks. Shoppers Stop has seen a big surge, and most of the gains coming by in just the last 15 minutes or so. The Nifty is at the higher end of today's trading range, 12% up move on Shoppers Stop, backed by decent volumes as well. So it turns out that this move has actually taken the stock positive for the month, and if it continues for 1.5%, it will turn positive for the year as well. And we also have some traction on the defense names, which is coming by. So Cochin Shipyard has seen a spike. Alongside that, we have Hindustan Aeronautics. That's the one which has moved to the high point of trade as well. The defense index up for you on the screen at the high point for that one. We'll wrap up on this edition of Chartbusters on that note from Vivek May. Thank you so much for watching. Stay tuned. Trading Hour comes up next.
Good morning, you're watching Trading Hour. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I am Hormas Fatakia and with me is Ritu Singh. Ritu, good morning to you. The market's looking to end the week on a positive note, although we are still down for the week, but it's a good start to the trading day. 24,200 is where the Nifty has been for a better part of the first couple of hours now. And the banks and the IT stocks are the ones that are doing the heavy lifting. Of course, still a significant distance away from the recent highs of 24,530, but for the fact that we A, managed to defend 23,800 on the downside, and B, the fact that we are managing to sustain above the mark of 24,000 is something that will give the bulls a lot of comfort. Ritu.
Yes, lots of comfort, Hormaz, and good morning to you. The Nifty, yes, down for the week by about 0.3%. So, despite that, I mean, like you said, holding up comfortably above that 24,000 mark. In fact, above 24,200 as we speak. The Bank Nifty also very close to the 5,800 mark. For now, 57,967 is where it's at. So these are some of the key levels we will keep our eye out on. But the market breadth shows you, I mean, you have almost, 2,319 stocks that are in the green compared to about 640 odd stocks that are in the red on the National Stock Exchange. The IT pack doing pretty well in trade today. In fact, it's green across the screen. The broader markets are doing well. The FMCG pack is doing well in trade today. The metal pack, top gainer in trade, real estate, media, all of that in the green. So looking pretty good for the trade setup today. The heavyweights also pulling their weight. Reliance, ICICI Bank, HDFC, all adding to the gains on the frontline index. But as always, let's focus on the key movers and shakers to keep our eye out on. And Hormaz is on standing by to give us that list.
The second straight day where we are seeing some bit of recovery from lower levels, while yesterday's move was very unconvincing considering the fact that we could not sustain at higher levels. The good part is we have broken above yesterday's high and we are sustaining above that, at least as of now. So the index now at 24,200, 240 points higher. The bulls would hope even if they end the session at this level, they'll be fairly okay with that as the earnings season picks up pace starting today itself. The banks are the ones that are doing the heavy lifting though, and while the Nifty is still some distance away from turning positive for the week, the Nifty Bank is already turned positive for the week. So it's good going for the banking stocks. They are the ones that are doing the heavy lifting. 700 points higher on the Nifty Bank, back near the mark of 58,000, and that is something that will please the bulls even more. You take a look at the two levels that you need to watch on the Nifty and the Nifty Bank for a positive close for the week. 24,270 is the level for the Nifty, so we are still around 70 points away from those levels. And for the Nifty Bank, it's 57,938, so we are 40 points higher in comparison to last Friday's close. So the Nifty Bank, after that 1,600 point fall that you saw after President Trump's remarks earlier in the week, recovered all of those losses and has now turned positive for the week as well. Now take a look at the result impact of the day was TCS. That was the one in which has moved the entire IT space along with it. Of course, at one point the stock was up 4%, but has given up most of its gains since then, still up 1% as of now. The analyst commentary too has been cautiously optimistic, if not better. But not for TCS, the mid-cap IT space is the one that is buzzing and buzzing with very, very strong moves. Newgen Software is now up 11%, Zensar is up 10%, Birla Soft is up 4.5%, and Sonata Software too is having a good day at the office. Both Newgen and Zensar are the top two gainers on the Nifty 500 today. Heavyweight banks, as Ritu highlighted, are putting their hand up today, while HDFC Bank is not featuring in the list of top gainers, but ICICI Bank is 1.5% higher today as well. Axis Bank is up 1.5%, but RBL Bank is the one that's doing well, and Bandhan Bank doing even better, gains of anywhere between 4 to 5.5% in these mid-tier banks. Look at the newsmakers today. Dr. Reddys was down 6% yesterday. It's extending its losses down another 1.5%, but the actual choppy move has come in one source. That at the start of trade, the stock was down around 7% and then has seen a sharp recovery from the lows. So that's still down around 2%. Blue Jet Healthcare after the QIP closure is up 5.5%, and CDSL, a positive brokerage note coming in earlier in the day, 5.5% higher today as well. But the one stock that has stood out this week has been Kalyan Jewellers, another 6% higher today, 35% higher in the last 3 sessions, and 25% higher for the week. It's going to be the best week on record for the stock. And lastly, stocks at 52-week highs. Anand Rathi Wealth, of course, is a result reaction, 3% higher in today's session. Oracle Financial, the only Nifty IT stock that is trading with gains on a year-to-date basis, that is at a 52-week high, another 3.5% today. And J&K Bank too is at a 52-week high in today's session. Ritu.
Thanks very much, Hormas, for running us through that list. But let's put the focus back on the IT pack. That sector is very much in focus today, up almost 2% in trade. And that is on the back of the TCS results. And more than the results, the commentary coming in for the second quarter that has perked up all of the other IT stocks on the street. So let's go across to Rima to get us more details on this one. Rima.
Thanks so much for that. Let me begin with what sparked the rally in TCS post the numbers. Well, expectations were low, expectations were lowered, and the company managed to deliver on all fronts. The company's revenue growth came in at 0.4%, slightly ahead of flat growth estimates, and the management said they're positive about Q2 and FY27 should be better than FY26. The deal wins were steady at $9.5 billion, and analysts believe that the company is on track to deliver a 2.5% to 3% revenue growth in FY27, at par with peers like in Infosys and HCL Tech, and this comes after 2 or 3 years of underperformance. So the fact that it's catching up to the industry is also seen positively, and the AI piece of the business for TCS is growing. It now constitutes nearly 9% of the overall revenues, $2.6 billion of annualized AI revenues, growing at 13.6% quarter on quarter. As you rightly pointed out, the TCS sentiment is rubbing off on the rest of the sector as well. And IT is actually in the last couple of days done well. 1st of July was when it hit a 52-week low, and since then it's rallied about 6-7%. But to keep the rally in context, the rebound, it's down 27% year to date, and most large cap IT companies are trading at 13-14 times valuation multiples, closer to 10-year lows. But I must point out that while the company has delivered on near-term expectations, Q1, Q2, we still don't have clarity on what the longer-term picture is going to look like. When will the new revenues from AI, the new volumes, incremental revenue volumes coming in from AI, offset the deflation seen on account of AI? The brokerage view is more positive, but you would still call it mixed. On one hand, you've got JP Morgan, and they say that we don't think the business model is broken. They believe the company can defend earnings from year on, and there are a lot of valuation metrics which look positive to JP Morgan. Dividend yield, highest in the last 10 years. PE multiple at 2 standard deviations below the 5-year average. Free cash flow yield, highest in the last 8 years, ex of COVID, which is why they've got an overweight rating on JP Morgan. But Citi is not convinced. He's like, we still don't know what the fair valuation multiple of TCS is going to look like, or the industry sluggish growth continues. They, in fact, lowered the valuation multiple even further to 12 times, and they've got a sell call on the stock. Back to you.
Rima, thank you for that update there. Earlier we did speak, and Rima in fact did speak to the management of TCS as well on the strategy, enterprise adoption trends, and how it is building new AI-led capabilities. The management also spoke about the growing partnerships with the leading AI players and its approach to capability-led acquisitions. Take a look.
The last year or so, we have changed how we deliver with AI, right? And we said that we have a new playbook called Innovate with AI, Build with Scale with AI. It's about doing rapid execution with a team. We called it a rapid build squad. We can call it FDE, but the FDE term again is getting redefined, and we will invest. We already have some FDEs, but we will come up with our own definition of FDE. We will scale, and we will target a large number of FDEs who will be cross-skilled from our people who have the contextual knowledge and the technology expertise. Plus, we'll also hire from the market. So we will be building these competencies. These are important, but I think this is becoming part of customer conversations more recently. But we have been delivering in similar models over the last 1 year.
But have any of these companies come up when you're bidding for new deals? Are they coming up as competitors? Sorry, just to close. Not yet?
I have not seen that.
You haven't seen anything. Yet. Okay. What about
they're also looking, they're also talking to us for partnerships, right? Yeah. Whether it's the hyperscalers or the frontier model companies.
We don't look at them as competition.
So, and those are some of the deals that we have signed, because they are looking at scaling within enterprises, and we have our foothold within the enterprises.
Enterprise plumbing stays with system integrators. Absolutely. You're not sharing that with these companies. Okay. Yes. What about Q2, FY27 now, Kriti? How will you characterize what's coming? Because H2 is typically weak, so the burden of expectations to deliver in FY27 falls now on Q2.
See, overall, still I would say Q2 is positive, but at the same time, things been quite volatile in terms of whether H1 is better than H2. Okay, that I don't want to say H2 will be weaker than H1. Okay, but we are quite positive on Q2.
Okay, and FY27, if you have to characterize it?
Last quarter also said it will be better than 26. I still stick by that. It will be better than 26.
Just one question on acquisitions. We've seen you've done acquisitions. Industry, a lot of companies are going out there acquiring. Will we see more from TCS? I think the answer, Samir, was yes last time we sat down.
We are actively looking for, and last time also we spoke. Wherever there is an opportunity to quickly scale our capability and competency. In the scale,
a bit of urgency now. I mean, the pace has picked up. I'm not talking about TCS, but across the industry.
Urgency to acquire the right skills. Like we are not running, trying to grab something for the sake of revenue. We'll never do it for top line. We'll do it for capability.
Sure. Just one last question from my side. Is there you use the word AI washing? Not from the context. I don't want to ask you whether there's a lot of it going on with regards to what is being reported as AI revenues, but a consultant I was talking to said that a lot of companies, especially when they're public, they have to have an AI strategy. Otherwise, I mean, there's a fair bit of that FOMO feeling across the board. Is that something which you out there see as well, or is all real? One of the things we heard early on is that there's a big gap between how fast models are going and enterprise adoption, right? So
no, there is I think Aarti talked about it just now. See, adoption is lagging, and we know that usually what they say is technology evolves exponentially. Enterprises adopt them linearly. So sometimes there will be a gap, and that is to be expected. And every enterprise today has an AI strategy in a genuine way, because I don't think any company doubts the power of AI or the value AI brings in. So I don't think there is people are trying to be just putting a lipstick on this thing. This is a very serious conviction every organization has, that they have to have a strategy. And there is a lag in between what the technology can do.
That's where you guys come in terms of closing that gap.
Prashant, we speak to a number of CEOs and CXOs, right? So I think Kriti is absolutely right. The promise and the potential, everybody has bought into it. But enterprises are going to be pragmatic in terms of the speed of execution, and and they will calibrate, and that's what we see happening.
All right, that is the TCS management, and we'll keep getting you snippets through the day. But for now, let's step into a break. When we return, the management of Paras Defense is waiting by. We're going to talk to them about the order book, tapping into the drone ecosystem in India, margins, revenue targets, all of that. So stay tuned.
Welcome back. And the Defence Acquisition Council now has cleared proposals worth 52,000 crore rupees, and Paras Defence is among the expected beneficiaries of this. Now, separately, the company has also signed an IP license with Georgia-based Tandem Defence for a counter-drone interceptor systems. Joining now to discuss more on this and the road ahead for the company is Amit Mahajan, the Director of Technical and R&D at Paras Defence. Amit, good morning. Thank you for taking out time. The 3 points that we want to focus on in today's conversation, of course, is your outlook on the order pipeline, the counter drone system opportunity, and of course your margin outlook along with the top line guidance for the full year as well. But before I get to that, the big point has been the fact that the DAC's recent approval, right, the 52,000 crore approval that they have given, that also includes an approval for the fixed wing high altitude pseudo satellites. Are you expecting to participate in this order? And if so, what is the contribution that you will have in a project like this?
So firstly, thank you for having me on the show. I also want to give you a disclaimer that we are in silent period, so I won't be able to talk about specific numbers. But yes, about when we're talking about pseudo satellites and we're talking about satellites which will have anything to do with imagery, Paras Defense will contribute largely to it. Now, when we began our journey in the space arena, we started off doing optical components for the Space Research Organization. And then subsequently, we are nurtured today to do a complete system. So our value add or our value into a program like this will involve into a smaller component like an optical lens to a complete optical payload which can go up in the space. So that's the scale of opportunity we are looking at.
Amit, hi, this is Ritu. Any number you could put on that opportunity? And secondly, also the counter-drone opportunity. That's the other one we wanted to talk to you about. You've secured these exclusive rights for manufacturing and commercializing the Guardian 1 counter-drone interceptor technology. How large is the market in India? Have you already started trials with, any of the government agencies? What's the status there as well?
Let me first answer your first question. The opportunity size in space, whatever we see as a 52,000 crore surveillance satellites and all of that, this is great, but I feel this is recurring in nature and there is no way we can put a finite number to it. Our space situational awareness requirements and needs are compounding by every week. And whatever we try and do right now, we will always have a big opportunity lying ahead of us. So I don't want to put a figure because it will only look conservative. So that is that. Now, when it comes to counter-drone strategies, now when we started Paras Anti-Drone as our counter-drone subsidiary, the landscape then and the landscape today, this is a big, big change. And we have to adapt. We being a tech-based company, we need to be making sure that we are adapting to the changes that are happening on the war front. So when you look at our solutions, they started off being soft kill. Then we also are developing laser-based air defense system, and we are developing laser-based anti-drone systems. And now going forward, what we see today is one of the most important counter-drone strategies is to have an interceptor drone. Now we are also getting into that. The market for this, again, it becomes a consumable. You're not going to use bigger, larger systems to get down the smaller hostile drones, but you're going to use interceptor drones, which are relatively much, much cheaper, and they run in quantities. The quantities are going to be in thousands and lakhs. So the opportunity size is huge. And for our air defense and our anti-drone layered mechanism, this is a very, very vital technology that we want to bring to the country.
Your order book mix as of now is a 55, 35, 10, the anti-drone, the optics and optronic systems, with the counter-drone system that you are talking about as well, and the interceptor drones as well. Does that increase in FY27, say to 15%, maybe even 20% going forward?
See, you have to understand that today the defense is no more restricted, or rather the dependency of defense technology is not on larger platforms, but it's moving to very, very agile platforms such as drones. So we have to make sure that we build technologies which are adapting to the latest or the futuristic platforms that we're going to see in the war game. Now, if you look at how we are basing like interceptor drone, like drone cameras, we are preparing ourselves to make sure that we are relevant not just on tanks and submarines and ships and border defense, but we are also relevant for drone as a platform and also countering that. So whatever counter drone percentages that you see, they will only solidify and increase from here on.
Amit, two-part question. One is going ahead on future partnerships. Will we see more such technology licensing or strategic partnerships? What's in the pipeline? And secondly, and more interestingly, we've seen this recent deal being announced with Apollo Micro looking to acquire stake in Premier Explosives. Something like that on the radar for you? Are you looking at any kind of inorganic opportunities as you look to scale and tap into this large market?
See, Paras has a very, very rich pool of development in-house of cutting-edge technology. So we would always bank on this first. Yes, we are very, very open to cutting-edge technologies and partnerships where we can bring technologies and reduce time to market. So here we are open for partnering with global companies to make sure that our country is self-reliant in critical technologies. But we do not believe that there is a scope or we should indulge into something like an inorganic growth right now. We are very, very happy with the way the industry is panning out. The reforms are coming onto the ground and creating big opportunities for companies like us. And the growth that we are looking at is already very handsome, and we don't want inorganic opportunities at all.
Very quickly, Amit, since we are running out of time, last time we spoke, you had mentioned that you would be growing 30% this year compared to 40 to 50% that you had earlier projected. Not asking you for a specific number, but based on the quarter that has been that you have had and the kind of opportunities that you are seeing on the horizon, do you believe that FY27 will be a better number than what you had earlier projected?
See, whatever the results come out of this quarter, good or bad, whatever it is, I would like to mention that a defense company should always be looked at from a yearly perspective. And I'm telling you that the opportunity for the company in the coming year and the next 2 years to come is going to be huge. Whatever guidance we would have given in the past is only conservative.
Amit, pleasure having you today. Thank you so much for sparing time and joining us. Wish you good luck for the rest of the year and hope to speak to you again after your quarterly results as well. Take a short break. On the other side, Ajit Mishra from Religare joins in with some trading ideas and a quick chart check as well. Stay tuned.
Welcome back. You're watching Trading Hour. Now, mutual funds are emerging as one of the biggest pillars of India's primary market. With steady SIP inflows and strong institutional demand, domestic fund houses are taking a larger share of IPO allocations, even as foreign flows remain patchy. So the question now is, are mutual funds simply participating in the IPO boom, or are they becoming the force that's keeping it alive? Hormaz breaks it down for us.
Some very interesting data that Prime Database has come out with, and if you take a look at the numbers as well, if you the first half of 2026 so far has been fairly subdued in terms of IPO activity, and for obvious reasons, compared to the hyper activity that we saw in 2024 and in 2025. When you take a look at the record fundraise that you had in 2025, when you had around 1.75 lakh crore rupees raised through the IPO process, mutual funds had around about a 22% contribution to it, with that 37,833 crore number. This time around, in the first half of the year, we've raised close to 35,000 crore rupees, and this is inclusive of the SBI funds IPO that's going to open next week. So including that, we have raised down 35,000 crore rupees, and out of that, mutual funds have been fairly selective, bidding only for around 6,000 crore rupees in the 28 IPOs that we have completed so far. Now, in fact, out of the 28 IPOs, there are 9 of them where mutual funds have not bid at all. They have not bid or not participated, and 9 of them they have stayed away from. And what could be the possible reason? Well, size could be one of those reasons, because all the 9 IPOs that the mutual funds have not bid for is either between 150 crore to 400 crore rupees. It's not as if they have not bid for smaller IPOs. Yes, they have, but very selectively and in very small quantities as well. Now, what does the SEBI guideline says? The SEBI guideline says that up to 60% of the QIB category can be allocated to anchor investors, and within that, a third of it should be reserved for domestic mutual funds. Now, for the 28 IPOs that have been completed so far, based on that data from Prime Database, you'd realize that only 10 IPOs have managed to go past that 33% criteria, either 33% or more than that, either of that. Only 10 of them out of the 28. Of course, 9 of them saw no participation from the IPOs, and the other 9, of course, was lesser. Now, which have been their bigger bets? Now, Fractal Analytics is one. They've bet over 1,000 crore rupees in this IPO. The Coal India subsidiary, Central Mine Planning, that is the other one, 760 crores there as well. Pavarica, Sedmac, Amagi Media, investments of anywhere between 650 to 800 crore rupees in all of these issues. And for Pavarica and Sedmac, mutual funds were the big leaders here. 73 and 76% of the QIB portion was subscribed to by the mutual funds. Now, some of the IPOs that they stayed away from, of course, these are smaller IPOs. They may and may not have done well as well. Gaudium IVF, Shriram Twistex, Rajputana Stainless, Amirchand, Jagdish Kumar. There's some names, of course. There's some. They stayed away from 9 of them. But if you take a look at the 28 IPOs and who has led the bidding process, it's even Stevens so far. It's slightly in favor of the FPIs, 13 to 11 when it comes to mutual funds. But when it comes to performance, out of the 11 IPOs that the mutual funds have led in terms of subscription, 10 of them have delivered very strong returns. And the strongest among them has been Omnitech Engineering. That stock is up 133% from its issue price, and that was where mutual funds had bid significantly in that IPO, and FPIs had led the Gaudium IVF IPO, which is around about 51% higher in comparison to its issue price. So the mutual funds have remained selective, but the IPOs in which they have bid for have done fairly well, even though the activity has been fairly subdued in the first half. But the second half promises to be an action-packed one, considering the slew of mega IPOs that are lined up, including the NSE, Reliance Jio, and of course SBI funds that is lined up for next week. Well, the markets though have come off slightly from the highs of the day. 24,150 is where we currently are. Ajit Mishra from Religate Broking is now joining in for a quick chart check and some trading ideas as well. Ajit, good morning. Thank you for taking out time. Yet again, there is some supply that is emerging at higher levels for a market that did not was at 24,500 just 48 hours ago, is now struggling to hold on to 24,200. What are the key levels you're watching out for on the index, and your trading ideas as well for the morning?
Yeah, good morning, Hormaz. So yes, Hormaz, means we have seen the texture, changing of late after this sharp decline a couple of days ago. But at the same time, we are seeing that market is making attempt to recoup some of its losses. Means in case if we manage to hold this 24,150 mark, which is the 100 EMA mark, we shall be closing on a flattish note on the weekly basis. But as you rightly mentioned that we were very close to the previous swing highs, and we have reclaimed the major averages. So for any decisive up move, we need to again decisively cross and sustain above this 200 days, which is close to around 24,450. Otherwise, the sideways to like in a consolidation tone will continue in the markets. So index is likely to hover in this band broadly, 24,400 to 23,800 in the near future. But at the same time, like almost we are seeing that the key indices, banking is witnessing relatively higher strength. IT post TCS number is also showing recovery. And the best part is that the broader market is showing noticeable resilience. So keeping all that in mind, we feel that stock-specific approach is something that you should definitely focus on. Pharma is constantly doing well. So Glenmark from the pharma basket, wherein we see strength. So with stop at 2240, one can go long in Glenmark with 2420 as a target area. And then we have Anantraj, wherein we have seen like almost 1.5 year of consolidation ending. So 615 is what we are eyeing as a target area. So with stop at 558, one can accumulate Anantraj also.
Got that. Ajit, thanks very much for sharing those ideas and your top picks with us. Let's now go across to Manglam, who gets us the latest from the FNO space. Manglam.
Well, if you look at the market right now, it's doing extremely well. Across the board, there are gains. The Nifty is bouncing back. But more importantly, the broader markets, the portfolios are looking a lot better. So you have, for the second day running, the mid caps and the small caps actually outdoing what the frontline index has been doing. And that's something that we pointed out this morning as well. Importantly, the top contributors of the Nifty are the top weights of the Nifty as well. The Nifty Bank has bounced back from the 200-day moving average, a crucial support level. The Nifty IT index has done well, led by TCS's numbers and general optimism across the space. And we have Reliance. That stock too is higher by almost 1.7%. So that's also contributing to the cause of the frontline index. The other thing that's a positive is that we've seen the India VIX after a big spike that we saw day before yesterday. The skirmish news came by. The India VIX for 2 days is now lower. The only thing we'll watch out for is whether it goes below 12 or not, because every time it goes below 12, the market starts to factor in some sort of complacency. While the sentiment is good, the other part of the up move is also led by some of the call writers who've been caught on the wrong side. So they're covering their positions. 24,000 call and 24,050 call. Both of them saw a lot of writing in yesterday's trading session, but now those call writers have been caught on the wrong side, so they are covering their positions. And as that is happening, we've seen put writing come back as well. So 24,200 put and 24,150 put, both of them are fairly active in trade, telling you that the support for the market has moved higher as well. So while we're looking for complacency, signs of complacency in the India VIX, also look for signs of overheatedness in the Nifty PCR. The PCR is currently at 1.18, typically around 1.25 to 1.3 is where it starts to get overheated. So those are a couple of data points that I'll be monitoring on the way up. But on the way down, you look at the Nifty, the support is at the 100-day moving average, and we have the Nifty IT, which is facing resistance at the 50-day moving average. A lot of long positions added on Kalyan Jewellers, CDSL, and 197, which is Paytm.
Long moves in CDSL in today's session, 6% higher on the stock. Mangalam, thank you for that update from the FNO desk. Take a short break. Back with more on the other side. Stay tuned. Welcome back. Still around about 200 points higher on the index, but slightly off the highs of the day. But the much awaited news announcement that has finally come in is for Dixon Technologies, the partnership with Vivo India to establish a manufacturing JV. Upasana is here with more details on this. Upasana.
Well, the company gets the long-awaited government approval under PN3 for its JV with Vivo India. Now, both the companies have executed the JV agreement. Now, this approval certainly removes the regulatory overhang that has been going on since quite some time. And mind you that the JV was announced back in December 2024. Now, on the back of this JV, management has given certain guidance. It believes that the JV could lead to a revenue uplift for the company of nearly 30,000 crores with a higher average selling price compared to Dixon's current existing portfolio. Now, management had also guided that post the regulatory operations operations are likely to start after 60 to 90 days. So that is around H2 FY27, nearly around Q3 FY27. Now, Vivo has 35 million annual volumes in India, of which 67% will come to Dixon. That comes up to around 22 million. Now, management had also guided that FY27 revenue guidance of nearly about 56,000 and 32 to 33 volumes is what they are estimating ex-Vivo. So certainly a flat growth is what the management had guided for FY27, excluding the Vivo contribution. Now let us look at some of the brokerage view on the back of this update. Now Motilal has retained a buy with a revised target price of 16,100 per share. It estimates Vivo JV to contribute nearly 30 million volumes in FY27 and 17 million volumes in FY28. JP Morgan has also given an overweight rating with a target price of 16,700. It assumes Vivo to contribute nearly 11 million of mobile volumes in FY27 and 22 million in FY28 is what they are working with. UBS has given a buy rating with a target price of 13,700. CLSA has given an underperform rating with a target price of 10,400. It believes that the room for upgrade is limited now going forward, and most of this is already baked in the stock price. And lastly, coming to Phillip Capital, it certainly maintains its sell rating even now. So overall, a mixed review from the street is what we are seeing.
All right, Upasana, thanks very much for taking us through that long-awaited deal now finally done. For the markets, though, they're trending slightly lower. 24,161 is where we're at the frontline index. The bank Nifty staying at the levels it was at. The IT pack has seen some, bit of a downtrend there as well. But pull up a name like Zensar Tech and Kalyan Jewelers. These are names we've been telling you about since morning. In the last hour or so as well, they're, gaining on good volumes. Godrej Industries is another stock that's doing pretty well in the last hour trade, now up almost 4.5%. Zydus Wellness also doing pretty well. But on the flip side, Brigade Enterprises, seeing some losses in the last hour, still trading with gains of about 1.6%. Triveni Turbine, another name to keep an eye out on. We'll slip into a short break for now, but up next, we're going to discuss more on the market fundamentals with Varun Lochab of HDFC Securities. Stay tuned. Welcome back. You're watching Trading Hour. Let's bring in Varun Lochab of HDFC Securities for his views on the markets, market fundamentals, and a whole lot more. Varun, thanks very much for taking the time out and joining us here. Let's start with the IT pack. That seems to be the story of the day after that commentary coming in from TCS that perhaps the second quarter and FY27 overall will look better than the preceding quarter and the preceding year. And that seems to be rubbing off on all of these IT stocks today. The index, of course, is up this month, although still down 25-27% for the year. Going forward from here in the near term, what kind of an upside do you build in?
So see, on IT...
Pardon, if you're able to hear? Yeah.
Yeah, I can hear you. Yeah. So on IT, we are, constructive now. We turned positive around a couple of months back, and we have reduced our underweight, which we were running on the sector for last 2 years, and now it's a neutral. I think having said that, we believe that deflation is still very much there, and therefore FY20
seem to have a
7 will probably remain muted from an earnings perspective, but FY28 and FY29 is when, but valuations have become quite attractive, especially for the large caps, and therefore, we believe risk reward is favorable, and we are happy to add more, in the weakness in which has been there in the IT sector of late. So that's our.
We seem to have a bit of a patchy line with Varun. We get back to him in just a bit. We need to ask him about his views on the IT sector. By the way, since you are on that subject, Zensar was now up almost 13%. So good going for that one among the mid-cap IT space. That is the one that continues to do well. Kalyan Jewellers is the other one that has now extended its gains. That's now up 8% as we speak. So the best week on record for Kalyan Jewellers. That's turning out to be a good 3-day run that the stock has had. We'll get to touch base with Varun in just a bit. Since Varun, you're back with us, you mentioned that you'd be happy to add positions in IT, but what within IT are you planning on adding? Is it the larger names or the mid-sized names or the sector-specific ER&D companies?
Okay, we'll try and connect with Varun a tad later. We seem to be, not getting him on a clean line. But let's slip into a short break for now. We'll get you more on the macros when we return after this short break. Welcome back. We have Varun Locha back with us. Varun, you were telling us you've upgraded your view on the IT pack. You're now neutral, constructive on IT as well. Within the IT pack, where specifically are you placing your bets? And very quickly, your view on the financials as well. Banks versus NBFCs, private versus public. Where are you putting your money?
Yeah. So in the IT sector, our view is very stock specific, frankly. But broadly, in terms of space, ER&D, we don't like at this moment. We believe valuations are still on the higher side and growth won't be as strong. On the rest of the IT services, what we prefer are certain mid caps where the growth is going to be strong. Names like Emphasis, where even FY27 will see a strong high single digit to low double digit kind of a top line growth. And select large caps like both TCS and Infosys have now become attractive on valuation. So among the large cap, TCS and Infosys, and among mid caps, Emphasis is our topic in the IT sector. Coming to banks, financials overall, we believe earnings momentum will remain strong, based on our assessment for Q1 and even going into Q2. Loan growth remains steady, credit cost will remain healthy, and therefore, earnings growth for banks will look better this year, FY27. And in terms of preference, while earlier we preferred PSU banks, now we actually slightly prefer private sector banks over PSU banks, given the earnings momentum will be.
Varun, a lot of these EMS companies have received plenty of news flow over the last couple of days. So one, of course, with that customs duty relief as well on the import of display materials. That is one. The Dixon Vivo JV finally getting its approval as well. But for a company like Dixon, is this news already in the price? And B, whether beyond Dixon, are there other better opportunities within this EMS space, say for the likes of Amber or Sirma SGS or maybe even a Keynes?
Yeah, so in the EMS space, our positive view is on Sirma and Amber. So these two, we have a positive rating. Keynes and Dixon, we are remaining on the sidelines. Dixon, we like the business model, but we believe valuations are again starting to look full after the recent up move. So, preference is for Sirma and Amber.
And Varun, quickly in the capital market space, or some of these IPOs also lined up as well. Anything you like there?
Yeah, so capital markets, has been a strong space, and we have been fairly constructive on it for last 2 or 3 years. I think numbers are still going to be okay, but on exchanges, we believe valuations are looking slightly full now. So, we have taken some money off the table in our model portfolio on the exchanges side. AMCs is still okay. We believe they will continue to do reasonably well in the next 12 to 18 months. And brokerages, we only cover Angel One, where we have a positive view. So.
Varun, pleasure having you today. Well, so we caught you on a patchy line, but hope to interact with you once again and for a while longer. By the way, even as the index has cooled off slightly from the highs, real estate is one sector that is continuing to do well even today. So the real estate index is trading with gains in today's session as well. DLF is up 4%. Godrej Properties is up to or close to 3%. And Lodha is the one that is underperforming, the only stock that is trading lower in today's session. But of course, that's of course an adjustment with the divergence that was seen between the cash market rates and the futures market rates in yesterday's session. So today, some adjustments taking place there, 4% lower on Lodha. But India's love for gold is entering a new phase. The yellow metal is no longer just sitting idle in household lockers. It is increasingly being put to work. Now, as families unlock the value of their jewelry, the gold loan market has swelled to nearly 18.8 lakh crore rupees. Now, what is driving this surge? Who's leading the race? And why is this emerging as one of the fastest growing pockets in retail lending? Ritu will tell you all of that in today's macro signal. Well, Ritu, it does seem like gold is finally starting to glitter for a lot of these households.
It is, and a lot of those NBFC counters as well perking up in trade today. We had Digant Haria earlier today talking about how he likes some of these gold loan financiers as well. But yes, the market itself It's expanded to 18.8 lakh crores now, and that now accounts for 11% of our retail credit. Now, in the last 5 years, gold loans have grown at a remarkable 34% compounded rate, and that makes it one of the fastest growing segments in retail lending. The move, of course, has been fueled by that sharp rise in gold prices we've seen, but then the street also believes it's also being driven by greater consumer acceptance of gold loans as a mainstream source of credit. But despite this rapid growth, we barely tapped our household gold wealth. I mean, Indian households are sitting on, about the gold with them has risen from 19,000 tons in FY10 to nearly 30,000 tons today, while jewelry holdings have also increased to around 22,500 tons. And the gold pledged as collateral has also grown more than fourfold from 650 tons to 2,800 tons, but that still represents only 10 to 12% penetration for a country like India. So as a result, the addressable market has exploded from 14 lakh crores in FY10 to nearly 190 lakh crore rupees today, and that suggests there's still a lot of a headroom for long-term growth for players. Now, that opportunity, of course, has triggered what can best be described as a gold rush. Banks, particularly public sector banks, they're expanding aggressively. Diversified NBFCs, they're entering the market, and specialist lenders, of course, continue to dominate. When I speak about specialist lenders, Muthoot Finance remains the largest gold loan NBFC, 1.54 lakh crores of gold loan assets, followed by IFL Finance, it's risen up quickly to about 52,600 crores, and Manappuram Finance as well. The growth has been extraordinary in FY26 alone. Gold loan assets have grown 50% at Muthoot, 98% at Manappuram, 150% at IFL Finance, and that shows you just how intense competition is becoming. But the current pace of growth may not last forever. I mean, historically, if you look at it, gold loan growth has accelerated during periods of rising gold prices, but it has also slowed very sharply once these prices stabilize, which we are starting to see now. And analysts now expect the industry growth to moderate to around 12 to 15% annually, even though the long-term opportunity remains intact. In fact, RBI also flagging gold loans as a key watch point in the latest financial stability report that, the collateral could weaken, leading to higher delinquencies as prices come down. So that is a macro signal today. The loan boom is far from over, with just a tenth of the household gold currently monetized, but the opportunity remains enormous.
Well, gold rush indeed in India's households. Very interesting one there, Ritu. But we take your leave on this edition of Trading Hour from Ritu and me. Thank you for watching. Halftime Report takes the action forward on the other side.
Stocks take another leg up with the mid-caps leading the charge. Metals and utilities are the big gainers, healthcare being the only soft spot.
TCS posted a mostly inline set of numbers with muted growth and a margin hit following wage hikes. Deal wins, however, stay strong at $9.5 billion along with traction in AI business. The company expects some demand pickup in Q2.
After a long wait, Dixon Technologies' 5149 joint venture with Vivo Mobile gets the government's nod under Press Note 3. The venture to make electronic devices like smartphones for the #1 phone brand in India promises a strong second half for Dixon.
Apollo Microsystems inks a deal to buy the promoter's 41% stake in Premier Explosives for 1550 crore rupees to expand its explosive portfolio. Apollo also makes an open offer to minority shareholders for 26% equity. Hello and welcome to Halftime Report live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra and with me today is Mangalam Malu. Mangalam, good afternoon. Well, in the green, but Nifty has come off from the highs of the day around 45 points, but nothing really to complain about so far. Metal index is really doing well. We have IT which is contributing as well. Realty too continues its up move. That index is up around 11% this month and this week itself is up around 3.5%. If we talk about the Nifty, that one is up around 1.3% this month, but has been quite flattish this week so far in the red, so to say. But overall, ending on a strong note, the mid caps are doing well and Bank Nifty is participating as well.
Yep, today the Nifty has been led higher by all of the heavyweights. We have the Nifty Bank, which is doing extremely well, and then we have Reliance also, do not forget that one, holding up with a gain of almost 1.5%. So those two are major contributors today. The IT index obviously opened higher with TCS numbers, and across the board we saw gains, but it's facing some resistance around the 50-day moving average, which is a little around 21,800 for the IT index. So that's the one that should come up for you. Sorry, 28,300 thereabouts, where the 50-day moving average for the Nifty IT is hit that mark in the morning and thereafter saw a bit of a sell-off from the high, still holding with a gain of 1.5%. Doing good for the market, 2,200 stocks in the green for about 750 in the red. But on the show today, a lot of stuff that we've lined up for you. We'll be joined by the management of IKS Health as the company completes its acquisition of TrueBridge. Following that, we will speak to the management of Muthoot Microfin, which zooms in trade on the back of a strong first quarter business update. Then we'll focus on buzzing stocks, the big movers in trade today. Stay tuned for that one as well. And finally, in our Commodity Corner segment, Manisha caught up with International Grain Council's Arnaud Petit. Stay tuned for that. But let's start with things that are moving around in trade right now this afternoon. Vivek is at the wall.
Well, absolutely. It's been a very strong advanced decline ratio, especially as far as the broader end of the markets are concerned. In terms of individual stocks, first up on the list has to be Muthoot Microfin. Very strong update coming in. Looking at the AUM up almost 18%, disbursements up 49% in Q1. The other stock that saw a bit of a soft start but has gained momentum since then is Anand Rathi, largely in line with what the management had guided despite all of the uncertainty. When you're looking at the AUM up almost 14% on a sequential basis. The entire IT pack, especially mid-cap IT names, seeing quite a bit of a strong bounce. Names like Newgen Software, Zensar, all of them notching up double-digit gains. Blue Jet Healthcare, this particular name, a strong QIP coming across almost 800 crores is what the company has managed to mop up almost 6%. And Kanya Jewellers, the rally over here continues, one of the top F-note gainers again for the second straight session. On the other hand, a few laggards, not too many, but Schneider, Electric, that particular one stands out on high volumes, down almost 4%. Swiggy, after the recent rally, that particular stock has cooled off, even internally down marginally in the session. Lodha, yesterday saw very big difference as far as the cash as well as the future market is concerned. Today, you're seeing a bit of a a revert back to the normal as far as Lodha is concerned. Page Industries down for the second straight session, again on reasonably high volumes falling, and select pharma stocks, where there has been slight negative news flow. All of these stocks seeing a bit of selling pressure. Dr. Reddy, Aurobindo, as well as OneSource, all of these stocks under pressure today.
Okay, all right. Thank you so much for joining us.
Vivek, with that list. Let's get to the first management that we have on the show today, IKS Health, which has completed the acquisition of TrueBridge. The company had bought it for an enterprise value of $557 million, where subsidiary TrueBridge is a prominent provider of healthcare technology, including an electronic health record, EHR, and revenue cycle management solutions for rural and community hospitals. To discuss this and more, we have with us Nithya Balasubramanian, who is the CFO of the company, joining us now. Nithya, good afternoon. Thank you so much for joining us. Well, we did have a conversation on this when you had made an announcement of the acquisition, where you said that it will be EPS accretive and you will complete this particular acquisition in Q2 of FY27. Give us some numbers now. When does it start contributing? What kind of accretion are you looking at in the EPS, and what happens to the debt now?
Hi, thank you for having me today. We're of course very excited that we have been able to close the transaction sooner than even we anticipated. So yesterday was the close of the transaction. So you should expect, when we report Q2 numbers, about 80 days worth of TrueBridge numbers also to be included in the pro forma numbers. And therefore, if you look at the full year, almost 9 months of TrueBridge will be reflected in IKS pro forma numbers. $557 million was the consideration. You will remember that we already had a little bit of term loan on our balance sheet. So we have taken on a funding of about $611 million from the consortium of 3 banks that we had already announced earlier to the street. And that takes our leverage to about 3x. And given what we have planned in terms of our ability to create a combined business model, which can now create a very unique offering in the markets of both ambulatory as well as rural community health segments in the US, and our ability to optimize and extract synergies, we hope to be able to pay down the debt over the next 4-year time frame. So I think given... Please go.
No, so yeah, we were just wanting to get a little more details on this one. You hope to pay down the debt over the next 4 years. You've told us that, obviously the revenue integration would happen for 80 days in the second quarter numbers and roughly 9 months for the full financial year. On the balance sheet, just wanted to understand the impact. What's the kind of goodwill recognition that you will be doing here? And, what are the other specific milestones that we should track for you to be able to say that, the integration is on track and maybe this is a successful synergy recognition that we've seen?
Goodwill numbers, you will see it when we report our Q2 numbers, right? Because you'll have the balance sheet at that point of time as well. But I think in terms of milestone, what we have communicated to the street is FY30 targets, both in terms of EBITDA as well as net debt numbers. We have said that our true north for FY30 will be tripling of EBITDA from the 100-odd million that we were at in FY26 to a little more than $300 million, depending on the currency in FY30. And in the same time frame, we also hope to be able to pare down net debt to levels that we had in FY26. So if you remember, we closed FY26 at about $26 million of net debt. And we hope to be able to bring it to similar levels by FY30. I think that's the one North Star that we have communicated to the market, and we will be tracking towards that milestone.
Okay, all right. So that is about this acquisition. How has Q1 been so far, Nithya, barring the acquisition, which we will see in the numbers? What are the trends that you've seen?
So Q1, I think I won't be able to comment on Q1. We will be talking to you rather soon in a matter of weeks about how Q1 has panned out. And we will, of course, talk to you in detail when we do that.
Right. We'll, discuss those when we come to that post the Q1 numbers. But just from, a business strategy standpoint, you've given us a true north for the absolute EBITDA and the debt margins. I mean, is mid-30 on the EBITDA new normal, or should we see them move towards 40 at some point in time? If you could give us a rough range. And secondly, even on AI native products, what proportion of your revenue currently is from AI native? And what's the target road to say 10% plus 20% or something?
So in terms of margins, I think the combined pro forma margins, we had communicated that it would slide down to about 26% in that range. Because TrueBridge's, if you look at TrueBridge's financials, then they were actually enjoying about 20% adjusted EBITDA. So our pro forma EBITDA therefore will come down from what IKS standalone used to report. But we do hope to be able to improve their margin profile through a combination of driving optimal mix of onshore and offshore production people, as well as there are significant, in any such large combination, you can imagine that there are significant G&A synergies to be extracted as well as you combine the two organizations. So put those together, and we hope to be able to again come back to the early to mid 30s level in terms of margins, and that we believe in the long term is a sustainable number for IKS. In terms of operational synergies, I think as we continue to deploy more and more technology, we do believe that there'll be leverage that shows up. But we will continue to invest in technology as well, right? In terms of R&D, you already know that about 5% of my sales is being spent on R&D, and we want to make sure that we're staying ahead of the curve in terms of technology and AI, and therefore you will see that spend continue to inch up. So which is why
it'll continue to be at 5%? It'll continue to be at 5%, just the absolute amount will keep increasing.
So no, we think that number could actually inch up as well. Given that if you think about TrueBridge, a significant part of their business is actually an EHR business, which is a pure product business, right? And that will require investment in the future. And therefore, some of the operating leverage through implementation of AI solutions will be reinvested back into the business to make sure that we're protecting future growth for the business.
So if you're increasing R&D spends and with this acquisition, which has lower margins than the current business, what are the margins that you're looking at, say, in the next 18 to 24 months?
I don't think we've communicated anything near term. We're not talking about the curve to get to the early to mid 30s yet. But I think give us a couple of quarters. We've just finished the acquisition. Allow us to wrap our heads around and hands around the TrueBridge business model. We'll talk to you in more detail. But I think the 4-year curve is what we have communicated to you, and we talked about it, right? And we should be able to get to the early to mid 30s levels by FY30.
Right, which is exactly why I pressed for some near-term milestones that we should be tracking to know whether, this integration is going on well or not. But I take that point and your hesitance in the very near term to speak about some of the numbers. But just a final question from, our end here. Nitya, your last quarter's conference call, maximum amount of time was taken on artificial intelligence with not much detail on what revenue comes in from there and how do you expect it to actually, be a meaningful revenue driver or a cost controller for a business like yours? Have you been able to quantify some targets here?
So the way our business operates is that we are responsible for outcomes, right? We're not selling separate AI solutions. We're not selling separate software solutions, which is why we're not talking to you about how much is AI, how much is non-AI, etc. We have always been in the hook for driving customer outcomes, which is why our pricing has always been outcome-based as well, right? A large part of IKS's business and TrueBridge business now is actually take rate based, which is that we earn based on what we deliver to the customer in terms of revenues, and we get a share of that revenues. It's X% of the net patient revenue. And you will see us talk to you about which parts of the value chain, how much of technology that we're deploying. But at the end of the day, I'm on hook for delivering that outcome. Whether I deliver it through technology or I deliver it through people in the loop, that is something that we make sure that we are deploying the right combination. But at the end of the day, we want to drive the outcome. So in front end, as well as mid office and in back office, pretty much in all the features, there is significant amount of technology already deployed and will continue to increase the share of that deployment. And that is also something on a quarterly basis, we showcase to you what is the level of automation in each of those features.
Take that point, Nitya. Thank you so much for joining us with your thoughts today. And we look forward to speaking with you when Q1 numbers are reported as well. That's the word coming in from IKS Health. We'll step into a short break now. When we come back, we'll connect with the management of Muthoot Microfin. The stock is buzzing in trade on the back of strong Q1 business update.
Welcome back. You're watching us here on Halftime Report. The market continues to hold well. One of the stocks which is buzzing today and all through the morning and now as we speak as well is Muthoot Microfinance. The company has reported their first quarter business update where the assets under management expanded by about 18%. The collection efficiency improved as well. And the business mix is moving with average ticket sizes increasing as well. So what's the plan ahead for this year? And beyond that, we do have Sadaf Saeed, who's the CEO of the company, who joins us. We obviously discuss the first quarter business update, the growth outlook going forward, and the outlook on the sector at large as well. Thanks a lot, Sadaf, for joining in. And it's a good performance that you've reported for the first quarter. The only question that the street has now with the stock buzzing is how much of this is sustainable. And now the first quarter has gone the way it has. What's your overall target for the full year when it comes to AUM, disbursements, and credit growth?
Yeah. Good afternoon, Mangalam. I think, first of all, thank you for having me here. The quarter one that has gone by has been really good for us. I think overall the industry has fully recovered from the past. And for us specifically, I think we have done well both in the disbursement count as well as on the collection count. If you look at our disbursements have grown almost 50% from the last financial year. So for the quarter, we have disbursed around 2,500 crores of number 2,645 to be precise. And we are running, usually the Q1 is a slower quarter for microfinance business and for all the financial services business. But in the quarter also, we have done good amount of disbursements. Secondly, the most important thing is the collections are doing really, really well. We are back to around 98% collection efficiency overall, and X bucket is 99.9%. So like all the customers that we are disbursing now are paying really well. So that has really played out well in the overall financial of our business. And we are looking at a very good quarter in terms of financial numbers. And overall, the strategy that we had adopted of diversifying our portfolio into a non-JLG product, which is individual loans, gold loans, as well as some LAP loans, which is playing out really well. It is also helping us take care of our digital agenda. Our collection has moved to almost 40% as digital completely. Our diversification has led to around 3,200 crores of AUM, which is an individual loan, then another 200 crores, which is in gold loans, and another 70 crores of LAP portfolio. And all of this portfolio are super prime. There is absolutely no delinquency, no 30 plus at all. So that is where I think the whole turnaround of the business is showing. And one of the concerns for most of the microfinance companies was availability of funds. In the quarter, we have raised around 2,300 crores of debt, and we have a healthy pipeline of funds which are available. So from a liquidity point of view and growth point of view, we don't have challenge. We had given a guidance of 12 to 15%. We are likely to revise that guidance to around 20% this year. We are seeing good momentum building up. The asset quality is holding up. And the way we have wanted to take our diversification strategy, we are ahead in that game. We started this year with a 18% and 82% mix, where 82% was JLG and 18% was non-JLG. We are already at 76-24. Our target for this year was 75-25. We're likely to outdo our target in terms of diversification and likely to outdo our projection of growth as well. So likely to revise our growth to around 20% for the financial year.
That's for the disbursements part, Sadaf, the 20% growth that you're talking about?
The AUM.
AUM. Okay, so disbursements grew by 49%. And we've been having this conversation with other companies as well in the same field who indicated that quarter one has generally not been so strong, but this year it has been very different. But they've been very conservative in their guidance despite that. What's your target for disbursements growth in FY27?
Sonal, the thing that we are adopting is diversifying the portfolio mix. So whereas our JLG book will continue to grow at around 10 to 15%, but our non-JLG book will really grow rapidly. So on the non-JLG, because this was a lower base, it will be almost 100% growth on disbursement. On the JLG portion, it'll be around 20% growth on disbursement. So combined growth is likely to be more, but AUM growth is likely to be around 20%.
Understood. How big will gold loans be a part of your portfolio? And will that be one of the segments which will drive the stronger growth that you're talking about?
Yeah, I think that's a very pertinent question. Actually, gold loan, we have been doing as a referral business. Due to recent guidelines that RBI came up with, the gold loan co-lending and also guidelines with respect to gold loans itself, I think we have now ironed out all the difficulties that were there in between. And now there is a firm kind of a guideline there for the gold loans. And we have had a very healthy kind of a co-lending partnership. We are disbursing almost 100 crores of gold loan every month. This year we are likely to disburse around 1,200 crores of gold. The only challenge at gold is that the average AUM for this business is smaller. The average tenure is 6 months. So the AUM likely to be around 500 crore.
All right, AUM likely to be 500 crores. Sadaf, when you had come to the street for the IPO, I remember you said that you will open operations in Andhra and that will start contributing significantly. So I just wanted to get a status check on that one because, you're still more focused on Tamil Nadu and Kerala as against the other parts of the southern markets. So how's that expansion coming along? And secondly, you also wanted to diversify your loan mix towards 36 months. At that time, I remember it was low single digits and you were aspiring to go to high single, if not double digits. So where does that number stand at?
Yeah, I think both the aspects we have been able to deliver on our commitment. So Andhra Pradesh, we have now around 23 branches and we have a 170 crore portfolio. This portfolio is also behaving really well. We have 100% digital collection here and 100% on-time repayment. There is no delinquency at all in this portfolio. This portfolio by the end of the year is likely to double itself. We will be close to around 300 crores of portfolio by the end of the year in Andhra Pradesh. And with respect to the portfolio mix, as the asset quality mix changes, the loans that we are disbursing in individual loans and we are disbursing in LAP, they are longer tenor loan. On LAP, the average tenor is 5 years. On individual loan, the average tenor is around 3 years. The loan mix around 76% is around 2 years. And the balance 34% is almost 3 years, except for the gold loans, which is on an average around 6 months.
Okay. Sadaf, quickly before we let you go, asset quality has improved as well. What's the target for gross NPA and net NPA for the year?
So last year, we have seen almost 100 bips of reduction in our GNPA. If the momentum remains good, we have seen very good momentum in collections. We are collecting from overdue accounts also very well. And from the current account, there is no flow. There is absolutely zero flow in the portfolio, 99.9% repayment on time. So we will definitely in this year would be able to reduce more than 100%, 100 pips GNPA.
And would you at some point in the next near future consider becoming a full-blown NBFC beyond just being a microfinance company?
Well, that's a good question. Right now, the portfolio mix we have diversified because the RBI regulation has liberalized. Earlier, the qualifying asset requirement was 75%, and then it was reduced from 75% to 60%. So we still have some headroom. Also, we have opportunities like co-lending for non-qualifying assets as well as direct assignment that we can do. So at the moment, I think we are well within our control. So we will likely to remain as NBFC MFI. But going forward, we will evaluate if the opportunity comes.
All right, take that point. Always a pleasure speaking with you, Sadaf. Good luck for the next few quarters as well. You're likely to up your guidance. So we'll obviously speak to you post your first quarter numbers as well. Take a short break, come back on the other side. We focus on the market. Saumil Mehta, Mirae Asset Sher Khan joins in with some trading strategies. Well, holding just around the 24,200 mark, a little below that, no problems for the market. Perfect time to actually get you the FNO setup at noon. We have the Nifty, which is doing well, but beyond the Nifty, it's the broader markets which have been doing well for second day running. You have the mid-cap index up around 1.2%, the small-cap index, which was up around 1.4% yesterday, adds another 1.4% today as well. So basically, after the volatility that we saw 2.5 days ago, the street is, contained with this uncertainty right now, and we are moving past that. The good part is all the contributors of the Nifty are the heavyweights. We have the Nifty Bank, which is bouncing back from important levels, closed at the 200-day moving average yesterday, has moved higher. Nifty IT continues to hold high by about 2%, and Reliance as well, a fair weight on the index, up by about 1.75%. However, the fact that we saw a wee bit of sell-off from the highs of today have brought back some of the call writers back in action. A lot of the earlier up move could be attributed to call writers being caught on the wrong side and short covering. Now that's out of the way. We have call writers who are back. So 24,200 call has a premium of almost 100 rupees. That tells you that around 24,300 we will continue to see supply once again. And 24,200 put writers equally active, seeing a premium of 100 rupees, telling you that the support for the Nifty is strong at 24,100. For those who are writing this straddle, which is both the call and put together, which expires on Tuesday, you are playing basically for a range of 24,000 to 24,400 on the frontline index. Were the Nifty to fall below the 24,100 mark from here all, there is a strong support of the 100-day moving average at the 24,037 mark. The only thing that we're looking at for the IT index is some sort of resistance which happened today as well at the 50-day moving average, which is at 28,383. But amidst all of this, a lot of stocks are seeing well-bid moves. We have DLF, which is seeing a lot of long positions being added. CDSL is the other one, which is up 6%, long positions added. Swiggy, which was an outperformer over the last 2.5 trading sessions, coming in for some profit taking. And there are some short positions that we're seeing on Swiggy.
Okay, all right, that's the FNO setup, but let's take it forward and welcome Saumil Mehta, who's from Mirae Asset Sharekhan, joining us on the show now with his technical call. Saumil, good afternoon. Thank you so much for joining us. What about you? What are the next important levels that you're tracking on the Nifty?
Good afternoon to everyone. Markets have taken resistance around 24,500 levels, which is very close to 200 daily exponential moving average. Now this level becomes very crucial, and we've seen a very sharp decline from those levels. We are trading very close to 20-40 daily moving average, about 20 and 40 daily moving average. However, at this point of time, my view would be sideways to a little negative, because we've taken resistance at very crucial resistance, and we've slipped down. Now that we have taken support at 40 daily moving average and trading about 20 daily moving average, in the very, very short term, I'll be expecting us, sideways correction. However, overall, now the trend remains negative, and I'll be expecting markets to go down below 23,780, which is a very crucial support. And below that, I'll be expecting a target of around 23,600. So my view is negative to sideways, and sell on rise should be the strategy. However, in the very short term, if we are in a very short range between 24,300 and 24,500, I think there will be opportunities in some pockets where I'll be expecting, but we should focus more on large cap stocks.
All right, focus more on large cap stocks. So I reckon your stock picks will be from the large cap universe itself, and perhaps a mixed view, or maybe all longs.
Both long, because I'm expecting a sideways correction and expecting still more opportunities in few areas. One is real estate. TLF is really doing well, taken support at 200 daily exponential moving average, started making higher top, higher bottom formations. Weekly swing highs has broken on the upside, so DLF would be my top pick. Stop loss would be 654, and my target would be 735. The second one is from the defense pack, HAL. HAL has broken out of a flag pattern on the daily charts, taken support at 200 daily moving average, started making higher tops, higher bottoms. So a great setup here. Stop loss should be 4,390, and my target would be 4,900.
Right. You were speaking about the real estate space this morning. Lodha, after having done extremely well, opened about 4% lower. The dip has swiftly been bought into. In fact, Lodha has now cut its losses to sub 1%, and it's a big spike that we've seen. So that's telling you or perhaps the inherent strength?
It is, and the stock is a big call, the technical call by CLSA as well. So that's Lodha for you. Thank you, Somil, for joining us today with your technical picks. But it's time for a break now. On the other side, in our Commodity Corner segment, Manisha Gupta will connect with International Grain Council's Arnaud Petit on key trends in global grain market amid weather risks and West Asia war. Stay tuned for that. Welcome back. Well, the International Grains Council has revised its 2026-27 global grain production forecast higher. Our colleague Manisha Gupta spoke with Arnaud Petit, who is the Executive Director of International Grains Council, and began by asking about the impact of climate change and the ongoing West Asia conflict on the global grain production. Listen in.
First of all, that last year we had a very record crops with a lot of stocks today. So this is why, even if we are still looking for smaller crops, harvest in 26, indeed we are still in the second in the world record harvest for 26. So we have indeed ample supplies. We are looking for 26, 27, and we are not expecting tension on the market. But as your question relating to weather impact today, I would say Europe and US are under watch, and particularly for the maize production, because we're at the time of flowering season, and high temperatures can be damaging for the yield prospect. So that's really the two regions we are looking closely for the time being. But if we look about other regions, so we have a good harvest for 26.
Point taken. And also the second half of this year is looking at an El Nino, and we're looking at Southern Hemisphere getting impacted from it. Are you particularly concerned about a region or a crop therein?
Yes, El Nino has definitively, I would say, the power to disrupt crop production. So definitively, we are really monitoring the confirmed El Nino starting most probably is effect by November and would go most probably to March. That's something that's not yet clearly defined, but we are looking definitively at the South Hemisphere. We have seen already Australian farmer which are shifting really tremendously this cropping system with less wheat and less maize production. We will have to look also about definitely India, where the monsoon it seems to be lower than expected and might have an impact on rice production. And then with a mixed result will be for South America, because usually an El Nino can bring more rains. so which could be beneficial for Argentina. So we might have a mixed results about El Nino. Again, what is still need to be confirmed is the grade, or I would say the power of this El Nino. If it is a very strong El Nino, yes, we can have some disruptions on harvest, and particularly the rice market can be exposed to that.
Let's talk about rice then. And India is a major player when it comes to exports in sense of rice. How do you see, or how is IGC now looking at India's crop prospects from here?
On rice, so we are still cautious in terms of our figures. We continue to expect more or less the same harvest than last year. So it's because we are still at the beginning of the season. So this is why it's still early to have figures which we can be really count on it as granted. For the time being, we see that India would continue to have a good harvest. We don't see a sharp decrease on production. We might have, as I said, some impact later in the season, maybe more in Southeastern Asia, where Malaysia, Philippines can be impacted. But as I said, India, we are still expecting a very good harvest along the season with a good opportunity of trade. We are not downgrading the export capacity of India for 26-27.
All right, that point is well taken. How are you also looking at the corn production for Indian markets now, especially given the fact that India is pushing for more ethanol, and then feed sector has been asking for imports as well? That looks a bit messy, would you say?
Or I would say we have to bear in mind that the biofuel production or the biofuel ecosystem is very complex and provide different or supply different markets, feed and fuel. So this is why producing more biofuels is also responding to the feed sector. If you look in the different countries or different regions, North America, South America, or even Europe, with more production of biofuels, indeed, you produce more feedstock for the livestock sector at a cheaper rate. So this is why it's not, I wouldn't say it's messy, it is going in a good direction. The question is how to structure the market. And I think it's there, which is still needed as it is an emerging market in India.
We haven't spoken about oil seeds, and how are you looking at, one, the overall global grain consumption on one side, and what is your sense also on the oil seed sides of it?
So oil seeds, it's an amazing market. If in the last 10 years, we have seen only increase of production, increase on trade. Usually, we tend to characterize that oil seed could be resumed to the trade between Brazil and China. 60% of the trade of soybean are going from Brazil to China. But if we look in the last 5 years, 50% of the increase of trade is coming from non-China countries, if I may sum up my short presentation. And therefore, we have to really look about the demand from new countries, which are very interesting for South America, but also for US with new opportunities. It is right that soybean is a crop which can be suffer from drought, and we are still having some doubt about the final harvest, particularly in India. We continue to have to be confident, but it is right if the drought or the monsoon is more delayed, it can be have an impact on soybean in the future for India. But again, what we see for soybean is an increase on trade in volumes because the demand in terms of bean, but also on soybean is very important.
I know with all the kind of moves that the market is looking at, and volatility, and of course the West Asia conflict and El Nino on the other side, and the trade protectionisms, etc., are you more bullish on certain commodities than the other?
For the time being, we have really a lot of grains in stocks from the major exporter, and we are looking at harvest in the major importer with a good harvest. So therefore, there will be less trade. Trade is designed by demand, not by what you produce. Therefore, there will be less demand, particularly in North Africa, for example, or even in Near East Asia. So we are expecting less trade on grains. It is right, but mainly because the demand will be down. But if we look at the next 5 years, we did just a baseline scenario for the next 5 years. Trade will continue to increase by an average of 2% in volumes per year. So trade will remain a relevant tool for food security in our global system.
All right, while that conversation was going on, we had the numbers of Indian Bank at the bottom of your screen, and as a result of which the stock saw a big spike. If you look at some of the internals, the gross NPA is improving quarter on quarter from 1.98 to about 1.86. The net NPAs have been absolutely flat quarter on quarter, and the reason for that is the company has chosen to reduce its provision, which is not necessarily a bad thing. In fact, net NPAs at 0.15% is flat quarter on quarter, but has seen an improvement year on year as well. But most importantly, we have the return on assets of the company, which have actually seen an improvement from 1.28% last quarter to about 1.31%. So on all parameters, it is a good set, which is why the stock is higher by about 5.5%. We take a short break, come back, get you more on the markets and similar stock-specific action. Stay with us.
Welcome back. You're still tuned into Halftime Report on CNBC TV 18. Well, I'm tracking the oil marketing companies, the entire energy space in general, because there's an interesting note from ICICI Securities where they talk about how the country is now facing, or the OMCs are now facing, a problem of plenty when it comes to LPG stocks. Now, remember, LPG was one of the most discussed energy component during the West Asia war, because a lot of imports come from the Strait of Hormuz, and it has been quite volatile, the demand-supply dynamics over the last 3 months. Prior to the conflict, 62% of Indian LPG requirement, it was being met by imports, and the rest, that is around 38%, it was done domestically itself. At the peak of the conflict, however, there was a lot of effort from all these refiners, and that's how they helped boost domestic production by more than 40%. And that is something which has continued till date. Availability has risen to 1.5 to 1.6 million tons per month, and now domestic availability is more than 65% versus what we have seen in the month of April and May. Imports have slumped to 1 million tons per month, which is around 38% of the total consumption. Now remember, this was around 1.7 million tons per month earlier. The additional thing that has happened is that domestic throughput plus contracted imports, they are now ahead of consumption, which has fallen steeply. So we have more LPG and less consumption requirement, which has caused more supply in the market. LPG demand is down 18% versus pre-war levels as per this note, and demand has fallen due to a number of reasons. We saw that big hike in commercial LPG prices that has led to lower consumption. There is elongated refill cycles in the domestic segment, and also the replacement of LPG with gas in specific industrial areas, and that trend has continued till now, and that's why the demand for LPG has gone down. The sudden surplus in LPG availability, of course, augurs well for prospects in the near term because there are fears again that there could be some concerns around Strait of Hormuz and West Asia war. A reduction in prices is also, there could be a reduction in prices actually, that's what ICICI Securities says, in order to ensure that there are more takers for LPG in the market. A reduction in prices will reduce the subsidy element in the LPG segment for OMCs. Only the quarterly run rate of LPG losses for these oil marketing companies could come down substantially. It was expected at around 22,000 crore rupees in Q1. It could come down to levels of 12,000 crores in Q2. So that is the kind of big impact that we would see on oil marketing companies' balance sheets as well. The developments for the LPG availability are positive for the economy and from an OMC's balance sheet perspective as well. The stocks are not reacting, but this is a big data point where we are talking about LPG availability being higher than the demand, something that was absolutely the opposite during West Asia war.
Take that point, LPG availability higher than the demand. The question is whether there will be a price cut that will come by or not. But PSU Bank Index is the one that has spiked, and that's largely been led by the stellar results of Indian Bank, and alongside that we have seen some traction build in all the other PSU banks as well. So the Nifty PSU Bank Index telling you the story of the day. We'll take a short break, get you more on the markets. In fact, we'll get you more on earnings expectations. Ananya joins in to decode how the first quarter will be for NBFCs. Stay with us. Time for our special segment, Quarter Se Quarter Tak, where we bring you earnings expectations from each sector. Today we have Ananya joining in to tell us how the first quarter will be for the NBFC space. Ananya.
Q1 FY27 updates clearly show that NBFC growth is holding up despite seasonal softness. Now, if you look at the numbers, Bajaj Finance AUM is up 24% year-on-year. Bajaj Housing AUM is up 24%. Good set of numbers from them. L&T Finance retail book is up 28% year-on-year. And M&M Finance AUM is up 12%, while the disbursements are up 21%. So growth is clearly visible. But the real question is the quality of growth. Now, at the sector level, the outlook remains constructive with healthy double-digit AUM and earnings growth expected. But with margins still under pressure from elevated borrowing costs, earnings quality becomes the key theme here. Now, within this setup, diversified NBFCs look best placed because they have multiple growth engines across consumer, SME, rural and secured lending. Now, the key watch point will be NIM resilience, credit cost and retail loan growth, especially as unsecured lending competition rises. Now coming to housing finance is also growing well, supported by affordable housing demand, but the focus is now on profitability as lower PLRs and sticky funding costs are putting pressure on spreads and NIMs. So investors will watch out for that. Now vehicle finance should remain healthy, but performance will be uneven this quarter. Passenger vehicles, tractors and light commercial vehicles are holding up well, while medium and heavy commercial vehicles face pressure from fuel prices and freight uncertainty. So we'll watch out for that also. Now, one of the most interesting parts of the NBFC universe this time is microfinance. Now, after a tough FY26, AUM growth is expected to rebound to around 20% from 4%, as CRISIL states in its report. Now, supported by non-MFI products rising from 6% to 14% of AUM and repeat borrowers improving to 66% from 53%. Now, coming to gold finance, they also remain a standout. Gold loans now form nearly 11% of India's retail credit, as you can see, with the sector growing at a 34% CAGR over FY21 to FY26. But the key question is whether growth is price-led or business-led. Now, funding trends are supportive, with Q1 FY27 securitization volumes hitting a record 60,000 crore, up 22% year-on-year, and NBFC contribution over 98% of issuances. Now, gold loans became the largest securitized asset class, but cost of funds remain the key earning variable. Now, coming to valuation front, the valuation gap across the sector remains wide. Bajaj Finance and Muthoot still command premium multiples, while Shriram and Home Finance look relatively attractive. Overall, NBFC enter Q1 FY27 with strong growth momentum, but investors will focus on rural risk from El Nino, fuel prices pressure, gold loan sustainability, and most importantly, earnings quality. So not just who grows faster, but who grows better.
Okay, all right. Thank you so much, Ananya, for bringing us all those expectations from the NBFC space. By the way, the market is trading higher, continues to do that, and it's the PSU banking space that you should keep an eye out on. And with that, it's a wrap on this edition of Halftime Report. Business Lunch will take all the action ahead.
Stocks take another leg up with mid-caps leading the charge. Metals and utilities are the big gainers, with healthcare being the only soft spot.
TCS posted a mostly inline set of numbers with muted growth and a margin hit following wage hikes. Deal wins, however, stay strong at $9.5 billion. Along with traction in AI business, the company expects some demand pickup in Q2.
After a long wait, Dixon Technologies' 5149 JV with Vivo Mobile gets the government's nod under Press Note 3. The venture to make electronic devices like smartphones for the #1 phone brand in India promises a strong second half for Dixon.
Apollo Microsystems inks a deal to buy the promoter's 41% stake in Premier Explosives for 1,550 crore rupees to expand its explosive portfolio. Apollo also makes an open offer to minority shareholders for 26% stake.
Good afternoon, you're with us here on Business Lunch. This Friday afternoon, we are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormuz Fatakia. With me as always, Arundhati Ramanan. Arundhati, good afternoon.
Good afternoon, Hormuz. You know, the market's firing on all cylinders. A little bit lower than from the high point of the day, but nothing to complain about.
Nothing to complain about, indeed. And the two good things that have happened in today's session is the fact that A, we have broken above yesterday's high, and B, the fact that we are trying to reclaim that 24,200 mark on the upside. We are still down for the week. 24,270 is that level that we need to close above to ensure that this is the fifth straight week of gains for the index. We were around about 85 points away from that level. But before I go further on the markets, just pull up Indian Bank. That's possibly been the stock of the last 30 minutes. And it's a very, very strong set of numbers that have come in from Indian Bank. And look at the spike on the stock as well. 9% higher now on the stock. And stable asset quality, core income growing 17%. Slippages ratio has improved on a sequential basis as well. So an all-round performance coming in from Indian Bank, 9% higher on the stock. That's possibly been the highlight of the last 60 minutes. And it has been the banks that have been doing the heavy lifting as well. They've kept the Nifty afloat in today's session too. More than the Nifty, it is the Nifty Bank that has done well, and it's now 850 points higher. But the Nifty is still down for the week. The Nifty Bank has already turned positive. So 57,938 was that level that it had to close above. We are well above 58,100 now. So the bulls will be happy. The fact that at least the banks are outperforming, and that is ensuring that the Nifty is doing well as well.
Absolutely. And what took place in Indian Bank has helped that PSU Bank index become the top sectoral gainer, right? It's 3% higher. We've got SBI that's up nearly 2%. We've got Indian Bank, as Hormuz pointed out, about 8.5% higher. And we've got Bank of Baroda also doing very well. Canara Bank, all of them 3% in the green. The other sector that's continuing its up move is that realty pack. That index is up 2%. DLF and Godrej, both of them up 4%. Prestige up over 2% in trade as we speak. So that index doing well has had a good run up this week. The other sector that's participating in the rally are those IT names. And this is post that inline set that came in from TCS and the commentary also being positive. The index is up nearly 2%. Infosys, TCS, Persistent, all of them higher between 1 and 4% in trade. The only index that was in the red by a thin margin is the FMCG pack. If we can bring that up for you. ITC, Nestle India, Marico, all of them between 0.5% to 1% lower in trade. So just mildly lower in trade over there.
Of course, as Arundhati was also mentioning, IT, the index doing well for itself after TCS's results, strictly in line with expectations. But the fact that there was no negative surprise that came in has been enough to spur an up move in a lot of these mid-cap IT names for that matter, even though TCS is off the highs of the day itself. Rima is here now with more details on that. Rima.
Thanks so much for that. Let me begin with what sparked the rally in TCS post the numbers. Well, expectations were low, expectations were lowered, and the company managed to deliver on all fronts. The company's revenue growth came in at 0.4%, slightly ahead of flat growth estimates, and the management said they're positive about Q2 and FY27 should be better than FY26. The deal wins were steady at $9.5 billion, and analysts believe that the company is on track to deliver a 2.5% to 3% revenue growth in FY27, at par with peers like Infosys and HCL Tech, and this comes after 2 or 3 years of underperformance. So the fact that it's catching up to the industry is also seen positively, and the AI piece of the business for TCS is growing. It now constitutes nearly 9% of the overall revenues. $2.6 billion of annualized AI revenues, growing at 13.6% quarter on quarter. As you rightly pointed out, the TCS sentiment is rubbing off on the rest of the sector as well. And IT is actually in the last couple of days done well. 1st of July was when it hit a 52-week low, and since then it's rallied about 6-7%. But to keep the rally in context, the rebound, it's down 27% year to date, and most large cap IT companies are trading at 13-14 times valuation multiples, closer to 10-year lows. But I must point out that while the company has delivered on near-term expectations, Q1, Q2, we still don't have clarity on what the longer-term picture is going to look like. When will the new revenues from AI, the new volumes, incremental revenue volumes coming in from AI, offset the deflation seen on account of AI? The brokerage view is more positive, but you would still call it mixed. On one hand, you've got JP Morgan, and they say that we don't think the business model is broken. They believe the company can defend earnings from year on, and there are a lot of valuation metrics which look positive to JP Morgan. Dividend yield, highest in the last 10 years. PE multiple at 2 standard deviations below the 5-year average. Free cash flow yield, highest in the last 8 years, ex of COVID, which is why they've got an overweight rating on JP Morgan. But Citi is not convinced. He's like, we still don't know what the fair valuation multiple of TCS is going to look like, or the industry. Sluggish growth continues. They, in fact, lowered the valuation multiple even further to 12 times, and they've got a sell call on the stock. Back to you.
All right, Rima, many thanks for those details. Let's also listen in to what the management of TCS had to say about their AI revenue and on the Q2 revenue outlook. Take a look.
Could be in the range of, in a given work, okay, when you renew it, or when it could be about anywhere, what we see on a large project would be about 10 to 15%.
Over 5 year, or a 5-year project, or 3 year?
Overall project value, it could be 10 to 15%. But we expect that it should not be, maybe it may be volatile or deflationary in the top line, deflationary in the short run. But in the long run, we talked about so many other projects that will happen because of AI. So net, we still expect this to be positive, and there could be some short-term volatility, and we are looking at what we are seeing and what we are doing. We are quite happy with the overall progress you have made this quarter. Difficult to predict because the deflation usually kicks in very quickly, and new projects, when people start leveraging it for their business transformation, that takes a little more time. Overall, still I would say Q2 is positive, but at the same time, things been quite volatile in terms of whether H1 is better than H2. Okay, that I don't want to say H2 will be weaker than H1. Okay. But we are quite positive on Q2.
Okay, and FY27, if you have to characterize it?
Last quarter also said it will be better than 26. I still stick by that. It will be better than 26.
Continuing to maintain that the second half will be better is the management of TCS. Of course, another one then, moving on from IT, a long-awaited news approval finally coming in for Dixon Technologies, as it will now partner with Vivo India to establish a JV. Upasana is joining in with more on this. Upasana.
Well, certainly the wait is over, I must say. Now, company gets long-awaited government approval under PN3 for its JV with Vivo India. Both the companies have executed the JV agreement, and this approval certainly removes the regulatory overhang that has been pending since so long. The JV was announced back in December 2024. Now, let us look at what the management had guided for on the back of this JV. Now, management said that this JV could lead to a revenue upliftment of nearly 30,000 crores with a higher ASP compared to the Dixon's existing portfolio. And post the regulatory approval, the management had guided that it will take about 60 to 90 days for the operations to start. So calculating from today, it's likely in Q3 FY27. Now for FY27, the company has given a revenue guidance of 56,000 crores and a volume guidance of 32 to 33, which is nearly flat. But this volume guidance excludes the Vivo contribution. So the Vivo contribution in FY27 is something that we'll be closely looking out for. Now let us look at what the brokerages are baking in terms of Vivo's contribution for FY27 and their view as well. Now Motilal has retained a buy rating with a revised target price of 16,100. It estimates the JV to contribute nearly 30 million of volumes in FY27 and 17 in FY28. JP Morgan has given an overweight rating with a target price of 16,700. It assumes the Vivo to contribute 11 million volumes in FY27 and 22 million volumes in FY28 and 29. UBS has given a buy rating with a target price of 13,700. CLSA has given an underperform rating with a target price of 10,400. And it believes that there is a limited room for upgrades now, as most of it is baked in the stock price. And lastly, coming to Phillip Capital, it retains its sell rating on the stock. So overall, certainly a mixed view, but looks like it is certainly baked in the price.
All right. Thank you so much for those details. But on that note, it is time for us to head into a short break. More news and updates on the other side. Stay tuned. Welcome back. You're still with us on Business Lunch. Let's now focus on the world of technology. Rachna Dhanrajani joins us now with the latest updates. Rachna?
Well, today's biggest newsmaker is ChatGPT, Altman, and so OpenAI. OpenAI has broadly released its GPT 5.6 family of models, Sol, Terra, and Luna, after weeks of restricted access under a US government review. CEO Sam Altman told CNBC the flagship Sol is 54% more token efficient on agentic coding than rival models. Tokens are the billing unit for AI and for enterprises running agents at scale. Token costs so now decide whether deployments are viable or not. When asked how much of the gain came from a focus on bringing down costs, Altman said entirely. The customers say it is not enough. Palo Alto Network CEO Nikesh Arora told CNBC that 54% is a good start, but the industry needs another turn at it. He wants AI pricing down 90% within 2 years. Remember, that's also what Palantir's Alex Karp had said just a couple of days ago. Now, the squeeze is that costs are rising on the other side as well. Altman called compute and memory costs a headwind, saying OpenAI needs algorithmic gains to keep customer prices falling while infrastructure costs continue to climb. There's also a new gatekeeper in the room. GPT 5.6 is the first OpenAI model to clear a government pre-release review. and Altman confirmed the next model faces the same process. Frontier AI in the US now ships with Washington's sign-off, but the launches are not slowing down. This week alone, SpaceX launched Grok 4.5 and OpenAI went broad. And with OpenAI valued at $852 billion and Anthropic both filing confidentially for IPOs. Now, whether token economics works at scale or not is the trillion-dollar question that the street will be watching out for. But let's also listen into excerpts of Sam Altman's interview with CNBC at the Sun Valley.
5.6 Sol, I think, is not only the best model in the world for most people, it's also much more efficient than other models out in the world. So it's 54% more token efficient on agentic coding tasks, and also, as good or better as the other best models out there. And we're really seeing people now start to care about efficiency, understand their spend, get a great ROI. So this is a great step forward for us. Cost and speed, it's also much faster. But customers clearly, every enterprise now is thinking about spend and the value they're getting in exchange for AI. And this is what we really want to do. Like, we want to be the best, most dependable, most reliable, best ROI partner for enterprises. I thought it was a very productive process. We had a very good time working with Secretary Lutnick, Secretary Bessent, Director Karen Cross. This is our first time through it, so there are things we will learn about how to make it better for the next one, which will get going on soon, and I think it'll be a much smoother process. But the government's technical capability was impressive to me. People really are doing good work testing and red teaming these models, and they really care about getting these models out quickly, but with a high level of safety. And I think this is actually in everyone's interest. If you want broad access, which we do, and you have powerful models, you really want to be able to be confident in your safety claims, because otherwise the world is going to get uncomfortable very fast.
And getting you the latest updates now from West Asia. Multiple sites in southern Iran have been hit by renewed strikes, according to local officials and state media. These strikes include attacks near the Bushehr nuclear facility in southern Iran. Meanwhile, reports from the US say that technical talks with Tehran continued despite 3 days of escalating military exchanges. This, even though the US President Donald Trump had said earlier in the week that the truce with Iran was over. Elsewhere, mourners gathered in Mashhad for the burial of Iran's late Supreme Leader Ayatollah Ali Khamenei, who was killed in a joint US-Israeli strike on the 28th of February, which was the first day of the war in Iran.
And moving on, the US Federal Reserve has named Raghuram Rajan, Raj Chetty and other experts to lead 5 task forces reviewing monetary policy under Fed Chair Kevin Warsh, with findings expected by the end of this year. CNBC's Steve Leesman joins us now with all of those updates.
As promised last week by Fed Chair Kevin Warsh, he is out now with the names of the people on his task forces to rethink how the Fed is doing its business. He said the Fed's commitment to price stability and maximum employment is unwavering, and issued the following statement, Scott, saying the U.S. economy has changed significantly over the last generation, and never more so than right now. Each task force will carefully consider whether policymakers' means and methods, analytical tools, and policy approaches can be improved upon. So let's go through the names. On the Communications Committee, which is designed to review how the Fed conveys policy deliberations, there's Peter Fisher. He was head of fixed income at BlackRock and at the New York Fed from 85 to 01, including heading the Fed's accounts, SOMA account over there. He has been a member of the Shadow Open Market Committee and criticized Fed communications, saying the Fed's decision-making and communications process is broken and has been for some time. Also, he's criticized reliance on forward guidance. Arminio Frago is also on that. He's the former president of the Central Bank of Brazil, as well as previously reported Mervyn King, the former governor of the Bank of England. Balance sheet policy. Raghuram Rajan, as you know, a frequent guest on CNBC, the former governor of the Bank of India and from the University of Chicago, as well as Jeremy Stein, the former Fed governor from 2012 to 2014, and Karen Dinan, professor of economics at Harvard. She was in the Obama administration in the Treasury from 2014 to 2017. On data, here it gets pretty interesting. Raj Chetty, very well-known economist from Harvard University. Doug McMillon, former president and CEO of Walmart. They have a lot of data, and it'll be interesting to see what he thinks about that, as well as Kevin Murphy, professor of economics at Chicago, on the Productivity and Jobs Task Force. Well, there's Mark Andreessen. We sort of thought he was going to end up on one of these panels. In addition to everything you know, Mark Andreessen is, it's well to remember, he's one of the tech bros that my colleague and I, Matt Peterson, wrote about, who knew Kevin Warsh going back to Stanford in 2013, or sorry, earlier than that. He knew him from his days at Stanford University. Asha Sharma, Vice President, Xbox CEO from Microsoft, and Charles Jones, Professor of Economics. Finally, on inflation, an interesting group. Greg Mankiw, who you know well also, from Harvard, Council of Economic Advisors under George Bush, 03 to 05. Thomas Sargent, very famous economist, Nobel laureate for his work and research on cause and effect in the macroeconomy. And finally, William White, Howe Institute, former economic advisor for the BIS, who seems to be best well known for being among those, Scott, who predicted the 08 financial crisis. So a really interesting group. Some of them may be leaning in the ways that Kevin Warsh wants to move the Fed, but none of them really, all are going to be, I believe, well respected in the economic and monetary policy communities.
Steve Leisman, thank you for that update there. Take a short break. Back with more on the other side. Welcome back. Now, Prime Minister Narendra Modi wrapped up the Australia leg of his three-nation tour and is now headed to New Zealand. The Prime Minister visited the iconic Melbourne cricket ground alongside Australian Prime Minister Anthony Albanese, where he interacted with young cricketers, signed jerseys, posed with Australia's official mascot Ruby the Roo, and met former Australian cricket captain Steve Waugh. Prime Minister Modi and Albanese jointly released the India-Australia Sports Collaboration Roadmap, covering high-performance training, sports, science and infra investments, with India hosting the Commonwealth Games in 2030 and Australia the Brisbane Olympics in 2032, creating a natural decade of sports collaboration ahead. Listening to what Prime Minister Modi had to say.
आज प्रधानमंत्री अल्बनीज़ी के साथ इंडिया ऑस्ट्रेलिया स्पोर्ट्स कोलैबोरेशन रोड मैप लॉन्च करना मेरे लिए बहुत ही खुशी की बात है। इसके तहत हम क्रिकेट के साथ अन्य खेलों में भी सहयोग मजबूत करेंगे। स्पोर्ट्स ट्रेनिंग, स्पोर्ट्स साइंस एंड टेक्नोलॉजी के साथ मिलकर के हम आगे बढ़ेंगे। लेट अस प्ले टुगेदर, लेट अस विन टुगेदर। 2030 में भारत कॉमनवेल्थ गेम्स की मेजबानी करने जा रहा है और जैसा मेरे मित्र ने बताया, हम 2036 में ओलंपिक्स भारत में आयोजित करने का भी प्रयास कर रहे हैं। 2032 में ब्रिस्बेन ओलंपिक्स होस्ट करेगा। इन ग्लोबल इवेंट्स को आयोजित करने के लिए मेगा स्केल पर स्पोर्ट्स इंफ्रास्ट्रक्चर तैयार किया जाएगा। यानी आने वाले वर्षों में हमें एक दूसरे से सीखने के, एक दूसरे के साथ मिलकर काम करने के अनेक नए अवसर प्राप्त होंगे।
And the FIFA World Cup quarterfinals have begun, and France are the first team through to the semi-finals. Kylian Mbappe was once again at the heart of the action, initially missing a penalty but making up for it by scoring later and then setting up Ousmane Dembele as France beat Morocco 2-0. The victory keeps France on course for another World Cup final, although there was a late scare after Mbappe limped off with what appeared to be a foot injury. He later returned to celebrate with his teammates, easing immediate concerns. France will now face the winner of Spain and Belgium for a place in the semi-final.
Well, getting into the business end of the tournament now, but the markets too are getting into the business end of what is the final trading day of the week. Still 200 points higher on the index, exactly 100 points away from the level that it needs to cross for the Nifty to close on a positive note for the week. The Nifty Bank, though, still doing well for itself, above the mark of 58,000. That has been the positive one. After that 1,600 point down move that you saw in the middle of the week, the Nifty Bank has recovered all of those losses and has turned positive for the week again. Indian Bank, of course, up 7%, and following Indian Bank, all other PSU banks too have seen a sharp surge. Remember, Bank of Maharashtra too comes out with results later in the day. Kalyan Jewellers still up 7.5%. Zensar Technologies has extended its gains to 14%, while Newgen Software too is up around 13%. So both Zensar and Newgen continue to remain the top gainers on the Nifty 500. Take your leave on this edition of Business Lunch from Arundhati and me. Thank you for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Mid-Cap Radar. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, Vivek Iyer. Continues to be a market in the green. It's a Friday cheer. The mid-caps are contributing a lot more, and Bank Nifty is the one which is supporting the Nifty. So it's a lot of heavyweight-led market in trade today.
That's right. Good afternoon, Sonal. What a recovery as far as the broader end of the markets are concerned. And along with the results of Indian Bank, what you're actually seeing is a very sharp spike across most of the PSU banks. So that is also leading to one particular leg higher as far as the markets are concerned. But a lot lined up on the show, so let's start off with the top headlines. Market continues to hold on to gains with the Nifty trading comfortably above the 24,100 mark. Financials, IT, realty lead sectoral gains. Broader market underperforms.
Center green lights the long-pending joint venture between Dixon Tech and Vivo. Approval removes a key regulatory overhang. Company guides for a 30,000 crore boost to the top line. Brokerages Motilal Oswal, JP Morgan, UBS, CLSA all share upbeat verdict on the counter.
Muthoot Microfinance asset under management grows 18% in Q1. Disbursements too post a steady show with a 49% growth. The management tells CNBC TV 18 that they expect another 100 basis point reduction in gross NPA. AUM growth seen at 20% on the back of diversification. The stock jumps 10%.
Assets under management of Anand Rathi Wealth surpassed the 1 lakh crore mark in Q1. Margin 2 spikes 420 basis points to 33%. Stock maintains its stance in the green at lunch hour.
Steady gains in the shares of Blue Jet Healthcare. The company closes a QIP and raises 800 crore rupees. 1.58 crore shares issued to QIBs at 506 rupees a share. Shamak Investment, owned by Nimesh Shah, and ICICI Prudential Mutual Fund among the key allottees.
Okay, those are the top headlines that we are tracking as the broader end of the market, which is doing really well. A lot of contribution coming in from PSU banks as well. So the PSU bank index is one of the major gainers in trade today. But we have to talk about the mid-caps, right? This is our special segment, Mid-Cap Movers. We have Upasana with us to take us through the mid-caps that are moving around in trade. Upasana.
Well, the Nifty Mid-Cap 100 Index is up over 1%. Clearly, we can see the market is at a day's high right now. So let us focus on the top gainers in today's trading session. First up, topping the list is Newgen Software, one of the volume buzzers today, up more than 12%. Zensar Tech is the next one, up more than 13%. Lux Industries also in focus, another volume buzzer. Volumes up more than 23 times the weekly average. IFB Industries is also surging on high volumes, up nearly 7%. And lastly, coming to Indian Bank on the back of that strong Q1 reported by the company, up more than 8%. Now let us look at the defense sector. Certainly the stocks here continue to rise. Now Idea Forge, DCX System, Zen Technologies, all these counters are seeing a sharp surge from 1 to 4% as we speak. Now, on the flip side, let us look at some of the top losers in today's trading session. Schneider Electric is the next one, down nearly about 4%. Elcon Engineering has recovered a bit. And lastly, coming to Page Industries, that is seeing a cut of nearly 2%.
Okay, all right. Thank you so much for joining us as always, Upasana. Let's go across now to Himeen Kapadia from DR Choksi's FinServe, joining us for a quick technical check on the markets. Himeen, good afternoon. Thank you so much for joining us. What are the next important levels to watch out for on the Nifty?
Very good afternoon to you, Sonal. Thank you for having me on the show. It's always a pleasure. We were in a range between 23,800 and 24,200. Now that has got expanded to 23,800 to 24,550. That is a range we've been here for around 11, 12 trading sessions. But 24,150 is important from a near-term point of view. But if we have to take this out in the sense the swing high comes in at 24,588 only. And this high was posted on 21st April. So till then, we've been moving sideways. Okay, we've shown relative strength, resilience. Once we take this out, I think things will start looking better from a medium-term point of view also. VIX is 12.32. So everything else, Bank Nifty, which was a bit wobbly, has started recovering. Reliance is now in a mood to go up. IT is oversold, downside limited. So everything, I mean, index heavyweights seem to suggest that this could be happening sometime this month. 24,588, Sonal.
Yeah, all right. That is about the levels on the Nifty. Quickly, if you can tell us, Himin, before we talk about the Amphi data, quickly your technical bets.
Okay, I think cement is looking good as a sector. A bounce is coming in. Buy call on Dalmia Bharat at 1780, stop loss 1730, target of 1880. Medium term positives indicators looking good. Secondly, a buy call on Godrej Consumer. We are in an intermediate uptrend zonal, so one can buy Godrej at 1085, stop loss of 1055, target of 1145. Higher tops, higher bottoms, oscillators, support looking good. So.
Okay, thank you so much, Himain, for joining us as always. Have a great weekend. Let's talk about the June mutual fund data. The net equity inflow has improved on a month-on-month basis. That is something which was expected because remember, last month we saw 40% month-on-month decline in equity flows to come in at 22,897 crore rupees. So that number has seen an improvement in this particular month. The total AUM has improved as well, the assets under management that is. The other trends that we saw was large cap flows halved on a month-on-month basis, which was at the lowest level since December 2025. These are the main numbers that I'm talking about. SIP contribution also declined on a month-on-month basis, but it was above the 30,000 crore mark. Mid caps also saw a 33% month-on-month drop. So across the board, there was a big decline that we saw, but this time around, the large cap fund inflow has continued to decline. Yes, it is a positive flow, but it has come in at 2,061 crore rupees, which compares with the level of around 2,500 crore rupees on a month-on-month basis. So the large cap flows continue to decline in the month of June as well. Let's take a look at what the mid caps and small caps have done. Small cap funds flows have improved, looking at 5,600 crore rupees versus around 5,000 crore rupees on a month-on-month basis. I think that would be the case with mid caps as well because mid caps and small caps have seen some traction, but the large cap outflow is something that continues.
Large cap outflow continues, a bit of a concern, but along with the recovery as far as the equity market is concerned, what's actually transpired is that the total AUM has significantly gone high, 82.2 lakh crore, again up on a sequential basis. The equity market inflow has jumped up quite significantly, over 28,000 crore, which is just around 22,000 crore. Again, on a month-on-month basis, this is quite strong. Looking at the small cap fund inflow, that too has jumped up quite significantly, almost a 600 crore uptick when you're looking at it on a sequential basis. We also have Deepak Jain, President and Head Sales, Edelweiss Mutual Fund. Deepak, if you could hear us, what do you make of the numbers at first glance?
I think, May numbers were aberration in terms of flows. As you rightly pointed out, there has been a recovery in June. It also coincides with a small cap recovery in terms of the NAV and stock performance. If you see in the month of June, the indices or broad market on the small cap side was up close to 7-8%. In fact, we had launched an next top 100 SIF that was almost up 7-8% within the same month. So we have seen that getting reflected in flows as well. So I think though we are not at the peak of April flows, but there is a bit of recovery that we are seeing, which is underway.
The large cap inflows, they continue to reduce. Is that something which indicates sustainable momentum that you could see going forward as well? What has the general mood been on the large caps, Deepak?
If you look at data for last 2 years, let's say look at Nifty numbers. In March 24, the Nifty was 22,100. Today it's 24,000, almost 9 quarters, and returns are flattish. So there's a reallocation that is happening from large cap to hybrid, and in some cases people are also taking higher risk and moving to small and mid cap. But from an overall AUM perspective, the numbers still are very robust on a large cap side. But some amount of allocation is definitely happening. We are seeing a lot of flows in hybrids, which may be coming out from large caps.
Sectoral funds have also seen an increase on a month-on-month basis, while the NFO figure, that continues to be lower. At least there were 7 NFOs this month, which garnered around 480 crore rupees. You spoke about how hybrids have been doing well. If I look at some of the numbers, hybrid schemes have seen an inflow of around 12,892 crore rupees this month itself. We do have gold ETFs, where we did see an outflow in the month gone by. This time around, that has at least become positive figure, and in the month of June, gold ETFs have garnered some decent money. The SIP figure continues to be on our radar, but we talk about SIP cancellations as well. Deepak, what do you make of that? Because that number also continues to be very high.
Yeah, so if you look at this is a tremendous amount of maturity Indian investor. I pointed out Nifty numbers 2 years ago. If you look at corresponding SIP numbers in March 2024, that was 19,200. From 19,200, we are close to 31,000 crore. Almost 60% kind of a jump where markets haven't necessarily moved up. So people have shown tremendous amount of resilience and faith in creating wealth dip by dip, sip by sip. So I think if belief and momentum continues to be strong, though there are odd cases of some people redeeming or stopping their SIPs or changing funds, which can happen in a market which is range bound.
Right. Deepak, that was what I was coming to next. SIP inflows, what is the monthly number you will be comfortable with? Anything about 30,000 sounds good. And last time around, we saw a significantly higher SIP stoppage ratio. So is that something that was a bit of a concern last time? Has that improved this time around?
So, see, as stoppage ratio in a flat market, I am not necessarily concerned. And most of these, stoppages are on the small ticket size. So maybe first-time investors not necessarily feeling great. But I would look at more long-term trends. And your monthly contribution gives you a sense on where the long-term trends are moving, where your 5-year SIPs are, if they are stopping, then I'll be concerned. If short-term SIPs of lower value, people who have and not seeing great days, if that happens, that's a part of journey. We all have gone through it. In the last 20 years, multiple times, people have started and stopped and started and stopped. But the large message that I derive from the numbers on SIP is resilience.
Okay. Take that point, Deepak. Pleasure speaking with you. Thank you so much for joining us. That's the update as far as the AMFI data for the month of June is concerned. The equity inflows have improved. Large caps continue to see a decline in inflows, while mid and small caps have made a comeback. Gold ETFs also see an inflow after the outflow that we saw in the month of May. Slip into a short break now. We'll focus on Apollo Micro Premier Explosives deal. Apollo Microsystems has secured 41% stake in Premier Explosives in an all-cash deal worth 1550 crore rupees. We'll connect with TV Chaudhary, the managing director of Premier Explosives. We'll also talk to Pulkit Agrawal, director of Care Age Ratings, to make sense of what's happening in the defense sector.
Welcome back to Mid-Cap Radar. Well, you saw a very large deal that transpired as far as the defense space is concerned. Apollo Microsystems has secured a 41% stake in Premier Explosive via an all-cash deal worth over 1,500 crores. The transaction is expected to be completed by the end of the year. TV Chaudhary, Managing Director, Premier Explosives, joins us, and we also have Pulkit Agarwal, Director of Carriage Ratings, to break down the entire deal for us. Well, thank you so much, gentlemen, for joining us. Well, let me come across to you, sir. Mr. Chaudhary, thank you so much for joining us. Well, break down some of the key numbers for us. Number one, why are you selling out as far as Premier Explosives is concerned? It's a very good time as far as India's defense space is concerned, number one. Number two, how did you arrive at the price? And number three, what happens to the management post this particular deal?
Yeah, the deal is done by the promoter, Dr. Reddys Gupta and his family trust. So the reasons and all those, they know that. But from my point of view...
I'm sure you're in the loop, sir.
Yeah, but not at the initial of the deal, but yes,
sure.
I've come to know at the later stage. Yeah, the purpose of this is to strengthen the company and also to ensure that there is a continuity in operations and all those. And we being the hardcore explosives manufacturing and company, so the new generation munitions and all those are a combination of explosives and electronics and communication systems. So it was felt that it would give a good strength to Premier Explosives.
Okay, all right. Mr. Chaudhary, if you can give us a sense of what happens to the management now. The entire stake has been sold. Nothing remains with the promoter. Will there be changes to the management, the entire management as well?
So as far as the management is concerned, Dr. Gupta remains to be the chairman of the company and I remain the managing director. So my other colleagues. So basically there is no change in the management as on date. Of course, the future, we may be inducting some more on the board or other activities.
About yourself, will you continue to be associated with the company in some capacity post the transaction? What has been the talks with Apollo as for this? And number two, give us a sense on how the valuation was arrived for as far as this particular transaction is concerned.
Yeah, as far as I am concerned, I will be continuing as managing director. I will continue my term fully.
Okay.
And then, next what happens, you have to see. But as far as the pricing, no, I will not be able to give any. I have little knowledge on that, how both promoters, how they arrived at that price and then all those. It was between them.
Okay, Pulkit, coming on this conversation, what do you have to make of this deal? Mr. Chaudhary is unable to give us an answer on the valuation and the pricing of the deal. What have your calculations suggested? How are other defense companies trading at? And this valuation is something, what did you make of it?
So thank you for having me on the show. So see, if you look at India's defense sector overall, so there has been clearly an increased focus of the government on increasing in domestic procurement. Even if you look at the budget allocation for the defense, it increased by almost 15% to around 7.85 trillion. And out of that, around capital outlay on defense services also increased to around 2.19 trillion, which is almost a 22% jump as compared to the last year. Further, if you look at the acceptance of necessity approvals almost stand at 6.7 trillion, which is almost at all-time high. So there is a clear focus on domestic procurement, and that's why we are seeing a lot of these activities undertaking in private space. Even in the private space, if you look at the share of from the private companies in the overall defense procurement increased to almost 24% as compared to 22% in the overall procurement. So there is a clear activities.
In terms of this particular deal itself, how does this strengthen Apollo, or what kind of a change does it make as far as the Indian domestic defense space is concerned? What kind of capability does this combined entity have?
So see, with this, there would be clearly a increase in domestic supply for the company, but I have not gone in detail for this deal per se. But overall, clearly there would be a scale which will come into the picture for this deal.
Right. Mr. Chaudhary, coming back to you, in terms of FY26, it was quite a muted performance by the company. You did see declining revenues, you did see margins that went down. FY27, what is the kind of guidance that you're working with? Is it fair to say that you're targeting top line in the range of 600 to 700 crores with 15 to 20% of EBITDA margins? Is that a fair estimate as far as FY27 is concerned? And also a word as far as the timing of the deal is concerned. Could you have waited a little longer, and maybe get better valuations?
Like I said, it is the promoters who took the decision, and then they felt that this is the best deal they could get. And from my side, I have, of course, informed all the strengths the company has, and based on that, I think they have negotiated and taken the decision.
Okay, and in terms of FY27?
FY27, yes, 600 to 700 crores is our target, and we are marching towards that. And that is that too, as much as the 1,500 crores order book what we have, the target is to execute that first. And even if you execute half of it, we'll be touching 700 crores. And the second half goes to the next financial year. And we are expecting the new, the capex where we are putting money in the building the new mixing plant and RDX and HMX capacities. We are expecting they will contribute sufficiently in this year and also coming years.
Okay, Mr. Chaudhary, the other question what we want to ask you is in terms of the combined entity, what is the kind of synergy benefits that you can garner? Number one, for Apollo, do they get better backward integration benefits? For you, do you get access to more markets? What is it that you are actually gaining out of this particular deal? And especially from Apollo's point of view, what do you think they look for as far as your company is concerned?
See, the strengths, as far as strengths are concerned, we are a strong player in the explosives and high energy materials and rockets and missile systems. But the other areas which are developing nowadays, it's not just the explosive and high energy materials, it is automatic systems and electronics and communications in the areas of landmines, loitering munitions, and other special munitions. A combination of both are needed, whether it is for domestic market or export market. So with our strong presence in explosives and Apollo systems in the electronics and communication, we feel that we will meet the future requirements.
Okay, coming across to Pulkit. Pulkit, give us a sense, especially as far as, the segments that, both Apollo as well as, Premier is currently present in. What is the kind of growth trajectory you can expect? What is the kind of ordering that we can expect? And typically, do Indian players have an edge, especially when it comes to winning tenders?
So if you look at our overall guidance for the sector as a whole, we expect in next 4 years to grow by around 10 to 15% overall defense. What that is our expectation. Indian companies are getting capabilities through forming JVs and technology transfers. But it will take time. Obviously, it will not happen immediately. But over next couple of years, we expect the Indian defense companies to have those capabilities so that there can be an increase in domestic procurement.
Well, thank you so much for joining us today with your time and your take on this deal. With that, we'll slip into a short break. When we come back, we'll get you more on the markets and stock-specific action on the other side. Stay tuned. Welcome back. Very close to the 24,200 mark. That's where the Nifty is at. A lot of action in the broader markets. We do have Indian Bank, which is up 9% on the back of its numbers. MRPL is the other one, which is making an up move, 8% higher on MRPL. Even Chennai Petro is giving it some company. Real estate stocks, they are on fire today. Be it the South-based companies like Brigade Enterprises or Prestige Estates or the NCR-based player DLF, all of them are doing really well. And Lodha also made a recovery from the lows of the day. So going very well for the realty pack. By the way, the large cap funds have also seen an inflow. It's not a decline in inflows on a month-on-month basis. So that's just the correction across the categories. We have seen inflow increasing on a month-on-month basis.
That's right. And as we wrap up mid-cap radar, we are nudging towards the 24,200 mark as far as the Nifty is concerned. Just around 5 points available. Just around 5 points left, and all of the large caps now once again hitting the day's highest point. Looking at some of the auto names like Tata Motors passenger vehicle, names like Mahindra & Mahindra have all headed towards the day's highest point. But with that, it's all the time we have on this edition of Mid-Cap Radar. More news and updates on the other side.
Hello and welcome to Your Stocks live from the CNBC TV 18 Motilal Oswal studio. I'm Arundhati Ramanan. The markets today are firing on all fronts. We've got the Nifty that's now near the 24,200 mark, up about 234 points. We've got the Nifty Bank that's above that 58,000 mark, doing well. It's 1.5% in the green, and it is supporting the up move on the Nifty that we're seeing today. Indian Bank rallying 8% in trade, if we can bring that up after a strong set of numbers in Q1. And And that's helped pull up all of the other PSU banks as well, whether it's SBI, whether it's Bank of Baroda, all of them gaining about 2 to 3% in trade. The Realty Pack also doing really well in trade today. That's continuing its up move. It's done well over the last 2 days. That index is up over 2% in trade. We've got DLF, Godrej, Prestige, all of them up between 2 and 4%. The IT stocks, they're also participating in the rally as we speak. This was after TCS's numbers that came in line with expectations. There were no surprises there. And that was good for all of the IT stocks, pulling the other ones up as well. So Infosys doing well, TCS doing well, Persistent, all of them between 1 and 4% in the green. So that's how the markets are shaping up this afternoon. But it is time to answer all of your stock queries. And joining us today are Vaishali Parekh, Vice President Technical Research at Prabhudas Leeladhar, and Shaina Mukaddam, the independent market expert, to answer all of your stock queries. Ladies, thank you so much for joining us on the show today. You know, the first query is coming in from Ismail, who's writing to us from Kolkata. He wants to know whether to buy Nalco or wait for further downside correction in the stock. The stock is currently at 355. Shaina, what do you make of Nalco? Is that a good bet? Should he invest in the stock now or wait for some time?
Based on good afternoon, ladies. Based on valuation, what I feel is that at current levels, it does look like interesting to add even at current levels. Aluminum prices are stable, around $3,000, $3,200 per ton. And Nalco actually has about 2 million aluminum refining capacity, which actually it is expanding, adding another 1 million. And I would say that in terms of overall valuation, it is just about, even if you look at replacement, it's less than 2 times its replacement cost, and it's 5 times EV by EBITDA. So I would believe that even if you start buying it at current levels, it's decent.
All right. And Vaishali, what's your view on Nalco? And if he does want to invest in the stock, what are the levels he should watch out for?
Hi, very good afternoon to all of you. So I think overall, most of the metal stocks, and talking per se about Nalco, a good corrective move has taken place. We saw a brief correction and consolidation at around 330, 340 levels. So I would say it is a good level, depending on your time period. If it's for a trading perspective, wait for a little bit of a dip. But if it's for a long term, as you said, investment, then I think it is the right time to start buying, because I think it's ready for getting into a trend, and we can see higher targets like 440 and higher.
All right. The next query is coming in from Meher Chand, who writes to us from Vishakhapatnam. He wants to know whether to invest in Apollo Microsystem. There's been a lot of news around that stock. If yes, what is the entry level, target and time horizon? You know, before we get to the targets, let's go to Shaina for the fundamental on the stock. That stock is up in trade. And what's your view?
Yeah, so it's very much in the news. I personally also hold the stock, have been holding it for a couple of months, and it has done very well for itself in terms of stock price. Basically, what they are doing as of now is using their strong balance sheet actually to expand, make acquisitions. Recently, they had made the ADL acquisition for explosives. And now today they are, in fact, the latest, I think in the last couple of days, now we are hearing about Premier Energies, so which is also into explosives. I would believe that, the Premier explosive acquisition is not cheap. If they are acquiring it, like, see, last year Premier acquisition did something like little less than 400 crores of turnover. And they are acquiring it at a market cap, including, say, EV, including debt of about 3,800 crores. So it is not cheap, but I would think that it is a very good synergistic acquisition, and it will help Apollo Micro to actually expand its product portfolio, backward integrate, and have better offerings. So I think it's a good acquisition. They have, cash on the balance sheet, which they actually did a recent. In fact, they're planning to do a QIP, and they will have sufficient funds to fund these acquisitions. So I think it's a good growth story, factoring in all these things. And I would say, while current valuations are expensive, 30 times EV by EBITDA, if you exclude all these acquisitions, 2 to 3 years forward, I think the stock should do pretty well, being in the sector, as well as the acquisitions that it is making. Hopefully, it will improve its EBITDA margins also.
All right. So it is a good bet is what you're saying. Vaishali, what are the targets the viewer needs to watch out for if he wants to invest in Apollo Microsystems, and at what entry level?
I think, Arundhati, the stock has moved right from 160 to, recent high of 470 levels all in one go. So right now we are seeing a little bit of a consolidation and definitely on a near-term support basis, 380, 390. So if longer term is the horizon, then I think 380 acts as a near-term support, but I won't be disturbed even if it goes to around 350, 360. So accumulate between this range 380 and 350 levels, and even now, and wait for the near-term target comes to 470 once again. So that can come even in a fortnight's time, and beyond that, we can look at a target of 500. So I'm looking at a time period of say around 1 or 2 months for a target of 500, and a positional trade would take you to around 600, 700.
All right. The next query is coming in from SP Khandelwal, who writes to us from Jaipur. He holds 100 shares of GE Power at 860 rupees, and he wants to know the outlook from a 6-month perspective. He is making a loss on the stock. It's currently at 822. Shaina, the fundamental view on the stock, do you think it's a good investment and he should stay invested?
The group is very strong. It is part of the GE Vernova Global Group. Having said that, I think just GE Power, in my view, I would say that most of the upside, it is a turnaround stock. If you saw FY26, actually, they turned it around, made a profit, good profit, versus 4 preceding years of losses. So it's a turnaround stock. Having said that, now the price has also really gone up and more or less factors in, at least for the medium term, most of the upside. The one negative that I see, which is why I'm saying it is a switch from current levels for me, is that the government has introduced their opening of their government tenders to Chinese companies for power equipment. So at least it's for 2 years. So I think that is likely to put some pressure on their at least margins, if not revenues, going forward. They have sufficient order book to cover at least 1 year, current year, but I think there will be some pressure going forward. So, and valuations are not cheap. So I would say it's a switch.
All right. So you would say it is a switch right now because of these risks coming in from the policy move. Vaishali, what's your view on the stock? I mean, it's not too much lower than the price he bought it at. Any key targets that he should watch out for, or do you also believe that he should book his losses and switch?
I'll say that actually all these stocks, and talking about GE Power itself, it was a euphoric move. Again, one-way rally, and then now we are seeing, because of course it was too overheated and overbought, so we have seen a good corrective move coming in. Now that the person is continue holding with a stop loss of 800, because that would damage the trend even further on. From here, maybe there is again a new round of momentum setting in. So for now, it is quite intact. The trend is intact. So hold with a stop loss of 800, exit if it breaks, and wait for a rise. It can go to 900, 950 from here on.
All right. Okay, so that's the view coming in there on GE Power. The next query is coming in from Sarvanan, who writes to us from Chennai. He holds 1,735 shares of Jio Financial Services at 274 rupees. He is making a loss. The stock is currently trading at 241. He wants to know the long-term view on the stock. Shaina, I'll come to you for the long-term view.
If an investor is having a long-term view, there are two things one looks at. One is the management capability, and second is the business opportunity. Now, for both these factors, Jio Finance is very strong, very good to hold for the long term. The stock is actually corrected, consolidating in the last couple of months because fourth quarter was a bit disappointing. The expenses were pretty high, which actually ate into some of the profits. That is actually hopefully will start correcting in the medium to longer term. But otherwise, if you see the growth in their revenues has been very strong. You look at the AUM for their NBFC, that is actually grown by about, I think it's doubled. And while they are, the tie-up and the mutual fund segment is actually showing a little bit of slower growth, but that we will need to watch and see. But otherwise, in terms of valuation also, at 1.2 times book, it is not too expensive. So I would suggest continue holding, hold it for the long term.
All right, continue to hold and hold it for the long term. Vaishali, do you believe that he should hold it for the long term as well? Any targets for him to watch out for?
I would say so. Actually, again, this stock has really not performed at all and not participated in the rallies that have come in the past. So long consolidation happening between 230, 240 levels. Now today's candle, it shows some revival. So I would say with 230 as support, I think add more, because since you bought at higher levels, accumulate at these levels so you better your buy price. And I think the near-term target that I would look at is around 270, and above 270, there is a confirmation of an uptrend to start, and that could trigger higher targets. So for now, just keep a range of 230 to 270.
All right, so that's the range to watch out for. All right, Vaishali and Shaina, thank you so much for joining us on the show. It is time for us to take a quick break. But on the other side, the management of Indian Bank joins us to discuss the Q1 numbers.
Welcome back. Indian Bank has reported a strong first quarter, double-digit growth in profits and operating earnings, net interest income, asset quality improvement, strong business growth, and even a margin improvement for the quarter. No surprise then that the stock has perked up in trade. So let's bring in Binod Kumar, the MD and CEO of Indian Bank, for more on the way ahead for the lender. Mr. Kumar, thanks very much for your time here on CNBC TV 18. You know, your loan growth, your deposit growth, all of that is actually running ahead of the guidance you had given us for the full year. What is driving this outperformance? Is it broad-based across retail, MSME, corporate? And these numbers from the first quarter, do they give you enough confidence to revisit your FY27 growth guidance?
No, so when I have given guidance at the end of the year, I was confident that I will do better than that. I have a very strong team, and you must have noticed my CASA growth is 15.43%. And all the sectors, RAM also has grown at very 14.80%. MSME has grown by 17%. Retail has grown by 18%. This growth could have been even better because only but for the agriculture, which is around 9.96%. Because of the change in the guidelines of the RBI for the jewel loan, the first 2 months were little sluggish. Thereafter, we picked up. So I am confident that we will be consistently achieving whatever guidance we have given. Revision of the guidance I will see, because so many things are still hanging over around, so many uncertainties are there. So still after Q2 I will see if we can do better than that.
Okay, so for now deposits 9 to 11%, advances 11 to 13%. You stick with that?
Yes.
Okay, quickly on the deposits before we move on, how much have you raised in foreign currency deposits so far under that special RBI scheme, if you could update us?
Yeah, till yesterday I have raised around 140 million.
140 million. And what is your expectation by the end of September?
I'm expecting to raise in the range of 1.5 to 2 billion in shape of FCNR, and around 6 to 7 million in shape of ECB.
Okay, that's a big number. Hopefully the street takes note of that, and we'll put that out on flashes as well. Quickly on your margins as well, sir. There was an expectation for small contraction in the margins, but you've been able to expand that as well. 3.29% overall, 3.41 is a domestic NIM number. That's also, again, above your guided range, which was up to 3.25%, if I'm not wrong. Would you say margins have peaked here, or is there room for further improvement with the RBI expected to cut rates, hike rates later in the year? And are you revising your guidance here?
No, see, we have made some strategy, even low yielding in this quarter also. I have said it around consistently we are setting, and even in this quarter I have said it around 6,000 crore. So low yielding we are setting wherever we get opportunity. Plus we also remain very mindful for that's why you might have seen my growth is a little less than the system, but I am mindful of the balance between growth and the bottom line NIM. So we remain very mindful when raising resources also, and when going for the lending also. And my bulk has remained at the same level as of the March it was 1,61,000 crore. It is same at the same level. So we remain very mindful. Going forward, NIM, I think there may be expansion, not a very huge expansion, but marginal expansion we can expect.
Okay, so a marginal expansion over the overall number, which is 3.29% at the moment. Let me quickly get to asset quality. Again, there we've seen an improvement. Your fresh slippage is at 1,300 crore. But if I was looking at the breakup, there's been some spike we've seen in your MSME book from 450 crores to more than 600 crores in this quarter. What's really happening there? Is it on account of West Asia? And apart from MSME, any other pockets of stress you're going to be watchful of, if you could highlight for us?
No cause of concern. MSME, it is because of the one or two accounts. Otherwise, there is no concern. And so far, West Asia crisis impact we have not seen. I cannot say when it may fructify, but so far we have not seen even SMA number. If you see, my SMA number is also very sequentially also it has come down from 4.73 to 4.69. So we don't see any concern on the asset quality side so far.
Okay, and for the full year, again, your credit cost and slippage ratio, would it remain sub 1%?
Yeah, definitely. Credit cost will remain sub 1%. Presently, it is 0.23. And slippage ratio will also remain sub 1, 0.77. Sequentially, I expect that it should go down only.
Okay, that's again a strong guidance coming there for the street to take note of. Again, sir, on the ECL provisioning, I can see that you've created 1,000 crore rupee additional buffer. The ECL guidelines, of course, kick in from April 2027, and that will be staggered over a 4-year period. How would you guide the street? I mean, is the provisioning front-loaded now, or should investors expect more provisions in the coming quarters, and will they be meaningful provisions like the ones you've made?
See, my expectation is by the time I transition to ECL, I should be in readiness to absorb all the impact in the first quarter or maximum in the first year itself. I have estimated ECL impact of around 3,000 crore. And I have given guidance that during the year, I will be creating provision around 1,500 to 2,000. So out of that, 1,000 already I have made provision for ECL. So going forward, I don't see much impact. It should be a smooth transition. Don't see much of the impact.
I see, sir. Again, for your treasury book, if you could give us any guidance, yields have been trending downwards. So in the second half, do you expect a meaningful improvement?
No, see, treasury initially we were expecting that it will not be very good, but because of the truce in the war, you see the yield has substantially come down from 7.02 in March to it has come down to 6.75. That's why even this quarter treasury profit is better than expected. I was expecting in the range of 300, but ultimately it is 500. So treasury profit, I think going forward, assuming yield will remain range bound, neither very good profit from treasury, it should remain in the same range.
Okay. So a word on your capital as well. Overall, your CET1, of course, has improved in the quarter. The overall number has moderated slightly, I guess, because of your loan growth. Is your existing capital enough to comfortably fund these growth ambitions? Or do you see a need to raise capital? If so, how soon?
No, I think 17.53 is very good capital. And RBI has permitted to add back quarterly profit for computation of CRAR. But we have not taken into that. If we have added back, then my CRAR would have been better by 72 basis points. So I don't see, growth capital I don't need. Last quarter, although we still have provision for raising capital through QIP or other source of around 5,000 crore. But I don't see any need of the capital. ECL, I was thinking maybe I will need for ECL, but since I have already made 1,000 provision going forward also, I will be creative. As I have given guidance between 1,500 to 2,000, I will be able to create that. So I don't think I will need to raise capital either for growth nor for ECL.
Okay, no requirement to raise capital to fund your growth or for the ECL provisioning. Finally, sir, your CD ratio, I remember earlier you had said the target, the ambition is to get to around 80% or so. You're currently a little above that, almost 82% or 81% or so. By when do you expect to hit that target?
81% is also comfortable. If you see domestic, it is less than 80 because of the overseas where the CD ratio typically remains higher. So CD ratio for domestic is still less than 80, but I am comfortable with 81 also. No need to bring it down. I'm comfortable at 81.
All right, sir. Then any final word you want to leave the investors with on how FY27 would shape up and the key highlights we should watch out for then after this first quarter performance?
I think we are on the track. And one thing, as conclusion, one thing I will like to highlight, participation of the branches has increased. Earlier in Q1, normally 25 to 30% of the branches used to achieve their target. This quarter, 51% of the branches has achieved the target. So buy-in from the staff has increased, which has supported us in the performance. So hopefully this type of performance we will able to sustain.
All right, Mr. Binod Kumar, thank you very much for joining us here. First on CNBC TV 18, after that stellar set of numbers in the first quarter, and we hope to connect with you again, in the coming quarters as well. Thanks very much for your time.
Thank you. Thank you for having me here.
And on that note, we'll wrap up this show as well. Thanks very much for tuning in, but stay with us. More news and updates continue right here after this short break.
headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Taiwan is a foundry-heavy market, so it is seeing some lows.
The margins declined on a quarter-on-quarter basis by 130 basis points on account of a wage hike.
Iran reported strikes on, a perimeter of a nuclear power plant and 2 railway bridges.
This is the fourth quarter of consecutive growth.
Now, this stake will be acquired from the promoters at a price of rupees 698 per share.
So 24,150, it's about 0.8% higher. The Nifty Bank is up 0.75%, 0.9 actually.
If I look at IT as a broad space, sentiments have been the overhang.
This approval certainly removes the regulatory overhang that has been going on since quite a while.
The market's looking to end the week on a positive note.
Whereas our JLG book will continue to grow at around 10 to 15%.
Chosen to reduce its provision, which is not necessarily a bad thing.
Continues to be a market in the green. So saw a 33% month-on-month drop. So across the board, there was a big decline that we saw.
Well, that was the day so far. 1 hour to go before we wrap Friday's trading session and the week. And the Nifty is above the 24,200 mark. It's been a steady positive session. 1% gain on the Nifty Sensex as we speak, with the mid-caps outperforming. You're watching Closing Bell. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I am Reema Tendulkar. With me are Sonal and Hormuz. Hi, guys. Afternoon.
Hey guys, good afternoon. It's been a long week, longer for you, Reema. So you started with the earnings.
So volatile, right? Like the whole first half of the week was markets coming under pressure, and then the rebound yesterday and today.
The West Asia volatility came back, and that is something that the markets avoided last 2 days. So we are ending the week with Nifty so far above that 24,200 mark, as Reema has been mentioning. What a performance by the mid-caps today. That has definitely supported the market moves that we've been seeing. Bank Nifty doing really well, and the earnings coming in thick and fast for PSU banking names. Indian Bank, for instance, really fired up the sentiment that we saw in the PSU banks, and a lot of earnings. The commentary from Muthoot Microfin, they might upgrade their guidance in their quarter 1 numbers. So it's been a good day so far for financials. The big question is whether we sustain that or not, or something happens over the weekend.
We hope not. Definitely hoping not for anything to happen over the weekend. But yes, it's been a good a couple of days for the markets after the rebound that we have seen, and 24,270 is the level that you need to watch out for going for a positive close on the index. What has already turned positive for the week has been the Nifty Bank. 57,938 was that level that it had to cross. It's trading well above that. It's trading above the mark of 58,100 now, so a 900 point up move on the Nifty Bank. The star of the day undoubtedly has been Indian Bank. You just heard the management from just a few minutes ago, 10% higher on that stock. But on the flip side, Bank of Maharashtra's numbers have left a little to be desired, I guess, for the street. The stock has cooled off very, very sharply from the highs of the day, and is now just down up less than 1%. So it's a sharp cool off. There's some rise in provisions on a sequential basis for Bank of Maharashtra. We'll get more details on that, of course, in just a bit. But the day, of course, also has belonged to the mid-cap index. The mid-cap index is at a record high. In fact, it has, from the lows that it made on the 2nd of April of this year, it's up 17% from those levels. And if you take a look at the movers as well, it's a very diversified list of movers. Oracle Financial is possibly the only IT name that is still trading with gains on a year-to-date basis.
And Ramco Systems.
And
That's
Ramco
the
Systems.
other products company. So both
Yes.
of them are the ones with gains. Yeah.
And of course, Oracle is, of course, at a 52-week high as well in today's session. And Vodafone Idea 64, BHEL 56, BHEL I was meant to say. Radico Khaitan and Prestige Estates too, seeing some healthy gains. Of course, there are a lot of other real estate names as well that have done well in the mid-cap index from the lows of April. But let's unpack the final hour of trade and tell you what's lined up on closing bell. The market is holding on to the opening gains as of now. The Nifty is hovering around that 24,200 mark. The broader markets are doing well, as we just mentioned. The mid-cap index is at a record high. Metals are the ones doing well. Life insurance counters are also doing well because the industry has recorded a 21% growth in June. Yash will tell us how individual companies fared. Of course, IT stocks led higher by TCS. That itself is off the highs of the day, but the mid-cap IT stocks are firing away in today's session. We get you the highlights of the quarter gone by as well. And of course, the Nifty Bank, 900 points higher on that index. The Nifty PSU Bank is doing well as well on the back of very strong numbers from Indian Bank. The Bank of Maharashtra, though, has cooled off from the highs. We'll await some slippages numbers as to how they fare. And then, of course, the stock that has cooled off from the highs of the day.
Okay, all right. So that is what we have lined up for you on the show. But how should you position yourself in this last hour of trade? Bonanza Portfolio's Mitesh Thakkar is joining us now with some closing strategies. Mitesh, so far so good for the markets. What are some strategies you would like to advise our viewers? What kind of moves do you expect on the markets next week?
Yeah, good afternoon. So I think, day before yesterday when the market was falling, I was looking at 23,800, 850 as a support zone. That held. But it only means that we are basically back into that range of 23,800 on the downside to roughly about 24,354 on the upside. So I think we might head towards 350,400, but not sure whether we'll get a breakout on the upside or see some continuation on the upside immediately. So for the timing, we're keeping that as the near-term target, 24,400, give and take a few points. And then if we cross that, 24,600 is the April high, which could also be tested. Having said that, on the stock side, I have buy on Union Bank with a stop at 161.5. Look for targets of 170. And Blue Star is a buy. Keep a stop below 1620. Look for a target of approximately 1700.
Okay, thank you very much for that, Mitesh. We'll come back to you. So for now, maybe a little more upside, but doesn't see a big breakout on the Nifty at least. But let's talk about India's life insurance sector that's showing no signs of slowing down. The June numbers highlight very strong momentum across the industry. The sum assured growing 21% on a year-on-year basis. Yash joins in with the details on this. Yash.
Well, just day before yesterday, we had reported that the June premium collection looked strong for the life insurance industry. SBI Life, Max Financial Services leading that growth as far as the June numbers are concerned. Now, that was premium collection. Today, what we're going to talk about is the sum assured, essentially the cover which the life insurance industry is provided in the month of June. That has seen a healthy growth of about 21%. Again, SBI Life leading a large part of that growth. SBI Life's sum assured in the month of June has grown at 43%. Axis Max Life Insurance, their sum assured has seen a growth of 35%. HDFC Life at 31%. ICICI Prudential Life at 26%. Canada HSBC Life Insurance, though it's small in size, but that company has seen a growth of about 87% when it comes to the sum assured in the month of June. Why is the figure on sum assured important? That's because it gives you an indication in terms of how the margins for the company are likely to shape up in the coming quarter. Higher sum assured could indicate that the companies have sold a larger portion of protection products, that is term life insurance products, where the sum assured is generally higher. And hence the margins on that side of the book could be higher for companies. So an indication as far as how the margins of the company could perform in the first quarter, the results which are about to come next week. I'll also speak about policy growth in the month of June. HDFC Life has seen the strongest growth as far as the new policies issued in the month of June is concerned at 14% growth. ICICI Prudential Life with about 6% growth. Axis Max Life Insurance with 13% growth. SBI Life with 5% growth. Canada HSBC Life has seen about 25% growth in terms of new policies issued. And finally, Life Insurance Corporation of India, or LIC, seeing a 5% growth in the number of new policies issued in the month of June.
Okay, all right, Yash, thank you so much for joining us. So that's about the insurance sector. By the way, Waterways Leisure, that should be the stock on your radar. It's just a recent listing. The debut was muted, closed at 17% or listed at 16% discount to its issue price at around 681 rupees a share. The company has now announced that there'll be a stock split. 1:10 is the ratio. Of course, they had announced earlier that they will be taking up this resolution. This has come by, but there is a big fall from the highs of the day. The stock rallied on the back of this announcement earlier. It did well after that muted listed, but now again at the day's low. Bank of Maharashtra is the other one on the back of that lower net interest margin growth on a quarter-on-quarter basis. That has come in lower both on a YY and on a quarter-on-quarter basis, and that's why that stock too has come up from the highs at the day's low for these two.
You know, though, mentioning Waterways, it listed at a discount, ended 17% lower on its listing day, then had a 3-day winning streak going into today's session as well. So the IPO price was 808, and it's now down around 2.5% after the stock split announcement. Of course, mind you, it's very little float in the market. The promoters still hold around 89% after the IPO. So keep that on your radar. And of course, Bank of Maharashtra has cooled off significantly from the highs of the day. Ashish Chaturmota, the managing director and fund manager at Jio Financial, is joining in now. Ashish, good afternoon. Thank you for taking out time. We've seen a lot in the market, which is now one step forward, two steps back. The earnings season has also begun, which will pick up pace over the next 2 weeks now. Do we just remain locked in this very narrow range because a very significant upside trigger appears to be missing, if that is the case?
Hi, very good afternoon. Thank you for inviting me on this show. So, as you rightly mentioned, yes, at least for Nifty, it makes a lot of sense what you said, because if you look at even from the earning growth perspective this quarter, we have not seen any meaningful recovery, and with even IT companies also not showing very strong set of numbers, I think the entire focus of the market remains on the small and mid cap basket, and this is the reason why, because of a very strong earning growth momentum which they showed in the last quarter, and now also we are witnessing the numbers looks quite promising, at least for this small and mid cap space. So I think even the banks, if you look at Indian Bank, or even for that matter some of the PSU banks or some of the microfinance companies, the numbers are very, very encouraging, and that's where markets are going to reward these sub-segment themes within the larger themes. But as far as broader markets are concerned, or Nifty is concerned, it looks like we are going to remain into this consolidation phase for an extended period of time. And as FIs are also not showing any significant interest, maybe some last 3 weeks, some buying interest has emerged, but it is not meaningful enough to make sure that Nifty crosses 24,500 or 25,000 kind of trajectory.
Ashish, wanted to get your views on the IT sector. Basically, I think, what we gathered from TCS, the management commentary, the conference call, the numbers is that maybe the downside is protected. Expectations have been lowered. Valuations are at a 10-year low. And the companies seem okay to deliver on those very subdued, lowered expectations like TCS did. And maybe the near term is okay because the company is talking about Q2 being positive. They see demand picking up sometime in Q2 because of pent-up technology demand. Overall, FY27 should be better than FY26. So that's the near term. But I still don't think we've got clarity on what the medium term is going to look like 2 years, 3 years down the line, because we specifically asked the management of TCS that when do you think the new revenue from AI, new volumes from AI will offset the AI deflation? And he didn't have an answer to that. He's like, we'd like it to be soon, but we don't know. So this year maybe the industry grows 2-3%, but we don't know whether it stays at 2-3% for FY28, then FY29 it picks up. So that long-term clarity, medium-term clarity is still missing. So in that sense, what's the call now on large-cap IT names or mid-cap IT names or product companies? Like Hormus was talking about Oracle, Ramco. These are companies which have outperformed and investors have gravitated towards them.
So as far as for the large cap IT companies, or to be very specific about TCS, so the overall TCV is in a good shape, but the challenge is if you look at the AI service business, it is a very lumpy business at this point of time, and it's a very short cycle. So if you'll see, the projects are typically 1 quarter, 2 quarter projects, and then again they have to bid and again win these. So this is not giving a very strong revenue visibility even from AI services or AI-led transformation businesses. So all put together, we firmly believe that with lesser discretionary IT IT spending, and then the challenges coming from the AI side of the story, and even the AI-led transformation business is not very, I would say, annuity income even at this point of time. So this numbers look very, very, I would say suboptimal, because if you'll see the overall quarter-on-quarter growth of the numbers, it is just 2%, and maybe from a valuation perspective, from a FCF yield perspective, it will look interesting, and that's not the case now. It was 6 months back also. It used to look interesting from a valuation perspective, but investors are not making money because the growth is completely missing, and there are no immediate reason to believe that IT is going to come out of this confused state at this point of time. So we are completely avoiding the large cap IT names. But definitely where our interest is lying is particularly companies like Coforge or Persistent, because of the kind of acquisitions they have done. And I think at some point of time, Coforge will enter into that 23-24% kind of growth phase. And that's where our top pick in the entire IT space would be Coforge. And as you rightly mentioned, on the product side, Oracle Finance is something which looks very promising.
Okay, all right. So you like something in the mid-cap IT space. Hold on. We will actually listen into what the management of TCS had to say about their AI revenue and on the Q2 revenue outlook as well.
Could be in the range of, in a given work, okay, when you renew it, or when it could be about anywhere, what we see on a large project would be about 10 to 15%.
Over 5 year, or a 5 year project, or
on
3 year?
Overall project value, it could be 10 to 15%. But we expect that it should not be, maybe it may be volatile or deflationary in the top line, deflationary in the short run. But in the long run, we talked about so many other projects that will happen because of AI. So net, we still expect this to be positive, and there could be some short term volatility, and we are looking at what we are seeing and what we are doing. We are quite happy with the overall progress you have made this quarter. Difficult to predict because the deflation usually kicks in very quickly, and new projects, when people start leveraging it for their business transformation, that takes little more time. Overall, still I would say Q2 is positive, but at the same time, things been quite volatile in terms of whether H1 is better than H2. Okay, that I don't want to say H2 will be weaker than H1. Okay, but we are quite positive on Q2.
Okay, and FY27, if you have to characterize it?
Last quarter also said it will be better than 26. I still stick by that. It will be better than 26.
The management of TCS, the stock has cooled off substantially from the highs of the day. It was up 4% at the start of trade, but now holding on to gains of just about 1%. What is still at the highs of the day, though, is the banking index. The Nifty Bank well above the mark of 58,000, heading back towards that 58,100 mark as well. So 800 points higher on the Nifty Bank. Ashish, compared to the Nifty Bank has been the better performer, at least in terms of the setup as well, that appears on the charts. But for the banking stocks, we just had a couple of banking results, both of them seeing divergent reactions, both Indian Bank and Bank of Maharashtra. But for the private lenders that announce results in the next couple of weeks, would that also provide an additional trigger if the results are good enough for the markets to move higher?
So in the NBFC segment, we are quite positive on the CV financiers, because we firmly believe that the way, for example, Shriram Finance, if you look at their cost of borrowing has come down significantly, which will get reflected into the margin profile of the company. And even if you look at from a growth perspective, 15 to 18% kind of growth is what is being witnessed for players like Shriram and Cholamandalam. So we firmly believe with a very reasonable valuation of 2.2, 2.3 time price to book and a ROE of more than 15-16%, with these kind of growth and cost of borrowing coming down, players like Shriram Finance, Cholamandalam looks very, very promising. Even a space which has seen a very sharp fall in the last 2-3 years time frame was the microfinance space. But what we are seeing is a very good traction coming into a lot of these players. So just to give you a context, company like Muthoot Microfinance, here we have seen a very, very strong growth coming into play, and also lesser dependency on the microfinance side of the story. So now a lot of these gold loan, personal loan, SME financing is also taking part of the overall exposure for some of these, I would say, MFI players, and this is also transitioning the margin profile of these players. So our belief is that now, since the credit cost is below 1%, and the overall net NPA numbers are also very under very comfortable zone. So this is making this is looking like this entire NBFC story, particularly the microfinance story, is also looking very promising at current levels.
Okay, so that's about the financial space. Ashish, one segment that has done really well is the realty space. The index was down 30% from the 52-week high when we started this year. It worsened over time, but it has made a quick comeback. This month itself, it's up around 9%. We are getting all these quarterly updates from the companies, and they have indicated good demand despite the macro level picture not looking so good. Even today, the realty pack is the top gainer. It is at the day's high as we speak. All the realty names, be it DLF, Lodha, Brigade, across geographies are doing well in trade today. What do you make of this up move? Is this sustainable? Because at a macro level, the growth, of course, has slowed down, but it is not declining for now.
So what we have observed is that at least the luxury segment is doing extremely well for a lot of these players, and this is where I think Ubra, Realty, DLF, or Prestige, these are the players who are very, very active into the higher ticket segment, and that's where the growth has been really good even in the last 6 months time frame. Even if you look at the pre-sales data, it's also very, very encouraging. And now with inflationary risk also coming down to a great extent, I think this is also going to be very positive for the real estate space. But one thing, this space has already done very well in the last 6 months time frame. So maybe at current level, some consolidation is possible. But yes, from a 6 to 12 month perspective, this space is looking very promising. And Oberoi Realty and Prestige Estates, these are the two names which we are liking in the entire basket.
Oberoi and Prestige. Let's talk about Muthoot Microfinance. That's also surging on the back of the Q1 business update. The management also joined us earlier, and they had some positive, very positive commentary. So Ananya joins in to tell us the numbers and even what the management had to share, which got the stock so excited.
Well, yes, Muthoot Microfinance came out with a strong business update. You can see the stock also reacted positively today due to that. And if you go visit a year ago, the key concerns were the portfolio stress and collection quantity. Now, this quarter, this management also highlighted the focus has shifted back to growth, with AUM rising 18% year-on-year and disbursement jumping 49%. Now, but the most important part is the quality of this growth. Now, collection efficiency improved to 97.97%. The individual loan portfolio maintained near zero delinquency, and the company continued reducing its dependence on traditional group loans by expanding individual business loans and entering gold loan co-lending with Muthoot FinCorp. Now, the funding position has also strengthened, supported by CRISIL upgraded to AA-, a stable rating, healthy liquidity and rising digital collections. Now, the market appears to be recognizing this improvement, with the stock gaining around 23% in the past 1 month and nearly 35% over the past 1 year. Also, today the management mentioned that the JLG book will grow more than 20%, and JLG will see more than 100% disbursement, likely to up a diversification target beyond JLG as well. Now, this may they have also revised their targets to 20%. Now, if momentum remains good, they said that they will be able to reduce GNPA by over 100 bips this year. So, yeah, good business update by them.
Good business update indeed. 12.5% higher on Muthoot Microfinance. Ananya, thank you for that update. Take a moment to thank Ashish as well for sparing time and joining us today on the show. Take a short break on closing bell. The market still extending its gains now, 24,220 on the index, 50 points away from turning positive for the week. Back on the other side with Abhiram Ileswarapu of BNP Paribas.
Welcome back. You're still tuned into Closing Bell. Well, let's talk about the AMFI data that we got for the month of June. That's the mutual fund data. And the overall trend suggests that the equity inflows have improved on a month-on-month basis. They have come in at 28,961 crore rupees, which compares with 22,897 crore rupees. It was expected to be an improvement on a month-on-month basis because remember, in the month of May, equity inflows saw a decline of 40%. And there was a decline across all the categories. And that trend has reversed. Now, large caps, small caps, mid caps, all three of them have seen an improvement on a month-on-month basis. Where for large caps, it has come at 2,067 crore rupees versus 1,600 crore rupees. For mid caps, it has improved to levels of 6,100 crore rupees, which compares with 4,385. Even small caps have seen an improvement to 5,600 crore rupees, which compares with inflow of around 5,000 crore rupees. This is something which is reflected in overall market move as well in the month of June, especially the outperformance that we've seen in the middle and small cap space. Some contribution that came in from the sectoral and thematic funds this time around, 1469 crore rupees. So here is where inflows doubled on a month-on-month basis. We did see specific sectors doing really well, and those mutual funds seeing more inflows as well. NFOs is where the activity declined again. We did have around 7 NFOs in the month of June, but the inflows from them were just 460 crore rupees, which was the lowest that we've seen in a lot of months. It is actually at a record low in terms of inflows from the NFO space this time around. The SIP contributions, after declining in the month of June, did make a comeback in the month of, after declining in May, did make a comeback in the month of June above the 31,000 crore mark for now. And gold ETFs, that was the other thing that did see a decline in the month gone by because of the gold prices also declining sharply. That has made a comeback now at around 3,443 crore rupees. The multi-asset category, that was something that was declining in last couple of months, has made a comeback again. 4,810 crore rupees are the inflows. So overall, the momentum has improved and the mood as well across the categories.
Okay, thank you very much for that. That's the June numbers. Let's invite on the show Abhiram Elaswarupu, Head of India Equities, BNP Paribas, on the show. Abhiram, before we get chatting about what to expect from the quarter, the market mood, can't not ask you about IT. You know, you've been an IT watcher for how many decades now? For a long time now. What's your take? Do you think the downside is protected from here on? Is there a structural opportunity to play IT, or it's just in a void?
Hi, Rima. Thank you for having me. So selling the structural story has become quite difficult with IT, as you can imagine, especially with the AI deflation theme kind of playing out. Now, that said, at least tactically, I think that we are near a bottom for IT services. As you may see, results have just started, and even if they're more or less in line, I think investors may start to look at the space more favorably. Bear in mind, the stocks have been beaten down considerably. They're under-owned, and valuations are quite cheap. Now, from a longer-term perspective, I think it will take IT services companies to demonstrate that their value proposition is still intact. In other words, clients will expect companies to pass back some of these AI benefits and for the companies to retain a little bit themselves so that they can protect their margins and sustain growth. So the short answer is, in the near term, I think there is an opportunity to buy this sector. Longer term, I think we'll have to still wait.
Abhiram, good afternoon. Thank you for joining in. Is the near-term opportunity the opposite for the lot of the capital market names? The kind of regulations that have come in, the details that are emerging from a lot of the derivative transactions as well, from the business updates that the companies have put out for the quarter. How are you playing this theme? There are multiple ways, of course, to play it, be it the exchanges, be it the asset managers, or you're just playing it through the discount brokers.
Well, to be honest, I haven't dug to that level of depth in terms of the in the space. Now, that said, I would say that asset management is a long-term theme in India. As you can see, you just showed the AMFI data that came out. Flows are very strong in India, and we have a pretty favorable industry structure as well. And the large players are getting larger, not just in India, but across the world. And so asset management is actually quite an interesting theme from a long-term perspective. Now, I think from a broader financial standpoint, we like the space. And now India has so many opportunities to play financial services. But I think at the very least one should look at private banks today, simply because they seem to offer the best growth opportunity in terms of credit growth, as well as asset quality. So if I were to break down financials a little bit, from the very beginning, we like private banks, drill down a little bit more selective into insurance, and then asset management.
Okay, that's about the financial space or the market participant space, Abhiram. One of the segments which has been consolidating for a long time in the last 2-3 years has to be chemicals because of inventory destocking, global demand pressures, and then we had the West Asia crisis as well. Despite them, some pockets, be it the amine segment where Balaji Amines, alkyl amines are up 90 to 100%. There's Accuras Chemicals, which is up another 50-60% this year. And I know chemical companies have different product profiles, so you can't put them all in the single basket. But are you seeing some opportunities available in the chemical space now? Because a lot of these stocks have not done anything in the last couple of years.
Well, again, I wouldn't go specific just chemicals, but I'll kind of broaden out the question a little bit more to say that if you see one of the big themes for the second half of the year actually is going to be falling commodity prices and falling input prices. So we start looking at from that perspective, there are several sectors to start playing out. One of them could be actually all the way from consumption. And consumption, then we go into, for example, air conditioning, then into four-wheelers, and so on and so forth. And we broaden that out into various other sectors. So chemicals per se, you'll have to forgive me, it's not a space that I've done a lot of work on. But I think falling commodity prices becomes a pretty reasonable theme to look at for the second half of the year.
Okay. Since you're talking about falling commodity prices, what would you make of the oil and gas space in that case? Because oil or gas, the prices there which surged are now coming back to stabilized levels. Do you think in that case you can look at some of these upstream or downstream companies in any form?
That sector has been very difficult to call, as you can understand. I mean, on the one hand, we had oil prices jump significantly, and on the face of it, that should have benefited the oil producers. Now, since then, oil prices have again fallen significantly back to the same price where they started from, more or less. So rather than directly looking at oil companies, it would make some sense to look at what would happen through the rest of the year. One of the areas that you could consider as a outcome of falling oil prices could be autos. And that also comes down to the fact that within autos, the base effect is obviously a factor, but you see numbers actually looking really good, especially for four-wheelers, coming to high teens growth. I know some of that is partly led by the GST benefits and so on, but even if you strip that out, it does look like there is considerable demand. And I just heard you speak earlier about how corporates are generally talking about demand being still pretty good. So I would look at a more indirect way of playing oil prices falling, and one of them could be autos. Another way of looking at falling commodity prices in general could be to look at air conditioning companies. Also being, there's another tailwind that could be from the expectations of an El Nino, which would keep temperatures higher. I know it's at the moment the monsoon looks rather good, especially for the past 1 week or so. But there are calls for El Nino this year, and we think that air conditioning companies could be another way to look at it.
So is air conditioning your highest conviction idea that you are, selling to your clients? Or tell us the idea that you're most convinced about, your highest conviction.
I mean, within the consumer durables space.
Generally, all options open.
Okay. So in terms of a portfolio construction, Rima, I think one of the places where we are starting to see an incremental change is FMCG companies. The growth numbers are starting to bottom out. We are starting to see less pressure on their margins. So we've actually turned positive on FMCG recently. And so that's point number one. Point number two, I think I already mentioned about credit growth still being very strong. Deposit growth has lagged, I agree, but I think that will start to catch up. And so private banks as a second option. The third option could be four-wheelers. Air conditioning is the other one that I mentioned to you. And as a more tactical play, IT services companies. So I think I've given you enough on the plate.
Thank you very much, Abhiram, for joining in. Always a pleasure. And thank you for helping our viewers construct their portfolio, at least top down. We will get into a break. On the other side, we'll tell you what our dealing rooms are saying in our segment D Street Chatter. We also get you a few buy calls from our technical experts.
Welcome back. Still trying to hold on to that 24,200 mark on the index. But here's some special a segment for you. We are looking at India's wealthiest promoters. And in focus today is Solar Industries, where the Nuwal family's 73% stake is now valued at almost 1.2 lakh crore rupees. Nimesh is joining us to take us through their journey from explosives to defense and where they stand amongst India's top promoter groups. Nimesh.
Well, Norma, it's been a fascinating story, not only for the investors, but for the promoters as well. And as you rightly pointed out, the wealth of this particular promoter is over 1 lakh crore. But first, what this is company all about? Solar Industries. It's one of the largest, explosive and defense manufacturer, and it is based out of Nagpur. So that's the basic about the company. As I said, the promoter owns 73.1% stake in the company. Who are the promoters? Now, Manish Nuwal is the MD and CEO. He's the son of Satyanarayan, and he was a founder of Solar Industries. So Manish owns 38.9%. Satyanarayan owns close to 3.5%. The trust owns close to 29% stake. And Seema Nuwal, who is the wife of Manish Nuwal, she owns a small 1.37% stake. So combined altogether, the promoter holding is 73.1% stake. Now, what is Solar Industries? Just the graphic will come up for you. They started as a small explosive trader in early 90s. And only in 1995, Solar Explosive was incorporated. And from there, they've built up one of the largest package explosive facility out of Nagpur. So that's the small journey of what the promoters have done. Now, this is interesting, where the pivot came. The pivot came when Manish Nuwal actually joined the company in the 90s. He was actually one who was leading the defense and aerospace expansions since 2010. And the defense revenue for this company has grown from 5% to 20% under his leadership. And that's where you've seen a big pivot and a change in terms of market cap as well for this company. Look at the financials now for 2026. The company has reported a revenue of close to 10,000 crores, PAT of around 1,800 crores, ROE of close to 29%, and ROC of close to 37.5%. So the number shows for itself, and that's the reason why the company is getting this kind of market valuation as well. As I said, look at the wealth that the promoter has created. So basically, the overall market cap is close to 1.6 lakh crore, and of this, since the promoter owns little 73%, it's basically they own close to 1.2 lakh crore. Just to put into perspective where Solar Industries stand in terms of the list of wealthy promoters or wealthy promoters, Now, this is the whole list. Avenue Supermart stands out. R.K. Damani is hands down the topmost guy at close to 2 lakh crores of personal wealth, because of its listed entity. The rest are largely, conglomerates or bigger MNCs. Nestle India, Bajaj Finserv, Bajaj Auto, of course, the two Bajaj Group, Adani Group, Asian Paints, JSW, Wipro. A large part of these names are basically conglomerates or from larger corporates. Solar Industries stands out at number 10. The interesting part is today Solar Industries promoters are even above DLF promoters in terms of wealth creation. So that's the kind of wealth the promoter has created. As I said, they're currently at number 10. The promoter's wealth is close to, again, it's a wealth on the paper, right? It's just a market cap, but still, Solar Industries, from a company based out of Nagpur from nowhere, is now currently the number 10th wealthiest person, having a personal wealth of over 1 lakh crore with a market cap of 1.6 lakh crore. It's basically not only the promoters, but even if you look at the shareholding pattern, the FIs have owned money, the DIs have owned money, and of course, promoters have created the biggest wealth. Now they're sitting on over 1 lakh crores of wealth as being a listed entity of Solar Industries.
Incredible. What a story and what is that list? I was just looking at the list, and kudos to our team as well for presenting it in such a fabulous way. But look at that list. It's so hard
to break into. You've got the Adanis, Ambanis and the Damanis, and for a Solar Industries to break into, the list is very important. Yeah.
Of course, it's created wealth, but if you look at the list of the names, really for me, the two people stand out. Avenue Supermart, R.K. Damani, an individual guy, with no background from the market, started DMart, and look what he's created in terms of wealth. And of course, Solar Industries. See, the rest are all bigger names, right? Bajaj has been in the market for a very long time. Asian Paints, JSW is a large group, Wipro is a large
all
group.
three of them are first-generation entrepreneurs, right? Mr. Damani, even the Adani Group, and Mr. Noval of Solar Industries, right?
And what struck me to do this was, I was talking to some larger investors and larger corporates
big
as well.
funds who have
Not many people know who's Manish, who are the owners of Solar Industries. I mean, these guys are sitting on over 1 lakh crores of market cap. That's the kind of wealth they've created. So it's hats off to and kudos to this promoters of Solar Industries from Nagpur, creating one of the biggest explosive company and having a market cap of over 1 lakh crore. The individual wealth.
Spirit of entrepreneurship.
Explosive company, explosive returns as well, right? Nimesh, thank you for summarizing that for us. A wonderful story and some fabulous graphics as well from our graphics team. Well, as we count down to the close of trade, Mitesh Thakkar is back with us to tell you what to buy or sell today for a reverse trade going into Monday. Mitesh, you're still not managing to get past that 24,250 mark on the index. So what do you do? What's the trade looking like for next week? And of course, your BTST calls.
Yeah, good afternoon. I think, I said that not breaking below 23,800 was very important. So we're back to the range at least. So any chance of, the declining movement accelerating has been kind of negated. But on the stock side, CDSL is a BTST for me. That's the BTST with a stop at 1419 for targets of 1415 or thereabouts, 1450 or thereabouts, sorry. And the other one is CAMS, which is also BTST with a stop at 779 for targets of 804.
Thank you so much for joining us with those BTST calls. It's time now for our segment D Street Chatter. Nimish is back with us. He'll get us all the insight into the dealing room chatter as well as a few tidbits about the stocks that are up and about in trade. Nimish?
A strong day for the markets, largely led by the financials, and within financials is the PSU basket, PSU bank basket, which has done really well. Of course, the Indian bank numbers were good, and that had a bit of a rub-off effect on the PSU stocks. But my sense is, in general, there has been buying interest in the PSU names at a couple of leading FIDs. So the moves in the PSU bank is largely backed by institutional buying as well. That's the overall sense. From a flow perspective, again, a strong day. I guess there is a bit of buying interest, and there's going to be a small MOC basket buying as well towards the end. So maybe this level of upside on the Nifty may sustain. Having said that, the bigger moves is likely if on a closing basis the Nifty closes about 24,350, 24,400 level. That's a bit of a resistance zone in the very near term. So if that gets taken out, maybe you'll see further short squeeze in the overall market as well. And the momentum seems to be clearly there in the broader markets. Even today, the mid-cap index is up 1.5%. And in general, the broader markets have relatively outperformed. And a lot of individual stocks as well are buzzing as well on good volume. So a good day of trade, despite a Friday. Normally we see a Friday factor playing out, but that's not the case today. It's almost at day's high. And to some extent, the PSU rally, especially in the bank stocks, is backed by FI buying as well.
What about stocks, Nimesh?
Well, so in terms of individual names, the first stock on my list is Indus Tower. It's generally been a bit of a drag, has relatively underperformed as well, but a bit of uptake in today's market, largely on the back of small buying, but largely, I guess the selling pressure from a domestic mutual fund is largely over. So they were a big sellers, and that seems to be over. And for Indus Tower, I think, a couple of triggers to watch out for, which can come very soon. One, the Vodafone fundraising, that could be a big debt funding, that could be a big trigger for Indus. And also, there is a renewal of Jio tenancies which is pending. So if that comes in, maybe you'll see further upside there. So that's the first name. The second stock is Kirloskar Oil. Couple of initiating reports, we got the management as well. Seems like the institutional interest is quite high. So again, today, expect high delivery volumes, and there is a bit of buying in Kirloskar Oil. The third name is Thermax. It's not. It's been under largely languishing or been a bit soft of late. But my sense is that some of the domestic mutual funds are actively looking to buy or add Thermax at current levels. And the last is Coforge. Of course, the IT pack has done well today, but Coforge stands out. It's actually been a bit outperformer as well in the mid-cap IT names. And my sense is one of the leading family office has been an active buyer even at current levels in Coforge.
Okay, all right. Thank you so much for joining us with all those details, Nimesh. So that's the dealing room chatter. But let's get more stock specific now. Apollo Microsystems is set to acquire a major stake in Premier Explosives in an all-cash deal worth 1550 crore rupees. Ria is joining us now with all the details that she's picking up. Ria.
Well, yes, Apollo Micro is set to buy nearly 41.33% stake in Premier Explosives. This will be an all-cash deal for rupees 1,550 crores, and they will be acquiring the stake from the promoter group at 698 rupees per share. Now, the transaction is expected to close in December of 2026, and following the completion of this acquisition, Premier Explosives will come under the umbrella of Apollo Microsystems, wherein it will continue to operate under its existing brand, although with scale performance. Now, the company Apollo Micro will be making a mandatory open offer to buy nearly 26% stake in Premier Explosives at 698 per share. Again, and already they've made the public announcement for the open offer as well. And after this, Apollo Micro can end up owning nearly 67.33% stake in the company if the open offer gets fully subscribed. And the implied valuation for Premier Explosives, as per this, comes up to nearly 3,753 crores versus yesterday's closing market cap of nearly 3,833 crores. Now, although this valuation does seem quite sustainable, do remember that the market cap of Premier Explosives had seen quite a bit of erosion in the days leading up to the announcement of this acquisition, since the street had widely expected this acquisition to come in. However, in terms of the rationale also, let's take a look at that. The company has said that they will be combining their complementary capabilities in defense systems as well as energetic materials, and this will enable some operational efficiencies for them as well as some enhanced R&D opportunities as well. And in fact, they will also see some broader participation in the defense and space-related programs going forward once the acquisition is completed. And this strategic acquisition will also support next-generation defense and space programs once the acquisition is completed. So on the back of this, Apollo Micro is trading higher by nearly 3%, but Premier Explosives, although it did open in the green, has come down by nearly 3% today, largely because the price of 698 was lower than yesterday's closing price.
Indeed, Ria, thank you for that update there. We also caught up with TV Chaudhary, the Managing Director of Premier Explosives, earlier, listening to what he has to say about the acquisition.
Yeah, as far as I am concerned, I will be continuing as Managing Director. I will continue my term fully. Okay. And then, yeah, next what happens, you have to see. It is the promoters who took the decision, and then they felt that this is the best deal they could get. And from my side, I have, of course, informed all the strengths the company has, and based on that, I think they have negotiated and taken the decision. FY27, yes, 600 to 700 crores is our target, and we are marching towards that. And that is our, and that too, as much as the 1,500 crores order book what we have, the target is to execute that first, and even if you execute half of it, we'll be touching 700 crores.
Okay, there were two big stories today. One, of course, was Apollo Micro acquiring Premier Explosives, and the other one was Dixon Technology, because finally it got all the approvals for establishing that partnership with Vivo India. Upasna joins in with the details. Upasna.
Well, finally the wait is over, must say. Now the company gets the long-awaited government approval under Press Note 3 for its JV with Vivo India. This literally means that the approval removes the regulatory overhang that has been clouding the company since some time ago. Now, JV was announced back in December 2024. Now, let us look at what the management has to say on the back of this JV. Now, JV could lead to a revenue uplift of 30,000 crore with a higher ASP as compared to Dixon's existing mobile portfolio is what the management had guided, and it had also guided that the post-regulatory approval, the operations are likely to start after 60 to 90 days. That is around Q3 FY27. Now, Vivo has 35 million annual volumes in India, of which 67 will come to Dixon, which is nearly about 22 million. And for FY27, company has given a revenue guidance of 56,000 crores and a volume guidance of 32 to 33 million, which is nearly flat. But this volume guidance is excluding the Vivo contribution. So the Vivo contribution in FY27 is something that we'll be closely watching out for. Now, let us look at what the brokerages are penciling in terms of volumes from Vivo from FY27 and FY28. Now, Motilal has retained a buy rating with a target price of 16,100 per share. It estimates 13 million volume in FY27 and 17 million in FY28 from Vivo. JP Morgan has given an overweight target with a target price of 16,700. It assumes Vivo to contribute 11 million mobile volumes in FY27 and 22 million each. That is in FY28 and FY29. Moving on to UBS, it has given a buy call with a target price of 13,700. CLSA has given an underperform rating with a target price of 10,400. It believes that there is a limited room for upgrades now, as most of this is already penciled in the stock. And lastly, coming to Phillip Capital, it maintains the sell rating on the stock. So overall, we are seeing mixed reviews on the street.
Okay, all right. Thank you so much for joining us with all those details, Upasana. Let's get in Anand Tandon, who's a market expert on the show as well. Anand, good afternoon. Thank you for joining us. What do you make of the big deal in the defense space and this approval that has come by for Dixon? Because the general approach towards Dixon is at least that most of it has been priced in and it will not make such a big impact on the overall stock price as well.
Well, in case of Dixon, the problem is that telephones are one of the lowest margin kind of assembly business. And while many of these companies have been doing it for a while now, the reality is that, the margin expansion that was estimated has been much, much slower and to a large extent non-existent. So you were expecting that overall the value addition, for example, in the assembly would be going up to, let's say, about at least 15 to 20% in India, given that it's much higher in China. But by and large, we are stuck in the 3 to 4% range. So that means that while your top line may grow, the bottom line impact will be somewhat muted. When you're talking about the defense space, I guess you're talking about the deal you just mentioned, that of Premier Explosives. Premier had a problem that they had no succession plan as such. To that extent, I think the fact that they have sold out is a good thing because it now makes continuity a far easier thing to do. And it has one of the biggest, or perhaps one of the most established explosive programs for the defense and aerospace. They've been making explosives, even those which go into ISRO's rockets. So they have a lot of experience. They have the capacity in that area. Therefore, overall, I think it will be something that is good. Of course, valuations can be debated. But by and large, I think it's good because the overhang of lack of promoter continuity now goes away.
Anand, stay on. Tomorrow, LTM, that's L&T Mindtree, will be reporting their numbers. Now, broadly, what the expectation is that FY27 will be better than FY26. Q1 will be soft. Expect a recovery in Q2 and Q3. The reason why Q2 will be stronger is because of a ramp up of two large deals, the CBDT and a large retail client. So therefore, Q2 will be higher. But Q1 will be impacted on account of the Middle East clients and some manufacturing related issues. So therefore, revenue growth will be seen on the flatter side. Margins, again, slightly lower, maybe flat, 15.1%. There is a part wage hike impact offset by the currency tailwinds. Profits will be up 4%. So in a nutshell, flattish Q1, but there is a recovery expected in Q2 and Q3, and hopefully the management guides for that when they report their numbers tomorrow. Okay, let's get into a break then. We'll come back with more on the market. Stay tuned.
Welcome back. Still tuned into Closing Bell and counting down to the close. But before we do that, let's bring in Anand Tandon, market expert, back with us on the show. Anand, post Indian Bank's numbers, a lot of these PSU banking names are doing well. We also have J&K Bank, which is higher by 15%. Indian Bank, of course, itself is up 10%. PNB is also higher. So there is this optimism that we are seeing in the banking space. What do you make of this? And this earnings itself, do you expect PSUs to outperform private banks? What's the general take here?
Clearly, it is a space which is reasonably valued and now growing. One of the concerns was that credit growth was somewhat muted for the last few quarters, but I think that is now back in quite a bit. And the balance sheets have never been better before, and especially for PSU banks. So overall, I think the sector itself is in fine fettle and is perhaps likely to be a good performer for the next few quarters at least, barring any accidents we see in terms of raising interest rates and so on. Even that, if it were to happen, will actually benefit the banks to some extent. So net, I think it's in a sweet spot, and therefore, and with unchallenging valuations, I think it's a space to be. Whether private sector or public sector is a matter of convenience and tactical positioning. My own preference always is to take private sector banks for the simple reason that they have a better deposit franchise, and therefore will be continue to gain market share against the public sector banks. There are, of course, now some convergence in terms of technology. The private sector banks had a huge head start compared to the public sector ones on technology. That gap is now slowly narrowing, and therefore, you may find that the incremental market share gains are slower to come. But despite that, I think you will see the public sector banks continue to lose market share. And from that perspective, notwithstanding the tactical positioning, I would suggest that one has at least some large private sector banks in the portfolio.
Anand, pleasure having you today. Thank you for sparing time and joining us. Wish you a happy weekend as well. Just pull up J&K Bank as Anand was speaking. A sharp up move that you've seen in the last few minutes for J&K Bank. That stock is now up 13%. That was already at a 52-week high earlier in the day and is now seen that very, very sharp up move over the last few minutes. What has also seen an up move continuing to extend its gains, it's Kalyan Jewellers, 8.5% higher now on the stock. The best week on record that the stock has had. And just before we close, look at Godrej Industries as well. That too has seen a very, very sharp up move in the last 15 to 20 minutes. The top gainer on the Nifty 500 now, 15% higher on that stock as well. So good going for Godrej Industries there, Sonal.
Actually, the list doesn't end of the gainers today, right? So many of them. Talk about Greaves Cotton, which is up around 11.5%. The standalone refiners are also doing really well. We've been talking about how product cracks are at a record high. So MRPL is one of them, up 8.5% right now. We do have Vedanta Iron and Steel, which is doing well in trade, 5% higher. Sagility is up 4.5%. Hormiz mentioned Kalyan Jewellers. That's the star performer of the week ever since the quarterly update came by. But on the downside, we do have a couple of these names which are coming some for profit booking. Spark, for instance, is down around 4.5%. Premier Explosives, we've been talking about that stock since the word go. That one is down 4%, has been acquired by Astro, the company today, and that is the other one which is on our radar. We have Equus, which is around down 3.5%. Swiggy, which was doing well yesterday, has come in for some profit booking as well.
Well, Swiggy has had this one up day, one down day move over the last 4 days, but as we close 24,214 for the provisional close on the index, so we still fall marginally short of that 24,270 mark, but the Nifty Bank has been the one that has stood out, 800 points higher on the index, closing above the mark of 58,000. The bulls would be happy with that. There are a lot of earnings to track tomorrow as well. Avenue Supermarts coming out with numbers, LTM coming out with numbers, and of course earnings season picking up pace going into next week as well. We take a leave on this edition of Closing Bell from Rima, Sonal and me. Thank you for watching. Editors Roundtable on the other side.
The last trade ended the week on a mixed note. The Nifty and the Sensex snapped their 4-week winning streak to end mildly lower, but the broader markets outperformed. The Nifty Bank and the mid-cap index each gained over 1%. Realty, IT, metal stocks led the gains, while FMCG emerged as the biggest laggard. Well, over the next 30 minutes, we will decode the week gone by on Dalal Street, find out where we are headed next week, put the spotlight on TCS's Q1 earnings, and tell you what to watch from the rest of the earnings season. Hello and welcome to Editors Roundtable. I am Rima Tendulkar. With me are my colleagues Nimesh and Prashant, and joining us here in the studio is Vetri Subramanian, Managing Director and CEO of UTI AMC. Hi guys, good evening. Well,
decent week, right? I mean, all the indices have participated. There was a bit of momentum as well. Broader markets have started outperforming again, participating. A lot of individual stocks I was observing this week have given some outsized returns. So looks like the momentum from retail also seems to be back in the broader market. That's a good sign.
We had that midweek flare-up on in, Middle East explosions. Commercial ships getting crude prices going to $80 per barrel. So all things considered, we ending flat on the Nifty and the Sensex with gains in the mid caps is not bad.
We've had a reversal of the reversal. We had a reversal first, which is in Wednesday, right? And then we had a reversal of the reversal over the last 2 days. But I mean, I think mid-cap index is at a new high, right? Small-cap index is at a new high, or maybe almost at a new high. And anyone and everyone we speak to say, well, maybe the large caps now
should do
better in the second half. So that's the broader kind of.
So again, the view is that go for large caps, but it's a small and mid-cap which continue to.
सबको small, large cap में बात करना है, सब कर रहा है mid cap and small cap, but I think that's been the mood like. But I don't think it's changed view, right? We spoke with, I think, I was surprised with that conversation. Vikash Jain of CLSA was with us.
Yeah.
And if you remember, he was very worried about Iran.
He said he was not so worried about it on Tuesday, and then come Wednesday morning or Thursday morning when we spoke to him, he says, now I'm suddenly very worried.
Because he sounded, I asked him specifically, I said, so Tuesday morning you were constructive and now you're cautious.
And
he said, well, yes, I am.
Constructive also, but now he's not going to.
Yeah, but the point is, to be fair to him, he's got to have a portfolio view, overall view, and his point was that
prepare for the downside.
Prepare for the downside. Don't be. I mean, all the right things, but the market price action is telling you that. I mean, they're not worried. They're not looking at this entire thing as the start of a new conflict, new phase, maybe the end of, or the start of a last phase of some kind of a threat. Maybe this is just bullying to get Iran to agree to terms or whatever. We don't know, but what we'll see. And of course, IT kicked off with TCS.
IT kicked off, and expectations were so low, Vetri, and just come in on the IT sector. Expectations were low. Expectations were lower. Estimates were lower. I remember when I spoke to analysts, buy side, sell side, at the start of the quarter in April, and they all indicated that when we spoke to the management, we sort of got the indication that they could do a 1.5% growth. And as the quarter panned out, those expectations came down to zero, because there is generative AI deflation, maybe a little more than that, and the macro situation remained uncertain. So, expectations were sharply lowered. Valuations, which at the start of the year were 17, 18 times, people were still holding on to that. They were brought down to 13, 14 times. So compared to that, I think the street, TCS has managed to deliver on that. And at least for the near term, they are saying that things are stable. So they spoke about Q2 being positive. The words he used in the conference call were that at some time in Q2, we see demand picking up on account of pent-up technology. So near term is here. But, Prashant, when we spoke to the management and we tried to talk to him about the longer-term recovery, there is no clarity, right? We specifically asked him that when do the volumes, volumes or the new AI work offsets the loss of work due to AI? Can it be FY28? And he says, I don't know. Right, so I think the long-term uncertainty is still remains.
I got the sense, Rima, from the conversation, and we spoke, it was mostly about AI, etc. I got the sense that they were kind of now okay with, not okay, but basically, when something new comes, everybody's kind of deer in the headlights kind of situation, right? You don't know what's happening. I don't think they are in that situation now. Although it might seem like with all these new models every day, etc. They know what's happening. They know there is a challenge. And at some level, it just, to me, it seemed like they were more confident of figuring out what to do. I mean, that SKF deal, I think the reason they spoke so much around it is because, it's like a marquee and it's new. It's a new customer. It's not as if it's like an old customer to which they're just adding on one more AI level. It's a completely new customer. It's a global deal. So I think at some level, I'm not saying that all is clear, it's all clear, but I'm just saying that maybe they know that this is happening. This is the way ahead, and we've got to deal with it. They are, I think, dealing with it. So it'll be bumpy, I'm sure, but I mean, they're not deer in headlights.
And markets are also not reacting incrementally badly to new AI news, right?
Yeah,
You're getting
that's
these
because
advanced models
No, but
announcements.
that's because of valuations as well, right? I mean, historically, it's come below the historical averages as well. So valuation captures everything.
It's at a 10-year low.
Exactly.
Like,
So to some extent, I think valuation captures. Vetri, what's your take? First on the IT in general, and within that, your preference towards large cap or mid cap IT?
Sure. So if you think about it, and the point Rima made, I've never experienced in my career that you get cheap valuations with great visibility or clarity of management about the way forward. It's always the case that when there is lack of visibility and clarity is when you get the cheap valuations, and when you have rich valuations, everybody is able to see 20 years out into the future. So, you can't look at these valuations to say, where is the clarity? Not going to happen. That's the reality of the situation. If you look at the challenges, I would say at this point of time, even the companies are trying to figure out where are the opportunities and equally where are they likely to face deflation related impacts in their business model. But I do think to the extent that most of our companies are really in a sense more of contractors and integrators in terms of putting IT solutions together. My sense is at some point you will actually see surprises come through in terms of their involvement in helping companies get AI ready. And as somebody who's moved to the business side of things, the one thing I can tell you is that no existing organization has the capability to overnight switch to AI, because you've got to make it work with all the systems that you already have in place. And you can't do that if you don't have an integrator come in and tell you how to keep your systems up and running 24/7 and not run into an issue in terms of migration. So I think there will be an opportunity for them. Till then, the valuations give you some comfort to remain invested. It's not just a 10-year low.
Why? Because valuations protect the downside, maybe.
If you're a contrarian, you should.
Are you a contrarian?
Yeah, I'm always been, all my career.
So you're bullish on IT at this level?
I would certainly say at these valuations, and it's not just the PE. If you actually look at their free cash flow yields, they're trading only slightly richer than bonds. Now, if you're getting equities at valuations which are only slightly costlier than bonds, where there's scope for capital appreciation which you don't have in bonds, I would say it is a risk worth taking. On the large versus mid, it's not my preferred prism because every company is different. But I would admit that some of the mid-sized companies maybe don't have as much of a deflation problem as the larger companies. But I think you'll have to get more stock-specific rather than.
But with mid-cap companies, the question is they've been aggressively going out and doing acquisitions. So
that's true.
Some of them go well, some of them don't go well. So in that sense, there's a bit of risk as well, right?
They've put balance sheet at risk. So you're right. I mean, we may have temporary revenue visibility because of the acquisition, but you put balance sheet at risk. And in every acquisition, you've got to ask yourself, and I always tell analysts this, it's not a question of whether it is EPS accretive. That is the worst possible benchmark that you should use to judge an acquisition. The only reason for any capital allocation is my return on capital going to be higher than my cost of capital? EPS accretion is the wrong thought process about any M&A transaction.
Do you have a view? Sorry, go ahead.
No, so IT was one side which is at the bottom, valuations capturing everything. Look at the other side of the market, the defense names, the aerospace names, the transmission lines and transmission companies, all are trading at 70, 80, 100 times. Being a contrarian investor, what's the view there? You'll pay for that growth, or you'll be a little cautious now?
No, I'd be a lot cautious over there. I think when stuff gets to that kind of valuations, and again, my experience over many years, individual companies can sometimes sustain valuations which look very different from their peers because they have a unique set of circumstances which are helping them outperform everybody else. But when sectors start to reflect the same trend, it typically reflects the inability to distinguish between individual companies, and that's where the maximum errors of both optimism and pessimism happen. So when you see a whole bunch of companies trading at that valuation, to me it's an opportunity to figure out which are those companies which actually don't deserve to trade at those valuations.
No, the reason I asked you is because I was reading a report on a company, Acres, which is into aerospace, and the analysts had written, 30 years down the line, what could be the number could be, and then extrapolating and putting out a PE. It's a loss-making company right now, promising a lot of growth, but it's very difficult to figure out how should one
And I saw some commentary around Acres in social media, but I thought, and I actually wrote to somebody who saying, they were using the analyst report to beat down the company, which I thought was unfair.
Which is unfair.
But it's a good company, and our colleague Madhya, who's here, She's gone to the. I mean, so it's a legit operation, and they're doing well. But the thing, though, and by the way, what they're doing, that report, I think it was I'm not sure which one, but they said
there was an Obama and there was an IFL note. Both came out.
So I'm not sure which one was that 30-year that Nimesh is talking about, but they are using a 30-year DCF.
Yeah, 30-year DCF.
To use a that kind of a model for a high growth company. I mean, I think it kind of is.
Honestly, what surprised me in that report was there were supposedly two triggers. There is one merger of an aerospace company which is pending in ACUS, so that's going to come. It's in public domain that there is a merger going on. And two, the kind of growth even the company has been talking about, this will require them to raise funds. So there's going to be a dilution as well going forward, right? In which I think most of the analysts have.
But I think it's that is also.
But broadly, what's your sense on defense, on aerospace? Is it getting too hot and too uncomfortable for an investor like you?
Yeah, I think the valuations are definitely cause for concern. There could be a few bottom-up opportunities, but it's not an area where I would say it's not the preferred sector or the theme at this point of time.
You know, one area, Nimesh, which I think within that entire defense ecosystem, which perhaps the market starts to look at closely is shipping. Shipbuilding. I'm not talking about the Cochin and the Mazgaon and those. Maybe those as well, but those are much larger now. But I'm talking about this massive. And by the way, the government is providing capital subsidy for shipbuilding. The stated aim is you want to get 50% of the ships which we operate, and I think we import most ships have to be built here. So the private sector basically said, well, we can't do it. It's too. So I think there is capital subsidy. So maybe in that ecosystem, that is, I don't know, maybe we are in that space where broader defense was in 2021, after that policy change in 2020. So that's another area. The power area, electrification theme, you think is the same? You'd be very cautious here?
See, I think over there are still a lot of good product-related companies which have typically not ever been stressed too much in terms of cash flow. They are strong manufacturing operations with good return on capital. They don't need to make large capital calls in terms of equity raises. Yeah. So I think some of them may still be businesses that you might want to just remain invested in. Do you want to allocate more capital at these valuations? Question mark. But I think there is a growth opportunity there that might cause you to say, I'm willing to, give them benefit of doubt because no capital calls, high ROC, strong cash flows.
Yeah.
Okay. We'll come back and talk more. But Nimesh, next week we will get more numbers other than IT. So what should we expect?
So, I do this every quarter, right? A bit of a preview on what to expect and few positive and negative surprises. Broadly, from a numbers point of view, on the headline numbers, for Q1, most of the analysts are expecting income growth. That should be around 14% or 15% ex of OMCs. OMCs are going to be a bit of a wobbly thing. In terms of net profit for BSE, the expectation is 5% YY growth in profit, and for Nifty close to 10% YY growth. So that's on the bottom line number. Kotak puts out this EPS estimate for FY27. They put out an FY27 EPS estimate for Nifty at 1244, and for FY28 they put an estimate of 1426. So on a 1426 at close to 24,000. I don't think it's at par in terms of valuations, right? At around 20-21 times. Now on the sectors wise, overall from some of the larger sectors to talk about. Autos, in terms of autos, expect there will be a good revenue growth of 15%, but the margins are going to be hit. So 50 basis point hit on the margin is something Citi is anticipating, and overall EBITDA growth of 10%. So kind of steady, no big surprises there. Banks largely to be a stable quarter. If there is any negative surprise, there could be some in terms of NIM contraction for some of those names. Capital goods, again, is going to be quite volatile and very company specific. But within that, electricals and T&D pack could surprise on the upside. Staples, again, a steady quarter, no big surprise there. Despite the price hikes, there is going to be a decent quarter for them. Cement, again, a bit of a softness, and there could be a degrowth in terms of EBITDA up and estimate as well. So the cement is not going to be a big surprise there. So is the case with telecom as well. No big surprise expected, and a flat quarter, so to speak. So that's some of the sectors. Now, Citi also puts out the positive and the negative surprises in Q1. I'll run through the positive surprises first. First stock which Citi believes can surprise positively in Q1 earnings is Havells. And largely the surprise is going to come in the cable and wire business. GAIL, that's again a very unusual name, but that's part of the list. They expect GAIL to see and expect a sequential improvement led by dual pricing of on improved LNG as well as marketing they expect a surprise there. Britannia, within the FMCG pack, this is one stock which is likely to surprise positively in Q1. And Yes Bank, they've identified within the banking names which can surprise positively. So interesting 4-5 names where they expect positive surprise. The negative surprise is something to watch out for. ITC, Citi expects a negative surprise in the Q1 earnings. HCL Tech, Rima, they're expecting a margin guidance contraction, so that's something to watch out. Ashok Leyland margin pressure going in and market share loss is something Citi is expecting, and so is SRF expect a negative in terms of their agrochem business. So these are the few names where Citi expects a negative surprise. Vetri, of all the sectors that I put out to you, banking, what's your broad sense? Because now the consensus is watch out for large private banks and they're going to benefit. Are you of that camp?
So let me put it this way, Nimish. Sure. I've been hugely positive on, I'd say, pretty much the entire banking financial sector for the last, I would say, more than a year, maybe even 2 years. It's the only place where I think the valuation equation is in your favor. Now, the reason I never describe anything as a second half story is that what I've always learned as a fund manager is to position where the valuations are in your favor. Yeah. Whether that payback happens in 6 months or 12 months or 18 months or 24 months is actually never in our capability to either forecast or know in advance. So I would say on that basis, I would say the banks are a great place to be. I think their balance sheets are in great shape pretty much across the board. And looking at the way credit growth is currently behaving, if you are able to get 2-3 years of double-digit credit growth and double-digit comfortable mid-teens or higher teens profit growth, then these starting valuations open up the possibility of earnings compounding combined with a re-rating possibility. So I would say hugely attractive in that entire BFSI space.
Any other sector where you think valuations are in favor and earnings can surprise positively, which means not only an earnings upside, but a multiple upside as well?
Honestly, outside of the banks, nothing so dramatically clear. The larger healthcare sector, I think, including the pharma, hospitals, all of that put together, I'd still say reasonably well placed relative to the kind of growth they are experiencing at this point of time. But entry valuations are not as cheap as they are in the banks.
So banks is your highest conviction idea right now?
Absolutely.
Oh. Hold on. We need to slip into a very short break. We'll come back and talk more.
Welcome back. You're with us here on Editors Roundtable. We're speaking with Vetri Subramaniam of UTI AMC. Vetri, thanks for staying on. Are neighbors in BKC coming to the office at UTI AMC for IPO pitching?
Of course. Of course. I just met the NSE management today more as courtesy. I'm not involved in the investing side anymore. And then a few weeks back, we had SBI Funds Management. So it's good. The financial sector actually has so many listed companies that are always bumping into each other on different sides of the table.
And the IPOs from BKC and all get done in BKC. Yeah?
Of course.
There's enough firepower.
I was looking at the NSE list. SBI Mutual Fund. And one of the big investors is Prashant Jain of 3P Investments.
Yeah. 150 crores.
So, but there's value left on the table, according to you, in SBI Mutual Fund?
I mean, I have no specific view on that, IPO itself, but I think the team is positively inclined, so I should presume there is. And, it's a very, very significantly dominant franchise. So it will, in that sense, command a premium in the marketplace. So,
I think they've left. I think at the P multiple, they've left value on the table in that sense. At least that's what I mean. It's just a cursory reading shows you it's not wildly priced or anything of that sort.
True.
Which I think is interesting. Yeah.
Vetri, the other thing, we were discussing this week itself on the defense opportunity. It's kind of a decadal theme. A lot of analysts have been writing about it, but broadly, what's your sense? How would you approach the defense theme? Why I'm asking is, if you look at the PSU basket in the defense stocks, Cochin and Mazgaon are up some 20 times, 30 times. BL is up 11 times, 12 times. HAL is up 12 times in the last 5-6 years. A lot of the positives priced in.
Approach it defensively. No?
he stole the words from my mouth.
It's a Friday afternoon.
No, but just because they were up 20 times in the last 5 years doesn't mean you're going to own 20 times by buying it today.
Okay, exactly.
So I think that has to be the starting point.
Right.
And this is my biggest conversation point with most investors. Sure. Everybody looks at the equity market and says, oh, last 5 years we made so much.
Yeah.
Look, you can only earn out of companies what they deliver in terms of earnings growth. If you earn more than that, it's because something in the valuation equation worked in your favor.
No, but that's what I'm saying.
I think that's the lesson
earnings
of
growth was not there. Like earnings growth, I put out that piece. The earnings growth was, the earnings doubled, PAT doubled, but the market cap was up 5x for the entire basket. So
because they were trading at like 1 time and 2 times earnings. So that's where the gain has come from.
But the question now is, are you going to see a pivot from PSU defense to private defense? And is that going to be the next theme for the next 10 years?
It could be, if we could see which are those private companies which actually are able to build a significant franchise. Yeah. At least from what I recall, last time the defense spending benefit to some of these private companies is a small portion of their aggregate business. So can it be a growth vertical? Yes. Will it add to their aggregate growth? Yes. But it's still a very small portion of their aggregate market value. So you can't own them only for the defense.
Sure. No, but that will change, right? I mean, look what happened this week. There was a big deal in M&A space. Premier Exclusive got bought over by Astra Micro. So
those are idiosyncratic one-off, but you can't position a whole portfolio for one M&A.
No, of course not. But largely, the whole question was, are you going to see more outperformance in the private defense space? So again, as you said, there are not many, and if there are some, there's going to be a very small vertical for the larger conglomerates. Yeah.
Avijay, you run a listed mutual fund. Good things happening? Without going into details?
Yeah, I mean, I think the industry is growing.
As an industry, yeah, exactly. As an industry.
And investor interest is very strong. We've gone from literally 1 crore unique investors to 6 crore unique investors over the last 5-6 years. So there's still a wonderful runway ahead. And I think the thing that I really like is that people are starting to get disciplined about this habit of saying, we need to invest on a regular basis, which is what the whole SIP mantra in that sense is about. So I think it bodes well for the economy. But keep in mind that we shouldn't get carried away. The target market for mutual funds is not 140 crore people, right? I mean, 85 crore people are being given free food. I think our challenge is for large number of people, we still need to create the income opportunities. But at 6 crore people, we still have enough runway for penetrating the market for those who have enough savings to invest to say, hey, please consider instead of only going to the banks and doing fixed deposits or post office savings account or whatever your preferred mechanism is. So I think there is a strong and positive outlook for this industry.
Okay, out of time. Thank you very much, Vetri, for joining in. Look forward to the next one. Have a good weekend.
Thank you so much.
Thank you.
Cheers.
Well, with that, it's curtains down in this edition of Editors Roundtable. Thank you very much for watching. Stay tuned for more news and updates.
Good evening. Thanks very much for joining us on Business 360. I'm Shireen Bhan. The top stories that we're tracking for you this evening. The US and Iran halt attacks as mediators push to get diplomacy back on track. White House officials say technical talks with Tehran will continue. Iran buries its slain former supreme leader Ali Khamenei after 6 days of state mourning. Crude oil prices decline marginally but remain on course for a weekly gain. The International Energy Agency expects annual oil demand to decline for the first time in 6 years. Shipping traffic at the Strait of Hormuz remains largely at a standstill. The Sensex and the Nifty snap a 4-week winning streak even after broad-based gains on Friday. Inflows into equity mutual funds up 26% in June. Mid-caps and small caps get more funds compared to large caps. TCS shares rise after the company meets muted expectations in Q1. The management is upbeat on Q2 despite lack of clarity on long-term recovery. Expects FY27 to be better than FY26. Shares of Dixon Technologies rally in trade after the government's long-awaited green light to its joint venture with China's Vivo. This is the first major approval after restrictions on FDI from China under Press Note 3 were relaxed. OpenAI's new model is 54% more token efficient, says Sam Altman on the release of ChatGPT 5.6. Defends the White House vetting of powerful AI models, calling it productive and in everyone's interest. That's a CNBC exclusive. The CEO of Truecaller, Rishit Jhunjhunwala, slams the telecom regulator's latest directive on spam calls, calls it a get-out-of-jail-free card for spammers. Says the caller ID company is complying with the order and not flagging calls from numbers starting with 140 or 1600 as spam. That's an exclusive. Prime Minister Modi wraps up the Australia tour with cricket diplomacy and a visit to the Melbourne Cricket Ground. Australia's Big Bash League season opener will be held in Chennai this year. China successfully lands a reusable rocket for the first time in a major breakthrough for its space program. State media says the rocket returned to Earth vertically and was recovered using a floating platform. A stunning strike from Mbappe takes France into the World Cup semi-final at the expense of Morocco. Spain will face Belgium in another quarter-final clash later tonight. Also on the show, meet the Nuval family, the promoters of Solar Industries, India's largest explosives and defense manufacturer. They've now entered the list of top 10 wealthiest promoters of listed companies in India. A special report coming in. Well, let's go straight to the top story this evening. US and Iran have halted the retaliatory attacks as mediators push to get diplomacy back on track. Now, here are the latest developments. The US media reports that technical talks with Tehran will continue. The reports cite US officials that suggest that Washington is committed to finding a solution. But the official also said that President Trump had described Iran's attacks on commercial vessels as acts of terrorism. Iranian officials have not confirmed or denied the next round of negotiations. In Iran, former Supreme Leader Ali Khamenei has been buried after a 7-day funeral procession, according to Iranian state media. Nearly 41 to 43 million people participated in the week-long funeral event. Khamenei was killed by US-Israeli airstrikes in Tehran on the 28th of February. Meanwhile, oil prices have eased, but they still remain on track to clock weekly gains. And shipping traffic at the Strait of Hormuz remains largely at a standstill. This, as International Energy Agency has said, that global oil demand is set to decline for the first time in 6 years.
The war in the Middle East has led us to cut our expectations for demand growth this year by 2 million barrels a day. So now we're expecting a 1 million barrels a day contraction for the year as a whole. And this is the first loss since the midst of the COVID pandemic in 2020. The situation normalizes. We do expect those contractions to ease in the third quarter. And as you noted, a return to growth towards the end of the year. 2027, we see a recovery in oil demand, so growth of 2 million barrels a day. But the year on average growth for these 2 years is well below historical trend.
Well, that's the IEA on demand for oil will decline for the first time in 6 years. On to the day's market action. The Sensex and the Nifty witnessed some broad-based gains today, ending near the day's high. The mid-cap index, in fact, hit a record high, while the Nifty IT, Realty and PSU Bank index outperformed. Nifty IT up 2% today on the back of the earnings that came in from TCS. Mid-caps up 1.5% and 1% higher for both the Sensex and the Nifty. For the week, though, the Nifty and the Sensex have snapped the 4-week winning streak. In fact, the broader markets have outperformed, with the mid-cap index up by 1.3%. The Nifty and the Sensex closing lower for the week. Well, net inflows into equity mutual funds have risen over 26% on a monthly basis for the month of June. SIP inflows during the month hit a 3-month high, while assets under management surpassed the 82 lakh crore mark. Sonal joins us now with all the mutual fund data. Sonal.
Well, let's talk about the AMFI data that we got for the month of June. That's the mutual fund data. And the overall trend suggests that the equity inflows have improved on a month-on-month basis. They have come in at 28,961 crore rupees, which compares with 22,897 crore rupees. It was expected to be an improvement on a month-on-month basis because remember, in the month of May, equity inflows saw a decline of 40%. And there was a decline across all the categories. And that trend has reversed. Now, large caps, small caps, mid caps, all three of them have seen an improvement on a month-on-month basis, where for large caps it has come at 2,067 crore rupees versus 1,600 crore rupees. For mid caps it has improved to levels of 6,100 crore rupees, which compares with 4,385. Even small caps have seen an improvement to 5,600 crore rupees, which compares with inflow of around 5,000 crore rupees. This is something which is reflected in overall market move as well in the month of June, especially the outperformance that we've seen in the middle and small cap space. Some contribution that came in from the sectoral and thematic funds this time around, 1,469 crore rupees. So here is where inflows doubled on a month-on-month basis. We did see specific sectors doing really well, and those mutual funds seeing more inflows as well. NFOs is where the activity declined again. We did have around 7 NFOs in the month of June, but the inflows from them were just 460 crore rupees, which was the lowest that we've seen in a lot of months. It is actually at a record low in terms of inflows from the NFO space this time around. The SIP contributions, after declining in the month of June, did make a comeback in the month of, after declining in May, did make a comeback in the month of June above the 31,000 crore mark for now. And gold ETFs, that was the other thing that did see a decline in the month gone by because of the gold prices also declining sharply. That has made a comeback now at around 3,443 crore rupees. The multi-asset category, that was something that was declining in last couple of months, has made a comeback again. 4,810 crore rupees are the inflows. So overall, the momentum has improved and the mood as well across the categories.
All right, Sonal, many thanks for joining us. And one of the big stories today, TCS, shares of TCS up in trade after the company met expectations in Q1. Speaking to CNBC TV 18, the management says it is confident about its near-term growth prospects despite a lack of clarity on the longer-term recovery. Rima standing by with more of what came in from the TCS management. Rima, you know, there's been a lot of nervousness around Indian IT services, particularly TCS. What's the management telling you?
I think the first takeaway for me is that the near term is steady, but there is still no clarity on the long-term recovery for the Indian IT industry. The company met very subdued expectations in Q1. They said they're positive about Q2, FY27 should be better than FY26. But when we asked them that when do you think more work from AI, new work from AI will offset the loss of work on account of AI, the management couldn't give a timeline on that. Net-net, they did say that it will be positive, but again, there is still no clarity when very low single-digit revenue growth this year for the industry will get to mid-single digits or even higher. That's the first takeaway. The second one is the deflation. Everyone's worried about AI deflation. The management said it's about 10 to 15% on the project value. But what's also interesting is that the company, the CEO said we're actively encouraging our employees to pass on the productivity benefits to their clients. Now the AI revenue per se is about 8.5% of their overall revenues, $2.6 billion in terms of an overall size, growing at 13.6% on a quarter-on-quarter basis. But the AI deal size, according to the CEO, are going up, and these are not annuity revenues, which run for 3 years, 5 years. These are short-term projects, but it's important that the deal size is going up. And this is the part I think I found most interesting. We asked them that for what percentage of your clients, the customer base of TCS, are you doing AI work? And Kriti said that for our large clients, say $50 million plus in terms of revenues, we have 139 of them. For 130 of those, 130 out of 139, we're doing AI work. That's more than 90%. So then the next obvious question was that why isn't it showing up in your revenues? And he said that we have a very narrow
definition of AI. We don't want to do AI washing. We don't want to call everything AI revenue. And finally, on margins. Now, Q4 margins were at 24%, but they got impacted on account of the wage hike. What the company said is that we've taken all the headwinds in Q1. From here on, given the productivity benefits, efficiency-led tailwinds, we should gradually improve our margins to at least the FY25 number.
Overall, still I would say Q2 is positive, but at the same time, things been quite volatile in terms of whether H1 is better than H2. Okay, that I don't want to say H2 will be weaker than H1. Okay. But we are quite positive on Q2.
Okay, and FY27, if you have to characterize it?
Last quarter also said it will be better than 26. I still stick by that. It will be better than 26.
Well, that's TCS for you. Now, a group of e-commerce sellers have approached the Competition Commission against Flipkart for allegedly abusing its dominant market position. Reports say sellers claim Flipkart is indulging in deep discounting, preferential treatment to some sellers and anti-competitive arrangements. The complainants have claimed that this move is hurting small merchants. The competition watchdog is examining the complaint. WhatsApp has submitted its response to the government over its new username feature. Sources say the centre is examining the response and will make a decision on the next course of action. The government has raised concerns over WhatsApp's username feature, saying it could enable identity theft, fraud. Korean chip maker SK Hynix is all set to list on the Nasdaq tonight after raising over $26 billion. The company has priced its ADR at $149. This makes it the largest overseas first-time share sale by a foreign company in the US. The demand for the offer was immense, drawing over 7 times the number of available shares. The company's stock in Seoul has soared over 270% in 2026 so far, taking its overall market cap to over $1 trillion. On to CNBC exclusive, OpenAI CEO Sam Altman says the firm's new model ChatGPT 5.6 is 54% more token efficient. Speaking to CNBC, Altman also defended the White House's vetting of powerful AI models, calling it productive and in everyone's interest. Rachna joins us now with more. Rachna, how do these new models cut costs for the company?
Well, firstly, OpenAI has broadly released its GPT 5.6 family of models. That's Sol, Terra, and Luna. And this is after weeks of restricted access under a US government review. CEO Sam Altman told CNBC the flagship Sol is 54% more token efficient on agentic coding than rival models. Now, tokens are the billing unit for AI, and for enterprises running agents at scale, token costs now decide whether deployments are viable. When asked how much of the gain came from a focus on bringing down costs, Altman said, entirely. The customers say it is not enough though. Palo Alto Network CEO Nikesh Arora told CNBC that 54% is good, but the industry needs another turn at it. He wants AI pricing down 90% within 2 years. This is also in line with what we saw Palantir's Alex Karp was saying a few days ago when he said there's something seriously wrong with tokenization. Now the squeeze is that costs are rising on the other side as well. Altman called compute and memory costs a headwind, saying OpenAI needs algorithmic gains to keep customer prices falling while infrastructure costs continue to climb. There's also a new gatekeeper in the room. GPT 5.6 is the first OpenAI model to clear a government pre-release review, and Altman confirmed that the next model faces the same process. Frontier AI in the US now seems to ship with Washington's sign-off. Meanwhile, Meta fired the loudest shot on price. Mark Zuckerberg broke a 3-year silence on X, posting on Elon Musk's platform himself to announce Muse Spark 1.1, priced at roughly a tenth of Anthropic's Fable 5. Now, Musk, whose Grok 4.5 launched a day earlier, replied with a quote tweet where he plugged the platform X as a great way for companies to announce and gain followers, as Musk's post had about 12 million views. Now, with OpenAI valued at $852 billion and Anthropic both filed for IPOs, whether token economics works at scale is now the trillion-dollar question that the street will be watching out for. But in the meantime, let's get you this exclusive conversation that Sam Altman had with CNBC at the Sun Valley.
I thought it was a very productive process. We had a very good time working with Secretary Lutnick, Secretary Bessent, Director Karen Cross. This is our first time through it, so there are things we will learn about how to make it better for the next one, which will get going on soon, and I think it'll be a much smoother process. But the government's technical capability was impressive to me. People really are doing good work testing and red teaming these models, and they really care about getting these models out quickly, but with a high level of safety. And I think this is actually in everyone's interest. If you want broad access, which we do, and you have powerful models, you really want to be able to be confident in your safety claims, because otherwise the world is going to get uncomfortable very fast.
Well, that's Sam Altman there on the launch of their new ChatGPT 5.6. Now, the U.S. Federal Reserve announced the members of its new task force set to review the central bank's monetary policy mechanism. 3 Indian origin names across 3 verticals of the task force have been appointed for the review. Those include former RBI Governor Raghuram Rajan. He's set to co-lead the balance sheet policy division. Harvard economics professor Raj Chetty will be a part of the data task force, and Xbox CEO Asha Sharma will co-lead productivity and jobs and that task force. This comes after new Fed Chair Kevin Walsh announced plans to overhaul Fed communication last month. India has opposed the proposed 12.5% tariff under the U.S. Trade Representative Section 301 investigation into alleged forced labor. Industry sources say that India's legal framework already provides robust labor protection. They also say that India's acts, policies and practices do not burden or restrict the U.S., contrary to the assumptions underlying the investigation. So, of course, that is going to be a big one to watch. The trade agreement between India and the UK is set to come into effect on the 15th of July, unlocking wider market access, cutting tariffs and creating new opportunities for businesses and professionals. The deal aims to double bilateral trade to $120 billion by 2030. Abhimanyu joins us now with more. Abhimanyu, so what can we expect come the 15th of July? Finally, the UK-India FTA will be operational.
Huge expectations of benefits from the India-UK Free Trade Agreement, which is expected to come into force from the 15th of July. Now, benefits are expected to flow not just to India's exporters, who are going to get access to a huge British market in which labor-intensive exporters of agricultural products are expected to benefit by virtue of availability of a large market. Indian consumers are also expected to benefit by virtue of availability of cheaper Scotch whisky and cheaper imported cars from the United Kingdom. Now, several cars like Aston Martin, Bentley, JLR, McLaren and Rolls-Royce, which are made in the United Kingdom, are going to get cheaper in India. The DGFT has already issued a notification which has indicated details of import duty cuts on 3.78 lakh units of conventional engine passenger cars, in which the duties are going to fall from 110% to 10% over a period of a few years. Also, cheaper Scotch whisky and gin from the United Kingdom will be available in India for Indian consumers, in which the current 150% import duty is going to drop to 75% immediately and will subsequently fall by the 10th year of the implementation of the FTA to 40%. Also, zero duty would be witnessed by India's overall exports on 95% of its tariff lines, which include areas like agriculture, fruits, vegetables, processed foods and cereals. Also, labor-intensive exports are slated to benefit, and no duty concessions have been given on optical fibers, bundles and cables, TV camera tubes, base stations and plastics. Apart from that, there has been a quota which has been set for imported cars, in which no duties have been lowered for EVs, hybrids and hydrogen vehicles priced below £40,000 to protect the mass domestic market for conventional cars. So overall, both Indian exporters as well as British exporters are looking for huge benefits from the implementation of the India-UK Free Trade Agreement.
All right, Abhimanyu, many thanks. Shares of Dixon Technologies up in trade after the government's long-awaited green light to its joint venture with China's Vivo. This is the first major approval after restrictions on FDI from China under Press Note 3 were relaxed. Ashmit is here with more. Much anticipated, Ashmit. Dixon finally getting the go-ahead. Can we expect more approvals for investments lined up from China?
Well, there is substantial interest and momentum behind partnering with Chinese companies to bring in not just investments, but also technology and for building local capacity. As he correctly pointed out, in the month of March is when we'd seen a relaxation of the Press Note 3 mechanism. There was a fast tracking that was allowed under the Press Note 3 framework for 60 days. And that's yielding results. Of course, the latest one being the Dixon Vivo deal. This was a long time coming. This will be, of course, used for manufacturing of Vivo phones. But there are other JVs also that have secured secured approval. For example, the Dixon HKC partnership JV, which secured Press Note 3 approval for developing display modules. There's also Dixon Longcheer Intelligence, and that's an important partnership given as how Longcheer brings a lot of design capabilities. Uno Minda has secured Press Note 3 approval going forward for, in fact, building EV powertrain components here in India. And not just that, going forward, we're seeing an increasing amount of partnerships developing, if not via the equity route, then via technical partnerships that is beginning to take root. Take PG Electroplast, for example. They're building an AC plant. They reportedly in close conversations with Shanghai Highly Group. There's Electra, for example, has a technology partnership with BYD that's been extended till 2030. Amber has signed a deal with Oppo for manufacturing of phones on a sublease model, again, not requiring a Press Note 3 not there. EPAC Manufacturing is looking to build an AC plant in partnership with Hisense for AC manufacturing. So clearly a lot of momentum behind partnering with Chinese companies, bringing in investment, and if not investment, at least technology that will help build local capacity here for Make in India.
All right, Ashwit, many thanks for joining us. And staying with China, China's space program has achieved a significant breakthrough. The country successfully managed to land a reusable rocket for the first time. The rocket managed to place a satellite into orbit and return back to Earth. It was retrieved using a floating platform. These reusable rockets can significantly lower the cost of launching satellites and space exploration. Only Elon Musk, SpaceX and Blue Origin, owned by Jeff Bezos, have successfully managed to land rockets so far. Well, that is a sight to watch. Time for us to head into a break, but up next, meet the Nuval family, the promoters of solar industries who've now entered the list of top 10 wealthiest promoters of listed companies in India. At least 10 people have died after torrential rains unleashed widespread destruction across several parts of India. Fresh floods were reported in Himachal Pradesh. Rising water levels submerged a 100-foot iron bridge in a river. Officials said landslides have hit several places in rural areas, but no loss of life has been reported so far. The Indian Met Department has issued a red alert for parts of western UP, forecasting heavy to extremely heavy rainfall over the next 24 hours. This has intensified monsoon activity, claimed at least 7 lives and caused disruptions across the state. Relentless monsoon rain has also battered Delhi, inundating roads, uprooting trees and triggering widespread traffic snarls. However, the downpour also helped the national capital record its cleanest air since September of 2023. Heavy monsoon showers also lashed a large part of West Bengal, with northern parts of the state receiving the highest rainfall in 24 hours, continued well past the morning, causing waterlogging and slowing of traffic across Kolkata. Now, the Nuval family, promoters of solar industries, have entered the list of top 10 wealthiest promoters of listed companies in India. Founded in the 1980s, Solar Industries is India's largest explosives and defense manufacturer. Nimesh is here with more on the company and its very under-the-radar promoters. Nimesh.
It's been a fascinating story, not only for the investors, but for the promoters as well. And as you rightly pointed out, the wealth of this particular promoter is over 1 lakh crore. But first, what this is company all about? Solar Industries. It's one of the largest, explosive and defense manufacturer, and it is based out of Nagpur. So that's the basic about the company. As I said, the promoter owns 73.1% stake in the company. Who are the promoters? Now, Manish Nuwal is the MD and CEO. He's the son of Satyanarayan, and he was a founder of Solar Industries. So Manish owns 38.9%. Satyanarayan owns close to 3.5%. The trust owns close to 29% stake. And Seema Nuwal, who is the wife of Manish Nuwal, she owns a small 1.37% stake. So combined altogether, the promoter holding is 73.1% stake. Now, what is Solar Industries? Just the graphic will come up for you. They started as a small explosive trader in early 90s. And only in 1995, Solar Explosive was incorporated. And from there, they've built up one of the largest package explosive facility out of Nagpur. So that's the small journey of what the promoters have done. Now, this is interesting, where the pivot came. The pivot came when Manish Nuwal actually joined the company in the 90s. He was actually one who was leading the defense and aerospace expansions since 2010. And the defense revenue for this company has grown from 5% to 20% under his leadership. And that's where you've seen a big pivot and a change in terms of market cap as well for this company. Look at the financials now for 2026. The company has reported a revenue of close to 10,000 crores, PAT of around 1,800 crores, ROE of close to 29%, and ROC of close to 37.5%. So the number shows for itself, and that's the reason why the company is getting this kind of market valuation as well. As I said, look at the wealth that the promoter has created. So basically, the overall market cap is close to 1.6 lakh crore, and of this, since the promoter owns little 73%, it's basically they own close to 1.2 lakh crore. Just to put into perspective where Solar Industries stand in terms of the list of wealthy promoters or wealthy promoters. Now this is a whole list. Avenue Supermart stands out. R.K. Daman is hands down the topmost guy at close to 2 lakh crores of personal wealth, because of its listed entity. The rest are largely conglomerates or bigger MNCs. Nestle India, Bajaj Finserv, Bajaj Auto, of course the two Bajaj Group, Adani Group, Asian Paints, JSW, Wipro. A large part of these names are basically conglomerates or from larger corporates. Solar Industries stands out at number 10. The interesting part is today Solar Industries promoters are even above DLF promoters in terms of wealth creation. So that's the kind of wealth the promoter has created. As I said, they're currently at number 10. The promoter's wealth is close to, again, it's a wealth on the paper, right? It's just a market cap, but still, a Solar Industries, from a company based out of Nagpur, from nowhere, is now currently the number 10th wealthiest person, having a personal wealth of over 1 lakh crore with a market cap of 1.6 lakh crore. It's basically not only the promoters, but even if you look at the shareholding pattern, the FIs have owned money, the DIs have owned money, and of course, promoters have created the biggest wealth. Now they're sitting on over 1 lakh crores of wealth as being a listed entity of Solar Industries.
Well, that is the story of Solar Industries, and what a story indeed. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV 18. Stay tuned. We're back in a minute with more.
Hello and welcome to IPO KYC. This is a special one. Rima and I are here at the offices of SBI Funds Management, the company behind what all of us know as SBI Mutual Fund. I think needs little by way of introduction. We're sitting right here, the heart of, the offices, a lot of hustle bustle around it. It's a special time. SBI Funds is going the public way. It's a formidable entity, the largest asset management company in the country, 30 lakh crores in terms of assets, 6 lakh crores in terms of equity assets, 3,000 crores in net profits, the last reported number that we have, and it's going to list pretty soon. So we're going to ask the trajectory, the roadmap, and what does it mean for you and me as investors into SBI Funds Management. We've all, of course, had SIPs running with SBI Mutual Fund. Now, of course, you can be an investor in the company too. And to discuss all of this, we have Mr. DP Singh. He's Joint Managing Director and Deputy CEO of the company. Srinivas Jain is Executive Vice President at the company as well. Gentlemen, thank you very much, both of you.
Thank you.
Appreciate it. So between the both of you, it's about 50 years at SBI Funds.
I'm not so old.
Yeah. I mean, how does it feel?
It feels very, very great. I remember when me and Srinivas started the journey in SBI Funds Management, it was a 2,500 crore company.
Yeah. 2,500 crore AUM?
Yeah.
Wow, 30 lakh crores now.
Yeah, it's a big franchise. We're very proud to be part of this growth journey.
Part of the growth journey.
Yeah.
And, let me just get to the valuation. I mean, we got the price band earlier today. At the upper end of the price band, at about 574, the valuation is about a little less than 1.2 lakh crores. And, you can take forward projections and, assuming 25-26% growth, 5,000 crore net profits in F5 28, which gets us a multiple of about 24 times. Is that the right way to look at is that the right multiple, Mr. Singh?
So many factors around it, but if we go by our past history, the way we have been growing, then definitely yes.
Okay.
But there are always in the market, there are uncertainties. It could be more than this, it could be a little less than this. But the growth rate, the more and more financialization happens in the country, SBI Mutual Fund is at the forefront. We will get the maximum benefit. The moment today the biggest friction in growth of mutual fund business is the way KYCs are being done. These small players, the way it's a linkage between the remuneration for acquiring a customer and all efforts to be bring in. So that is not working. The moment that friction is over, which is likely to happen very, very soon, and once because all the bank accounts are now KYC compliant. The moment any bank account which is KYC compliant frictionlessly can part money in mutual fund, I think that will be the biggest revolution. And the number which is there today, only 6 crore investors, that will multiply like anything, and that the number could be anywhere. I'm not saying as much as number of bank accounts are there, but at least 20% of the bank accounts will be the mutual fund investors.
As soon as this KYC is that big,
whenever that happens. That's big, because lower level, middle level, nobody is servicing today.
Yeah. So just to close the loop on that, I'm not wildly inaccurate when I say 5,000 crores in net profits, 24 times earnings, which is actually quite reasonable as compared to some of the other listed peers, which I'm sure is a conscious decision. Srinivas, you want to just point, come in on that KYC and, that big leap that provides?
What are the two factors today driving the growth of this business, right? One is, of course, education. We talked about the 100 crore bank accounts, 5.5 crore customers in mutual fund industry. So obviously, there is some gap. That means that needs to be driven through either education. With mutual funds IA and such campaigns have really been helpful building that. As that moves, you now need to remove friction also. I think the way eKYCs have now come on board, the friction is kind of come down, but still it exists. Today, if you're a bank customer and you've done every KYC that's there, why do you need to do another KYC when you do a mutual fund? There's new KYC 2.0, which is CKYC 2.0, what they're calling as One Nation, One KYC. If that comes in very quickly, this friction point also goes away.
Do we have any timelines for it?
My understanding is that they are fairly advanced and ready from a technology point of view. We've also been talking to both Protean, CKYC team and all. SEBI chairman actually made a statement saying you should expect that very soon because he's kind of spearheading this particular debate. So one of the things that we at SBI Group have about 55 crore customer base. And even if you take all those Jan Dhan accounts and others away, we have a 35 crore investors who are KYC'd in the bank. And that's like 55 lakhs today with us from already KYC'd SBI mutual fund customer. The headroom for us to grow and this friction that's going to go away is going to make it a big...
55 lakh accounts, 35 crore KYC'd.
35 crore is the target audience. And 55 lakh is the audience today.
Where you are right now.
It's 2%, right? So from 2% to even if I were to go to 10%, DP's number, which we are talking about 20 is a little far. Even if I go to 10%, that's a huge number. That's like 5 times our business that we are today with the bank. That's 2.5 lakh crores is what State Bank of India's AUM is with us. So think about it. That's a huge business.
It's a huge headroom to grow. So let's just understand about SBI Mutual Fund and the scale today.
Right.
So Srini, 30 lakh crore in terms of an overall AUM. Break that up for us in terms of categories and the kind of profitability that you make on each.
Yeah, I'll come to the profit, but let me explain the business to you. I think there's a different franchise we have been able to build. One, of course, is the bread and butter mutual fund business, which today, as we speak, about 13 lakh crore plus assets under management, making us the largest asset manager with almost 15.5% market share. We also have a very large ETF pool, which we are our largest passive provider. We have roughly about 4 lakh plus crores of ETF assets. I went 30% market share there. But one of the big business that we do is on the institutional side of the business. We have a very large 16.5 lakh crore worth of business that we do on the pension funds management. A large chunk of it is coming from EPFO. It's roughly about 9 lakh crores of that business. It's a fixed income mandate, but it's a very prestigious mandate. We do impact 11 lakh crore investors who invest through EPFO. In a way, it's a nation building capability that we have. While that business is not a very large revenue pool business, there is also a pool of business in the PMS, which is our international operations. We have a fairly large international client base, roughly about $4.5 billion worth of assets that we manage for global investors, our own joint venture, Amundi. So that's a very revenue generating kind of numbers. So the piece of business that's well known is the bread and butter mutual fund business. That gives me the highest revenue pools. And the second piece of business that we have is the management fee coming out of our portfolio management services business, which has both the EPFO and the other fixed income mandates, plus the money that we get out of our international business.
So in that 13 lakh crore of mutual funds, what is the contribution of equity, debt? And then if you could tell us the yield that you make on each of these and including the ETFs.
I mean, so it's all in the public domain, but I can tell you we are about 6.5 lakh crore worth of active equity out of the 13 lakh crore that we have. Equity is a fairly profitable, very profitable business for every asset manager. For us too, it's upwards of 60 basis point is what we make on that pure equity assets. But then we also have, the scale kind of comes down. We have hybrid products, we have, fixed income products, we have money market products, and then we have ETFs. In ETF also, there are 3 varieties of ETF. The one we manage for the Nifty and Sensex, which are extremely low yield but very high volume business. But we also manage a gold ETF and silver ETF, which are fairly large margin businesses, which are even closer to active equity kind of margin. So it's widely diverse, the pace of business, and it also widely diversified. That means thanks to hybrid business, it's also not very volatile thanks to mark-to-market impacts that we have. We also have a fairly large fixed income pool that we manage. So our business margin moves from 2 basis point to a 65 basis point kind of spread.
Okay. On a blended basis, you would be at 37 basis?
Yeah, in fact, that's an interesting story there. Absolutely. Absolutely. That's a very interesting story. I think one of the things that have happened to us is that passive overhang that we had as 40% plus market share is kind of averaging out, and we are actually building a strong equity book. As you see, our SIP book is now 4,000 plus crores every month. And that's actually improving our active mix. Last 3 years, we've grown almost 32 to 42%. And that's a very steady growth. And I see that growth continuing.
That 6 lakh crore, which is active equity, where will that number be? I mean, what should we expect in terms of growth here?
You want to answer? Please.
No. See, what happens in the 6.3 lakh crores exactly. Today we have got a SIP book of 4,000 crores, out of which 3,800 crores is for this category only. So that itself is beginning 48,000 crores as today's number. If we grow by 10%, it will become 60,000 crores. Then net sales also happen across the country, 50-60,000 crores. And if I take 10% mark-to-market year-on-year basis, of course not in a straight line manner, but if we are talking about 3 to 5 years, so if we take an average of 10%, so the 1 year itself it should grow up by 2 lakh crores. This is 6 lakh crores business. And the other is the ETF, etc. The mark to market will come there as well at the stock level. Even if you say incrementally I will get 26% flow. But the stock which is there, which came at a higher level of 75-50%, that is there with us, the mark to market. So the equity book, which is 10 lakh crores today, will grow by 2.5 to 3 lakh crores in 1 year, going by these back of the envelope calculations. And the multiple of that in next 2 to 3 years. So this is going to continue. This is what I'm saying. I'm considering this number is net sales number.
And this is persistency an issue? I mean, across
accounts? Our persistency is better.
It's better. And there is another unique thing also, which of course we've been, it's been a part of our design that we've been trying to get very long-term SIPs only as part of our. So we've always incentivized to get what we call perpetual SIPs, those 30 years NPCI mandates that are there, which has actually helped us to build a very 98% of our SIPs are very long-tenor SIPs, which is a very good thing because we don't have to go every year or alternate year to renew them or ask them to top up their SIPs or sign up on new things. So that's a unique business model we've been able to build, and we have like 1.6 crore SIPs today. Last year alone we added about 40 lakh SIPs to the book. So it's growing at a very fast pace.
So as your equities, which are actively managed, compound at 20-25% on an annual basis from here on, what would your blended yield look like going ahead, say 2 years or 3 years down the line?
I think the way to think about it is that today the best in class is close to about 44 basis point. I think we should come very close to that because clearly, as you see, the active participation going up. But at our scale, that's a difference. The blended yield for a smaller player at 40 basis point and at a 13 lakh crore player is a completely different way to think about it. So we are probably one of those few very large asset manager because of this active mix going up.
Your operating cost, I believe, is also the lowest in the industry.
Yes. We run a very tight book. In fact, our cost-to-income ratio is like 20%, which is probably one of the most attractive, not just in India, globally, for any asset manager.
So you should get to 44 basis points, which is best in class.
We don't want to predict that number because that's like very forward-looking. The better way to think about it is that we want to come closer to an average of the industry, despite having an extremely high book. Size of our book. So that's the way to think about it.
The reason we ask is because the total expense ratio rules also changed effective 1st of April.
Right.
Has that had an impact, and are you passing on the impact to distributors?
No, we have already we are through that, and we have actually neutral to that, revenue neutral. We have passed on this also. There were some things where we got some benefit as well, and the biggest barometer is if you look at our direct plan expense ratios. If those are remaining intact, that means my management fee is intact. As simple as that. And we have not changed that. Our revenue is continuing.
What is the split between like direct and sort of distributor-led sales now?
It's around 22-23% direct. And the remaining is distributed. That's how this is.
Is this also like a...
This is going up.
It's going up.
This is going up.
Yeah, there's a move towards direct anyway. That's been going on for almost a decade now. Yep. It's picking steam, but at the heart of it, we are a distributor-driven organization, whether it's State Bank of India or third-party distribution. Yeah. Very focused on it, but we also see a very large trend of self-service investors coming to us. We built an app called Invest App, which is the biggest app among asset managers out there, 4 million plus users, and we get 12% of our SIP book out of that. So it's built a very strong, B2C case also. But at the core of it, we are a B2B company.
Absolutely. Any pressure on yields? I mean, from anywhere, regulatory-wise or anything else? And I mean, we've spoken about this shift to passives globally.
Is the worst is behind us now.
Okay. Whatever had to happen regulation-wise.
Has happened. Okay. At least for next 3, 4, 5 years, nothing is going to happen. That's one thing. And this also has happened because it was already going on. It was work in progress, so they had to do it. They have done it.
This global shift to passives, do you think that will play out here in India?
I mean, not really. If you look at the data, other than maybe 1 year that was post-COVID, active managers have done extremely well. And even when you look at dispersion of returns across asset managers, even the worst asset manager has been able to beat index significantly. Not across the board, but largely. So India continues to have a very active management space, and I think for a while it will be there. But maybe at some point of time that shift will happen.
Well, I have a long list of questions, and I'm sure Reema has more as well. But I think this gives investors a fair bit of sense of what the IPO is about. Not that they needed, an introduction to SBI Mutual Fund. I think we all know it. But we wish you all the best of luck, Mr. Singh.
Thank you, Prashant.
Thank you so much. Thank you. Thank you for coming here. Thank you.
Well, we'll take a quick commercial break. We'll see you on the other side. We are still right here at the SBI Funds Management offices in BKC in Mumbai. The IPO, of course, a fair bit of excitement around it. It's, of course, one of the largest asset managers in the country. And now we are sitting down with Mr. Debashish Mishra, MD and CEO at SBI Funds Management. Mr. Mishra, great to have you with us here.
Yeah.
Thank you very much for joining us. You know, mutual fund say has become a mantra, has done so well, done wonders for the industry, has done wonders for SBI as a leader as well, SBI MF as a leader as well. What gives you the confidence, the next leg of growth? Because India's sort of, savings, financial savings are still largely in, deposits with banks and real estate and all kinds of things. Equity is, I dare say, still a newer asset class in that sense. What gives you the confidence that this share will structurally keep growing?
So, we have 1.4 billion people. Guess what is the number of bank accounts? 950 million. We are roughly reaching to 80% of the citizens for banking transactions, thanks to PM, Jandan, Jam Trinity, thanks to the inclusions by banks and NBFCs. But you look at the number of customers having investment accounts or folios, you would say in parlor terms, only 53 million. So that gives us a lot of confidence that in future or in today, we have enough to move around, and there's a big road ahead for all of us to cover. My second point is, today's investor is not the one you think of believing in going to the bank or sitting across the counter. Digital delivery is the key, the buzzword for all the investors today. Youngsters, they would like to see the Facebook, maybe the Twitter, maybe the social media to find out who is investing, where is investing, and what is required. Number three, even if we take the last 5 years journey of financialization, there has been a move from saver to investors. The whole financial assets creation is increasing 11% of CAGR, whereas mutual funds have grown by 41%. Yep. So there is an increasing trend to bring these people from the saver to investor world.
So within the SBI ecosystem, right, I think SBI bank accounts are 530 million.
Yeah.
In that, the ones who have a YONO account, 120.
Yeah.
But you're saying only 5.5 million of those invest money with SBI mutual fund,
yes,
right?
unique customers.
Unique customers. That's a very small number. So now, say in the next 3 years, what would you like that number to go up? And other than, fixing the KYC issue, are there any other friction points that you'd like to solve?
So, KYC is one, of course, it is going to resolve, I'm sure. Now it is in the hands of SEBI and Government of India. We are now going to solve it through digital integration. So we have got an app called Invest app, which is an AI-based app. We are going to now seamlessly integrate the YONO, so that any YONO customer can go to invest in SIP, in lump sum, in any investment product, digitally, seamlessly. So that work in progress. We are already having the integration done. KYC thing comes up, we fix it, and it's done. We are also trying to have increasing our base in B30 centers. So we have now 270 branches of SBI AMC. We are going to make it 50 branches more in this financial year. So we are reaching out to people directly also for solicitation, for clarifications, for any doubts, for any grievances. Our own people, my own people will be there. We are also trying to train our SBI employees with the NISM certification to reach out to people. As per regulation, you can't sell a mutual fund product if you don't have a certification. So as of now, there are 13,000 employees of State Bank of India who are qualified to sell. We are trying to make it maybe 30,000 in coming 3 years.
So what will this 5.5 million number go up to?
So I answered your question, double. So we are trying to make it, we'll make it 10 million in 3 years' time.
So 12 out of 10 basically will be on it.
Yes.
That's going to be a big number, right?
Yeah.
I mean, and that's the thing. You don't need to look elsewhere for growth. You've got this captive large base in that sense.
I have a supplementary answer to this.
Yeah.
In addition to SBI, our other side of channel is also equally good and great.
Yeah.
I have 130,000 IFAs, individual financial advisors, who are advising to more than 40% of my asset base, or AUM base. See, SBI, although it's a parent bank and we have got a shareholding and all, but they consume only 23 to 25% of the business.
Yeah.
So we have got a large chunk of business in the hands of AIFs, institutions, PMS. Also we are into alternates. Every sector we are increasing our footprints.
I have a question, slightly maybe offbeat, but Mr. Mishra, you were a career banker at SBI. You've done so many roles across, right? And now you're at the helm of this organization as it goes public. What will change at SBI Funds Management? I mean, it goes from a private financial institution in that sense to like a listed public company now with minority shareholders. What should investors expect?
That's a good question. I expected this to come. See, the priorities for me as a senior management in State Bank of India is only three. Customer centricity, value creation and governance. Here also same three. So I have to look at my investors. Now I have to add my shareholders. And I have to look at governance because we will be listed. So we will be more governance oriented, disciplined and value creation. So my investment team, which is creating value, I'm sitting with them. My first interaction with them is only after coming here to understand the whole gamut of investment and fixed income and derivatives, equities, everything. See, overall, in the bank, we understand customer is the key. So as long as I believe that and carry on in my whole activities, then whether it is AMC or bank or anywhere, it's all the same game.
Well, we wish you all the best of luck, Mr. Mishra.
Thank you.
It's a momentous occasion. Yeah. And I'm sure this is the first of many interactions right here on CNBC TV.
Absolutely.
Thank you.
Thank you.
All the
Thank you all.
best. All the best.
Hello and welcome to News Center. I am Ashmit Kumar. Now, back in the month of March, the government eased long-standing foreign direct investment restrictions for companies from India's land bordering countries. Now, those curbs had been imposed under Press Note 3 in April of 2020 during the COVID-19 pandemic to prevent opportunistic takeovers of Indian companies. While the rule applied to all land bordering nations, it was widely seen as primarily targeting Chinese investments. Now, with the government approving the Dixon Technologies Vivo joint venture, it marks a major positive for FDI flows into the country. The two companies had announced their partnership way back in 2024, but the regulatory hurdle was an overhang, which has now been cleared. The JV is expected to generate around 30,000 crore rupees in revenue. Operations are likely to begin in the third quarter of FY27, which is within 3 months of the approval. Dixon will hold a majority stake of 51%, while Vivo will own the remaining shares. The joint venture is expected to manufacture nearly 2/3 of Vivo India's annual smartphone volumes, around 23 million units, since Vivo's annual volumes are around 35 million units. So, how will this pave the way for other deals in the pipeline and companies mulling over similar future partnership? To discuss this further, we have with us Niti Aayog's former Vice Chairman, Mr. Rajiv Kumar. Mr. Kumar, thank you so much for joining us. Pleasure having you with us. First question, over the last few months, we've seen very many approvals being granted under the Press Note 3 route. Earlier this year, in the month of March, we even had a relaxation of the Press Note 3 mechanism, allowing for a fast tracking of approvals within 60 days. Are you seeing a strategic shift, a strategic pivot, if I can call it that, in terms of how India looks at Chinese investments, Chinese technology?
Hi, Ashmit. Wonderful to be here. Thanks for inviting me here. And very good news. You know, the Dixon Vivo joint venture clearance under Press Note 3. Very good news, and I hope a beginning of a new trend, of a beginning of a new policy framework. Because I've been arguing for a while that the Press Note 3 had outlived its usefulness and should be removed, and which the government did in March. And I believe that joint ventures with Chinese companies, technology transfers from Chinese companies, investment into India are a much better way forward than to run a huge bilateral trade deficit, which we do at the moment. So I'm very happy at what's happening, but I hope that this is not a sort of a single shot in the situation, and that things will continue. And the 2-year time frame that you just described for this approval would be shortened to months, because we need a lot of FDI, and all those who are willing to come in should be encouraged to come in. And that's probably also the way to develop our own indigenous technology through transfer. And along with that, the security concerns, if any, can be taken care of, which is quite independent of the quality of the investment proposal, which should not take as long as it has done so far, even from our neighbors, the land neighbors, as has been the case so far. So very good news as far as I'm concerned.
Well, speaking of that Dixon Vivo approval that has come via the Press Note 3 process, Mr. Kumar, I want to ask you that here's a case where the Indian entity enjoys a 51% stake. There's capital being brought in by the Chinese partner. There's technology being brought in by the Chinese partner. Is this the model framework, perhaps, on which future JVs can structure themselves? This is a model that perhaps works for India?
It's a better model. It's, of course, where the Indian company has a majority stake in the company, but not necessarily the only model. I wouldn't mind the Chinese companies having the majority share, because as long as you have 26% share, you have some control over what the decision making is. You have your nominees on the board, so therefore I would not make it into a condition under any case that the Indian partner should have the majority stake in the equity of the company. And I think there will be the bigger Chinese companies, or some of the companies with more strategic technology in the field of electric vehicles, in batteries, in quantum engineering or in biogenetics, etc., may want a higher share in the equity, and that should be looked at very positively. Actually, the principle underlying all this, Ashmit, should be the one condition for all, and not differentiated conditions. So whatever you apply for the American companies or European companies should be the same as that for the Chinese companies. I don't think there is any reason now, given the current geopolitical, geoeconomic situation and all that's going on, that we need to have a differentiated approach towards any foreign investor who wants to come and set up real capacities in the country. I'm not talking about portfolio investors. I'm not talking about those who bring in private equity. I'm talking about those who are bringing in what we call, genuine investment to create new capacities and generate new employment. The same stake should apply for everybody, every investor around the world, because that gives clarity, that gives predictability, that takes away uncertainty, and that takes away unnecessary discretion, which takes time and takes time, and that also sort of confuses the ease of doing business. So that's my principle. Apply the same rule across the board, whoever it is who is wanting to bring in investment with technology and for generating employment.
Sure. In the spirit of not having a differentiated approach, Mr. Kumar, so far we've seen a bias as far as approvals coming in towards the electronics, the semiconductor space. Would you also want this to be widened? Under Press Note 3, that provision is there. The Committee of Secretaries can do that. Would you want this portfolio of sectors to be widened?
Of course, absolutely. For example, our APIs, advanced pharmaceutical ingredients. We import nearly 100% of that, and that's a vulnerability. That's a dependency. Which we should be which we should be addressing. And so, if there are Chinese companies who want to invest in manufacturing APIs in this country, most welcome as far as I'm concerned. Or those who maybe wanting to produce batteries with new technologies. I believe China has now started producing 80-volt batteries, which is, so far the world norm had been 60. If there's a Chinese company who wants to come and set up a battery plant, right away, as far as I'm concerned. So it should be across the board, again, across the sectors. Whichever sectors, let me sort of say, whichever sectors you permit Israeli investment, you should be permitting Chinese investment, along with taking good care of our security concerns, if there are any. Maybe telecom may not be the ones that you want to do it, but again, you have to look at even in that sector, you may want to look at the nature, the quality of the investment, the composition of the investment more carefully before taking any decision. But please open the door for any investor, including Chinese, who want to set up genuine capacities here, especially with those bringing in frontier technologies.
Mr. Kumar, the last time you were with us, you talked about how India is not as large a market to sustain a manufacturing momentum, that to do that, to build manufacturing capacity at scale, we need to then target export-led growth. My question to you is, in order to do that, to cater to a world market, to build that kind of scale and capacity here, given the fact that a lot of technology rests in Chinese hands, a lot of industrial capacity rests in China, you think this is an eventuality to engage with China as well as Chinese entities if we want to build that scale here in India?
China would be one of the partners, but not only the only one, because they may not want to dilute their share in the world market, and they may not want to create competitors, on their own accord. But if they are willing to have export-oriented production, we should be more than willing. We should be more than encouraging for them to do so. And I think, the Institute of Strategic Studies Australia has come out, I think, with the fact that out of 73 frontier technologies, Chinese are leading now in 67 of those. And if that is so, then this will come from them, and and we could encourage them. We could incentivize joint ventures which are export oriented across the field, special steels could be one, APIs could be another. You could have batteries, etc. So I would extend this beyond electronics to begin with, and two, I would encourage and give incentive and actually work with the state governments to provide the kind of incentive that they can, which the center cannot, because that's where the real sort of ease of doing business comes through in every state, for them to do that sort of lay the groundwork for these companies to come in and start exporting after a while. But it is absolutely right that the Indian, if you cater only to the domestic market, you may not get the scale and you may not get the competitiveness and the productivity levels which you will get if you were operating in the world markets. And India needs to very much increase its share of world trade, which is stuck at less than 2% for decades now. And that's not the way forward for achieving our aspirational goals for 2047, where you need to ramp up the rate of growth of economic growth plus employment plus also exports.
Right, Mr. Kumar, always a pleasure having you. Thank you. Appreciate your insight on what it may take for India to grow its manufacturing base and what role, if any, Chinese entities can play going forward. Thank you, Mr. Kumar, once again for joining us. With that, it's time now for a short break. But coming up next, I speak with Truecaller CEO Rishit Jhunjhunwala on spam calls and blanket whitelisting and a lot more. That's up on the other side of this short break. Telecom regulator, the TRAI, and Truecaller have locked horns over how spam calls are to be defined. The TRAI approach is that the Electronics and the IT Ministry should take some kind of action. The TRAI is seeking powers to act as an authorized agency under the IT Act so it can regulate call management applications such as Truecaller. Now, the regulator claimed that Truecaller is wrongfully tagging calls from the 140 and the 1600 series as spam, even though these prefixes are meant for legitimate commercial calls. Truecaller pushed back, saying that users actively block 4 lakh calls from the 140 series and 1.25 lakh calls from the 1600 series every day. CEO Rishit Jhunjhunwala also clarified that those calls get a frequently blocked badge but did not get the spam tag. Joining us now to discuss this is with us the man himself, the CEO, Mr. Rishit Jhunjhunwala of Truecaller. Thank you so much for joining us, Mr. Jhunjhunwala. First question, let's address the elephant in the room. The TRAI is looking to take action against you. They've reached out to MeitY. They're seeking some kind of powers under the IT Act. Now, you... referring to your post on social media, you've called it an attempt to scam you. You've called it a lose-lose situation. You've called it an attempt to censor you. Would you care to explain the post that you put out on X?
Yeah, absolutely. Thanks for having me, firstly. Just to give you a little bit of description of how exactly spam markings work on Truecaller, just to set that context. We respect the user's choice. So if X number of users tell us that a number is spam, then we mark it as spam on Truecaller so that all the rest of the users then know that this is a spam call. We were told by the TRAI that 140 and 1600 our designated number series, and all call management apps like Truecaller are prohibited from tagging or marking as spam or blocking or doing anything around these two designated series numbers. This, of course, I mean, we knew what was going to happen, that this would give a get out of jail free card essentially to spammers. Spammers would just use the 140 and, more importantly, the 1600 series to spam its users, because Truecaller is never going to mark them as spam. And exactly as we had predicted, the numbers skyrocketed. Like you mentioned, there are lakhs of people blocking 1600 numbers every single day. And this therefore results in exactly the reverse of what the department was trying to do. They're trying to create a trusted channel for trusted communication between businesses and consumers. And instead, that trust is completely broken, because consumers are now saying, I'm getting spam from 1600, and Truecaller is not even telling me it's spam, but it's a spam call. Somebody's selling me a personal loan, somebody's selling me insurance. So people are not even picking up legitimate 1600 calls now. That is the problem that is taking place.
Sure. Let's build on that. Now, your stated position, Truecaller's stated position, is that in letter you've complied with what the TRAI directive was, that there's no longer 1600 calls or 140 calls being flagged as spam. But question that some are asking is that, have you complied in spirit? Because we're given to understand that you're deploying a badge that flags these calls as frequently blocked. Is that a valid legal middle ground that you think Truecaller can work with?
Well, look, we had to take the side of our consumers. We can't have a service that promises that we will protect you from spam and scam calls, and yet not give the user any indication that this is probably not a call that you should be picking up. So we did comply. We have no tagging on it anymore. We don't show red, which is the iconic marking of Truecaller to show a spam call. Both 140 and 1600 calls will never be spam on Truecaller. But we had to do something, because consumers were telling us that Truecaller is not working for me. I received this call. It happened to be a 1600 number, but it's not showing spam on Truecaller. So we had to do something. And I mean, the data speaks for itself. If there are 1.25 lakh people every day manually blocking the 1600 series calls, we had to do something about it. So we introduced frequently blocked, which gives the consumer an indication that a lot of people block calls from this number. That's essentially what we built eventually.
Now, you mentioned that blocking of calls from 1600 series has increased. The number that you gave on your ex-post was 208%. You also mentioned that the TRAI is trying to censor you. Why do you think that is?
Well, the intention that the TRAI had was to create these number series which consumers can trust is a legitimate call and pick up with confidence, right? That was what 1600 was for. 140 is reserved for registered telemarketer companies. In doing that, I think that that intent was probably the right intent. But then telling call management apps like us that you have to blanket whitelist 1600 numbers, that is, I believe, the wrong practice. Because if a consumer is saying that this number is a spam call, then even Truecaller cannot override that. Nobody should be able to override a consumer's voice. If consumer is saying, if lakhs of consumers every day are saying these calls are spam calls and nobody is doing anything about it, I think that is definitely the wrong approach. And it's literally censoring a consumer's voice because they are telling us that this is a spam call.
Right. Now, reports are indicating that Truecaller is also trying to be in conversation with banks and financial institutions for some kind of a premium badge. Is that the reason? Some are saying that, is that the reason why you're opposing the TRAI action?
It has nothing to do with our, it's called Truecaller for Business. That is the offering that we have towards enterprises. We offer a suite of communication tools that help them communicate better with the audience. We do KYC on their numbers, and we confirm that this number is owned by that business, and therefore it becomes green, which is verified on Truecaller. And that unlocks a set of capabilities to them when they sign up to Truecaller for Business. Even in Truecaller for Business, it doesn't matter if you pay us. if you're a spammer, you will still be marked as a spammer even if you are verified on Truecaller. So we don't have that conflict at all. If you're a spammer, even if you pay us, you will still be a spammer on Truecaller.
But are you in conversation with banks? How far have those conversations proceeded?
We launched Truecaller for Business back in 2021. Since then, about 3,000 of the largest enterprises globally, in India as well, and globally, have already signed up to the service. So it's an offering that has been there for a long period of time now.
Right. Now, the next question I want to ask is that have you presented these views to the government? When I mean government, I mean in response to the latest initiative that the TRAI is trying to take, that they've reached out to MeitY. MeitY in turn has reached out to the DOT. Have you reached out to the ministries, the Ministry of Electronics and IT, the Department of Telecom? Will you be making any submissions based on the numbers that you've cited, the spike in alleged increase in spam calls?
Yeah, absolutely. We will definitely be making submissions to MeitY. We have written multiple times in the past to TRAI. TRAI is well aware that this is the pattern that we are seeing. In fact, during the public consultation that took place a few months ago on the next amendment of the TCCPR guidelines, in that as well, we have clearly mentioned that this is the trend that we're seeing on 140 and 1600. That is publicly available as well.
Sure. Let's move ahead, and this question is slightly speculative, but I'll seek your indulgence. If the TRAI does get this power, they're seeking to be authorized, to be called an authorized agency under the IT Act. If that were to pass, if the MeitY and the DOT agree with their position, how will Truecaller respond? Will it continue with this badge for 1600 calls by calling them frequently blocked? Or will it fall in line both in letter and spirit with the TRAI directive, which is to whitelist the 1600 calls without any badges?
Look, we absolutely want to respect a consumer's choice. If there are hundreds of thousands of people saying that this is a spam call, we still want to protect our consumers no matter what, because that's the reason why 500 million people across the world trust Truecaller today. We cannot break that trust. If we start breaking that trust, we don't have a business anymore. So we will always respect the consumer's choice and the consumer's voice. I believe TRAI is seeking powers to enforce rules and enforce IT rules on call management apps like us is probably more for the future, and it's not so much for the present. And that is a bit worrisome, because if there are mandates such as whitelisting 1600, 140, I don't know what else will come up in the future. And I'm worried that if we have to keep doing things that are anti-consumer and they actually facilitate spam, I think that will make the situation worse.
On that note, let me also get a wider perspective from you, Mr. Jhunjhunwala. A lot of concerns, conversations within government circles is that spam is not restricted to only the telecom companies. It often travels beyond them, goes into the realm of the OTT messaging applications, whether it's WhatsApp, whether it's Telegram. The question I want to ask is, as somebody who's taken on the mantle of fighting spam on behalf of customers, at least that's what your claim is, is there a case to be made for the TRAI to have some kind of oversight as far as spam on OTT messaging platforms is concerned? The TRAI so far says that we have a hands-off approach. That's beyond my realm, that's beyond my jurisdiction. Should there be some kind of regulation of even the OTT applications?
Look, I think there is regulation. OTT apps are regulated by the IT ministry, of course, not by TRAI. And I think the TRAI has taken a good approach on that they are hands-off from OTT apps. I believe the MeitY is a very responsible organization, as are the OTT apps. And I'm sure if there is a spam problem on OTT platforms, I'm quite sure that it's something that they would solve. But we are playing our part. We actually do have an offering within Truecaller that detects spam calls even on OTT apps like WhatsApp and Telegram. It works well on iOS, and it's not that fluid on Android. And we'll always try to improve that. But we do our part on that as well.
So if I can summarize what you're saying, TRAI has no business, has no role as far as OTT applications are concerned, like WhatsApp, Telegram.
I believe so. I think being regulated by the IT ministry, because they are OTT apps after all, they are very different from traditional telecom infrastructure. And I think that's a good way to leave it.
Before I let you go, Mr. Jhunjhunwala, a couple of questions about the India market. It is your biggest market. Now, India has seen an aggressive rollout of caller name display. A lot of companies are required to do that, telecom companies. Even under the latest Telecom Act, there's a requirement for telecom companies to use AI tools to reduce the occurrence of spam. Does that impact you at the core of your business? There are reports which indicate that perhaps downloads for Truecaller in India in the recent months has slowed down.
We haven't seen much of an impact as yet, simply because two reasons. One is that CNAP has actually existed in other markets as well, and we have coexisted with CNAP in those markets as well. The reason why I believe that we won't see a significant impact on Truecaller, even with the rollout of CNAP and the telco-powered spam services, is because Truecaller goes way beyond just showing a name. And the example I always give is, if your phone rings right now and it flashes and CNAP shows you that it's, Rajesh Kumar calling, what can you do with that call? There's not much that you can do. This could be Rajesh Kumar, that's an important call. It could be Rajesh Kumar, the spammer. What Truecaller does is actually qualifies that for you and gives you context that this is, Rajesh Kumar from this company. It's Rajesh Kumar calling from Truecaller. It's, someone based in Delhi. Those are the signals that we get from our community. And I believe that's the reason why Truecaller continues to play a very important role in spite of having CNAP.
And my one final question to you, a regulatory hurdle that's coming your way will, of course, be the implementation of the DPDP Act. It's not very far away now, 2027. Tell us, you're handling sensitive data for millions and millions of users and consumers. How do you go about managing the question of obtaining consent from these millions of users? How will that be implemented? How will that be executed come 2027?
So I think there is a big misconception about Truecaller that has existed for decades, that we upload people's phone books and that is how our data gets populated. That's not the case. We do not upload your phone book. That's not how Truecaller works. It works by the entire community of 500 million people coming together and suggesting names and correcting names on Truecaller. That is how Truecaller works. Secondly, about DPDP, we are compliant with more than 15 different data regimes across the world, including GDPR. We were compliant with GDPR on day one in 2018. And we will be compliant to DPDP on day one as well as it gets rolled out.
Right, Mr. Jhunjhunwala, thanks a lot for that perspective on this ongoing development, this developing story. We'll, of course, hope to stay connected with you going forward. But that's all the time that we have on this edition of News Center. It's a wrap on this edition, but the news and updates will continue right here on CNBC TV 18.
Welcome to Genomics. The big question I'm asking today on the show is, do economists and RBI need to seriously upgrade their India GDP growth forecast for this year? Right now, RBI is at 6.7% and economists on the street are between 6.3 and 6.9%. But just look at the recent data. Credit growth in May and June was over 17%, actually at 17.7%, highest in 2 years. Exports in April and May grew by 16% versus 4% in Jan-Feb March. And auto sales for June alone are at 21% for two-wheelers and 29% for cars. So if India grew by 7.8% in Jan-March quarter, how can we dip below 7% in the April-June quarter? Joining me to discuss the India growth picture are two top economists, Samiran Chakrabarti of Citi and Shantanu Sengupta of Goldman Sachs. Of course, since we have these two top economists, we are also going to discuss FCNR deposits, balance of payments, direction of rates and rupee. But first, the growth question. Samiran, to you, exactly what I said. If Jan-March was 7.8, and if April, May, June has seen 17% credit growth, 16% export growth for April, May at least, and fiery auto sales, should we be prepared for a 7% plus GDP for this quarter and for the year?
So, Lata, thanks for having me. Our own number for the quarter is 7% plus. So I think the high frequency indicators that we have got, they're tracking that around 7% GDP growth number. But as you know, a large part of the GDP comes out of the corporate earnings. We are yet to find out that how those corporate earnings numbers will look like for the quarter. Based on that, we might have to tweak the numbers a little bit up and down. But for now, I think 7% is a real possibility. And there is a good reason behind it also. We would have to go back and see that 2025 was the year of stimulus for India. And that stimulus effect gave the economy a certain kind of momentum, which probably was able to counter the headwinds coming from the Middle Eastern conflict situation. And even from the conflict, I've always maintained that two things worked in India's favor. India does not produce power out of natural gas, and India had enough diesel and petrol stock because it's a refining economy. And because of these two things, power and transport, two of the most important things in growth, was not affected. So with that stimulus and these two supporting factors, I think the economy did pretty well even through the April-June period. Now, whether there is any lingering effect from this shock that still will pass on into the rest of the year, whether the shock can re-emerge or not, these are still open questions. But for now, whatever macro high-frequency data we are tracking seems to suggest that things have held up better than what probably people would have feared.
Would you say that there is an upside bias to your 6.9%? The reason why I called Shantanu and Samiran, both of you are at the higher end of the GDP forecast. Shantanu is at 6.8 and you are at 6.9. But will you say there is an upside bias now to the 6.9 going by the April, May, June data?
So, I mean, we have to be honest in admitting that this decimal place forecasts are not easy, and we should not put too much emphasis on this, the decimal number after the 6% or 7%. So, but given still, I think one of the things that we are still yet to figure out fully is the El Nino effect.
Yeah.
So maybe that's why we have taken about a 20 basis point odd lower number on our forecast, thinking that that's the kind of El Nino growth effect that we have to factor in for. If monsoon turns out to be better than what feared, then maybe there is some upside to our GDP growth forecast as well, based on the fact that we have already taken that 20 basis point downside in our forecast.
Okay. I just have this doubt that, this hunch that economists, all of us, were very bearish in April and May when the way the rupee was behaving and crude was behaving. But now that things have subsided on that front, two dramatic changes, crude from above 100 to around 70, 75, and this FCNR gush. maybe we need to change the numbers. Shantanu, therefore to you, would you say that given the recent data, there can be an upside bias to your 6.8%?
I would just say, thanks for having me in the first place, Radha, but I would just say that there are two parts. One is the economy has been more resilient through the crisis, but that's not true for only India. That's pretty much true for many other emerging markets that we have seen. Inventory draws have been quite stark across the world. Two, refinery runs have also been quite high for the refineries that and that is what has cushioned most economies, and that was a learning for us as well, that you're able to withstand these kind of shocks better. The second thing, apart from the power point, which Samiran rightly pointed out in our view, is that you're able to switch to other forms of fuel very quickly. So the renewables surge has also been quite stark for India over the last several years. This had nothing to do with the Middle East conflict, but over the last several years, post-pandemic, you've been shifting, and therefore you did not quite feel the kind of shortages where other countries were dependent on fossil fuels. With regards to the current growth trajectory and going forward, what we think, I would say a slight upside risk to our fiscal year numbers, mainly from where the conflict is right now and the fact that oil prices are in the low 70s or the mid 70s, although it's ironic that we are talking on the day when, again, it's $75 a barrel. But I'll just point out that, remember, the consumer was completely insulated through the crisis until about mid-May. So June is the first month where you saw the impact of higher prices on the consumer. And this quarter will be the first quarter where the consumer will feel that price effect for the first time. Having said that, as you pointed out, credit growth is doing better. Monetary policy stimulus is working through. So I would say a slight upside risk to the numbers with the current state of affairs.
And your first quarter number?
We have a 6.8, and I would say an upside bias to that.
Okay. Shantanu, you were saying that it's not just India. A lot of countries exhibited this resilience. And I was looking at the export growth of many countries. I don't know what their historical trend is, but many of them were at double digits. And ours is clearly an outperformance in April and May. And I'm only taking goods. I'm not even looking at services exports. Goods exports was up 13.5% in April and 18% in May. So there seems to be a global engine that's working favorably. Would that be a reason to upgrade Indian forecasts as well?
I would just say that even there, we should be careful about looking at the kind of goods during that period that countries were demanding. So, for instance, our exports to the Middle East shrank in the month of March and has rebounded very, very quickly thereafter. So if you look at the charts, it'll look like a sharp dip and then a very, very sharp rebound. And you are also supplying refined products to the rest of the region. You are able to refine and supply, especially to Southeast Asia. Singapore was a big importer of products. And hence, that's the kind of goods trade that went on during that period. But overall on growth, I would say the points that you made earlier during the conversation, which is credit and the general broad basing of credit. I mean, industrial credit growing at 15% is a very, very positive number for, and probably merits thinking about, whether there are upside risks to growth.
Fair enough. And you're giving me that handover very nicely, because that was my next question to both of you. Samiran, this FCNR money, first of all, how much are you all anticipating now that, we are a few weeks into the scheme? If it is $50 billion or thereabouts, that's whatever, 5 lakh crore more of money which banks will have. So, first of all, how much? And will that also have a positive impact on growth?
So, Lata, it's a difficult thing to estimate right now that how much money will come in. If I just extrapolate from the FX reserves data that RBI is publishing every week, it doesn't look like as yet too much of money flow has happened. So our estimate is all the three schemes combined, we will get something around $55-60 billion additional coming in. Yes, it clearly increases the availability of resources with the financial system to lend, or in other words, if part of this can go into retiring the high-cost debt that the system has got, and the rest can be on lent for credit. Now, obviously, this is the lean period for credit, so immediately it might not go into credit, but might go into some investments into bond as well. But the bigger question really is that this credit growth is now very, very strong. In fact, not just the banking system credit. Yesterday, RBI has published the NBFC monthly credit data also, and it shows that the retail credit growth, X of housing, is growing close to 25%. Credit growth to consumer durables is 42%. Gold loan growth is close to 70%. So clearly there is a huge momentum of credit growth that is there. And this in turn is probably supporting the consumption activity as well. And once this consumption recovery takes shape, then it can feed into a proper investment recovery as well. So this is something that we have to very closely observe, that to what extent this additional liquidity that is coming in can get absorbed in the higher credit growth versus how much RBI will have to mop up from the system through its sterilization measures.
Fair point. So there is this positive Indian engine in terms of liquidity. Shantanu, similar question to you. Would you therefore say that what is your FCNR number? What is the growth impact?
On the FCNR, we are, again, putting all the three schemes together. So that's the FCNR, the ECB, as well as the bond inflows. We would think it will be about $80 billion. Again, the question really on the FCNR is the amount of leverage that foreign banks or domestic banks are able to take. If that is indeed very large, this number could be materially higher than what our estimates are. The liquidity impact, again, I would agree. We don't think even $80 billion will be easy for the RBI to manage if it comes in a very short period of time. That is in the next 6 to 9 months, and therefore we'll have to look at the sterilization tools. Of course, many are at their disposal, but I think that question will come up. What that does is it keeps financial conditions in general benign in terms of liquidity. What happens to rates eventually going into next year if growth is indeed this strong is another question. But it keeps overall financial conditions quite benign, and it solves the liability overhang that the banking system has had over the last couple of years or so. And that should essentially make sure that the credit growth cycle extends. Remember also, right now you're only looking at the domestic credit growth. It is happening at a time when ECBs had come down. So if you look at the overall system, so apart from the NBFC credit that Samiran mentioned, I would just say that you'll also find ECB-induced lending also coming into the real system. So the total private credit is going to look quite strong over the next year or so in our view.
Okay. I still have questions on rates and rupee, but before I take the break, just a word, a yes or a no. Would you say there is a very good chance of a 7% plus GDP growth this year? Samiran?
Yes, possible.
Shantanu?
Yes, I would say upside risks to our numbers.
Oh, thanks, both of you, for endorsing my optimism on economic growth. Have to take a break, but thereafter, important questions on inflation, where interest rates are headed, and where rupee is. Welcome back to this important Indianomics edition. I've been speaking with Shantanu Sengupta of Goldman Sachs and Samiran Chakrabarti of Citi India. There is this Bengali, control over Indian economic thinking, and that is reflected here in my guests. Okay, before the break, we were discussing the growth picture, but very importantly, inflation. We did see this one reading of 8% plus on WPI, but thereafter we have seen some of the fertilizers, etc., ease off. Samiran, what's the sense about inflation? Are we going to see it even go to the Reserve Bank's forecast of 5% plus? Even I think they're standing at 5.9 for the third quarter. Will we be pleasantly surprised?
So, Nata, there are three parts to this inflation discussion. One is what you were referring to, which is the WPI part, and that's more connected to the input costs in some sense. In the Ukraine war period, we saw that whatever was the increase in WPI over the 4 months when the conflict was at its peak, that got completely reversed over the next 12 months. So do we see a similar pattern emerging in this conflict as well, that over the next few months, this whole input price shock dissipates in a very even way? So that's one part. The second part is obviously the impact that is coming from the El Nino shock. As yet, there is nothing visible except for some increase in rice prices, which is slightly unseasonal, and some increase in edible oil prices. We don't see any signs of price pressures even going on to vegetables, etc. So no second round effect also. We have built in about 40 to 50 basis point upside risk from the El Nino. So we'll have to observe that to what extent we are right on that forecast. And the third factor is what we were discussing before about this somewhat improved growth momentum, particularly coming from the credit side. Does it have any meaningful effect feeding through to core inflation numbers with a lag? So these are the three things that I will be watching very closely on the inflation front. Our current view is average CPI headline of about 4.7% for the full year, with core somewhere around 4.5%, which probably does not warrant too much monetary policy action, even if for one quarter the headline numbers are slightly higher because of base effect. I think RBI can see through that.
Okay. Shantanu, you have an even lower forecast for inflation, if I'm not mistaken, for the full year. Then why are you expecting rate hikes?
Oh, so we have a 4.9 for the year. We are at 4.1. We go to 4.7, and by Q3 we are at 5.5, which is still about 50 basis points below the RBI. Look, our point is that, again, very quickly on the El Nino, our sense is that this is more of a, this will be surprising, but it's more of a winter cycle shock than a summer shock, because we think that the inventories are pretty strong in India. So we should not really have a material impact on rice or other long cycle crop prices right now. If at all it impacts, if reservoir levels are lower, it impacts the winter crop more. So that's why we have a little more backloaded inflation. We still think that core goods inflation will be high. Once companies raise prices, they don't tend to bring it down quickly. And therefore, if growth is indeed this strong, then later this year or next year is when we think a very shallow hiking cycle is on the cards.
Okay, fair enough. Are you expecting, Shantanu, anything specific from RBI in terms of liquidity absorption? I mean, is there a temporary CRR hike or something? And separately, where do you see yields itself? Yields have fallen from, 7.1 to 6.7 for the 10-year. Does it go even lower?
Well, on the bond markets, we think we like the ultra long end tenor of the curve. We like the 30-year bond space. Yields there. The curve was very steep. Yields were quite elevated there, and therefore we like owning that part of the curve. Also because not just because of FII demand, but also because of insurance, pension, and more local demand. With respect to liquidity, I think it's going to be a tricky question. It's a tricky question because the quantum of the FCNR is really unknown. So you can think about unwinding some of the short forwards, but eventually if you end up with a large liquidity injection, our sense is that short-term reverse repos will not be very effective in a situation. So, maybe we haven't really thought about the CRR, but maybe something like a longer-term reverse repo. So the exact opposite of what you had during a TLTRO is what you might be ending up looking at, because there's no way in this cycle that the RBI can be selling bonds and be doing OMO sales. So we think that those are the couple of options on the table.
Oh, yes. Something like a TLTRRO is on the cards, is it? Samiran, what's your estimate of where bond yields are headed?
No, first on the liquidity thing, I think the very interesting difference between the 2013 FCNR period and now is that the 2000 FCNR announcement was in September, and most of the flows were coming in October, November, which happens to be the festive season where the currency in circulation increase is significantly higher. So almost 70-80% of the inflows at that time was absorbed through increase in currency in circulation. This time around, we have that sort of a 2-3 month gap to hit that festive season currency in circulation increase period. So there is some merit in considering that we do some liquidity sucking mechanisms which last for that 2-3 months, and then hope that the currency in circulation increase takes care of the liquidity problem to some extent. Also in 2013, RBI had issued the cash management bills, the CMBs. So we can consider the CMBs. I think the CRR hike will be somewhat odd because on the one hand, we are giving CRR relaxations on the FCNR inflows, and then we are putting CRR back on the incremental deposits, so it will go in cross purposes. So I think we have to think of more a CMB / longer term VRRR to head into that October-November period and get the currency in circulation increase to take care of the rest of the issues. Yes, bond yields will keep on trying to push downwards till the point RBI signals that it's now starting its sterilization program. I think that will probably where the bond yields will hit the bottom. And obviously, we are going to track the global cues to see whether any Fed rate hike expectations, how it changes in the market, because that can also have a meaningful effect on this cycle.
I just want a quick last question to both of you. Samiran, even if the Bloomberg Barclays bond inclusion doesn't actually happen, it does look like it is around the corner. And we already have seen debt FPI flows fairly sticky, better than equity for sure. So what's your call on the rupee, Samiran, and then I come to Shantanu?
So one thing is already happening. Whether to some extent the front running of the index inclusion news is happening or not is hard to say. But because of the removal of the withholding tax and the capital gains tax on Indian government bonds, there was a certain section of FPI investment which was going towards the quasi-sovereigns issuances which do not have this capital gains tax earlier. Now, but those are illiquid markets. So now some of that investment is flowing back into Indian government bonds because they also now have the similar characteristics compared to those quasi-sovereigns. So our sense is that we're going to get, if you look at our BOP forecast itself, it has completely swung from a 50 billion deficit to a 45 billion surplus now. So almost 100 billion swing in just about a fortnight. So this creates the right backdrop for RBI to reset the USD INR levels to a much lower level. The governor himself has mentioned in media interviews before that the INR is undervalued. So this is probably a good time to get that undervaluation corrected and to go to a more fair value levels. But this process will probably start only after we see the inflows actually materializing. Today, it's too early for that.
Fair point. Shantanu, out of time, but what's your rupee range?
You're looking at 94, 96 as the range, 94 in the more short term, so a bit of appreciation from here. And then over a 12-month period, once all these flows are over, we think you trace back towards 96 odd. So you'll have a little bit of vol, but it's going to be very much anchored around where current spot levels are.
Okay, thank you very much, Shantanu and Samiran, for a 360-degree perspective of the economy and for endorsing my optimism that we are likely to head to a 7% plus growth, and that yields are still likely to be headed lower until the Reserve Bank shows its hand on sterilizing the liquidity. Thank you very much for joining me on this very interesting edition of Indianomics.
Good evening. Thanks very much for joining us on Business 360. I'm Shireen Bhan. The top stories that we're tracking for you this evening. The US and Iran halt attacks as mediators push to get diplomacy back on track. White House officials say technical talks with Tehran will continue. Iran buries its slain former supreme leader Ali Khamenei after 6 days of state mourning. Crude oil prices decline marginally but remain on course for a weekly gain. The International Energy Agency expects annual oil demand to decline for the first time in 6 years. Shipping traffic at the Strait of Hormuz remains largely at a standstill. The Sensex and the Nifty snap a 4-week winning streak even after broad-based gains on Friday. Inflows into equity mutual funds up 26% in June. Mid-caps and small caps get more funds compared to large caps. TCS shares rise after the company meets muted expectations in Q1. The management is upbeat on Q2 despite lack of clarity on long-term recovery. Expects FY27 to be better than FY26. Shares of Dixon Technologies rally in trade after the government's long-awaited green light to its joint venture with China's Vivo. This is the first major approval after restrictions on FDI from China under Press Note 3 were relaxed. OpenAI's new model is 54% more token efficient, says Sam Altman on the release of ChatGPT 5.6. Defends the White House vetting of powerful AI models, calling it productive and in everyone's interest. That's a CNBC exclusive. The CEO of Truecaller, Rishit Jhunjhunwala, slams at numbers starting with 140 or 1600 as spam. That's an exclusive. Prime Minister Modi wraps up the Australia tour with cricket diplomacy and a visit to the Melbourne Cricket Ground. Australia's Big Bash League season opener will be held in Chennai this year. China successfully lands a reusable rocket for the first time in a major breakthrough for its space program. State media says the rocket returned to Earth vertically and was recovered using a floating platform. A stunning strike from Mbappe takes France into the World Cup semi-final at the expense of Morocco. Spain will face Belgium in another quarter-final clash later tonight. Also on the show, meet the Nuval family, the promoters of Solar Industries, India's largest explosives and defense manufacturer. They've now entered the list of top 10 wealthiest promoters of listed companies in India. A special report coming in. Well, let's go straight to the top story this evening. US and Iran have halted the retaliatory attacks as mediators push to get diplomacy back on track. Now, here are the latest developments. The US media reports that technical talks with Tehran will continue. The reports cite US officials that suggest that Washington is committed to finding a solution. But the official also said that President Trump had described Iran's attacks on commercial vessels as acts of terrorism. Iranian officials have not confirmed or denied the next round of negotiations. In Iran, former Supreme Leader Ali Khamenei has been buried after a 7-day funeral procession, according to Iranian state media. Nearly 41 to 43 million people participated in the week-long funeral event. Khamenei was killed by US-Israeli airstrikes in Tehran on the 28th of February. Meanwhile, oil prices have eased, but they still remain on track to clock weekly gains. And shipping traffic at the Strait of Hormuz remains largely at a standstill. This, as International Energy Agency has said that global oil demand is set to decline for the first time in 6 years.
The war in the Middle East has led us to cut our expectations for demand growth this year by 2 million barrels a day. So now we're expecting a 1 million barrels a day contraction for the year as a whole. And this is the first loss since the midst of the COVID pandemic in 2020. The situation normalizes. We do expect those contractions to ease in the third quarter. And as you noted, a return to growth towards the end of the year. 2027, we see a recovery in oil demand, so growth of 2 million barrels a day. But the year on average growth for these 2 years is well below historical trends.
Well, that's the IEA on demand for oil will decline for the first time in 6 years. On to the day's market action. The Sensex and the Nifty witnessed some broad-based gains today, ending near the day's high. The mid-cap index, in fact, hit a record high, while the Nifty IT, Realty and PSU Bank index outperformed. Nifty IT up 2% today on the back of the earnings that came in from TCS. Mid-caps up 1.5% and 1% higher for both the Sensex and the Nifty. For the week, though, the Nifty and the Sensex have snapped the 4-week winning streak. In fact, the broader markets have outperformed, with the mid-cap index up by 1.3%. The Nifty and the Sensex closing lower for the week. While net inflows into equity mutual funds have risen over 26% on a monthly basis for the month of June, SIP inflows during the month hit a 3-month high, while assets under management surpassed the 82 lakh crore mark. Sonal joins us now with all the mutual fund data. Sonal.
Well, let's talk about the AMFI data that we got for the month of June. That's the mutual fund data. And the overall trend suggests that the equity inflows have improved on a month-on-month basis. They have come in at 28,961 crore rupees, which compares with 22,897 crore rupees. It was expected to be an improvement on a month-on-month basis because, remember, in the month of May, equity inflows saw a decline of 40%. And there was a decline across all the categories. And that trend has reversed. Now, large caps, small caps, mid caps, all three of them have seen an improvement on a month-on-month basis, where for large caps it has come in at 2,067 crore rupees versus 1,600 crore rupees. For mid caps it has improved to levels of 6,100 crore rupees, which compares with 4,385. Even small caps have seen an improvement to 5,600 crore rupees, which compares with inflow of around 5,000 crore rupees. This is something which is reflected in overall market move as well in the month of June, especially the outperformance that we've seen in the middle and small cap space. Some contribution that came in from the sectoral and thematic funds this time around, 1,469 crore rupees. So here is where inflows doubled on a month-on-month basis. We did see specific sectors doing really well, and those mutual funds seeing more inflows as well. NFOs is where the activity declined again. We did have around 7 NFOs in the month of June, but the inflows from them were just 460 crore rupees, which was the lowest that we've seen in a lot of months. It is actually at a record low in terms of inflows from the NFO space this time around. The SIP contributions, after declining in the month of June, did make a comeback in the month of, after declining in May, did make a comeback in the month of June above the 31,000 crore mark for now. And gold ETFs, that was the other thing that did see a decline in the month gone by because of the gold prices also declining sharply. That has made a comeback now. at around 3,443 crore rupees. The multi-asset category, that was something that was declining in last couple of months, has made a comeback again. 4,810 crore rupees are the inflows. So overall, the momentum has improved and the mood as well across the categories.
All right, Sonal, many thanks for joining us. And one of the big stories today, TCS, shares of TCS up in trade after the company met expectations in Q1. Speaking to CNBC TV 18, the management says it is confident about its near-term growth prospects despite a lack of clarity on the longer-term recovery. Rima standing by with more of what came in from the TCS management. Rima, you know, there's been a lot of nervousness around Indian IT services, particularly TCS. What's the management telling you?
I think the first takeaway for me is that the near term is steady, but there is still no clarity on the long-term recovery for the Indian IT industry. The company met very subdued expectations in Q1. They said they're positive about Q2, FY27 should be better than FY26. But when we asked them that when do you think more work from AI, new work from AI will offset the loss of work on account of AI, the management couldn't give a timeline on that. Net-net, they did say that it will be positive, but again, there is still no clarity when very low single-digit revenue growth this year for the industry will get to mid-single digits or even higher. That's the first takeaway. The second one is the deflation. Everyone's worried about AI deflation. The management said it's about 10 to 15% on the project value. But what's also interesting is that the company, the CEO said we're actively encouraging our employees to pass on the productivity benefits to their clients. Now the AI revenue per se is about 8.5% of their overall revenues, $2.6 billion in terms of an overall size, growing at 13.6% on a quarter-on-quarter basis. But the AI deal size, according to the CEO, are going up, and these are not annuity revenues, which run for 3 years, 5 years. These are short-term projects, but it's important that the deal size is going up. And this is the part I think I found most interesting. We asked them that for what percentage of your clients, the customer base of TCS, are you doing AI work? And Kriti said that for our large clients, say $50 million plus in terms of revenues, we have 139 of them. For 130 of those, 130 out of 139, we're doing AI work. That's more than 90%. So then the next obvious question was that why isn't it showing up in your revenues? And he said that we have a very narrow definition of AI. We don't want to do AI washing. We don't want to call everything AI revenue. And finally, on margins. Now, Q4 margins were at 24%, but they got impacted on account of the wage hike. What the company said is that we've taken all the headwinds in Q1. From here on, given the productivity benefits, efficiency-led tailwinds, we should gradually improve our margins to at least the FY25 number.
Overall, still I would say Q2 is positive. But at the same time, things been quite volatile in terms of whether H1 is better than H2. Okay, that I don't want to say H2 will be weaker than H1. Okay. But we are quite positive on Q2.
Okay, and FY27, if you have to characterize it?
Last quarter also said it will be better than 26. I still stick by that. It will be better than 26.
Well, that's TCS for you. Now, a group of e-commerce sellers have approached the Competition Commission against Flipkart for allegedly abusing its dominant market position. Reports say sellers claim Flipkart is indulging in deep discounting, preferential treatment to some sellers and anti-competitive arrangements. The complainants have claimed that this move is hurting small merchants. The competition watchdog is examining the complaint. WhatsApp has submitted its response to the government over its new username feature. Sources say the centre is examining the response and will make a decision on the next course of action. The government has raised concerns over WhatsApp's username feature, saying it could enable identity theft, fraud and cybercrime. South Korean chip maker SK Hynix is all set to list on the Nasdaq tonight after raising over $26 billion. The company has priced its ADR at $149. This makes it the largest overseas first-time share sale by a foreign company in the US. The demand for the offer was immense, drawing over 7 times the number of available shares. The company's stock in Seoul has soared over 270% in 2026 so far, taking its overall market cap to over $1 trillion. On to CNBC exclusive. OpenAI CEO Sam Altman says the firm's new model ChatGPT 5.6 is 54% more token efficient. Speaking to CNBC, Altman also defended the White House's vetting of powerful AI models, calling it productive and in everyone's interest. Rachna joins us now with more. Rachna, how do these new models cut costs for the company?
Well, firstly, OpenAI has broadly released its GPT 5.6 family of models. That's Sol, Terra, and Luna. And this is after weeks of restricted access under a US government review. CEO Sam Altman told CNBC the flagship Sol is 54% more token efficient on agentic coding than rival models. Now, tokens are the billing unit for AI, and for enterprises running agents at scale, token costs now decide whether deployments are viable. When asked how much of the gain came from a focus on bringing down costs, Altman said, entirely. The customers say it is not enough though. Palo Alto Network CEO Nikesh Arora told CNBC that 54% is good, but the industry needs another turn at it. He wants AI pricing down 90% within 2 years. This is also in line with what we saw Palantir's Alex Karp was saying a few days ago when he said there's something seriously wrong with tokenization. Now the squeeze is that costs are rising on the other side as well. Altman called compute and memory costs a headwind, saying OpenAI needs algorithmic gains to keep customer prices falling while infrastructure costs continue to climb. There's also a new gatekeeper in the room. GPT 5.6 is the first OpenAI model to clear a government pre-release review, and Altman confirmed that the next model faces the same process. Frontier AI in the US now seems to ship with Washington's sign-off. Meanwhile, Meta fired the loudest shot on price. Mark Zuckerberg broke a 3-year silence on X, posting on Elon Musk's platform himself to announce Muse Spark 1.1, priced at roughly a tenth of Anthropic's Fable 5. Now, Musk, whose Grok 4.5 launched a day earlier, replied with a quote tweet where he plugged the platform X as a great way for companies to announce and gain followers, as Musk's post had about 12 million views. Now, with OpenAI valued at $852 billion and Anthropic both filed for IPOs, whether token economics works at scale is now the trillion-dollar question that the street will be watching out for. But in the meantime, let's get you this exclusive conversation that Sam Altman had with CNBC at the Sun Valley.
I thought it was a very productive process. We had a very good time working with Secretary Lutnick, Secretary Bessent, Director Karen Cross. This is our first time through it, so there are things we will learn about how to make it better for the next one, which will get going on soon, and I think it'll be a much smoother process. But the government's technical capability was impressive to me. People really are doing good work testing and red teaming these models, and they really care about getting these models out quickly, but with a high level of safety. And I think this is actually in everyone's interest. If you want broad access, which we do, and you have powerful models, you really want to be able to be confident in your safety claims, because otherwise the world is going to get uncomfortable very fast.
Well, that's Sam Altman there on the launch of their new ChatGPT 5.6. Now, the US Federal Reserve announced the members of its new task force set to review the central bank's monetary policy mechanism. 3 Indian origin names across 3 verticals of the task force have been appointed for the review. Those include former RBI Governor Raghuram Rajan. He's set to co-lead the balance sheet policy division. Harvard economics professor Raj Chetty will be a part of the data task force, and Xbox CEO Asha Sharma will co-lead productivity and jobs and that task force. This comes after new Fed Chair Kevin Walsh announced plans to overhaul Fed communication last month. India has opposed the proposed 12.5% tariff under the U.S. Trade Representative Section 301 investigation into alleged forced labor. Industry sources say that India's legal framework already provides robust labor protection. They also say that India's acts, policies and practices do not burden or restrict the U.S., contrary to the assumptions underlying the investigation. So, of course, that is going to be a big one to watch. The trade agreement between India and the UK is set to come into effect on the 15th of July, unlocking wider market access, cutting tariffs and creating new opportunities for businesses and professionals. The deal aims to double bilateral trade to $120 billion by 2030. Abhimanyu joins us now with more. Abhimanyu, so what can we expect come the 15th of July? Finally, the UK-India FTA will be operational.
Huge expectations of benefits from the India-UK Free Trade Agreement, which is expected to come into force from the 15th of July. Now, benefits are expected to flow not just to India's exporters, who are going to get access to a huge British market in which labor-intensive exporters of agricultural products are expected to benefit by virtue of availability of a large market. Indian consumers are also expected to benefit by virtue of availability of cheaper Scotch whisky and cheaper imported cars from the United Kingdom. Now, several cars like Aston Aston Martin, Bentley, JLR, McLaren and Rolls-Royce, which are made in the United Kingdom, are going to get cheaper in India. The DGFT has already issued a notification which has indicated details of import duty cuts on 3.78 lakh units of conventional engine passenger cars, in which the duties are going to fall from 110% to 10% over a period of a few years. Also, cheaper Scotch whisky and gin from the United Kingdom will be available in India for Indian consumers, in which the current 150% import duty is going to drop to 75% immediately and will subsequently fall by the 10th year of the implementation of the FTA to 40%. Also, zero duty would be witnessed by India's overall exports on 95% of its tariff lines, which include areas like agriculture, fruits, vegetables, processed foods and cereals. Also, labor-intensive exports are slated to benefit, and no duty concessions have been given on optical fibers, bundles and cables, TV camera tubes, base stations and plastics. Apart from that, there has been a quota which has been set for imported cars, in which no duties have been lowered for EVs, hybrids and hydrogen vehicles priced below £40,000 to protect the mass domestic market for conventional cars. So overall, both Indian exporters as well as British exporters are looking for huge benefits from the implementation of the India-UK Free Trade Agreement.
All right, Abhimanyu, many thanks. Shares of Dixon Technologies up in trade after the government's long-awaited green light to its joint venture with China's Vivo. This is the first major approval after restrictions on FDI from China under Press Note 3 were relaxed. Ashmit is here with more. Much anticipated, Ashmit. Dixon finally getting the go-ahead. Can we expect more approvals for investments lined up from China?
Well, there is substantial interest and momentum behind partnering with Chinese companies to bring in not just investments, but also technology and for building local capacity. As he correctly pointed out, in the month of March is when we'd seen a relaxation of the Press Note 3 mechanism. There was a fast tracking that was allowed under the Press Note 3 framework for 60 days. And that's yielding results. Of course, the latest one being the Dixon Vivo deal. This was a long time coming. This will be, of course, used for manufacturing of Vivo phones. But there are other JVs also that have secured approval. For example, the Dixon HKC partnership JV, which secured Press Note 3 approval for developing display modules. There's also Dixon Longcheer Intelligence, and that's an important partnership given as how Longcheer brings a lot of design capabilities. Uno Minda has secured Press Note 3 approval going forward for, in fact, building EV powertrain components here in India. And not just that, going forward, we're seeing an increasing amount of partnerships developing, if not via the equity route, then via technical partnerships that is beginning to take root. Take PG Electroplast, for example. They're building an AC plant. They reportedly in close conversations with Shanghai Highly Group. There's Electra, for example, has a technology partnership with BYD that's been extended till 2030. Amber has signed a deal with Oppo for manufacturing of phones on a sublease model, again not requiring a Press Note 3 not there. EPAC Manufacturing is looking to build an AC plant in partnership with Hisense for AC manufacturing. So clearly a lot of momentum behind partnering with Chinese companies, bringing in investment, and if not investment, at least technology that will help build local capacity here for Make in India.
All right, Ashmit, many thanks for joining us. And staying with China, China's space program has achieved a significant breakthrough. The country successfully managed to land a reusable rocket for the first time. The rocket managed to place a satellite into orbit and return back to Earth. It was retrieved using a floating platform. These reusable rockets can significantly lower the cost of launching satellites and space exploration. Only Elon Musk, SpaceX and Blue Origin, owned by Jeff Bezos, have successfully managed to land rockets so far. Well, that is a sight to watch. Time for us to head into a break, but up next, meet the Nuval family, the promoters of solar industries who've now entered the list of top 10 wealthiest promoters of listed companies in India. At least 10 people have died after torrential rains unleashed widespread destruction across several parts of India. Fresh floods were reported in Himachal Pradesh. Rising water levels submerged a 100-foot iron bridge in a river. Officials said landslides have hit several places in rural areas, but no loss of life has been reported so far. The Indian Met Department has issued a red alert for parts of western UP, forecasting heavy to extremely heavy rainfall over the next 24 hours. This has intensified monsoon activity, claimed at least 7 lives and caused disruptions across the state. Relentless monsoon rain has also battered Delhi, inundating roads, uprooting trees and triggering widespread traffic snarls. However, the downpour also helped the national capital record its cleanest air since September of 2023. Heavy monsoon showers also lashed a large part of West Bengal, with northern parts of the state receiving the highest rainfall in 24 hours, continued well past the morning, causing waterlogging and slowing of traffic across Kolkata. Now, the Nuwal family, promoters of solar industries, have entered the list of top 10 wealthiest promoters of listed companies in India. Founded in the 1980s, Solar Industries is India's largest explosives and defense manufacturer. Nimesh is here with more on the company and its very under-the-radar promoters. Nimesh.
It's been a fascinating story, not only for the investors, but for the promoters as well. And as you rightly pointed out, the wealth of this particular promoter is over 1 lakh crore. But first, what this is company all about? Solar Industries. It's one of the largest, explosive and defense manufacturer, and it is based out of Nagpur. So that's the basic about the company. As I said, the promoter owns 73.1% stake in the company. Who are the promoters? Now, Manish Nuwal is the MD and CEO. He's the son of Satyanarayan, and he was a founder of Solar Industries. So Manish owns 38.9%. Satyanarayan owns close to 3.5%. The trust owns close to 29% stake. And Seema Nuwal, who is the wife of Manish Nuwal, she owns a small 1.37% stake. So combined altogether, the promoter holding is 73.1% stake. Now, what is Solar Industries? Just the graphic will come up for you. They started as a small explosive trader in early 90s. And only in 1995, Solar Explosive was incorporated. And from there, they've built up one of the largest package explosive facility out of Nagpur. So that's the small journey of what the promoters have done. Now, this is interesting, where the pivot came. The pivot came when Manish Nuwal actually joined the company in the 90s. He was actually one who was leading the defense and aerospace expansions since 2010. And the defense revenue for this company has grown from 5% to 20% under his leadership. And that's where you've seen a big pivot and a change in terms of market cap as well for this company. Look at the financials now for 2026. The company has reported a revenue of close to 10,000 crores, PAT of around 1,800 crores, ROE of close to 29%, and ROC of close to 37.5%. So the number shows for itself, and that's the reason why the company is getting this kind of market valuation as well. As I said, look at the wealth that the promoter has created. So basically, the overall market cap is close to 1.6 lakh crore, and of this, since the promoter owns little 73%, it's basically they own close to 1.2 lakh crore. Just to put into perspective where Solar Industries stand in terms of the list of wealth promoters or wealthy promoters. Now, this is a whole list. Avenue Superma stands out. R.K. Daman is hands down the topmost guy at close to 2 lakh crores of personal wealth, because of its listed entity. The rest are largely, conglomerates or bigger MNCs. Nestle India, Bajaj Finserv, Bajaj Auto, of course, the two Bajaj Group, Adani Group, Asian Paints, JSW, Wipro. A large part of these names are basically conglomerates or from larger corporates. Solar Industries stands out at number 10. The interesting part is today Solar Industries promoters are even above DLF promoters in terms of wealth creation. So that's the kind of wealth the promoter has created. As I said, they're currently at number 10. The promoter's wealth is close to, again, it's a wealth on the paper, right? It's just a market cap, but still, a Solar Industries, from a company based out of Nagpur, from nowhere, is now currently the number 10th wealthiest person, having a personal wealth of over 1 lakh crore with a market cap of 1.6 lakh crore. It's basically not only the promoters, but even if you look at the shareholding pattern, the FIs have owned money, the DIs have owned money, and of course, promoters have created the biggest wealth. Now they're sitting on over 1 lakh crores of wealth as being a listed entity of Solar Industries.
Well, that is the story of Solar Industries, and what a story indeed. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV 18. Stay tuned. We're back in a minute with more.
Hello and welcome to Startup Street. I'm Arundhati Ramanan, and with me as always is Shruti Mishra. These are the top headlines from the startup world. Mukesh Bansal's Nurix AI has acquired enterprise conversational AI startup Verloop.io. Acquisition is aimed at strengthening Nurix AI's enterprise AI capabilities and expanding its customer service automation offerings. Terms of the deal have not been disclosed.
A group of e-commerce sellers has approached CCI against Flipkart, alleging abuse of its dominant market position. Reports say the sellers have accused Flipkart of deep discounting, preferential treatment for certain sellers and anti-competitive arrangements, claiming these practices are hurting small merchants. The competition watchdog is examining the complaint.
The CEO of Truecaller, Rishit Jhunjhunwala, slams the telecom regulator's latest directive on spam calls, terms it a get-out-of-jail-free card for spammers, says the caller ID company is complying with the order and not flagging calls from numbers starting with 140 or 1600 as spam. That's an exclusive.
Google has challenged a Delhi High Court ruling holding it liable for trademark infringement over its Google Ads keyword bidding system. The court had ordered Google to pay 30 lakh rupees to Hinware. Google says keyword bidding is a standard lawful industry practice. The High Court will hear the appeal on July 24.
OpenAI CEO Sam Altman says that the firm's new model, ChatGPT 5.6, is 54% more token efficient. Speaking to CNBC, Altman also defended White House's vetting of powerful AI models, calling it productive and in everyone's interest.
Those were the headlines we've been tracking for you this evening on What's Brewing. From beauty and fashion to food and wellness, we are increasingly seeing celebrities move from being brand ambassadors to becoming investors. Joining that list is Kareena Kapoor Khan, who has made a strategic investment in homegrown footwear brand Fizzy Goblet after being associated with the company for over a decade. The investment comes as the brand targets 100 crore rupees plus in revenue, expands its retail footprint and eyes international markets. Joining me now is Lakshita Govil, the founder and CEO of Fizzy Goblet. Lakshita, welcome to Startup Street. Kareena Kapoor Khan has moved from being your brand ambassador to becoming a strategic investor. Walk us through the contours of the deal. How much has she invested and how much stake does she own currently? And beyond capital, Lakshita, what role will Kareena play in shaping the business?
Hi, thank you so much for having me here. So with Kareena, it's been a very interesting relationship. It goes back 10 years. She was the first celebrity to ever wear us. And from there, around 5 years ago, she came on board as a brand ambassador. And the relationship has only deepened over time. And it was the next step was becoming an investor in Fizzy. And the reason why it made a lot of sense is because it feels like she's already been a part of the team. And she coming on board will also be a more design-led collaboration as well. We'll be having more collaborations with her coming up in the next 1 year. And as far as the specifics of the deal are concerned, I'm not at liberty to say, but it's been a lovely journey.
All right, Lakshita, Fizzy Goblet started with 1 lakh borrowed from your parents, remained largely bootstrapped for years, later raised capital, of course, from Axel, and is now tracking a 60 crore rupee revenue run rate with a target of 100 crore rupees plus next year. What have been the biggest growth drivers, Lakshita, and how close are you to profitability?
Yes. So Shruti, for us, we've been very disciplined about, the cash from the beginning. And for our entire first decade, we've, bootstrapped it. So for us, what has really worked is, going from one silhouette, which is the juti, to multiple silhouettes, from cracking one occasion, which is festive, to wear and casual. And from going from different categories, from shoes to bags, and our retail expansion from one city to multiple has also played a big role in our growth journey. To our own channels, of course. Yes.
And I was coming to that. One interesting aspect of your business is that 100% of sales come through your own website and company-owned stores. You've consciously, Lakshita, stayed away from marketplaces and franchisees. Why is that? And has it helped you build a stronger brand and better margins?
Yes. So I think that, whenever the brand recognition has been higher because we've controlled the customer experience, and the saving in the margin has allowed us to invest that we've been able to allocate that in different channels and of our choosing, whether it's product innovation, brand building, or even stores. So this has really helped us to, have more freedom in choosing which direction we want to do. And that has helped in giving a better experience to the customers and ultimately in the loyalty that we have and the community that we built.
Sure. Lakshita, you've expanded from 4 stores in 2022 to 16 today, while also talking about global ambitions. What's the expansion strategy from here? How many new stores are you planning to launch, and what new markets are you eyeing?
So for us, the expansion strategy is fairly simple. We are looking at doubling down on what has worked for us. We are currently at 16 stores across the major cities. So Physiogoblet, now we will be expanding it to 40 stores in the near future. Our own D2C channel has really started picking up, and especially global now that the tariffs, etc., have come in. It's really expanding a lot. So that is something that we'll be doing. We also have launched our own loyalty program, and we're going to be expanding into new categories. Because honestly, what really works for us is the fact that we build a lot of craftsmanship into the product, and like the design detail, the quality, the comfort is what really matters in the product. And we've noticed that whenever we've launched a new category or a new silhouette, that is what people expect, and that is why they keep coming back, and our repeat rates are so high. So we plan on just doubling down on that in every product that we make, so that we can occupy more space in the consumers' households, with their feet, be it a bag, be it, anything. Yeah.
Yes, and what about the new markets that you're eyeing, in terms of domestic and both global expansion?
So domestic, we are already present in the metro cities, Delhi, Hyderabad, Chennai. So few of the cities that we have in our list are like Ahmedabad, Jaipur, Raipur. Like there are a lot of cities which are really, coming up for us. Okay. Track our online data and follow it. Tier 2 and Tier 3 is showing strong signs of, showing a lot of strong signs. And for internationally, US and Middle East have really worked well for the brand. So.
Okay, you're going to expand there. Lakshya, one final question before I let you go. All your products are designed and manufactured in India. What kind of manufacturing capabilities are we talking about, and how are you looking to expand it? And if you could also take us to your new offerings, what's in the pipeline?
Sure. I love that question because I feel really proud to say that we are 100% made in India. India is one of the leading manufacturing, countries in footwear. But a lot of the times, the brands are always known for being made in India or manufactured, but not about design. So that is what we plan to do. We are doing rather than planning. We are making sure that we pay a lot of emphasis on the designs, making them contemporary, making them something which is very different from what's out there, and then combining it with the making it in India with the quality, and then taking it out to the world. I feel like that is that people will look forward to.
All right, Lakshita, on that note, it's time for me to wrap up our conversation. Many thanks for joining me on Startup Street, and wish you the very best with your growth plans.
Thank you. Thank you so much for having me, Shruti. Take care.
And moving on, climate tech is no longer just about sustainability. It's fast becoming one of the biggest investment opportunities in the startup ecosystem. Now, venture builder and climate-focused fund 100 into 100 has launched its second fund targeting a corpus of $100 million to build 50 new climate startups across India and Southeast Asia. The firm is betting big on sectors ranging from clean energy and agriculture to logistics and advanced materials, with the aim of creating businesses that deliver both commercial returns and meaningful carbon reduction. Joining us now to discuss the opportunity and the roadmap ahead is Shubhadeep Sanyal, the partner at 100 into 100. Shubhadeep, thank you so much for taking time out and being here with us on Startup Street. Most funds invest in existing startups, right? But 100 into 100 actually builds companies from scratch. So why is this model sort of better suited to solving climate challenges, and how does it improve the odds of success?
Thank you so much for having us, and really stoked to be here. I think, it's a great question. Our fundamental thesis is around, these are hard to abate sectors, right? When we think about climate, when we think about some of these themes where emissions are growing, and there's a certain urgency for us to solve for it. Our venture build process basically is a very hands-on 6-month process where we undergo, there's a dedicated team working with the entrepreneurs that we select, and we bring in the climate thinking and the climate research to the table. So it's very collaborative that way. And it's spent in actually trying to solve for a lot of the hypotheses which typically entrepreneurs do much later when they start. So what we're trying to say is that if we can take care of the validations around the problem being deep enough, the solution being viable, all of that happens in that 6-month period where we actively work with the founders, and then we go ahead and launch the company. So what we've observed is, maybe just to the second point, is that we're observing in our first fund a typical drop-off ratio that happens in a classic VC. We're at about 50% of that, right? So 2x more companies actually graduate from that early stage to more like a pre-Series A or a Series A stage.
All right. And what are the kind of returns you're seeing? Because you've done this in Fund 1. So what's the revenue hypothesis like for these companies?
So that's again another area that we really like to kind of accelerate work. We're very, very focused on ensuring that our businesses, once we launch, get to revenue very soon. So on an average, any portfolio company that we start with will get to revenue within the first 5 months of its launch. And a dedicated team then works with them over the next 18 months to ensure that they get to like a couple of crores monthly in revenue. And again, we're also margin focused. So to answer the question around returns, I can give you an average sense. Like our portfolio is still very young in Fund 1. An average vintage is around 18, 19 months. And the collective revenue at a portfolio level is around $30 million annualized, right? And by December, that's going to hit around $50 million. So we are seeing that just because you're building in the space, there's no trade-off as such that you need to be a slower growing business, or there are these pockets where you can find and accelerate growth as well, as long as you do the build part right.
Absolutely. The build part being the key here. You know, you've identified India as a key market for Fund 2, right? So which sectors like energy, agriculture, mobility, or manufacturing do you believe offer the biggest opportunities for building the next climate unicorns?
So I think for us, we kind of like all the spaces, and we take a very emissions first view. So and for every region, whether it's Southeast Asia or India, we have a carbon map where we have outlined the largest emission pockets. And those are like for India, I think energy transition is an amazing opportunity. Industrialization or manufacturing is, again, a very, very interesting opportunity where we'll see multiple good companies getting built. Food and agri still remains a very large space where we have to decarbonize a lot faster. So, and again, these are all spaces where we have started doing work. We have done all our initial companies over the last 1 year that we've been active in India from Fund 1 perspective. We've launched these businesses here now and hope to do more with Fund 2.
Absolutely. And now that Fund 2 has been launched, where will the first tranche of capital go? Are there any emerging technologies or problem statements you're actually excited about that could produce the next breakout climate company? And, what's the typical ticket size or the check size for these companies?
Sure. So I think for us, as I said, the build process is very, very integral. And unlike a lot of other kind of venture builders, we really index for the founder also to have a lot more stake, right? So we're not like a CVC where we're taking the lion's share. This is actually led by the founder. So we ensure that the incentive aligns there. And hence, in terms of sectors, while we have a wish list and we have about 40 white spaces identified, a lot of what we launch will end up being co-led and co-developed with the founders that we select. But the sectors remain similar, right? I think energy transition, ag, and food, and honestly, the circularity as a theme will hold a lot of value going forward, as we saw in the last few months around how energy and our supply chains kind of were fragile. I think food security, fertilizer security, all of these are very, very important problems to also solve for, and large businesses will help.
Sure. And if you could quickly tell us, you're targeting 50 new companies with this $100 million fund. What does your venture building playbook look like from identifying the white space to finding the right founder? And how quickly do you expect, you said 6 months, but how quickly do you expect these companies from Fund 2 to sort of scale? And also, over the course of how long will we see you invest in these 50 companies?
So our target is that we'll start kind of building out these companies even now. We have that in place, but hopefully over the next 3 to 4 quarters, as we get towards our first close, from there, I think we'll take another 3 years or so to build out these businesses, between 40 and 50. That's kind of been our track record in Fund 1 as well. Average 3.5 years to kind of build out the portfolio. And on an average, to your question, we would invest, or we would start the companies as we're kind of actually incorporating the companies ourselves with the founder. We would do between 500 to 800K to start the ventures, and then we have more money kept for follow-ons.
All right, absolutely. All right, Shubhadeep, thank you so much for taking time out and being here with us on Startup Street. And we wish you all the best on this journey going forward.
Thank you so much for having me. Cheers.
Well, on that note, it's time for us to head into a short break. But coming up, Analog has entered India through a joint venture with Megha Engineering. We speak to Analog AI founder and CEO Alex Kipman about the company's plans for India and his vision behind the partnership. Stay tuned.
Welcome back. You're still with us on Startup Street. Infrastructure major Megha Engineering is making a major bet on artificial intelligence. The Hyderabad-based company has entered the technology space through a 50-50 joint venture with Abu Dhabi-based Analog to bring physical intelligence to India, targeting applications across traffic management, smart cities and public infrastructure, with Hyderabad set to be the launchpad for pilot projects and R&D. CNBC TV 18's Meghna Sen caught up with Analog AI founder and CEO Alex Kipman. Take a look.
We've launched Analog as a company January 2024 in Abu Dhabi, where we've already deployed this technology and reduced it to practice with many public sector and private sector partners. We're extremely proud to come here to our second home, now Hyderabad, to announce this amazing joint venture with MEAL that we start today. And it's a start. It's a beginning. We do have already conversations going with the Telangana government, for example, for traffic improvement here in the city of Hyderabad, for example. And we also have conversations with different private sector companies where, each one of those will move through its own set of pilots, proof of concepts, installations, where over time, over the period of, say, 6 months, we get to showcase value. We get to showcase return on investment, and we grow the business together in the joint venture from there.
Why did you choose Megha Engineering and Infrastructure over any other, global infrastructure manufacturing companies? What does MEAL brings to the table?
A lot. Ultimately, I'm extremely lucky and I'm extremely grateful to have an incredible opportunity to talk to a lot of people, to be exposed to a lot of folks that I have the pleasure to want to partner with Analog. When I look at what Analog brings to the table, we bring intelligence. We bring frontier models for intelligence, specifically focused on the next stage of intelligence, which is physical intelligence. When I look at MEAL, they bring a level of execution and scale that simply you can't find anywhere else. But most importantly, to me, partnerships, joint ventures are about the people. When I get an opportunity to spend time with Krishna, the managing director for MEAL, and the partner in the joint venture with Analog here in India, that human connection is real. When you look at his story, what he's been able to accomplish over his career in building MEAL here in India, again, it's proof in the pudding of earning trust, of getting to scale, at delivering on time, at executing at a level that simply, I don't think is comparable to many others in this space, which in turn makes me extremely proud to be able to call them our partners in this joint venture.
Right. So is this a 50-50 JV partnership between between Analog and between MEAL, or can you take us through the size of investment? What kind of investment have you made to India?
Yeah, so we don't talk about precise financials, as you can imagine, but I can say that the partnership is 50-50 between us. And, over the next couple of years, for something that requires civic level infrastructure, you should think in the hundreds of millions of dollars of investment and opportunity created here in India for us to be able to push it forward.
One last question on your India strategy. Why India? Why now? And also if you could tell me about your hiring plans here in India or in Hyderabad.
Well, I think, look, one of the key things that I'm sure everybody has experienced in India is that it's fast, right? Again, I think the pool of talent that exists here is extraordinary, which means I think hiring of very high qualified, talented scientists and engineers will be something we do fairly fast. We're just now, establishing Analog India. We're just now establishing the JV, so we're just beginning. We're still in the process of, drying the ink upon all of these things. So that journey really is going to begin in the next little bit of time. But my objective is over the next, 6 months to be fairly well staffed up on both the joint venture as well as Analog India.
All right, moving on. From turning a personal health struggle into a fast-growing wellness brand to creating India's first face yoga school, here's the story of House of Beauty founder Vibhuti Arora. With each center generating annual revenues of around 1.5 crore rupees, the brand is now expanding across India. Xenia Baria caught up with the founder to learn more about her entrepreneurial journey, the business behind face yoga, and what's next for the brand. Take a look.
What's the one on-the-go tip that you would give them?
My AEIOU exercise, it's an on-the-go exercise where your entire lower face gets worked out. So it goes AEIOU. When you're on the go, you could just move your jaw left and right.
One beauty trend that's completely overhyped.
Retinol.
One skincare ingredient everyone should be using.
Hyaluronic acid.
One skincare product people spend too much money on.
I think blindly including vitamin C in your regime.
And what's the one beauty myth you would like to bust?
Facial shaving will lead to thicker hair growth. Definitely not.
Vibhuti, tell us, where does face yoga fit in the larger opportunity and where do you see this business headed next?
So when I started House of Beauty, it was about education and products, and slowly I realized that there's a gap in the market. There are dermafacials and traditional salon facials. There's nobody who's focusing on lymphatic drainage, non-invasive facelifting options, jawline, double chin reduction options, and that's where I basically created a category for all of us in India called face yoga, which now is being taken ahead, and the opportunity truly lies in breaking the shackles of all of these traditional treatments. This is huge right now.
Tell us from the beginning, how did it all begin? And most importantly, you started India's first face yoga school, the institution. You've trained so many people on face yoga. How did that journey begin?
It began with a personal struggle where when I moved to India, I got atopic dermatitis, I got lupus, and I think that's where you get innovating. I actually found relief in yoga, and as you know, you don't go looking for yoga, yoga finds you, because I was an avid yoga practitioner. Dadi Nani taught us Anulom Vilom, butterfly, exercises, and I used to call it exercises back then because I didn't know. And then when you become a teenager, somewhere in your adolescence, you forget about it. But when you get a disease and then you go back to the beautiful practice of yoga and Ayurveda, is where that whole change, I started seeing changes in my body. I started feeling healthy. My muscle health improved. My skin started to glow. My relapse of lupus was much lesser. And that is where I realized the importance of yoga. I studied yoga. I did an in-depth research, and that is where the face yoga school protocol was written. Today we have over 1,200 teachers we've certified globally, and more in the counting. I've trained thousands or millions of women because of my whole, the talk shows I do from Delhi to Ranchi to Hyderabad to Bangalore, all over the country, and that is how Face Yoga School began.
You've made a great reach on social media as well. I think somewhere around 3 million is the reach that you have with it, and that's great. So how did you identify this as a scalable, viable business?
I didn't look at it from a business standpoint at that point in time. I think it was pure passion. And what I did realize was there were a lot of unethical business practices which I wanted to correct. Luckily, numbers at that point in time did not matter. So when you're not focusing on money and you really want to give something to the end consumer, you start building. I think today I'm still in a building process, but that is where it became a scalable business. I mean, for example, any of the centers that we operate have an annual revenue of about 1.5 crore. And that is a franchising opportunity. I'm empowering women, whether you're a trained face yoga teacher or not, just a housewife sitting at home. I think women need to go out there, fend for themselves, get the financial independence, because that also gives them a seat on the table, right?
What are your expansion plans? You started off from Delhi, now we are in Mumbai here. Where all next are you planning to tap into?
We're already looking at expanding into 2 more spaces in Mumbai. We're looking at another space in Gurgaon. Noida is launching in the next 1 week. Bilaspur's coming up. I'm looking at tier 2, tier 3 as well, because a lot of people do not focus on that. Franchising options all over the country are open. Bangalore is on the card. So this year I'm looking at about 10 to 12 centers.
Okay.
And
what
in
are the next cities, if I may ask?
Bangalore, Calcutta, Chhattisgarh as a state, I would say Mumbai, Gurgaon, Noida, UP. So these are the states that we're focusing on, and then we will move to a Hyderabad as well.
All right.
And apart from that, we're also looking at 2 or 3 big tie-ups, work in progress. And once that happens, then we'll be very, very easily accessible all over the country.
It is Friday and it's time to take stock of the latest developments in the startup funding space. According to Venture Intelligence, Indian startups saw 17 deals worth a combined $64 million this week. Some of the biggest fundraisers included Elevate Education, which secured nearly $17 million from Westbridge Capital. Lab-grown diamond jewelry brand Okera Jewelry raised nearly $9 million from Ulterior Capital, Lighthouse Canton and Innovin Capital.
Well, that's not all. Rural commerce startup Velocity also raised $8 million from Ulterior Capital, Anicut Capital, Lightspeed Ventures and other investors. Meanwhile, wholesale sales enablement platform WizCommerce secured nearly $8 million from AlphaWave Global, Bloom Ventures, Peak 15 Partners, Z47 and others. Sustainable packaging company Econovus raised $4 million from Rainmatter Capital and Rockstud Capital. As per Venture Intelligence data, 2026 so far has recorded 498 startup deals worth $4.7 billion, highlighting continued investor interest in India's startup ecosystem.
And with that, it is a wrap on this edition of Startup Street. From Shruti and me, goodbye and many thanks for watching. More news continues right here on CNBC TV 18.
Hello and welcome to IPO KYC. This is a special one. Rima and I are here at the offices of SBI Funds Management, the company behind what all of us know as SBI Mutual Fund. I think needs little by way of introduction. And we're sitting right here, the heart of, the offices, a lot of hustle bustle around it. It's a special time. SBI Funds is going the public way. It's a formidable entity, the largest asset management company in the country, 30 lakh crores in terms of assets, 6 lakh crores in terms of equity assets, 3,000 crores in net profits, the last reported number that we have. And it's going to list pretty soon. So we're going to ask the trajectory, the roadmap, and what does it mean for you and me as investors into SBI Funds Management? We've all, of course, had SIPs running with the SBI Mutual Fund. Now, of course, you can be an investor in the company too. And to discuss all of this, we have Mr. DP Singh. He's Joint Managing Director and Deputy CEO of the company. Srinivas Jain is Executive Vice President at the company as well. Gentlemen, thank you very much, both of you.
Thank you.
Appreciate it. So between the both of you, it's about 50 years at SBI Funds.
Yeah. I'm not so old.
Yeah. I mean, how does it feel?
It feels very, very great. I remember when me and Srini started the journey in SBI Funds Management, it was a 2,500 crore company.
2,500 crore AUM.
Yeah.
Wow, 30 lakh crores now.
Yeah,
it's a big franchise. We're very proud to be part of this growth journey.
Part of the growth journey.
And, let me just get to the valuation. I mean, we got the price band earlier today. At the upper end of the price band, at about 574, the valuation is about a little less than 1.2 lakh crores. And, you can take forward projections and, assuming 25-26% growth, 5,000 crore net profits in F5 28, which gets us a multiple of about 24 times. Is that the right way to look at the? Is that the right multiple, Mr. Singh?
So many factors around it, but if we go by our past history, the way we have been growing, then definitely yes.
Okay.
But there are always in the market there are uncertainties. It could be more than this, it could be a little less than this. But the growth rate, the more and more financialization happens in the country. SBI Mutual Fund is at the forefront. We will get the maximum benefit. The moment today the biggest friction in growth of mutual fund business is the way KYCs are being done. These small players, the way it's a linkage between the remuneration for acquiring a customer and all efforts to be bring in. So that is not working. The moment that friction is over, which is likely to happen very, very soon, and once because all the bank accounts are now KYC compliant. The moment any bank account which is KYC compliant frictionlessly can part money in mutual fund, I think that will be the biggest revolution. And the number which is there today, only 6 crore investors, that will multiply like anything, and that the number could be anywhere. I'm not saying as much as number of bank accounts are there, but at least 20% of the bank accounts will be the mutual fund investors.
As soon as this KYC is that big, whenever that happens.
That's big, because lower level, middle level, nobody is servicing today.
Yeah. So just to close the loop on that, I'm not wildly inaccurate when I say 5,000 crores in net profits, 24 times earnings, which is actually quite reasonable as compared to some of the other listed peers, which I'm sure is a conscious decision. Srinivas, you want to just point, come in on that KYC and, that big leap that provides?
What are the two factors today driving the growth of this business, right? One is, of course, education. We talked about the 100 crore bank accounts, 5.5 crore customers in mutual fund industry. So obviously, there is some gap. That means that needs to be driven through either education. With mutual fund SAI and such campaigns have really been helpful building that. As that moves, you now need to remove friction also. I think the way eKYCs have now come on board, the friction is kind of come down, but still it exists. Today, if you're a bank customer and you've done every KYC that's there, why do you need to do another KYC when you do a mutual fund? There's new KYC 2.0, which is CKYC 2.0, what they're calling as One Nation, One KYC. If that comes in very quickly, this friction point also goes away.
Do we have any timelines for it?
My understanding is that they are fairly advanced and ready from a technology point of view. We've also been talking to both Protean, CKYC team and all. SEBI chairman actually made a statement saying you should expect that very soon, because he's kind of spearheading this particular debate. So one of the things that we at SBI Group have about 55 crore customer base. And even if you take all those Jan Dhan accounts and others away, we have a 35 crore investors who are KYC'd in the bank. And that's like 55 lakhs today with us from already KYC'd SBI mutual fund customer. The headroom for us to grow, and this friction that is going to go away is going to make it a big...
55 lakh accounts, 35 crore KYC'd.
35 crore is the target audience. and 55 lakh is the audience today.
Where you are right now.
It's 2%, right? So from 2% to, even if I were to go to 10%, DP's number, which we are talking about 20 is a little far. Even if I go to 10%, that's a huge number. That's like 5 times our business that we are today with the bank. That's 2.5 lakh crores is what State Bank of India's AUM is with us. So think about it. That's a huge business.
It's a huge headroom to grow. So let's just understand about SBI Mutual Fund and the scale today.
Right.
So Srini, 30 lakh crore in terms of an overall AUM.
Right.
Break that up for us in terms of categories and the kind of profitability that you make on each.
Yeah, I'll come to the profit, but let me explain the business to you. I think this is a different franchise we have been able to build. One, of course, is the bread and butter mutual fund business, which today, as we speak, about 13 lakh crore plus assets under management, making us the largest asset manager with almost 15.5% market share. We also have a very large ETF pool, which we are our largest passive provider. We have roughly about 4 lakh plus crores of ETF assets, even 30% market share there. But one of the big business that we do is on the institutional side of the business. We have a very large 16.5 lakh crore worth of business that we do on the pension funds management. A large chunk of it is coming from EPFO. It's roughly about 9 lakh crores of that business. It's a fixed income mandate, but it's a very prestigious mandate. We do impact 11 lakh crore investors who invest through EPFO. In a way, it's a nation building capability that we have. While that business is not a very large revenue pool business, there is also a pool of business in the PMS, which is our international operations. We have a fairly large international client base, roughly about $4.5 billion worth of assets that we manage for global investors, our own joint venture, Amundi. So that's a very revenue generating kind of numbers. So the piece of business that's well known is the bread and butter mutual fund business. That gives me the highest revenue pools. And the second piece of business that we have is the management fee coming out of our portfolio management services business, which has both the EPFO and the other fixed income mandates, plus the money that we get out of our international business.
So in that 13 lakh crore of mutual funds, what is the contribution of equity, debt? And then if you could tell us the yield that you make on each of these and including the ETFs.
I mean, so it's all in the public domain, but I can tell you we are about 6.5 lakh crore worth of active equity out of the 13 lakh crore that we have. Equity is a fairly profitable, very profitable business for every asset manager. For us too, it's upwards of 60 basis point is what we make on that pure equity assets. But then we also have, the scale kind of comes down. We have hybrid products, we have, fixed income products, we have money market products, and then we have ETFs. In ETF also, there are 3 varieties of ETF. The one we manage for the Nifty and Sensex, which are extremely low yield but very high volume business. But we also manage a gold ETF and silver ETF, which are fairly large margin businesses, which are even closer to active equity kind of margin. So it's widely diverse, the pace of business, and it also widely diversified. That means thanks to hybrid business, it's also not very volatile thanks to mark-to-market impacts that we have. We also have a fairly large fixed income pool that we manage. So our business margin moves from 2 basis point to a 65 basis point kind of spread.
Okay. On a blended basis, you would be at 37 basis.
Yeah, in fact, that's an interesting story there. Absolutely. Absolutely. That's a very interesting story. I think one of the things that have happened to us is that passive overhang that we had as 40% plus market share is kind of averaging out, and we are actually building a strong equity book. As you see, our SIP book is now 4,000 plus crores every month. And that's actually improving our active mix. Last 3 years, we've grown almost 32 to 42%. And that's a very steady growth. And I see that growth continuing.
That 6 lakh crore, which is active equity, where will that number be? I mean, what should we expect in terms of growth here?
You want to answer that, please?
No. See, what happens in the 6.3 lakh crores exactly. Today we have got a SIP book of 4,000 crores, out of which 3,800 crores is for this category only. So that itself is becoming 48,000 crores as today's number. If we grow by 10%, it will become 60,000 crores. Then net sales also happen across the country, 50-60,000 crores. And if I take 10% mark-to-market year-on-year basis, of course not in a straight line manner, but if we are talking about 3 to 5 years, so if we take an average of 10%, so the 1 year itself it should grow up by 2 lakh crores. This is 6 lakh crores business. And the other is the ETF, etc. Mark-to-market will come there as well at the stock level. Even if you say incrementally I will get 26% flow. But the stock which is there, which came at a higher level of 75-50%, that is there with us, the mark-to-market. So the equity book, which is 10 lakh crores today, will grow by 2.5 to 3 lakh crores in 1 year, going by these back of the envelope calculations. And the multiple of that in next 2 to 3 years. So this is going to continue. This is what I'm saying. I'm considering this number is net sales number.
And this is persistency an issue? I mean, across accounts?
Our persistency is better.
It's better. And there is another unique thing also, which of course we've been, it's been a part of our design, that we've been trying to get very long-term SIPs only as part of our. So we've always incentivized to get what we call perpetual SIPs, those 30 years NPCI mandates that are there, which has actually helped us to build a very 98% of our SIPs are very long-tenor SIPs. which is a very good thing because we don't have to go every year or alternate year to renew them or ask them to, top up their SIPs or, sign up on new things. So that's a unique business model we've been able to build, and we have like 1.6 crore SIPs today. Last year alone, we added about 40 lakh SIPs to the book. So it's growing at a very fast pace.
So as your equities, which are actively managed, compound at 20-25% on an annual basis from here on, what would your blended yield look like going ahead, say 2 years or 3 years down the line?
I think the way to think about it is that today the best in class is close to about 44 basis point. I think we should come very close to that because clearly, as you see, the active participation going up. But at our scale, that's a difference. The blended yield for a smaller player at 40 basis point and at a 13 lakh crore player is a completely different way to think about it. So we are probably one of those few very large asset manager because of this active mix going up.
Your operating cost, I believe, is also the lowest in the industry.
Yes. We run a very tight book. In fact, our cost-to-income ratio is like 20%, which is probably one of the most attractive, not just in India, globally, for any asset manager.
So you should get to 44 basis points, which is best in class.
We don't want to predict that number because that's like very forward-looking. The better way to think about it is that we want to come closer to an average of the industry, despite having an extremely high book. Size of our book. So that's the way to think about it.
The reason we ask is because the total expense ratio rules also changed effective 1st of April.
Right.
Has that had an impact, and are you passing on the impact to distributors?
No, we have already we are through that, and we have actually neutral to that, revenue neutral.
Revenue.
We have passed on this also. There were some things where we got some benefit as well, and the biggest barometer is if you look at our direct plan expense ratios. If those are remaining intact, that means my management fee is intact. As simple as that. And we have not changed that. Our revenue is continuing.
What is the split between like direct and sort of distributor-led sales now?
It's around 22-23% direct. And the remaining is distributed. That's how this is.
Is this also like a...
This is going up.
It's going up.
This is going up.
Yeah, there's a move towards direct anyway. That's been going on for almost a decade now. Yep. It's picking steam, but at the heart of it, we are a distributor-driven organization, whether it's State Bank of India or third-party distribution. Yeah. Very focused on it, but we also see a very large trend of self-service investors coming to us. We built an app called Invest App, which is the biggest app among asset managers out there, 4 million plus users, and we get 12% of our SIP book out of that. So it's built a very strong, B2C case also. But at the core of it, we are a B2B company.
Absolutely. Any pressure on yields? I mean, from anywhere, regulatory-wise or anything else? And I mean, we've spoken about this shift to passives
Prashant, I think
globally. Is
the worst is behind us now.
Okay. Whatever had to happen regulation-wise.
Has happened. Okay. At least for next 3, 4, 5 years, nothing is going to happen. That's one thing. And this also has happened because it was already going on. It was work in progress, so they had to do it. They have done it.
This global shift to passives, do you think that will play out here in India?
I mean, not really. If you look at the data, other than maybe 1 year that was post-COVID, active managers have done extremely well. And even when you look at dispersion of returns across asset managers, even the worst asset manager has been able to beat index significantly. Not across the board, but largely. So India continues to have a very active management space, and I think for a while it will be there. But maybe at some point of time that shift will happen.
Well, I have a long list of questions, and I'm sure Rima has more as well. But I think this gives investors a fair bit of sense of what the IPO is about. Not that they needed, an introduction to SBI Mutual Fund. I think we all know it. But we wish you all the best of luck, Mr. Singh.
Thank you, Prashant.
Thank you so much. Thank you. Thank you for coming here. Thank you.
Well, we'll take a quick commercial break. We'll see you on the other side. We are still right here at the SBI Funds Management offices in BKC in Mumbai. The IPO, of course, a fair bit of excitement around it. It's, of course, one of the largest asset managers in the country. And now we are sitting down with Mr. Debashish Mishra, MD and CEO at SBI Funds Management. Mr. Mishra, great to have you with us here. Yeah. Thank you very much for joining us. Mutual fund say has become a mantra and has done so well. Done wonders for the industry. It's done wonders for SBI as a leader as well, SBI MF as a leader as well. What gives you the confidence, the next leg of growth? Because India's sort of savings, financial savings are still largely in deposits with banks and real estate and all kinds of things. Equity is, I dare say, still a newer asset class in that sense. What gives you the confidence that this share will structurally keep growing?
So, we have 1.4 billion people. Guess what is the number of bank accounts? 950 million. We are roughly reaching to 80% of the citizens for banking transactions, thanks to PM, Jandan, Jam Trinity, thanks to the inclusions by banks and NBFCs. But you look at the number of customers having investment accounts or folios, we would say in parlor terms, only 53 million. So that gives us a lot of confidence that in future or in today, we have enough to move around, and there's a big road ahead for all of us to cover. My second point is, today's investor is not the one you think of believing in going to the bank or sitting across the counter. Digital delivery is the key, the buzzword for all the investors today. Youngsters, they would like to see the Facebook, maybe the Twitter, maybe the social media to find out who is investing, where is investing, and what is required. Number three, even if we take the last 5 years journey of financialization, there has been a move from saver to investors. The whole financial assets creation is increasing 11% of CAGR, whereas mutual funds have grown by 41%. Yep. So there is an increasing trend to bring these people from the saver to investor world.
So within the SBI ecosystem, right? I think SBI bank accounts are 530 million.
Yeah.
In that, the ones who have a YONO account, 120.
Yeah.
But you're saying only 5.5 million of those invest money with SBI mutual fund,
Yes,
right?
unique customers.
Unique customers. That's a very small number. So now, say in the next 3 years, what would you like that number to go up? And other than fixing the KYC issue, are there any other friction points that you'd like to solve?
So KYC is one, of course, it is going to resolve, I'm sure. Now it is in the hands of SEBI and Government of India. We are now going to solve it through digital integration. So we have got an app called Invest app, which is an AI-based app. We are going to now seamlessly integrate the YONO, so that any YONO customer can go to invest in SIP, in lump sum, in any investment product, digitally, seamlessly. So that work in progress. We are already having the integration done. KYC thing comes up, we fix it, and it's done. We are also trying to have increasing our base in B30 centers. So we have now 270 branches of SBI AMC. We are going to make it 50 branches more in this financial year. So we are reaching out to people directly also for solicitation, for clarifications, for any doubts, for any grievances. Our own people, my own people will be there. We are also trying to train our SBI employees with the NISM certification to reach out to people. As for regulation, you can't sell a mutual fund product if you don't have a certification. So as of now, there are 13,000 employees of State Bank of India who are qualified to sell. We are trying to make it maybe 30,000 in coming 3 years.
So what will this 5.5 million number go up to?
So I answered your question, double. So we are trying to make it, we'll make it 10 million in 3 years' time.
So 12 out of 10 basically will be on it.
Yes.
That's going to be a big number, right?
Yeah.
I mean,
and
that's the thing. You don't need to look elsewhere for growth. You've got this captive large base in that sense.
I have a supplementary answer to this.
Yeah.
In addition to SBI, our other side of channel is also equally good and great.
Yeah.
I have 130,000 IFAs, individual financial advisors, who are advising to more than 40% of my asset base, or AUM base. See, SBI, although it's a parent bank and we have got a shareholding and all, but they constitute only 23 to 25% of the business.
Yeah.
So we have got a large chunk of business in the hands of AIFs, institutions, PMS. Also, we are into alternates. Every sector we are increasing our footprints.
I have a question, slightly maybe offbeat, but Ms. Mishra, you were a career banker at SBI. You've done so many roles across, right? And now you're at the helm of this organization as it goes public. What will change at SBI Funds Management? I mean, it goes from a private financial institution in that sense to like a listed public company now with minority shareholders. What should investors expect?
That's a good question. I expected this to come. See, the priorities for me as a senior management in State Bank of India is only 3. Customer centricity, value creation and governance. Here also same 3. So I have to look at my investors. Now I have to add my shareholders. And I have to look at governance because we will be listed. So we will be more governance oriented, disciplined and value creation. So my investment team, which is creating value, I'm sitting with them. My first interaction with them is only after coming here to understand the whole gamut of investment and fixed income and derivatives, equities, everything. See, overall, in the bank, we understand customer is the key. So as long as I believe that and carry on in my whole activities, then whether it is AMC or bank or anywhere, it's all the same game.
Well, we wish you all the best of luck, Mr. Mishra.
Thank you.
It's a momentous occasion, and I'm sure this is the first of many interactions right here on CNBC TV. Thank you.
Thank you.
All the
Thank you
best. All the best.
Welcome back after the break. You're watching the CNBC TV 18 special. BMW Group India has also reported its highest ever first half performance, retailing 9,075 cars in the first 6 months of the year, a growth of 17%. Joining me now, Hardeep Singh Brar, President and CEO of the BMW Group India. Hardeep, thank you so much for joining us here on CNBC TV 18. Let me begin by asking you, BMW has reported its highest ever first half sales, growing 17% at a time when the broader passenger vehicle market has slowed. What's driving this divergence, Hardeep?
So Shivani, we have 5 key reasons which is really working for us. The number one is the portfolio. We've launched 11 new cars in the first half of the year, and we announced that we will be launching 25 plus models this year. So that has really given us a lot of momentum, a lot of noise around the brand emergence. So that is number one. Number two, the narrative around electrification is really gaining momentum because of the West Asia prices. The fuel prices have gone up recently, so that has really pushed the demands towards the electric vehicles. And we have one of the strongest portfolio in EVs today in the market, and that has really helped us. Number three, we moved towards the long wheelbase product portfolio in the recent past, and people are loving the space in the BMW. So that is point number three. And last but not least, we are doing a lot of these brand immersion for our customers. And, we did our golf events across 9 cities last year, and we are taking it to the next level of cities, the M Drift Academy, some art fair events, and also the Oberoi Concours, which is the latest one in our portfolio. So all in all, there's action on each and every front, which is really giving us a very, very strong momentum in the recent past, and I am sure it will continue in the second half of the year as well.
Hardeep, one of the interesting numbers that I could see from the numbers that you've shared is that 1 in every 4 BMWs you sell today is electric. Has luxury EV adoption in India reached an inflection point, or is this still largely an early adopter market?
I would say, if your package is great, people don't mind going for EV. I think this is an apprehension that people don't want to go for EVs. I think if your packaging is right, to give you an example, we have 2 cars of the 7 Series, which is top of the line, and second is iX1, which is the entry level. In both the cars, the EV penetration is 60%. So 60% EVs and 40% ICE. So if the packaging is right, the pricing is right, and you give everything that the consumer wants, I think people are willing to go for the electric vehicles.
But from your perspective, what are the biggest hindrances in the full transition that we are expecting? Policies there, government is pushing for the EV transition. We want cleaner mobility, specifically after the West Asia crisis and the petrol price hike. Hardeep, what do you think is the most important challenge that we need to focus on from a policy perspective, from an infrastructure perspective, that will actually lead the transition for us?
I think both OEMs and government, they have to work together. So from OEM perspective, 2 big factors, how do we bring the price parity between an electric vehicle and ICE vehicle? Till now, the price gap used to be about 20 to 30%. Now it is coming down to 10% and lower. And in our case, both our petrol and EV vehicles are at par. So that is giving a huge flip. Number 2, what OEM needs to do is increase the range. So all our cars are today 500 kilometers plus range, and the next generation will be hitting almost 800 kilometers on a single charge. On the government side, I think what is needed is how we can really speed up the charging infrastructure, especially on the highways, because your anxiety is not inside the city. It's when you hit the highway, when you have to cover 300, 400, 500 kilometers on a single day, how quickly you can take that pit stop and recharge your car to maybe 50% or more than that. And that's where you need the charging infrastructure, which is charging at a very high speed. And I saw that in this year budget, government has allocated 700 crores towards the charging infrastructure, which is very, very critical. Last but not least, which again, I think OEMs have to play a role, is the anxiety around the resale price. And we have brought in the assured buyback program for the electric vehicles, which is also one of the key factors why people are loving the BMW cars, because we tell them that, this is a assured value that you will get at the end of the tenure that you go for.
Hardeep, let me now turn to the debate that is raging all over social media, and it is concerned with the automobile industry, the ethanol debate. Consumers are looking for straightforward answers. Let me ask you this straightforward as well. Should BMW owners have any concerns about using the E20 petrol in their BMW cars, whether they be old or new cars?
I don't see any problem with that. We haven't come across any issues in any of our workshops so far as E20 is concerned. The new cars are all E25 compliant, so everything is sorted for now.
And how about the older cars? Would you say that probably fuel efficiency or any kind of corrosion could happen over a long period of time?
As I said, we haven't come across any concerns for the old cars using E25. Yes, there is a mileage drop to maybe 5 to 7%, but no problem so far as the engine maintenance, etc. is concerned.
So you're saying that the newer cars are compliant for E25, which is higher than E20. So if India moves beyond E20 in the years ahead, would you say that BMW is already, in the run and you're all already compliant with what is going to happen? And can today's vehicles adapt, even the E20 vehicles adapt to that higher ethanol blends eventually?
So as of now, we are compatible with E25. But in future, if this blend is going to increase in favor of ethanol, we would need a very clear guidelines and timelines when it is going to increase and by what percentage. That is very, very important so that we can tune up our cars according to that.
And about the concerns that are raised on social media, a lot of people are concerned about what it does to their car and whether higher blending should be there. People of India, citizens on social media are asking for the choice to choose their own fuel. Would you say that that should be the way to go forward for the government?
I think, we need to listen to customers. If there are issues which are found out in other cars, naturally, they need to look at that. But as I said, for our customers, there are no concerns. But if it is coming out and it is coming heavily, that needs to be investigated. Also, there are concerns whether it is happening because of the fuel adulteration. So that is what we really need to see. Well, how much is contributed by adulteration and how much is contributed by ethanol. So I think the investigation is required for that to come to the solution. What exactly is the issue so that you can really pinpoint and not create narratives which may not be correct.
Well, thank you so much, Hardeep, for joining us here on CNBC TV 18 for this special broadcast. So the luxury automobile market continues to chart its own course even as the broader industry adapts to changing consumer behaviors, evolving technologies and an ambitious policy on ethanol roadmap. What is clear from both the conversations is that the future of mobility will not be defined by growth alone. It will also be shaped by how quickly the industry can build consumer confidence, whether that's around electric mobility, cleaner fuels, E20 and beyond, or the technologies that power the next generation of vehicles. That's all on this CNBC TV 18 special. Thank you for watching. Hello and welcome to this special broadcast on CNBC TV 18. I'm Shivani Bazaz. The Indian automobile industry is at an inflection point. Demand in the mass market has moderated. The rules of mobility are changing with electric vehicles and alternative fuels. And in the recent weeks, few issues have generated as much debate as ethanol blended petrol. Yet, amid all this disruption, one part of the market continues to grow with remarkable consistency, the luxury automobile segment. What is driving that resilience? Is India's premium customer behaving differently from the rest of the market? How quickly is electric mobility changing the business? And what should every car owner know about E20 and ethanol blending? Over the next half an hour, we'll put all those questions directly to the leaders of India's two largest luxury car makers. And let me begin by introducing my first guest from Mercedes-Benz India, which has reported its highest ever first half sales, retailing 9,768 cars in the January to June period. Joining me right now, Santosh Iyer, Managing Director and CEO of Mercedes-Benz. Santosh, thank you so much for joining us here on this special broadcast. Let me begin with this. The market, Mercedes-Benz has reported its best ever first half, retailing close to 9,800 cars. Yet growth has moderated, Santosh, to 9%. What do you make of these numbers? And has the luxury market now entered a more sustainable phase after a few years of surge that we saw? Or do you still see room for another phase of strong growth from here on?
No, I think firstly, thanks for having me, Shivani, and glad to be here on the channel. If you see the way the total market has developed, it has grown significantly after the GST rate cuts. One of the things which has been hindering the luxury car market is also the constant increase in prices, not led by profit-led pricing, but more led by cost-led pricing. The input costs have gone up. The euro to the rupee, we all know how rupee has depreciated, and that meant that we had to subsequently increase pricing. So even after the GST cut, which resulted into a net 6 to 8% reduction for customer, today as we speak, we had to already go back to pre-GST level. So these are some of the headwinds. On the other side, if you look at the macroeconomic factors, there is GDP growth, per capita income is rising. You can also see the way the West Asia crisis was managed. The fuel prices hadn't gone up as significantly as in other parts of the world. So inflation was controlled, exports were there. So I think to our customer segment, the sentiments were on a yo-yo basis, and we could also see that in our monthly, quarterly numbers as we were steering the business. But on the other side, overall, if you look at H1, I think a strong, the quarter two was almost double digit, and on an H1 basis, a 9% growth is still great because the base is itself close to 9,000 plus cars, and we have grown significantly on that base. So quite happy with the outcomes. This was our prognosis at start of the year. And also, this growth is also led by product launches. We had the new CLA in the entry segment. We had the new V-Class in the top-end segment. We had the GLS Maybach, which we decided to localize in India. So if you look at the new product launches, that also excites customers and helps us to drive this growth. Future, yes, to expect a hockey stick kind of an environment, I think may be a fallacy, because I think, again, it's as good as also the external environment being stable is a fallacy. So things will be disruptive, and our expectation is we should continue to grow this market, and we should, the critical factor to note is the structure. We grew 28% in the top end, 20% in the top end segment. 28% of the cars we sell in India today are cars costing more than 1.4 crores. So that shows the structure is improving. Premiumization is all-time high. Even the entry segment cars, like the CLA today around 60 lakhs, that clearly shows how the market is shifting more and more towards premiumization for Mercedes-Benz.
Well, Santosh, one of the biggest shifts that we are seeing in India is the transition to EVs, and your EV penetration has, according to these numbers, doubled to 14% in the second quarter. Yes. What would you make of that number, and when do you see electric mobility now becoming a mainstream business for Mercedes-Benz rather than, fast-growing niche?
No, first of all, if you see in the segments we operate, let me say in the top end segment that we were discussing, the share of electric there is 25%. With one model EQS SUV, we have been able to reach there. In the entry, we never had a car line. It's only in the last quarter we had the new CLA, and today you see the overall share has gone up to 14%. Now, if you compare this with the mass market, they are still at 6 to 7%. So already, I think luxury customers, because they have charging infrastructure at home or office, they have multiple cars in their household, their affinity to buy an EV is much higher. Having said that, it's still, even in luxury segment, it's a TCO argument. Why should I buy an EV? Why not a diesel? Why not a plug-in hybrid? And there we would like to leave the choice to the customer. Unlike certain brands and portfolios, we have all the cars. We have the entire portfolio of EVs as well. Many of them, or all of them, most of them will make its way to India. So for us, we rather allow the market to decide the pace of transformation than pushing one specific car line, because the customer driving patterns are different. And today, let's also accept the charging infrastructure is not the same across India. The residual values of EVs are still developing. We give guarantees to customer, but still the real market, when the customer goes after 5 years, 7 years, may be different. So I think let the customer decide. Our job is to give the right products, great value, latest technology, best pricing, and in across portfolio, and let the customer then decide the pace of transformation.
But Santosh, what do you think is the single biggest hurdle today in this EV transition from an industry standpoint? Is it the charging infrastructure? Is it the consumer confidence still? Is it the affordability, or is it something else?
So I think the first and foremost is there are not enough products. If you look at our portfolio, we are selling today 11 locally produced cars in India, out of which one of them is an EV. So if you see from a portfolio perspective, we still are only 10 to 15% of EV compared to the balance still is combustion engines. And out of that portfolio, 14% of sales are EV. So technically, I think first and foremost is let's ensure that across segments, entry, core, TEV, we have enough and more offerings to the customer. The second, of course, is based on the use case, the charging range anxiety, as we call, which is not as much in luxury cars, because in our case, we have cars going up to 800, 900 kilometers on single charge. So maybe we can take care of the range anxiety. But charging still, not only availability of charging stations, but if you reach there, is the charger working? Is it operational? How easy is the payment mechanism there? And so these are, again, nagging concerns. It's a leap of faith. That's the reason we got a plug-in hybrid as well. So somebody wants to drive 100 kilometers pure EV range on an S-Class, can do. And then there is also a combustion engine to back it up if you are not able to find a charging. So all these solutions will emerge. It's no doubt that the end goal is basically decarbonizing the industry. To reach there, there will be different paths. We have also seen a significant increase in diesel share, for example, in the last few months. But the residual value also, which I touched upon, is one big impediment for consumers to shift. So these are the negatives, but there's a lot of positives. Low TCO, low maintenance, environment friendly, plus depreciation benefits, etc., etc. So it's a balance. I think every consumer looks at the economic value, balances the buy, and therefore you can see a different consumers offering or preferring different powertrains.
Okay, Santosh, let me now turn to the issue that has dominated headlines over the last few weeks. And a straight-up question, do Mercedes-Benz owners have anything to worry about when they fill up E20 petrol in their cars?
The simple answer is no, not at all. Cars which we have sold from 2020 are anyways certified materially compliant. Even 23, 24 onwards, they are also even emission and range compliant. So I think customers don't have to worry anything about the older cars as well, which are manufactured and sold after this period. Even before this period, I think the cars will be able to run. There may be certain compromises, slight efficiency drop. But, it's not that overnight the government has put 20% ethanol. These cars have been running on 15% ethanol any which ways for many years, and they were also running on this. So it's only a 5% increase that we are seeing in the last couple of months, and that should not have any significant impact to our customers, and we stand by them. There's a lot of queries at our dealerships, and we are able to answer them. I think one of the bigger problems that emerged in this crisis, in this entire debate, is a lot of adulteration is still happening in fuel pumps, which also means it's not E20, maybe somebody's filling an E30 or something else, and in terms of the fuel mix. And that is maybe causing problems to one of the other consumers as such. But a good amount of education and also, as I said, for us, we have already launched the E25 car. We introduced a new S-Class plug-in hybrid in Mumbai last 2 weeks back, and that's already E25 compliant. So we are always ahead of the curve, and our customers need not worry on this topic.
Santosh, what about the cars that were manufactured before 2020 from your stable? Would you say that they also have nothing to worry about? Of course, the mileage drop you spoke about. Other than that, the corrosion over the years that people are asking whether or not that will be an impact on the cars. Are you worried about that? What would you have to say about that?
Not really, because as I said, the cars have certain tolerances anyway inbuilt into them. These cars have been running on E15 fuel also for so many years. So we don't see a fundamental issue even for those customers driving these cars.
Okay, and so you spoke about adulteration, and customers everywhere in India have the same question. How does one know that this is an adulterated fuel, and how does one know where to go when such issues arise? Talk to us about that. How big is the issue and the problem?
So, first of all, you only come to know when the car is talking to you in terms of some issues that's propping up in the car, the engine light going up. And I think no better than the dealership. If you go in, they are able to take out the fuel and test it. There are enough testing agencies where fuel can be tested once the fuel is taken out of the tank. One also needs to see the state of the fuel tank. In some cases, there is rust and corrosion in the tank. And now, basically, because of higher alcohol content, these particles also sometimes comes and clogs the fuel filter in the fuel pump. So there are many reasons, but I think the most, if at all somebody faces a problem, there is no better than the authorized dealership who can really do a technical diagnosis and even share the fuel sample transparently and check in terms of quality and adulteration. But I would say the onus of this should be more on the authorities to ensure checking randomly the fuel pumps in many pockets, and they should then check whether the quality of fuel dispense is as per the norms that's laid out by the government.
Santosh, last question. You spoke about the new launches being E25 compliant. So if the government decides to move beyond E20, would you say there will be challenges for the auto sector, for the existing cars? What's the worst case scenario that you think?
I think what this entire discussions and debate has come up is we have to be cognizant of the current car park. So our view is always that if at all the government decides to go for E25, first and foremost, they should think what happens to the current car park, the older cars, maybe because now you are increasing the threshold significantly. So enough science-based studies needs to be done. And then if at all there is a risk, then let's continue the E20 and also give E25 as an option fuel to the customers who are buying newer cars. Second, there should be enough time given to the industry to shift and migrate because, as I said, a couple of our cars are already compliant, but to make every car line in India compliant may take some time. So enough guidance, enough roadmap should be given for auto industry to do it. And last, not the least, allow the customer to decide. Maybe if you are blending more fuel and if there is an economic benefit, let the customer decide how they want to. And that's where I'm a big proponent of put the market forces to decide if they really want to pay much more expensive fuel and they are okay with it. Let them decide on rather than we or anyone imposing that this is the only kind of fuel that can be used. So, but we wait for the policy. At this stage, what we hear is E25 is not on the top agenda of the government. Right now, they're still trying to clear doubts, apprehensions on the E20 fuel itself.
Okay, Santosh, thank you so much for joining us on this special broadcast. Thanks a lot for joining us on CNBC TV 18. Now we take a short break. After the break, we continue our special discussion on India's luxury automobile market with the BMW Group. Don't go anywhere. We'll be back soon.
Hello and welcome to IPO KYC. This is a special one. Rima and I are here at the offices of SBI Funds Management, the company behind what all of us know as SBI Mutual Fund. I think needs little by way of introduction. We're sitting right here, the heart of, the offices, a lot of hustle bustle around it. It's a special time. SBI Funds is going the public way. It's a formidable entity, the largest asset management company in the country, 30 lakh crores in terms of assets, 6 lakh crores in terms of equity assets, 3,000 crores in net profits, the last reported number that we have, and it's going to list pretty soon. So we're going to ask the trajectory, the roadmap, and what does it mean for you and me as investors into SBI Funds Management? We've all, of course, had SIPs running with the SBI Mutual Fund. Now, of course, you can be an investor in the company too. And to discuss all of this, we have Mr. D.P. Singh. He's Joint Managing Director and Deputy CEO of the company. Srinivas Jain is Executive Vice President at the company as well. Gentlemen, thank you very much, both of you.
Thank you.
Appreciate it. So between the both of you, it's about 50 years at SBI Funds.
I'm not so old.
Yeah. I mean, how does it feel?
It feels very, very great. I remember when me and Srini started the journey in SBI Funds Management, it was a 2,500 crore company.
2,500 crore AUM?
Yeah.
Wow, 30 lakh crores now.
Yeah, it's a big franchise. We're very proud to be part of this growth journey.
Part of the growth journey.
And, let me just get to the valuation. I mean, we got the price band earlier today. At the upper end of the price band, at about 574, the valuation is about a little less than 1.2 lakh crores. And, you can take forward projections and, assuming 25-26% growth, 5,000 crore net profits in F5 28, which gets us a multiple of about 24 times. Is that the right way to look at is that the right multiple, Mr. Singh?
So many factors around it, but if we go by our past history, the way we have been growing, then definitely yes.
Okay.
But there are always in the market, there are uncertainties. It could be more than this, it could be a little less than this. But the growth rate, the more and more financialization happens in the country. SBI Mutual Fund is at the forefront. We will get the maximum benefit. The moment today the biggest friction in growth of mutual fund business is the way KYCs are being done. These small players, the way it's a linkage between the remuneration for acquiring a customer and all efforts to be bring in. So that is not working. The moment that friction is over, which is likely to happen very, very soon, and once because all the bank accounts are now KYC compliant. The moment any bank account which is KYC compliant frictionlessly can part money in mutual fund, I think that will be the biggest revolution, and the number which is there today, only 6 crore investors, that will multiply like anything, and that the number could be anywhere. I'm not saying as much as number of bank accounts are there, but at least 20% of the bank accounts will be the mutual fund investors.
As soon as this KYC is that big, I mean, whenever that happens.
That's big, because lower level, middle level, nobody is servicing today.
Yeah. So just to close the loop on that, I'm not wildly inaccurate when I say 5,000 crores in net profits, 24 times earnings, which is actually quite reasonable as compared to some of the other listed peers, which I think I'm sure is a conscious decision. Srinivas, you want to just point, come in on that KYC and, I mean, that big leap that provides?
What are the two factors today driving the growth of this business, right? One is, of course, education. We talked about the 100 crore bank accounts, 5.5 crore customers in mutual fund industry. So obviously, there is some gap. That means that needs to be driven through either education. With mutual funds IA and such campaigns have really been helpful building that. As that moves, you now need to remove friction also. I think the way eKYCs have now come on board, the friction is kind of come down, but still it exists. Today, if you're a bank customer and you've done every KYC that's there, why do you need to do another KYC when you do a mutual fund? There's new KYC 2.0, which is CKYC 2.0, what they're calling as One Nation, One KYC. If that comes in very quickly, this friction point also goes away.
Do we have any timelines for it?
My understanding is that they are fairly advanced and ready from a technology point of view. We've also been talking to both Proteon, CKYC team and all. SEBI chairman actually made a statement saying you should expect that very soon, because he's kind of spearheading this particular debate. So one of the things that we at SBI Group have about 55 crore customer base. And even if you take all those Jan Dhan accounts and others away, we have a 35 crore investors who are KYC'd in the bank. And that's like 55 lakhs today with us from already KYC'd SBI Mutual Fund customer. The headroom for us to grow, and this friction that is going to go away is going to make it a big...
55 lakh accounts, 35 crore KYC'd.
35 crore is the target audience, and 55 lakhs is the audience today.
Where you are right now.
It's 2%, right? So from 2% to, even if I were to go to 10%, DP's number, which we are talking about 20 is a little far. Even if I go to 10%, that's a huge number. That's like 5 times our business that we are today with the bank. That's 2.5 lakh crores is what State Bank of India's AUM is with us. So think about it. That's a huge business.
It's a huge headroom to grow. So let's just understand about SBI Mutual Fund and the scale today.
Right.
So Srini, 30 lakh crore in terms of an overall AUM.
Right.
Break that up for us in terms of categories and the kind of profitability that you make on each.
Yeah, I'll come to the profit, but let me explain the business to you. I think there's a different franchise we have been able to build. One, of course, is the bread and butter mutual fund business, which today, as we speak, about 13 lakh crore plus assets under management, making us the largest asset manager with almost 15.5% market share. We also have a very large ETF pool, which we are our largest passive provider. We have roughly about 4 lakh plus crores of ETF assets. I went 30% market share there. But one of the big business that we do is on the institutional side of the business. We have a very large 60.5 lakh crore worth of business that we do on the pension funds management. A large chunk of it is coming from EPFO. It's roughly about 9 lakh crores of that business. It's a fixed income mandate, but it's a very prestigious mandate. We do impact 11 lakh crore investors who invest through EPFO. In a way, it's a nation building capability that we have. While that business is not a very large revenue pool business, there is also a pool of business in the PMS, which is our international operations. We have a fairly large international client base, roughly about $4.5 billion worth of assets that we manage for global investors, our own joint venture, Amundi. So that's a very revenue generating kind of numbers. So the piece of business that's well known is the bread and butter mutual fund business. That gives me the highest revenue pools. And the second piece of business that we have is the management fee coming out of our portfolio management services business, which has both the EPFO and the other fixed income mandates, plus the money that we get out of our international business.
So in that 13 lakh crore of mutual funds, what is the contribution of equity, debt? And then if you could tell us the yield that you make on each of these and including the ETFs.
I mean, so it's all in the public domain, but I can tell you we are about 6.5 lakh crore worth of active equity out of the 13 lakh crore that we have. Equity is a fairly profitable, very profitable business for every asset manager. For us too, it's upwards of 60 basis point is what we make on that pure equity assets. But then we also have, the scale kind of comes down. We have hybrid products, we have, fixed income products, we have money market products, and then we have ETFs. In ETF also, there are 3 varieties of ETF. The one we manage for the Nifty and Sensex, which are extremely low yield but very high volume business. But we also manage a gold ETF and silver ETF, which are fairly large margin businesses, which are even closer to active equity kind of margin. So it's widely diverse, the pace of business, and it also widely diversified. That means thanks to hybrid business, it's also not very volatile thanks to mark-to-market impacts that we have. We also have a fairly large fixed income pool that we manage. So our business margin moves from 2 basis point to a 65 basis point kind of spread.
Okay. On a blended basis, you would be at 37 basis?
Yeah, in fact, that's an interesting story there. Absolutely. Absolutely. That's a very interesting story. I think one of the things that have happened to us is that passive overhang that we had as 40% plus market share is kind of averaging out, and we are actually building a strong equity book. As you see, our SIP book is now 4,000 plus crores every month. And that's actually improving our active mix. Last 3 years, we've grown almost 32 to 42%. And that's a very steady growth. And I see that growth continuing.
That 6 lakh crore, which is active equity, where will that number be? I mean, what should we expect in terms of growth here?
You want to answer that, please?
No. See, what happens in the 6.3 lakh crores exactly. Today we have got a SIP book of 4,000 crores, out of which 3,800 crores is for this category only. So that itself is beginning 48,000 crores as today's number. If we grow by 10%, it will become 60,000 crores. Then net sales also happen across the country, 50-60,000 crores. And if I take 10% mark to market year on year basis, of course not in a straight line manner, but if we are talking about 3 to 5 years, so if we take an average of 10%, so the 1 year itself it should grow up by 2 lakh crores. This is 6 lakh crores business. And the other is the ETF, etc. Mark to market will come there as well at the stock level. Even if you say incrementally I will get 26% flow, but the stock which is there, which came at a higher level of 75-50%, that is there with us, the mark to market. So the equity book, which is 10 lakh crores today, will grow by 2.5 to 3 lakh crores in 1 year, going by these back of the envelope calculations, and the multiple of that in next 2 to 3 years. So this is going to continue. This is what I'm saying. I'm considering this number is net sales number.
And this is persistency an issue? I mean, across accounts?
Our persistency is better.
It's better, and there is another unique thing also, which of course we've been, it's been a part of our design that we've been trying to get very long-term SIPs only as part of our. So we've always incentivized to get what we call perpetual SIPs, those 30 years NPCI mandates that are there, which has actually helped us to build a 98% of our SIPs are very long-term SIPs, which is a very good thing, because we don't have to go every year or alternate year to renew them or ask them to top up their SIPs or sign up on new things. So that's a unique business model we've been able to build, and we have like 1.6 crore SIPs today. Last year alone we added about 40 lakh SIPs to the book. So it's growing at a very fast pace.
So as your equities, which are actively managed, compound at 20-25% on an annual basis from here on, what would your blended yield look like going ahead, say 2 years or 3 years down the line?
I think the way to think about it is that today the best in class is close to about 44 basis point. I think we should come very close to that because clearly, as you see, the active participation going up. But at our scale, that's a difference. The blended yield for a smaller player at 40 basis point and at a 13 lakh crore player is a completely different way to think about it. So we are probably one of those few very large asset manager because of this active mix going up.
Your operating cost, I believe, is also the lowest in the industry.
Yes. We run a very tight book. In fact, our cost-to-income ratio is like 20%, which is probably one of the most attractive, not just in India, globally, for any asset manager.
So you should get to 44 basis points, which is best in class.
We don't want to predict that number because that's like very forward-looking. The better way to think about it is that we want to come closer to an average of the industry, despite having an extremely high book. Size of our book. So that's the way to think about it.
The reason we ask is because the total expense ratio rules also changed effective 1st of April.
Right.
Has that had an impact, and are you passing on the impact to distributors?
No, we have already we are through that, and we have actually neutral to that, revenue neutral.
Revenue.
We have passed on this also. There were some things where we got some benefit as well, and the biggest barometer is if you look at our direct plan expense ratios. If those are remaining intact, that means my management fee is intact. As simple as that. And we have not changed that. Our revenue is continuing.
What is the split between like direct and sort of distributor-led sales now?
It's around 22-23% direct. And the remaining is distributed. That's how this is.
Is this also like a...
This is going up.
It's going up.
This is going up.
Yeah, there's a move towards direct anyway. That's been going on for almost a decade now. Yep. It's picking steam, but at the heart of it, we are a distributor-driven organization, whether it's State Bank of India or third-party distribution. Very focused on it, but we also see a very large trend of self-service investors coming to us. We built an app called Invest App, which is the biggest app among asset managers out there, 4 million plus users, and we get 12% of our SIP book out of that. So it's built a very strong, B2C case also. But at the core of it, we are a B2B company.
Absolutely. Any pressure on yields? I mean, from anywhere, regulatory-wise or anything else? And I mean, we've spoken about this shift to passives
Prashant, I think
globally. Is
the worst is behind us now.
Okay. Whatever had to happen regulation-wise.
Has happened. Okay. At least for next 3, 4, 5 years, nothing is going to happen. That's one thing. And this also has happened because it was already going on. It was work in progress, so they had to do it. They have done it.
This global shift to passives, do you think that will play out here in India?
I mean, not really. If you look at the data, other than maybe 1 year that was post-COVID, active managers have done extremely well. And even when you look at dispersion of returns across asset managers, even the worst asset manager has been able to beat index significantly. Not across the board, but largely. So India continues to have a very active management space, and I think for a while it will be there. But maybe at some point of time that shift will happen.
Well, I have a long list of questions, and I'm sure Rima has more as well. But I think this gives investors a fair bit of sense of what the IPO is about. Not that they needed, an introduction to SBI Mutual Fund. I think we all know it. But we wish you all the best of luck, Mr. Singh.
Thank you, Prashant.
Thank you so much. Thank you. Thank you for coming here. Thank you.
Well, we'll take a quick commercial break. We'll see you on the other side. We are still right here at the SBI Funds Management offices in BKC in Mumbai. The IPO, of course, a fair bit of excitement around it. It's, of course, one of the largest asset managers in the country. And now we are sitting down with Mr. Debashish Mishra, MD and CEO at SBI Funds Management. Mr. Mishra, great to have you with us here. Yeah. Thank you very much for joining us. Mutual fund say has become a mantra, has done so well, done wonders for the industry, has done wonders for SBI as a leader as well, SBI MF as a leader as well.
Good evening. Thanks for joining us on India Business Hour. I'm Shireen Bhan. The top stories that we're tracking for you this evening. US and Iran halt attacks as mediators push to get diplomacy back on track. The International Energy Agency expects annual oil demand to decline for the first time in 6 years. Crude oil prices declined marginally but remain on course for a weekly gain. The Sensex and the Nifty snap a 4-week winning streak after broad-based gains on Friday. Inflows into equity mutual funds up 26% in June. Mid-caps and small caps get more funds compared to large caps. TCS shares rise after the company meets expectations in Q1. Brokerage is largely positive on the stock after the management is upbeat on Q2 and expects FY27 to be better than FY26. Shares of Dixon Technology rally in trade after the government's long-awaited green light to its joint venture with China's Weibo. Uno Minda has already secured approval for Chinese investments as more Indian companies collaborate with their Chinese counterparts following the Press Note 3 relaxation. OpenAI's new model is 54% more token efficient, says Sam Altman on the release of ChatGPT 5.6, defends the White House vetting of powerful AI models, calling it productive and in everyone's interest. That's a CNBC exclusive. South Korean semiconductor maker SK Hynix debuts on Wall Street. The company raises more than $26 billion in what is the largest share sale by a foreign company in the U.S. B2B manufacturing platform Zetwa gets SEBI's approval to go public. The regulator also approves IPO papers from Rent Mojo, Tonbo Imaging, Mari Retail and Gujarat Victory Forgings. The CEO of Truecaller, Rishi Jhunjhunwala, slams the telecom regulator's latest directive on spam calls, terms it a get-out-of-jail-free card for spammers. Says the caller ID company is complying with the order and not flagging calls from numbers starting with 140 or 1600 as spam. That's an exclusive. Prime Minister Modi wraps up the Australia tour with cricket diplomacy and a visit to the Melbourne Cricket Ground. Australia's Big Bash League season opener will be held in Chennai this year. China successfully lands a reusable rocket for the first time in a major breakthrough for its space program. State media says the rocket returned to Earth vertically and was recovered using a floating platform. A stunning strike from Mbappe takes France into the World Cup semi-finals at the expense of Morocco. Spain will face Belgium in another quarter-final clash later tonight. Also on the show, meet the Nuval family, the promoters of Solar Industries, which is India's largest explosives and defense manufacturer. They've now entered the list of top 10 wealthiest promoters of listed companies in India. A special report coming up. Well, let's go straight to the top story this evening. US and Iran have halted retaliatory attacks as mediators push to get diplomacy back on track. Let's bring up the latest developments for you. Now, the US media reports that technical talks with Tehran will continue. The reports cite US officials suggesting that Washington is committed to finding a solution. Now, Axios has reported that Qatari negotiators are traveling to Iran to meet Iranian officials in a bid to de-escalate the situation and resume talks. Iranian officials have not confirmed or denied the next round of negotiations. Meanwhile, in Iran, former Supreme Leader Ali Khamenei has been buried after a 7-day funeral procession. According to Iranian state media, nearly 41 to 43 million people participated in the week-long funeral event. Khamenei was killed by US-Israeli airstrikes in Tehran on the 28th of February. Let's talk about oil prices. They have eased, but they still remain on track to clock weekly gains. Shipping traffic at the Strait of Hormuz remains largely at a standstill. This, as the International Energy Agency has said that global oil demand is set to decline. This for the first time in 6 years. Take a look.
The war in the Middle East has led us to cut our expectations for demand growth this year by 2 million barrels a day. So now we're expecting a 1 million barrels a day contraction for the year as a whole. And this is the first loss since the midst of the COVID pandemic in 2020. The situation normalizes. We do expect those contractions to ease in the third quarter. And as you noted, a return to growth towards the end of the year. 2027, we see a recovery in oil demand, so growth of 2 million barrels a day. But the year on average growth for these 2 years is well below historical trends.
Well, that is the IEA. On to the day's market action. The Sensex and the Nifty witnessed broad-based gains ending near the day's high. The mid-cap index hit a record high, while the Nifty IT, Realty and PSU Bank index outperformed among sectoral indices as well. So all closing in the green, up by about 2% apiece. For the week, the Nifty and the Sensex have snapped the 4-week winning streak. Broader markets have outperformed, with the mid-cap index rising over 1%. Now, net inflows into equity mutual funds have risen over 26% on a monthly basis in June. Mid-caps and small caps have received more funds compared to large caps. SIP inflows during the month hit a 3-month high, while assets under management surpassed the 82 lakh crore mark. And that is the latest as far as the mutual fund data is concerned. But the big global story: South Korean chip maker SK Hynix is listed on the Nasdaq tonight after raising over $26 billion. The company has priced its ADR at $149, making it the largest overseas first-time share sale by a foreign company in the US. The demand for the offering was immense, drawing over 7 times the number of available shares. The company's stock in Seoul has soared over 270% in 2026 so far, taking its overall market cap to over $1 trillion. That's SK Hynix there, listing on the Nasdaq. And on to a CNBC exclusive. OpenAI CEO Sam Altman says that the firm's new model ChatGPT 5.6 is 54% more token efficient. Altman was speaking exclusively to CNBC. He defended the White House's wetting of powerful AI models, calling it productive and in everyone's interest. Rachna standing by with more. Rachna, how do these new models cut costs for the company?
Well, firstly, OpenAI has broadly released its GPT 5.6 family of models. That's Sol, Terra and Luna. And this is after weeks of restricted access under a US government review. CEO Sam Altman told CNBC the flagship Sol is 54% more token efficient on agentic coding than rival models. Now, tokens are the billing unit for AI, and for enterprises running agents at scale, token costs now decide whether deployments are viable. When asked how much of the gain came from a focus on bringing down costs, Altman said, entirely. The customers say it is not enough though. Palo Alto Network CEO Nikesh Arora told CNBC that 54% is good, but the industry needs another turn at it. He wants AI pricing down 90% within 2 years. This is also in line with what we saw Palantir's Alex Karp was saying a few days ago when he said there's something seriously wrong with tokenization. Now the squeeze is that costs are rising on the other side as well. Altman called compute and memory costs a headwind, saying OpenAI needs algorithmic gains to keep customer prices falling while infrastructure costs continue to climb. There's also a new gatekeeper in the room. GPT 5.6 is the first OpenAI model to clear a government pre-release review, and Altman confirmed that the next model faces the same process. Frontier AI in the US now seems to ship with Washington's sign-off. Meanwhile, Meta fired the loudest shot on price. Mark Zuckerberg broke a 3-year silence on X, posting on Elon Musk's platform himself to announce Muse Spark 1.1, priced at roughly a tenth of Anthropic's Fable 5. Now, Musk, whose Grok 4.5 launched a day earlier, replied with a quote tweet where he plugged the platform X as a great way for companies to announce and gain followers, as Musk's post had about 12 million views. Now, with OpenAI valued at $852 billion and Anthropic both filed for IPOs, whether token economics works at scale is now the trillion-dollar question that the street will be watching out for. But in the meantime, let's get you this exclusive conversation that Sam Altman had with CNBC at the Sun Valley.
I thought it was a very productive process. We had a very good time working with Secretary Lutnick, Secretary Besant, Director Karen Cross. This is our first time through it, so there are things we will learn about how to make it better for the next one, which will get going on soon, and I think it'll be a much smoother process. But the government's technical capability was impressive to me. People really are doing good work testing and red teaming these models, and they really care about getting these models out quickly, but with a high level of safety. And I think this is actually in everyone's interest. If you want broad access, which we do, and you have powerful models, you really want to be able to be confident in your safety claims, because otherwise the world is going to get uncomfortable very fast.
Well, that's Sam Altman on ChatGPT 5.6. Now, SEBI has approved the IPO plans of 5 companies, and these include Zetwork, Rent-A-Mojo, and defense electronic equipment maker Tonbo Imaging. B2B manufacturing platform Zetwork plans to raise between 4,000 and 5,000 crore rupees, while Rento Mojo's proposed IPO comprises a fresh issue of equity shares aggregating up to 150 crores and an offer for sale of 2.84 crore equity shares. Shares of TCS gaining in trade after the company met expectations with its Q1 earnings. Brokerage is largely positive on the stock. JP Morgan maintains an overweight call with a target price of 2,400 rupees, which is a 16% upside from the current levels. Morgan Stanley has an equal weight call with a target price of 2,200, which is a 6% upside from the current market price. Nomura has a buy call with a target price of nearly 2,600, and HSBC is the only brokerage to cut its target price for the IT company. TCS's CEO is upbeat on growth, and this fiscal he expects FY27 to be a better year. Rima is here with the highlights from the TCS management. Rima, take us through the commentary.
I think the first takeaway for me is that the near term is steady, but there is still no clarity on the long-term recovery for the Indian IT industry. The company met very subdued expectations in Q1. They said they're positive about Q2. FY27 should be better than FY26. But when we asked them that when do you think more work from AI, new work from AI will offset the loss of work on account of AI, the management couldn't give a timeline on that. Net-net, they did say that it will be positive, but again, there is still no clarity when very low single-digit revenue growth this year for the industry will get to mid-single digits or even higher. That's the first takeaway. The second one is the deflation. Everyone's worried about AI deflation. The management said it's about 10 to 15% on the project value. But what's also interesting is that the company, the CEO said we're actively encouraging our employees to pass on the productivity benefits to their clients. Now the AI revenue per se is about 8.5% of their overall revenues, $2.6 billion in terms of an overall size, growing at 13.6% on a quarter-on-quarter basis. But the AI deal size, according to the CEO, are going up, and these are not annuity revenues, which run for 3 years, 5 years. These are short-term projects, but it's important that the deal size is going up. And this is the part I think I found most interesting. We asked them that for what percentage of your clients, the customer base of TCS, are you doing AI work? And Kriti said that for our large clients, say $50 million plus in terms of revenues, we have 139 of them. For 130 of those, 130 out of 139, we're doing AI work. That's more than 90%. So then the next obvious question was that why isn't it showing up in your revenues? And he said that we have a very narrow definition of AI. We don't want to do AI washing. We don't want to call everything AI revenue. And finally, on margins. Now, Q4 margins were at 24%, but they got impacted on account of the wage hike. What the company said is that we've taken all the headwinds in Q1. From here on, given the productivity benefits, efficiency-led tailwinds, we should gradually improve our margins to at least the FY25 number.
Overall, still I would say Q2 is positive, but at the same time, things been quite volatile in terms of whether H1 is better than H2. Okay, that I don't want to say H2 will be weaker than H1. Okay. But we are quite positive on Q2.
Okay, and FY27, if you have to characterize it?
Last quarter also said it will be better than 26. I still stick by that. It will be better than 26.
While a group of e-commerce sellers have approached the Competition Commission against Flipkart for allegedly abusing its dominant market position, reports say sellers claim that Flipkart is indulging in deep discounting, preferential treatment to some sellers and anti-competitive arrangements. The complainants have claimed that this move is hurting small merchants. The competition watchdog is examining that complaint. WhatsApp has submitted its response to the government over its new username feature. Sources say the centre is examining the response and will make a decision on the course of action. The government has raised concerns over WhatsApp's username feature, saying it could enable identity theft, fraud and cybercrime. Shares of Dixon Technologies up in trade, this after the government's long-awaited green light to its joint venture with China's Vivo. It's not the only company, by the way. Uno Minda has already secured approval for Chinese investment as more Indian companies collaborate with Chinese companies following the relaxation of Press Note 3, allowing FDI from China to come in. Ashmit is standing by with more details. Ashmit, Dixon finally getting the go-ahead. Can we expect more approvals to be cleared by the government for FDI from China?
Well, there does appear to be a very distinct momentum behind increased partnerships, joint ventures, tie-ups between Indian as well as Chinese entities. And to begin with, there is also that policy momentum as well. Let's not forget that as recently as March of this year, we had a relaxation as far as the Press Note 3 mechanism is concerned. There was a fast-tracking mechanism that was introduced, fast-tracking in as soon as 60 days. So clearly that policy momentum now translating into action as well. The Dixon Vivo joint venture, it was pending approval for nearly 2 years now, getting the final nod from the government under Press Note 3. But it's not the only candidate. In the last 2 years, many such companies have managed to secure approvals from the government. Bear in mind, the Dixon HKC Corp, that's for display modules, that was granted the Press Note 3 approval. There's the Dixon Longcheer tie-up, the JV that was also granted the Press Note 3. This is important because Longcheer brings on board a great deal of design capabilities as well. So the focus clearly is on expanding on the manufacturing setup here in the country, and not just manufacturing but design capabilities as well. To that end, Uno Minda managing to get a Press Note 3 approval as well, looking to build EV powertrain components. Now this, of course, is the Press Note 3 regime. Even outside of that, even outside of the Press Note 3 regime, we are seeing increased momentum. Let's not forget JSW partnering with MG Motors, making that JV here, picking up as much as 35%. The latest is there are reports suggesting that even a higher stake could be considered by JSW. That's on one side. In terms of looking ahead, PG Electroplast, that is one company that is reportedly working with Shanghai Highly Group. They're looking to build ACs. They're looking to expand their manufacturing capacity. We understand that Olectra already has a technology tie-up with BYD. No equity stake involved, but technology tie-up with BYD extending to as far as 2030. Amber is working in close partnership with Chinese companies Oppo. That's on a sublease model. Again, no equity there. So clearly, momentum being gathered here in terms of Indian companies partnering with Chinese entities, bringing in both investment as well as technology.
All right, Ashmit, many thanks for joining us. And there's more from China. The space program there has achieved a significant breakthrough. The country successfully managed to land a reusable rocket for the first time. The rocket managed to place a satellite into orbit and return back to Earth. It was retrieved using a floating platform. These reusable rockets can significantly lower the cost of launching satellites in space exploration. Only Elon Musk, SpaceX and Blue Origin, owned by Jeff Bezos, have successfully managed to land rockets so far. The U.S. Federal Reserve has announced members of its new task force, which will review the central bank's monetary policy mechanism. Now, 3 Indian origin names across 3 verticals of the task force have been appointed for the review, and these include former RBI Governor Raghuram Rajan. Rajan will co-lead the balance sheet policy division. Harvard economics professor Raj Chetty will be part of the data task force, and Xbox CEO Asha Sharma will co-lead productivity and jobs. This comes after the new Fed chief Kevin Walsh announced plans to overhaul the Fed's communication last month. India has opposed the proposed 12.5% tariff under the U.S. Trade Representative Section 301 investigation into alleged forced labor. Industry sources say that India's legal framework already provides robust labor protection. They also say that India's act, policies and practices do not burden or restrict U.S. commerce, contrary to the assumptions underlying the investigation. The trade agreement between India and the UK set to come into effect from the 15th of July, unlocking wider market access, cutting tariffs and creating new opportunities for businesses and professionals. The deal is aimed to double bilateral trade to $120 billion by 2030. Abhimanyu brings us the details on what we can expect come the 15th of July.
Huge expectations of benefits from the India-UK Free Trade Agreement, which is expected to come into force from the 15th of July. Now, benefits are expected to flow not just to India's exporters, who are going to get access to a huge British market in which labor-intensive exporters of agricultural products are expected to benefit by virtue of availability of a large market. Indian consumers are also expected to benefit by virtue of availability of cheaper Scotch whisky and cheaper imported cars from the United Kingdom. Now, several cars like Aston Martin, Bentley, JLR, McLaren and Rolls-Royce, which are made in the United Kingdom, are going to get cheaper in India. The DGFT has already issued a notification which has indicated details of import duty cuts on 3.78 lakh units of conventional engine passenger cars, in which the duties are going to fall from 110% to 10% over a period of a few years. Also, cheaper Scotch whisky and gin from the United Kingdom will be available in India for Indian consumers, in which the current 150% import duty is going to drop to 75% immediately and will subsequently fall by the 10th year of the implementation of the FTA to 40%. Also, zero duty would be witnessed by India's overall exports on 95% of its tariff lines, which include areas like agriculture, fruits, vegetables, processed foods and cereals. Also, labor-intensive exports are slated to benefit, and no duty concessions have been given on optical fibers, bundles and cables, TV camera tubes, base stations and plastics. Apart from that, there has been a quota which has been set for imported cars, in which no duties have been lowered for EVs, hybrids and hydrogen vehicles priced below £40,000 to protect the mass domestic market for conventional cars. So overall, both Indian exporters as well as British exporters are looking for huge benefits from the implementation of the India-UK Free Trade Agreement.
Well, the India-UK Free Trade Agreement operationalized on the 15th of July. The Nuval family, promoters of solar industries, have entered the list of top 10 wealthiest promoters of listed companies in India. From a small explosives trading operation to India's largest explosives manufacturer, this listed company's promoter stake is now valued at over 1 lakh crore rupees. Nimesh Shah is here with more on solar industries' rise and the breakout moment for its promoters. Nimesh.
It's been a fascinating story, not only for the investors, but for the promoters as well. And as you rightly pointed out, the wealth of this particular promoter is over 1 lakh crore. But first, what this is company all about? Solar Industries. It's one of the largest, explosive and defense manufacturer, and it is based out of Nagpur. So that's the basic about the company. As I said, the promoter owns 73.1% stake in the company. Who are the promoters? Now, Manish Nuval is the MD and CEO. He's the son of Satyanarayan, and he was a founder of Solar Industries. So Manish owns 38.9%. Satyanarayan owns close to 3.5%. The trust owns close to 29% stake. And Seema Nuval, who is the wife of Manish Nuval, she owns a small 1.37% stake. So combined altogether, the promoter holding is 73.1% stake. Now, what is Solar Industries? Just the graphic will come up for you. They started as a small explosive trader in early 90s. And only in 1995, Solar Explosive was incorporated. And from there, they've built up one of the largest package explosive facility out of Nagpur. So that's the small journey of what the promoters have done. Now, this is interesting, where the pivot came. The pivot came when Manish Nuval actually joined the company in the 90s. He was actually one who was leading the defense and aerospace expansions since 2010. And the defense revenue for this company has grown from 5% to 20% under his leadership. And that's where you've seen a big pivot and a change in terms of market cap as well for this company. Look at the financials now for 2026. The company has reported a revenue of close to 10,000 crores, PAT of around 1,800 crores, ROE of close to 29%, and ROC of close to 37.5%. So the number shows for itself, and that's the reason why the company is getting this kind of market valuation as well. As I said, look at the wealth that the promoter has created. So basically, the overall market cap is close to 1.6 lakh crore, and of this, since the promoter owns little 73%, it's basically they own close to 1.2 lakh crore. Just to put into perspective where Solar Industries stand in terms of the list of wealth promoters or wealthy promoters. Now this is a whole list. Avenue Superma stands out. R.K. Daman is hands down the topmost guy at close to 2 lakh crores of personal wealth, because of its listed entity. The rest are largely conglomerates or bigger MNCs. Nestle India, Bajaj Finserv, Bajaj Auto, of course the two Bajaj Group, Adani Group, Asian Paints, JSW, Wipro. A large part of these names are basically conglomerates or from larger corporates. Solar Industries stands out at number 10. The interesting part is today Solar Industries promoters are even above DLF promoters in terms of wealth creation. So that's the kind of wealth the promoter has created. As I said, they're currently at number 10. The promoter's wealth is close to, again, it's a wealth on the paper, right? It's just a market cap, but still, a Solar Industries, from a company based out of Nagpur, from nowhere, is now currently the number 10th wealthiest person, having a personal wealth of over 1 lakh crore with a market cap of 1.6 lakh crore. It's basically not only the promoters, but even if you look at the shareholding pattern, the FIs have owned money, the DIs have owned money, and of course, promoters have created the biggest wealth. Now they're sitting on over 1 lakh crores of wealth as being a listed entity of Solar Industries.
All right, Nimish, many thanks for joining us. India's wealthiest promoters, number 10, the Nuval family of solar industries. Up next on India Business Hour, the CEO of Truecaller, Rishi Jhunjhunwala, slams the telecom regulator's latest directive on spam calls, terms it a get-out-of-jail-free card for spammers. Details coming up. Catch all of CNBC TV 18's news and updates on YouTube, Facebook, Instagram, X and Jio Hotstar. Subscribe to CNBC TV 18 Access for our exclusive stories. At least 10 people have died after torrential rains unleashed widespread destruction across several parts of India. Fresh floods were reported in Himachal Pradesh. Rising water levels submerged a 100-foot iron bridge. Officials said landslides hit several places in rural areas, but no loss of life has been reported so far. The Met Department has issued a red alert for parts of western UP, forecasting heavy to extremely heavy rainfall over the next 24 hours. This has intensified monsoon activity, has claimed at least 7 lives and caused disruptions across the state. Relentless monsoon rain also battering Delhi, inundating roads, uprooting trees and triggering widespread traffic snarls. However, the downpour also helped the national capital record its cleanest air since September of 2023. Heavy monsoon showers also lashed a large part of West Bengal, with northern parts of the state receiving the highest rainfall in 24 hours. Rains continued well past the morning, causing waterlogging and slowing down of traffic in several parts of Kolkata. Prime Minister Modi has wrapped up the Australia tour with cricket diplomacy and a visit to the Melbourne cricket ground. Australia's Prime Minister Anthony Albanese accompanied the Prime Minister to the stadium and spent some time at the stand named after Shane Warne. Australia's Big Bash League season opener will be held in Chennai this year. Prime Minister Modi has arrived in New Zealand now for the final leg of his 3-nation tour. Ousted Bangladeshi Prime Minister Sheikh Hasina plans to return to the country from exile in December. In an interview to Reuters, Hasina said she plans to return to the country alongside senior officials from her Awami League to challenge the ban on her party. Remember, she's been living in exile in India after fleeing Bangladesh in 2024. This after protests ended her 20-year tenure as Prime Minister across multiple terms. In November, the country's War Crimes Court sentenced her to death in absentia for ordering a deadly crackdown on a student-led uprising. On to a CNBC TV 18 exclusive. The CEO of Truecaller, Rishi Jhunjhunwala, has slammed the telecom regulator's latest directive on spam calls. Speaking to CNBC TV 18, Jhunjhunwala terms the TRAI's move as a get-out-of-jail-free card for spammers. Take a look.
We were told by the TRAI that 140 and 1600 are designated numbers